Trump also warned that Iran's energy infrastructure on the island could be targeted if Tehran interferes with the Strait of Hormuz. Meanwhile, gold holds steady around $5,000 an ounce as oil continues to rally. Stocks on Wall Street closed Friday's trading session lower as investors digest situation in West Asia and surging crude oil prices. Nasdaq slips more than 200 points. Markets in Asia open mixed as investors keep an eye on oil prices. GIFT Nifty is indicating a positive start for the Indian market. The government amends LPG supply rules to bar households with piped natural gas connections from holding domestic LPG cylinders, requiring existing consumers to surrender connections to curb dual usage. Commerce Minister Piyush Goyal, speaking at CNBC TV 18 India Business Leader Award, says that the government is covering LPG and LNG requirement through diversified sources of import, and there is no need to panic. The Election Commission announces assembly elections scheduled for 5 states. Polling in Assam, Kerala, Pondicherry will take place on April 9th, while Tamil Nadu will vote on April 23rd, and West Bengal, its second phase of polling on 23rd and 29th. Continuing of the votes for all 5 assemblies will take place. Counting of the votes will take place on 4th of May. Hello, good morning. You've tuned into CNBC TV 18. You're watching Power Breakfast with me, Vinny Motiwala. While in terms of a lot of updates that have come in on the US, Iran-Israel front, the war that has been going on, the attack that came in on the cargo islands by the US, which is very important to Iran as well in terms of oil supplies. But first up, let's look at how that has impacted the Asian markets this morning. When you look at the Asian markets, most of them are moving up in the red. Mild cuts coming in there. Hang Seng, a very mild cut, 0.06%. Taiwan index is down almost 0.2%. ASX 200 down 0.4%. Nikkei, that's seeing sharper cuts of 0.6%. So we'll keep an eye out on where the Asian markets are headed, but a very muted start what has come in for the Asian markets. When you look at it in terms of the crude oil prices, that continues to trade around that $100 per barrel mark, right? So that is important as well. And in terms of the Nifty implied open, last week, obviously, we did see that sharper decline and sharp cuts coming in during the week. But today, we're seeing a bit of a positive start. So that is something that we'll keep an eye out on. We're watching out for a 187-point uptick right now for the Indian market. So key to keep an eye out on that. But like I was saying, the war in West Asia that's entered its third week now. US and Israel forces are continuing to strike Iran, hitting cities including Tehran as Iranian counterattacks continue, and with the damage reported in several Israeli cities as well. Iran's Foreign Minister Abbas Araghchi has dismissed US President Donald Trump's claim that Tehran wants truce talks and said that the war was a war of choice by the US president. He also added that the Strait of Hormuz is not effectively shut and that they have only closed it to US, Israel and their allies. The Iranian military decides whether ships passing through the Strait of Hormuz get security. On the other hand, US President Donald Trump has threatened more strikes on Iran's oil infrastructure. Take a look at this report.
U.S. President Donald Trump threatened more strikes on Iran's main oil export hub, Karg Island, over the weekend and said he was not ready to reach a deal to end the war, which has shut off the vital Strait of Hormuz and shaken up global energy markets. The U.S. on Sunday released this video showing what they say were strikes on Iran. Trump has said Iran wants to negotiate, but Iranian Foreign Minister Abbas Araghchi on Sunday disputed that claim. Araghchi told CBS's Face the Nation that Iran was, quote, ready to defend ourselves for as long as it takes. In Tehran on Sunday, Reuters spoke with residents who had returned to their damaged homes after they were hit by U.S.-Israeli strikes on March 13th.
Well, no one was injured, and that alone is a comfort for us. God willing, the day will come when the force of justice overcomes evil. That alone encourages us.
Iran's Revolutionary Guards said it had fired more missiles and drone barrages at targets in Israel and U.S. military bases in the region, where Saudi Arabia said it had intercepted 10 attacks. An Israeli army spokesperson told the briefing that Israel will continue to act in both Iran and Lebanon until the objectives of its operations are achieved. In Lebanon, more than 800,000 people have fled their homes since Israel began an offensive in the country after the Lebanese Hezbollah group opened fire at Israel in support of its ally Iran on March 2nd. Some displaced Lebanese with no room left at shelters fastened a tarp over the back of a truck to get out of the rain. What should I ask for? I just want a shelter for me and the children, he says. U.S. officials responding to economic uncertainty over high oil prices predicted on Sunday that the U.S.-Israeli war on Iran would end within weeks and that a drop in energy costs would follow. 3 sources told Reuters that Washington has brushed aside attempts by Middle Eastern allies to open talks.
And here is U.S. Energy Secretary Chris Wright on the impact of U.S. war with Iran on energy supplies and prices.
Come to the end in the next few weeks, and we'll see a rebound in supplies and a pushing down of prices after that. But yes, we were very aware that we would have short-term disruption. We would cause a little bit of increased prices on Americans. Prices today are still far below what they were in the Biden administration, where they were begging, bartering, and bribing Iran to behave better. We had $5 gasoline in the middle of the Biden administration. We hope we don't get there this time, but at least this increase in gasoline prices is for something that's going to change the geopolitical situation in the world forever.
Moving on, U.S. trade representatives also told CNBC that Iran war will come to an end in just a matter of weeks.
Well, I think that we're talking in terms of weeks, right? When I speak with Secretary Hegseth or with the president or others, they're much closer to it. But obviously, you can't talk about trade without the Iran war coming up and the effect of oil and gas and what that means. I think we're talking about a matter of weeks. Our expectation is that any effects we see will be short-lived. But we want to watch this, right? You could see other effects that affect cycles that we tend to see in commodity markets. So we're watching it very closely, especially in if there are particular spikes or if there are areas where we think we have more resilience.
Okay, on that note, we're going to step into a very short break. We'll get you to trade setup for the day on the other side. Welcome back to Power Breakfast on CNBC TV 18. Now getting you more on the Trump-related developments. Aboard of Air Force One, President Trump declared Iran's military has significantly weakened now that the war has ended. He said that he sees this as a development opening doors for other nations to step in. He demanded that other countries contribute to the defense of Strait of Hormuz as it remains effectively closed to oil tankers. He added that China is very reliant on oil transiting through the Strait of Hormuz and that they should come in and help secure this corridor. Moving on, the president's suggestion that countries should send their warships alongside U.S. naval forces to keep the Strait of Hormuz open and safe has brought no immediate commitments. Now, Makani, who says Canada supports the necessity to prevent Iran's nuclear program and exporting of terrorism. However, the country is not participating in offensive operations of US and Israel and will not ever participate in that. Now, China and South Korea have not announced any plans to send warships as yet. France previously said that it was working on possible international missions to escort ships through the Strait of Hormuz as well, but stressed that it must be when the circumstances permit, when fighting has subsided. And Germany has also categorically denied that it will not be an active part of this as well. Meanwhile, UK and Japan are among the countries that are considering options but yet to commit warships to the blockade shipping route. That's the update coming in from other countries as well. Now, what apart from that commentary came in from US President is also that he said that Iran wants to negotiate urgently, though he believes that they are not quite ready yet, but they will be very soon. In any deal that takes place, he insists that the starting point remains zero nuclear weapons for Iran and that plenty more gains to follow for the US as well. Moving on, President Trump has also said that he could delay his planned summit with the Chinese President Xi Jinping in Beijing if there's no unblocking of the Strait of Hormuz. Then President Trump has also warned actually in an interview that NATO would face a very bad future if member states fail to help in the Strait of Hormuz and removing the blockade over there. Lastly, in terms of comments that came in on Cuba as well, President Donald Trump said that Cuba wants to make a deal with the US, but he wants to finish the war in Iran before turning to the island nation. So that's the update that we have coming in from the US President Donald Trump and commentary from other countries as well. But how are all these cues going to be impacting our Indian markets? We have a team of research here to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. But first up, Hormuz, market cues that we're keeping an eye out on. It's a very important week even in terms of other events, but today's, what are we keeping an eye out on?
Morning, Vinny. Three very determining factors for our markets so far have been the oil prices. As of this morning, the oil prices are quiet. There is no significant action, although there is no significant decline either. The other one has been the dollar. The dollar crossed 100 on Friday. It still remains above 100, although here too there is no significant price action this morning. And the third one are the Dow futures. As of now, they are trading with gains of close to 200 points, and that is percolated onto the GIFT Nifty. The GIFT Nifty is currently trading 120 points, 130 points higher. At one point they were up 170, 180 as well. There's still around about 100-point gain is what the implied open is suggesting. But the texture of the market has significantly been sell on rallies, as was the case all through last week. Every single intraday recovery is getting sold into. There's a second instance in the month of March where we have seen a 1,000-point fall in the last 3 sessions. Now, the most important level to watch on the downside, now that the Nifty and the Nifty Bank have both corrected 13% each from their record highs, now comes the 78.6% retracement level on the index from the April 2025 lows to the January 2026 record highs. That level is 23,096. That's the important level to watch on the downside. We're just 60 points away from those. And the other one, of course, 23,400, 23,500 on the upside. Of course, there's some distance away, but that's the more important level to watch, because analysts also say that unless and until these levels are crossed decisively on the upside, the texture continues to remain a sell on rallies one. The other one has been the Nifty Bank. That has been the bigger underperformer, although in percentage terms both have declined a similar quantum, but the Nifty Bank has broken below all key important levels. 54,000 is the first one to watch. The selling in the heavyweight banks, though, that needs to stop for any sort of recovery that needs to come around. Now, of course, it's a very important week. We'll keep an eye out on geopolitical developments, oil prices, the dollar. It's a very important week for central banks as well. Central banks across the globe, from Fed to China to Japan, all of them have their policy decisions this week. Keep an eye out on that. For now, the GIFT Nifty is indicating a gap up start as of yet. But the question is, will that sustain, or will this intraday recovery get sold into as well?
Okay, Urmas, thank you so much for that. But let's go to Ria, who's here to tell us what are the important stocks to watch out for in the trading session. Good morning, Ria.
Well, good morning. Starting off with JSW Steel first, they have won the rights for a coking coal project in Mozambique, which has 850 million tons of reserves and the potential to yield roughly 250 million tons of usable coking coal. Indigo will also be in focus today. They have introduced a fuel surcharge of roughly 425 rupees in India and up to 2,300 rupees overseas as well, with effect from the 14th of March 2026. And this move has been driven by the 85% plus surge in fuel costs due to geopolitical tensions in the Middle East. Aster DM Healthcare will also be in focus today. The nurse strike in Kerala between the 8th to 13th of March has led to a revenue loss of almost 18 crores for the company, with a further potential loss of up to 5.3 crores possible as per the company. Zydus Life, they have received a regulatory nod in China for the novel drug Desidustat license to the China medical system. GMR Airports will also be in focus today. They have won a bid to operate and upgrade the cargo terminal 1 at Delhi Airport for a period of 10 years, with the estimated revenue potential of 340 crores for the first full year of operations. And apart from this, they've also come out with their business update for the month of February. They've handled roughly 10.3 million passengers in the month of February, which is flat compared on a year-on-year basis. Keep an eye on Viatec Vabak as well. The JV company has backed an order which is worth over 1,000 crores to build Chennai's looped water grid project, and the execution period for this will be 54 months.
Okay, thank you so much for that, Ria. But finally, let's get the update on what we should be keeping an eye out in the world of F&O today as well. Good morning, Sudarshan.
Good morning, Vinny. So the key question today would be, will we see any recovery or will continue to see the selling? Well, the GIFT Nifty is indicating that market will open with a gap up and will open around 23,100 or 200. Now, but the data is indicating that selling might continue. It might be another day where we might fail to hold any recovery. Now talking about the futures, just take a look at index futures. FIs continue to be on the sell side. In the stock futures too, they have been on the sellers. In the index futures, they have sold more than 5,200 crore. In the stock futures, they have sold almost 1,000 crore. Now about the exposure. They have done the minor addition towards the long side, where the addition was around 1,800 contracts, but the exposure has reduced to 10%. Look at the short side. The addition is more than 36,000 contracts just in a single day. And whatever they had added on Wednesday and Thursday on the short side, on Friday, they have done on a single day. Now, on the options front, call writing continues above 23,000. So the most active option on the call side were 23,500 and 23,600. And while on the put side, maximum open interest addition was seen for 22,800. So support for Nifty would be around 22,800, while resistance is around 24,300. Talk about the stocks. Two stocks remain in the band. Those are SAIL and Samant Capital. I'll keep an eye on Syngene. That has seen fresh short covering on Friday. So we'll see if it continues. And another stock that will be in focus is Reliance Industries. Despite the weak trading sessions, Reliance has held the ground. And today there is a positive news development as well. So keep an eye on Reliance.
Okay, thank you so much for that, Sudarshan, for giving us an update on what we should be keeping an eye on in the world of F&O. But on that note, we're going to sip into a very short break. After the break, we'll come back with cues in the world of commodities. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now let's move on and get to the latest update from the world of tech in our new offering, the AI Pulse. And we have Rachna joining in with us as always to take us through all of that. Good morning, Rachna.
Good morning. We begin with the reports that Meta may be preparing significant job cuts. According to Reuters, the company is considering layoffs that could affect around 20% of its workforce as it restructures around AI and the rising cost of building AI infrastructure. Now, Meta had nearly 79,000 employees at the end of 2025, which means cuts at that scale could affect roughly 15 to 16,000 roles. The company has not confirmed the plans, but says that the report is speculative. The discussions come as large tech companies invest heavily in AI systems while increasingly relying on automation to operate with leaner teams. Next, attention shifts to California, where NVIDIA has kicked off its flagship developer conference, the NVIDIA GTC in San Jose. CEO Jensen Huang is set to deliver the keynote, where the company is expected to showcase its next-gen AI architecture known as Vera Rubin. The platform is expected to deliver up to 5 times the performance of NVIDIA's current Blackwell systems and will begin shipping in the second half of 2026. Now, major cloud providers including AWS, Google, Cloud, Microsoft and Oracle are expected to deploy Rubin infrastructure alongside specialized AI cloud companies such as CoreWeave and Nscale. Meanwhile, Elon Musk says AI startup XAI is being rebuilt after a wave of departures among the company's founding engineers. Only 2 of the original technical co-founders remain, after several researchers left in recent months, citing burnout and internal tensions. At the same time, the company is bringing in new talent. Indian origin entrepreneur Aman Gotumukhal, who previously built the AI coding startup Firebender with a 3-person team, is now joining XAI to work on advanced coding AI systems. Musk says the company is restructuring as it works to compete with AI coding tools developed by rivals like OpenAI and Anthropic. Coming back to China, ByteDance has paused the global rollout of its new AI video generator, Seedance 2.0, following legal complaints from major Hollywood studios, including Walt Disney Company, Netflix, and Sony. These companies argue that the technology could generate videos using their intellectual property. Now, in recent weeks, the role of artificial intelligence in modern warfare has become increasingly clear. Now, the US Army has awarded a contract worth up to $20 billion to defense technology startup Anduril Industries. The agreement will deploy the company's Lattice AI platform, which integrates data from drones, radar and satellites into a unified battlefield command system. As per reports, Anduril is also in talks to raise new funding that could value the company around $60 billion. That's all for now that we have from the world of artificial intelligence, but the day is pretty young, so we will keep an eye out.
Thank you so much for that, Rachna. But let's move on. And Manisha Gupta is joining us to tell us what to keep an eye out in the world of commodities. Given the West Asia tensions, there's not much of an easing. So what's important there, Manisha? Good morning.
Morning, Vinny. Thank you for that. Well, yes, I'll start with the crude oil prices itself. And we started the Asia markets with $106 a barrel. We seem to be meandering around those levels right now as Middle East war enters its 3rd week. The U.S. strikes on military assets on Karg Island, and then Iran saying that any attack on its oil infrastructure will trigger a retaliatory strike on U.S.-linked energy facilities. So this is clearly far from over, and that continues to support prices there. A couple of positives in crude clearly are that, one, the U.S. could announce a coalition of countries to escort the ships through Strait of Hormuz. And the second is that the oil loading operations in Fujairah have resumed. So those are a couple of things that seem to be keeping slightly prices in check. But it is the crude price rise and inflation and the fact that perhaps the U.S. Fed will not cut interest rates anytime soon seems to be weighing on metals. So when you have gold, which is trading below $5,000 an ounce, silver is fallen below $80. Last 2 weeks have been weeks of decline as well. The strength in dollar index also seems to be weighing on copper, aluminum, zinc. All of that is trading in the negative in Asia right now.
Okay, thank you so much for that, Manisha. But, that is the update in the world of commodities. Important to keep an eye out on where we'll see crude, gold, silver prices headed as well. But with that, we're absolutely out of time on this edition of Power Breakfast. Thank you so much for tuning in. Up next, a Plaza Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and a green-looking Nigel back from the hills. I think the color of the hills. Morning, Nigel. Back.
Well, morning, guys. Good to be back. And yeah, I think that's what the designers thought this morning. That since they've seen me with so much of green, put some green. Because I asked them over the weekend. I said, "What am I wearing?" They said, "Green." I said, "Why?" They said, "Because probably there's no much green on the screen." But let's hope better times for the markets. It's been a rough past week. I was just updating myself, and hope things turn around.
Yeah, it was the worst, weekly fall that we've seen in the last 3.5, 4 years. The auto index was down nearly 10%. So Prashant, it was a bruising fall, and now the conflict has entered the third week, and at least as of now, there seems to be no respite that you can see.
No, absolutely, and I think we've been in those kind of markets which requires a little bit of standing up, right? Because and this is the third week, and when we started this, it looked like a couple of weeks, maybe 3 weeks, 4 weeks, 5 weeks, who knows? But now we're actually now entering the third week here. Let me just quickly run you through the sort of top highlights as we've been doing, because this is not this is of course about oil prices, etc. And oil, by the way, is at about $103 odd a barrel as we stand right now. But there is the element of the news flow, right? So US struck near Iran's key export hub at Kharg Island. And Kharg Island is the single most important point through which Iran sends its oil out. 90% of the oil which Iran sends out, and by the way, Iran sends out, exports about 1.5 million barrels of oil a day. 90% of that goes out through Kharg Island. I mean, it's basically a boat ride away from the shoreline of Iran, and 90%. Now, the thing is, President Trump in his Truth Social post essentially said that he's not struck military infrastructure. And this has basically been, he's kind of struck. He's struck military infrastructure, but not oil infrastructure. Now, Iran's response is still awaited. We don't know. The general assumption was that they will stay away from Kharg Island and will not hit it, but it looks like they have. So will Iran respond in a bigger way, wider way? And I think that perhaps has heightened fears of disruption to Gulf crude supplies in that sense. Let's move this along quickly, right? So Trump, of course, is also in his own style threatening to extend attacks to energy infrastructure if Iran interferes with the transit through the Strait of Hormuz. Trump said that Iran is ready to make a deal to end the war, but Trump basically saying that he wants better terms. So you got both sides, right, claiming Iran essentially saying that US wants to negotiate, but why should we negotiate? Trump is saying, well, Iran wants to negotiate, but, well, we want better terms as of now. The foreign minister of Iran essentially was on record saying that Iran has not asked for talks or a ceasefire. As I said, Wall Street Journal is reporting this morning that Trump administration will announce that multiple countries have agreed to form a coalition that will escort ships through the Strait of Hormuz. And I think this is important, right? The biggest reason why markets are panicked and markets are, in that sense, worried because oil's not getting through the strait. It's down to zero. And if ships can escort tankers through that strait, I think a lot of the problem will get started. But of course, it's not as easy as it sounds like. And Wall Street Journal is saying that sometime today, the Trump administration will announce that many countries have come together to do this. Now, some more comments here. It's basically who said what over the last 24 hours, 48 hours. Kevin Hassett, the National Economic Council, saying Pentagon estimates that the Iran mission could take 4 to 6 weeks to complete, but he didn't say whether 4 to 6 weeks is from the 26th of February or from today, or this is the new deadline from here out, and that's important. Energy Secretary Chris Wright saying this conflict will certainly come to an end in the next few weeks. I mean, these are all comments and little comfort to be derived from any of them, but these are still from senior officials out there. Now, I'll just quickly run you through the other sort of impact, right? There are so many implications of what's going on and the oil shock that we are seeing. Look at the 2-year yield, bond yield across developed markets. And I just looked at the US, Canada, Europe, and countries like New Zealand, Australia, etc. Just look at that. This is since the war in Iran began, 26th of February is the date that I've chosen. You know, anything between 30 and 55, 60 basis points higher on the 2-year. The reason I'm putting this out is because, you know, any hope that central banks around the world will step in, ease rates, I mean, that's disappeared, at least in the near term, because the implication is that on the front end of the curve, the market is telling you inflation is set to move higher. For how long is the question, but for now, I mean, maybe the moves are excessive and sometimes it does happen. But the point is these are very large moves in just about, 10 trading sessions flat. Now I'll come to the market here. The Nifty fell 5% last week. The Nifty Bank fell 7%. These are large falls. Markets, of course, are oversold. The weekly RSI for the Nifty is about, I think, 20 or 19 or 20. It can get more oversold. It can remain oversold for a while. Nifty's fallen 9% since the war began, which means that the Nifty lost about 2,350 points from the 26th of Feb, and we're down about 12% from the all-time high of about 26,373. Just look at that, right? 12% from the all-time high, 9% since the Iran war began. So bulk of the damage since the war started. We are already near 23,000 on the Nifty, and it's an important level. It's a level I said at the beginning of last week, perhaps we get to around 23,000 if there is no positive pushback. And we're already there, about 150 points away. So is this the point where perhaps your initial target kind of is met and you get a bit of a trading move higher? Let's see. Nifty Bank, similar numbers, 12% since the Iran war began. From the all-time high, it's down 13%. And here, the swing low is about 53,500. The question is, will we get a bit of a pause, a bit of a trading bounce from here? I think we'll just need to see. Now, you know, this is just something we put out, I think, Tuesday or Wednesday last week. Now, historically, right, geopolitically induced oil shocks have always been a great buying opportunity. But there are two caveats here. There are two tail risks in that sense. And the two tail risks remain. One is an actual oil shock-led recession. We've got those in the past, 1973, 1980, 82. Who knows, right? I mean, we can all look at recent events and say, well, unlikely to happen, and it's in no one's interest to keep the war going. And the second is, if inflation goes up, as I showed you the 2-year yields, central banks actually don't loosen, they come in and tighten because they have to fight inflation, which is not great news for equity holders. So, geopolitical events and oil shocks have turned out to be, over the last many years, to be good buying opportunities, but you've got to be mindful that things can go the other way as well. So, got to be nimble, and of course, it's a lot of headline watching out there. But how's the F&O positioning looking like? And that's the big question. Nigel has got all of that. Nigel, over to you.
Well, we thought, the tide was turning in February when the FIs turned buyers. But the geopolitical issue has weighed on global equities and resulted in the FIs selling lock, stock and barrel in the Indian markets. And adding Friday's net sell number of close to around 10,000 crores, FIs had net sold close to around 63,000 crores, which puts them in the reckoning to challenge the recent record sell numbers that we saw in January 2025. And if you want to backdate a little bit more, then October 2024 is when we saw those record sell numbers. Hopefully, you don't get there, but we still have a few sessions in March. So that's a bit of a worry. The FI positioning in the F&O market as well is fairly cautious. They added a massive 36,000 short contracts. That takes the short positioning to around 90%. In absolute terms, it's around 2.6 lakh contracts. Additionally, they have been writing calls aggressively. 2 calls written for 1 put. Now, this has caused the PCR to approach the lower end of the range. Currently, it's at around 0.75. Remember, it's bottomed out at around 0.62, 0.63 or thereabouts. So, in the near term, it appears the bulls will at least look to defend the 21,700 mark, 22,000 odd mark. That, remember, is the Liberation Day low in April 2025, from where the markets bounce back. But, on the upside, it's turned into a sell on bounce kind of market. And the previous day high will be a key resistance level, which comes up for you on the screen at around the 23,500 odd mark. Now, consensus seems to be convinced that 10% correction in the markets, the Indian markets as well, is in the offing. The fear is that crude oil prices obviously spikes up to around $150 per barrel mark. But if that does not happen, then that Liberation Day low, that's going to be a very, very strong support at around that 21,700 odd mark. Additionally, the India VIX, well, that was up, even in Friday's trading session. But it didn't spike as much, if you're looking at that. In the past 2-3 trading sessions, we haven't seen that much of a big spike for the kind of corrections that you're seeing on the Nifty. Remember, on Monday, we saw a flare up in the India VIX, but after that, we have seen not such high moves out there. So the hope is that the fear index is gradually factoring in the worst case scenario for the Indian markets. Finally, the first half of March is seasonally weak, but this time around the pain was amplified, because the war took place, and that's why you saw exaggerated pain in the first half of March 2026 itself. Mild positive, though, is that the advanced tax payment, the tax harvesting, for those that, however, made some profits, that's behind us. Now, history suggests dipping into a bearish market, an uncertain market, and keeping SIP flows, well, it's been rewarding for long-term investors. Hopefully, it plays out this time around. But the structure on the markets is a little bit weakish. We could see a bit of a bounce, but otherwise the structure is punctured. All eyes are on that Brent crude price. Will it flare up from here on? And the Liberation Day low of around 21,700, that's going to be a very, very strong support, at least in the near term.
Thank you very much for that. A quick check on Asia this morning. It's a mixed picture. The Japanese market, Nikkei, is down 1%. Kospi is flat. But the Taiwanese market is holding up in the green. Last week, remember, U.S. markets, the S&P was down nearly 1.5%, making it the third losing week in a row. Shanghai is also opened up mildly lower, at least it opened, but the economic data coming out of China has been fairly strong. So retail sales for the first 2 months of this year have gone up by 2.8%, beating economists' forecast of a 2.5% growth. Industrial output grew by 6.3%, again exceeding expectations of a 5% jump, though the investments in real estate continue to remain dampened. Matt Orton, Chief Market Strategist at Raymond James, is now joining in. Matt, thank you very much for joining in. Third week now. Do you get a sense that we're closer to the end, or do you think it's time to start pricing in a longer conflict? And what does that mean if you have to price in the fact that crude oil remains stubbornly high at $100 per barrel, and this goes on and on?
Hey, good morning, Rima. It's always great to join. And it's really hard to take a stance one way or the other with respect to what is going to unfold in the future. I think we've seen through this conflict playing out over the past 2 weeks that there's a lot of uncertainties around what the objectives are, what the end goal might be, what capitulation could potentially look like on either side. And so the main message I've been implementing in my own portfolios and that I give to all of our clients is this idea that diversification has to be tactical. Right now is the time to be in P&L preservation mode rather than trying to wade into the markets perhaps too early unless there are very, very compelling opportunities to do so. So over the past really a couple of weeks, even before this war started, I've been generally de-risking portfolios just because of other factors that I didn't like how they were playing out in the market. But I've aggressively de-risked over the past few weeks, and I'm perfectly fine sitting on elevated levels of cash, getting a shopping list ready for high quality assets with good balance sheets, revenues that are generally insulated from whatever is happening with respect to the war. And eventually we'll take the elevator back up. But there could be a couple more slashes, a couple more steps downward before we actually get to that capitulation moment with respect to the war. But the main concern is the longer that this plays out, the longer that the strait is closed, it increases the probability of elevated oil prices. And this is not something that a ceasefire can immediately turn back on because we're turning off production in the Middle East, and that takes a while to get back online. So there will be disruptions even after this war temporarily or permanently wraps up.
So aggressively de-risking, and now you're topping up on the cash holdings. What does it stand at right now?
Yeah, so my portfolio currently sits at about 15% cash right now. It's a little bit more tactical in nature, and we've been able to keep up on up days just by having some beta, at least in U.S. technology, semiconductors, memory names in particular, where revenues, margins are insulated from some of these concerns, as well as a little bit of exposure to energy that we've had from earlier this year. But a lot of early cycle cyclical names in the industrial sector, the material sector, a lot of emerging market exposure. A lot of that has been ratcheted down. I will be a buyer. I still like the longer term theme for emerging markets, especially ones that are more insulated from the oil challenges or that have exposure to commodities. I think they'll be beneficiaries longer term, so there will definitely be entry points. I just don't think we're there yet, and I'm willing to be a little bit late to make sure I'm comfortable as I put more chips back on the table.
Matt, hi, morning. Just your perspective on where we are here, because, markets have 11, 12, 13% kind of cuts from the highs on indices, Indian indices in that sense. But, I don't know if you look at technicals and charts, many stocks, and actually even the Nifty as of last Friday has broken the uptrend which was intact from the lows of COVID. That is, I think, May of 2020. So I mean, that's getting a fair bit of attention. I don't know how you look at it. And many stocks are at the lower end of that range, that channel, that upward channel from the lows of COVID. Do those become interesting ideas? I mean, or you start to get worried whether, this is now sort of ending something?
Prashant, it's a great point, because when you start to break long-term trends, things do become a little bit more concerning. So I'm definitely on that side of the coin right now. Again, we can have a great bounce off of that and restart another up channel. But again, it's going to take a lot of momentum. It's going to take a big breath thrust in order for that to happen across, a number of different sectors and industries within the market. So right now, I treat a lot of these names that are breaking down both in India and across the rest of the world as guilty until proven innocent. And we just have to wait to have both the technical washout happening, as well as ensuring that the fundamental perspective perhaps is not related to the technical breakdown. That's going to be where the best opportunities come, is where when you do your fundamental analysis, that the revenue streams are not impacted, that the margins may have a minimal impact from what's happening with respect to higher energy prices. And I think those are the names where you want to be looking for opportunities across a global perspective. And so that's where selectivity becomes really, really important to success moving forward. And the market is rewarding that. Dispersion remains at very, very elevated levels. And there's a lot of names across global markets that are in fact working. So there are things that are working, but right now I think you want to be a little bit more cautious and make sure that you're not catching a falling knife.
All right. Hi, Matt. Morning, and good to see you, Ben. You've never shied away from, naming a few stocks. So, if hopefully things don't escalate from here on, what would be the couple of names that you've looked at in the past? I think you've liked a couple of banking names, private sector banks, which have now pulled back a goodish bit. IndiGlobe Aviation, obviously, it's got a lot of headwinds currently. And Mahindra & Mahindra is another stock. So among these names, anything you'd be looking to dip into?
Hey, Nigel, I think M&M is a clear name to be looking to add exposure to once we get a little bit more clarity. It's obviously been treated with the rest of the auto complex with concerns around higher energy prices. Will people be as motivated to buy? But I think they're fairly well insulated from that, given their more premium strategy. And we also forget their exposure to the agriculture sector as well, where I think there's been a lot of favorable tailwinds from the budget. I think just from their margin overall with respect to that exposure. So M&M is a name that I think looks mispriced related to fundamentals. And I would also say a lot of the private banks look the same way. They've had a really, really rough past 6 months. And I do think that a lot of this behavior has just been technicals, now capitulation with respect to fear. It's been a one-way street with respect to flows. And I think the businesses themselves still look very solid. They're great ROE compounders. And so these are high-quality assets that are trading near Liberation Day lows. Those are names I want to start adding exposure to once I have confidence that the market's going to start to work again.
Okay, all right, Matt, thank you very much for joining us. Good speaking with you, and appreciate it. We'll take a break. We're going to just run you through the interactions which are lined up here on the program. So 8:35, Elara Capital's Jay Kale puts a spotlight on the auto sector. 9 o'clock, we'll be joined by Vikash Singh of ICICI Securities to discuss the recent downtrend in metals. 9:20, Hiren Ved of Alchemy Capital Management is the market master of the day. 9:40, we'll be speaking with the manager of Hatsun Agro on the F527 outlook and the road ahead. Towards the end of the program, Lata speaks with Macquarie's Suresh Ganpati on the bank Nifty's recent underperformance. That's an interesting one coming up as well. Take a quick break here. Our list of top stocks to watch with our research team comes up next.
Welcome back. You're tuned in to Bazaar Money Call. You're on CNBC TV 18. Well, our research team is standing by with CNBC TV 18's top stocks that you need to track for today. Let's set things off with Vinny, who's joining us to tell us about some stocks that she's tracking. Hey, Vinny, good morning.
Hi, good morning, Nigel. So first up, we have JSW Steel. Now, the company has said that they will be developing coking coal mine in the rights for this mine in Mozambique. The project has around 850 million tons of reserves, and it has a potential yield of around 250 million tons of usable coking coal. So positive there for JSW Steel. Interglobe Aviation, that's another one we'll keep an eye out on. Now, given the crude prices have risen so much over the last couple of weeks, this accounts to around fuel cost accounts to around 40% of their overall cost as well. So now the airlines has taken a fuel surcharge starting 14th of March. The charges range from around 425 rupees for domestic flights to international flights. It can go up to around 2,300 rupees as well. Jet fuel prices, obviously, do not forget that 85% surge due to the geopolitical tensions is a major important setback that came in for the company. So at least some bit of a relief comes in on this front. So I'll expect green here. As the DM, we're expecting red here after there was a nurse strike that took place in Kerala that led to a revenue loss for the company of around 17 crores, and a possible additional loss that they would be booking would be around 5 to 6 crores as well. So there's some bit of an impact of that. So mild red here. Zyduside, that's the last one. The company is one of its drug which is mainly used for enema and patients suffering from chronic kidney diseases. It's used for the treatment of that. That has gotten an approval from China, and that opens up a new market for the company as well. It's positive news there. Green here.
All right. Thanks very much for that. Well, Gaurav is here with details on IDBI Bank. Gaurav, good morning.
Well, yes, good morning. First of all, if you look at IDBI Bank, we have seen the story that IDBI Bank is looking for a stake sale. I mean, government is looking for a stake sale, and together, Government of India and LIC, they were going to sell around 60% stake. But it seems that the plan has been cancelled, and the reason being that, as per sources, the bids that they have received are below the reserve prices, and transaction may not be proceeded. As per sources, there were two bidders, prominent bidders. First is Emirates NBD and Fairfax. If you look at the structure itself, Emirates NBD recently acquired RBL, and if you look at Fairfax as well, they have they own CSB Bank already, and it looks like the bids that they have made, or any player that have made, have been below the reserve price, and that is the reason why in this fiscal year the divestment was expected to happen, or at least get bids. It is not likely to happen. If you look at the stake that they currently have, they have around 94% stake together, Government of India and LIC, and they were going to offload around 60% stake for a value of more than 30,000 crores. And if you look at IDBI Bank as well, in the last 1 month, we have seen the bank stock has gone down almost by 17%, but it still trades at around 1.7 times price to book. So it will be really interesting to see how investors now treat IDBI Bank from here on.
Got it. All right. Thanks a lot for that, Gaurav. Let's hop across to Vivek. He's here to tell us about some more stocks that are on the news. Hey, Vivek, good morning.
Good morning. Quite a few stocks in focus on the back of news flow. First on the list is GMR Airports. The company has gone ahead and won the bid. Remember, this particular bid that we're discussing is the bid that was cancelled by the Delhi International Airport from Sinexi. And after an open tendering process, GMR Airports has won the bid to go ahead and upgrade Cargo Terminal 1 at Delhi Airport for 10 years. The company expects or estimates revenue contribution in the first year itself to be close to 340 crore. The company has also given an update as far as February operationals were concerned, and as expected, given the kind of geopolitical tensions we've seen, passenger growth has been muted, just 0.3% growth on a year-on-year basis. Wartech Wabag is the other company in focus. Last week, the company had announced an over 1,000 crore order win. And again, over the weekend, the company has said that the company, as part of a joint venture, has got an order from the Chennai Metropolitan Water Supply. This is to develop transmission network for Greater Chennai City. And again, this particular order is worth over 1,000 crore. Important to see what is Wabag's contribution or what Wabag will get from this particular order. Couple of other order wins. Barjal Projects, the demerged entity of Bajaj Electricals, that particular company has got a 700 crore order from Maharashtra State Electricity Transmission Commission, and this particular contract is for EPC works for power transmission line and substation works. And lastly, Data Patterns, again an order win over here. 32 Doppler weather radars is what the company is expected to provide, and this particular order is worth over 280 crores.
All right. Interesting list there, Vivek. Appreciate it. Well, what we're going to do is just quickly recap our... okay, I think we have Rima with us, and Rima has moved across to the newsroom. Rima, Reliance, I guess, is in focus.
It is, because the Finance Ministry, in a notification on 13th of March, has amended the IPO rules. And now for very large IPOs like potentially Reliance Jio, the minimum public float requirement has come down from 5 to 2.5%. So this is basically trying to accommodate larger IPOs like Reliance Jio. Remember, at the AGM, Mukesh Ambani had committed that the Reliance Jio IPO will take place in the first half of this year. So this just paves the way. It's one step forward. According to some reports, which we've not managed to verify, the draft papers for Jio IPO are likely to be filed by April of 2026. Back to you.
Got it. Thanks a lot for that, Rima. Well, here's a quick recap of all the top stocks that we're looking at. Stocks with positive news flow include Reliance Industries, JSW Steel, Interglobe Aviation, Zydus Life, GMR Airports, Patek Babag, Pagel Projects, as well as Data Patterns. While the other ones will be reacted to negative news flow. They include IDBI Bank and Aster DM as well. That's about all the equity market stocks you need to focus on. But the commodity space can't keep it out of the spotlight. Manisha joins us to tell us what's going on out there. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, I'll start with the crude oil prices, where we did start Asian markets at $106 a barrel. Seems to be holding around those levels as Middle East war enters its third week. And the latest from the weekend is the U.S. striking military assets on Kharg Island over the weekend. Well, this is an area where 90% of Iran oil exports happen. As of now, there is no impact on or attacks on Iran oil infrastructure. But Iran says any attack on its oil infra and it will trigger a retaliatory strike on US-linked energy facilities. So we are far from out of woods really onto this one. The only reason that we are not holding 106 and above is because US is expected to announce a coalition of countries to escort ships through Strait of Hormuz. That is what the street is watching for at this point in time. But the strength in US dollar index and the inflation coming in from the crude prices on the higher side has led to money coming out for metals. Gold, if you look at that, is trading now below $5,000 an ounce. 2 weeks of decline is what we've seen in gold and silver both. Not just that, the metals also seem to be coming off slightly. So whether it's copper off its highs, aluminum off its 4-year highs, some pressure is in the steel prices as well in the Asian markets right now. So energy on the positive, metals not so much.
Got it. All right. Thanks a lot for joining in, Manisha, and giving us all of those cues. We'll slip into a short break. On the other side, we have Rohit Srivastava of India Charts and Strike Money, who will be joining in to talk about the West Asia war, the crisis impact on Indian markets and more. Stay with us.
Welcome back. There is no need to panic as India has robust forex reserves. That's the word coming in from Piyush Goyal, Commerce Minister, on the LPG crisis from the sidelines of the CNBC TV 18's 21st edition of India Business Leader Awards. Of course, this took place over the weekend. Star-studded event. Just wanted to play out some sound bites of Minister Goyal.
We are looking at various sources of alternate sources which will feed the requirements of India. What we have only done is to increase the time between two cylinders that a person can take. And of course, there's been a short-term, it's more a supply-demand time issue. It's not an issue of finally the availability as much as the timing to be able to give enough shipping time for these gas sources to reach India. And therefore, I see no reason to panic. I wish people would understand that we are in a war situation. They should not hoard gas cylinders.
All right, Rohit Srivastav is now joining us. He's, of course, been with us over the last, 15 days or so as this has played out. He's founder of India Charts and Strike Money. And for those of you not familiar with Rohit's views, he's been negative for a while. Way before the Iran conflict started. And of course, I mean, what's happened with Iran is has accelerated how his view has played out. Rohit, good to have you back on the program. So we are near 23,000 on the Nifty. We are near a swing low on the Nifty Bank, which is the September 2025 level. The question is are we pricing in a lot, or you think there is a lot more to go?
So yeah, good morning, Prashant. And I think when I started out, I was essentially studying macro factors also along with the breakdown in Nifty, which takes us to the dollar, etc. But before I go there, I'll just mention the Nifty is trading below the 20-month average, and it's pretty much broken that, although the month is not closed. So that was at 24,700 odd. And the next major support, which is near the 40-month, and the lower bands, which are closer to around 22,500, 22,600. That is what we'll be looking at as the next major support. So that's around 400-500 points lower than here. On some key indicators like RSI, it may look like the market is oversold. We do see even the FIA positioning having reached an extreme. But we haven't studied FIA positioning, in a severe, bear market. The previous occasions was probably when we didn't have data, which is like 2008 and 2020 in COVID. When it reached an extreme, there was a ban on further shorts, and then we recovered from there. So this has been directional. FIs have continued to hold shorts, but we look at that as a contrary signal. Sometimes I'm not sure whether we should right now or not. But yeah, we have one or two indicators that are reaching an extreme, but there are many others which are not yet there, like the put-call ratio is still not reached the oversold zone. And so what we are trying to do is simply wait it out and let it, base out before we really say that, we are getting to a bottom. But there's still downside risk. We can't completely rule that out, and which then takes us, to other factors that are impacting the market apart from, just the domestic data.
All right. Hi, Rohit. Good morning and good to see you. When, so the RSI has moved closer to extreme levels. PCR, I think, at around 0.75, it still has some distance to go. And the short positioning at around 2.6 lakh contracts, well, they are as well as getting a little bit extreme. Rohit, congratulations, first of all, on that call. You became cautious long before a lot of traders we heard. So good call on that. Now, the question is, what about the Nifty Bank? Because when the markets moved up, that was holding strong. Then last week, after a while, actually, the Nifty Bank underperformed the Nifty. And if the markets need to either rebound or move down from here, that's going to play a big role. So what are the levels you're looking at on the Nifty Bank?
Yeah, so I'll put out the similar levels. And you're right. In fact, it's not just Bank Nifty, but various other sectors that are slowly starting to participate in this, free fall or falling knife, as we call it. And that's where it's getting broad-based. So the 20-month average for the Bank Nifty, that's 54,580. Here also, we are trading below it at 53,757. So probably, around almost 800 points below that. And the next support after that, which comes in at 50,258, so that, opens room for another 2,000-3,000 points down for Bank Nifty, which is a lot more. So the pressure is actually building on sectors outside of the Nifty, which will then, of course, impact it as well, which have just started to participate on the sell.
What is the support on the Nifty Bank? I just missed that number.
Yeah, so the next one is 50,258.
Sorry, Rohit, the one before that, there is one.
Okay, the 21, that's 54581. That's the that's the 20-month, and we are just trading below that.
Below that,
yeah.
Yes.
So you're saying 54,581 and then 50,258. These are large gaps, right? In that sense, between where we are and
because the Nifty is already gotten there, and the Bank Nifty is just starting, so it has more room. And if we slowly shift towards the next index, which just sold off on Friday, like the metals, you'll probably see there's a lot more room happening there. So we are seeing this shift, happening from sector to sector. Those which were holding out, giving up one at a time. I think pharma is still holding out, so that's still an area of strength, probably where the defensive money really goes to. And we are seeing this even globally. So if you actually study US versus Europe, US versus Asia and emerging markets, they were all holding out till most of February, even most of March. You didn't see the sell-off in Japan start only till maybe a week or two ago. So same with Europe, so they were like UK was making all-time highs just till 5-10 days ago. It was just ignoring all the bad news. So we are seeing other markets start recognizing that this is becoming a more prolonged affair, and I think that's where the reactions are really coming from.
Yeah, Rohit, just a quick word on oil. I know it's a wild one, right? It'll all depend on actual demand, supply, and what happens to supply. But would you imagine that last Monday, same time last week, oil hit 120? And then as soon as we hit 120, voices started coming in, and from US officials started saying that maybe this is going to be short-lived and it's going to end quickly. And if you remember, and oil cooled off. So there is this reflexivity to markets, right? As they say, markets decide outcomes.
Yeah.
Would you say 120 perhaps for now is a kind of a soft peak?
So we made a high of around 124, 125, I think, when on WTI I'm talking, and of course Brent would have been higher in the 30s, maybe 135. So that was the high we made when the Russia-Ukraine conflict took out. So technically we would say that that is the peak level, that we don't really cross 130 in general. 120 that we touched is not very, very far away from that. So it's most probable that prices remain contained within this 100 to 130 range based on how the news flow really plays out. Sorry. I think the bigger concern, more than oil, is going to be the dollar itself. We may say that the dollar is going up because of one reason, and it might find another reason tomorrow. It could be bond yields. We can say bond yields are rising because of higher oil prices, but it could also be due to a prolonged war and the cost of the war itself. So there are different reasons that can cause bond yields and the dollar to remain elevated. So I think that will be a bigger risk to liquidity really flowing into emerging markets, Asia, commodities, etc., than oil itself. Oil could somewhere just remain elevated here. We may not see a significant new highs, like I said, contained within 130 to 100 range based on just near-term news flows.
Rohit, 130 is 20% higher from here. Markets will get slammed if we see those sort of levels, but hopefully we don't have to see that. Finally, just looking at a few outperforming sectors just for the month of March in this fall, the tech index that actually cracked very, very badly. Off late it's been outperforming because it made a low, I think, at the end of February of around 29,800 odd. It's currently at around the 29,000 odd mark. Does that have support, or is that bracing for a bigger fall? Because year to date it's down 25%.
I think, the IT sector has more legroom down. My own target for the Nifty IT index initially is at least towards 26,840. So that's still around 3,000 points lower than where we are. You're also seeing that in global software stocks. I think after a brief bounce last week, last 2 days, they've actually started selling off again. So I think the pressure is still there on IT. So if you're looking for defense, it's got to be somewhere else. I mentioned pharma some time back. That is one place where you will find defense against the market. You are seeing stocks like Sun Pharma, for example, holding out against the market. So look for that. There are a couple of others. In fact, yesterday, I was taking a session on using our momentum indicators, and we found Aurobindo, which is another pharma stock, was the only one which was giving a weekly bullish crossover. So it is the pharma. I think that is where there are a couple of defensive ideas. The second one could be in as an alternate to oil, as oil is under pressure. You're going to look for energy alternates. So there could be two things. One is renewable energy, and the second is ethanol. In India, we focused on that as a alternate source with oil, and I think ethanol producers could come into demand. But of course, that's as and when market stabilizes, you'll find more buying there. Otherwise, every day we see selling in most of these counters, but they're not falling. That's the good news.
Rohit, just two quick points, right? This trend line from the lows of COVID, which has been broken.
Yeah.
Is that significant?
I do think so. It's a first warning that maybe the entire rally that we saw from COVID is complete, and we are doing what we call as a retracement of that entire move. Okay, we take it one step at a time, but that is the first indication. The second indication is the 40-month average, which we spoke about, which is at 22,600. So breaking that and the trend line, if both happen, then it would indicate that we are in a much more serious bearish territory, which can then be time consuming, 6 months, 12 months. So that's what we will be looking at. The trend line break is the first indication of such a possibility.
And you had said that, I think earlier the call was to buy 26,000 puts, then it became 25,000 put the last time we spoke.
Yeah.
As protection, December 20. So, I mean, those of course would have done very, very well. But you recommended them as hedges, not as a trade in that sense, right?
Yes, I've told everyone not to get out because most investors they're not used to this and they get fidgety. Every day I get asked, should we book out? Now we are making gains. The 400, 500, 600 price has become 1400. My answer is, don't look for a particular level. People obsess with, is the bottom going to be at 22, 21, 19? I'm like, it's not about a level, but do we price in the risk in terms of India VIX or the volatility index? So the volatility index has two key levels. One is close to around 24, 25, which we've seen during the India-Pak war, the Israel attacks, even the Adani fiasco when it happened more than a year ago with the yen carry trade. But there are a couple of times we went to 30, 35, and that is, I think, more relevant. We got there, I think, even when the Russia-Ukraine attacks happened. And I think that's a level where we would get, maximum panic. So while markets are down, the India VIX doesn't reflect that people have, reached an extreme in terms of panic. And that is when we would take a call as to, whether we should book those hedges.
Yeah. Thank you very much. Good chat as always, Rohit. Thank you for joining us and running us through that picture. I mean, I think sets us up just in terms of frame of mind to think about things from here as we kick off and get into this new week. We'll take a break here. We'll come back and we'll turn our focus and attention to the auto sector. Jay Kale will be with us with the spotlight on the auto space and, I mean, road ahead there. Stay tuned. Coming up. Welcome back. I think there is a flash at the bottom of the screen. US arm of Glenmark Pharma is going to launch potassium phosphates injection in multiple vial sizes. We'll try and get a sense of what's the size and is it large, meaningful, etc. for Glenmark in just a bit. But Jay Kale is with us on the program now. Jay, good morning. Good to have you with us here. Thanks for joining us. Across your portfolio, across your coverage universe, beg your pardon, I'm assuming the direct implication from a straightforward perspective is CNG and then, of course, production disruptions, etc. for auto OEMs. So just kick us off with regards to how you're thinking about the implication for the auto space because of the Iran war, price hike as far as energy is concerned, and some disruption to gas supplies.
Yeah. Good morning. Yes, and if you see, up until Jan, Feb, and we had seen demand holding up quite well, and it was quite a pleasant surprise for autos that despite post-festive, where demand was expected to moderate, things were holding up quite well. And then you had this, Iran war coming up. Now that puts a lot of uncertainty in the short term. Multiple factors there, as you mentioned. One is the production disruption that is likely to come in the coming weeks if the gas issue persists. Second is one needs to see where crude settles and what that would have an impact on the end diesel prices and petrol prices, and hence the cost of ownership and the sentimental impact from consumer demand perspective. And third, of course, is the rising commodity prices, which can put pressure on the margins of most of the OEMs. And depending on which sector you are and where the demand is holding up, the ability of the OEMs to pass on these prices to the consumers will kind of decide which companies see the least earnings cuts in that perspective. So what started off as a welcome surprise in the auto sector has hit a speed bump in the new calendar year. It's still evolving, and one needs to keep a close watch on the production disruption in the coming weeks.
Would you want to
As of now, we are not seeing much of a disruption.
Yeah.
But if this situation persists, there could be likely production disruption.
Yeah. Yeah. Who's most at risk in your coverage universe, Jay?
No, I think, from a production disruption perspective, it's you can't pinpoint any one specific company, even a small supplier in the value chain. If it gets impacted, the entire supply chain gets choked. So it all depends on, of course, all the OEMs will be firefighting right now to get their production supplies, secured. But it's the risk is across the board. All OEMs are at risk because even if one supplier gets disrupted, it affects the value chain.
Yeah. In a way, Jay, it's actually the weakest link in the supply chain, right? Which will decide the outcome of this. Am I wrong?
No, absolutely. I think even a small supplier, tier 2, tier 3 supplier, or say a casting supplier, doesn't get the required amount of gas or a pipe natural gas, then the entire value chain, and you can't have a auto or a vehicle rolled out of the production line without even one part. So it's really sensitive to the weakest link in the value chain. And but that apart, we have seen these disruptions historically. Stocks have corrected. Of course, that gives some bit of an opportunity to value pick. We had seen some bit of these disruptions during the Russia-Ukraine war also, not so much from a production standpoint, but from a commodity and crude oil price standpoint. And things had recovered decently well. But one needs to see how long this persists for the extent of pain that we can see in the stock prices.
Since there's so much weakness, Jay, would there be a couple of companies that are on your radar that you would be actually optimistic on and you would advise adding positions on the long side?
Yeah, so I think we feel companies which are structurally in a positive space from a market share gains perspective and ability to pass on the raw material cost to the consumers. We see value picks in two-wheeler space where something like an Eicher and TVS have sustained their market share gains over the years. and their pricing power also will be relatively better. In two-wheelers, we prefer Eicher and TVS, and passenger vehicles, there is now value being sought for Mahindra and Maruti. While passenger vehicles, if you see during the Russia-Ukraine war, were a little slower than two-wheelers to pass on the raw material cost to the customers. But I think what is heartening till now, at least that the demand is holding up well as of now. So we would really want these disruptions to kind of ease off, and I think these four names would be our top picks.
Okay, all right. Got it, Jay. Appreciate you joining in and giving us your quick take on the sector as well as a couple of stocks that you believe are relatively better placed. Well, I think for the time being, we could maybe slip into a short break. Okay, all right. I think we have Hormuz actually. Before we take that break, let's go across to Hormuz. He's joining in to tell us about all those stocks that are moving around on Friday's trading session on large volumes, and some of them backed with delivery. Hey, Hormuz, good morning.
Morning, Nigel. Welcome back to you after your break as well. And the list today, of course, is a couple of stocks that were bucking the trend in an otherwise market that was having a bit of a meltdown on Friday. One of them was LTTS, L&T Technologies. The stock was up 10% in that kind of a market on Friday. The biggest single day gain that the stock had since March of 2020. Volumes were the highest since July of 2021. It had more than 35 lakh shares that were traded on the stock. The 20-day average is only 1.5 lakh. And among those shares traded, only 6% of those were marked for delivery. That is only close to 3 lakh shares. Even here too, the 20-day average is only 25,000 shares. And in fact, the stock made a 52-week low on Friday intraday of 3,010 and then recovered from those levels to surge over 10%. The big underperformer on Friday was CEAT, and the stock was down 9% on Friday. It snapped a 3-day gaining streak. But before Friday's fall, the stock was up 15% in the 3 previous sessions. The Friday's volumes during when the stock fell were less than Thursday, when the stock was up almost 7 to 8%. Those 4 lakh shares were traded. The 20-day average is 1.5 lakh. The percentage of delivery volumes as well in comparison to the total number of shares traded was also the lowest in the last 2 months. Only 83,000 shares were traded, marked for delivery, 20-day average of around 53,000. The important level now for CEAT is 3,400. And why is that so? Because it has not closed below that level for 2 consecutive days, going all the way back to September of last year. And the other one that bucked the trend on Friday was Syngene, as one of those 44 names on the Nifty 500 that ended higher. But in the previous 13 trading sessions, the stock had gained only twice. Now, that's the kind of underperformance we had seen on the stock. The Friday's volumes were the highest in almost a year. Close to 1 crore shares were traded, 20-day average of 10 lakh shares. Almost a quarter of those were marked for delivery, around about 27 lakh shares. Here too, the 20-day average is around 5 lakh. And this one too had a decline to a 52-week low on the 9th of March and saw that bit of a rebound on Friday's trading session.
All right, Hormuz, thanks very much for that. That's an interesting list of stocks with regards to price action, volumes, etc. on Friday. We take a break. We're back with the pre-open session. Vikash Singh of ICICI Securities will talk about that 5% sell-off that we saw in the metals index last week. Again, the big story is the disruption of in terms of gas supplies and whether it is starting to hurt. We'll also connect with Sudarshan Sukhani and Mitesh Thakur for some technical trading ideas coming up.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. And the markets are indicating a more or less flattish start. Remember, last week was to the bears because we saw a sharp correction of around 5% apiece on the Nifty, the Sensex, and the Nifty Bank pulling back close to around 7%. In fact, it could be a mildly positive start, but will that start be used as a shorting opportunity? Sudarshan Sukhani as well as Mitesh Thakkar are back with us. Hi, good morning, gentlemen. Good to speak to you all after a while. Well, Mitesh, you go first. A very sharp pullback. The bulls will argue that we can't keep falling 300-400 points every day. That's at least what we have seen the last 3 trading sessions. Do you think there's a case for a relief rally, or do you think just hold on to your short positions and ride it on the downside?
Morning, Nigel. We've been getting all those memes about the number of days of petrol and LPG cylinder has been stopped. And I think one of them was on Nifty as well, that we are falling by 300 days and we have got only 76 or 77 days of stock left. So, yeah, it can't keep falling every day. One. Two, I think, it's come to a very important level. If you look at the Nifty chart, on the 11th, between the 11th and the 15th of April 2025, there was a big gap around this 22,900 odd levels to about 23,100, 23,200 levels. So I think we are right there in that gap area. We are extremely oversold. Similarly, for the Bank Nifty, look at the historical chart, and sometime in September of 25, you will see a cluster of lows and bottoms being recorded around the 53,600 mark. Same on the 9th of May 25, same level was the low. And before that, in December 24, at least on 5 or 6 occasions, there were intraday highs made around this 53,600 mark. So on both the indices, we are at critical or important historical support levels. On both the indices, we are extremely oversold. Looking at that overall picture, while the bigger trend is still negative, is still weak, I think in the short term, you might be close to forming a bottom. And therefore, I think I said on Friday as well, that time to take profits off the table, at least on the short side, if you have, and around 60-65% or 2/3 of your position should be booked. So I think these are good levels to take profits. We might not go aggressively long because the broader direction is still on the downside, but once you get a pullback, and we are also very far away from the 10-20 day averages. Once you get a pullback, then I think I'll look at getting into fresh short positions.
Got that. Mitesh, in terms of your specific trades, what would those be?
Prashant, I have a mix of buys and sells. On the buying side is Aurobindo Pharma. It was a buy last week as well. Now I think, can be bought afresh with a stop at 1278. Targets of 1335 is what I recommend. Coal India is a buy with a stop at 459 for short-term targets of around 485. A sell on PG Electropast, it's broken a rising trend line. So sell on a mild pullback, say around 5-6 rupees higher from here, around 507, 509. Sell with a stop at 522 for targets of 480, and also a sell on Container Corporation of India with a stop at 462.5 for targets of 435.
Okay, well, some buys are emerging, some sells as well. Sudarshan, good morning. Good to have you with us here. I mean, it's been tough. Last week, of course, 5% and 7% gone on Nifty and Nifty Bank respectively. Where are we at? And top down, let's start there first.
Yeah, good morning. See, the trend is down. There's nothing to suggest that the trend has changed. Earlier, I had suggested somewhere around 23,000 could be a possible stop point. We are almost there. So short positions should be closed. This doesn't mean that the downtrend has come to an end. It simply means this is wise risk management. Now, for the short term, for today, it is also possible we can look at a buying opportunity if the Nifty holds on to 23,150, which is Friday's close. So it's not a very big deal. It's just if the Friday's close is holding, say, around half an hour, 1 hour after trading, that's a buy. That tells us that at least for the time being, the shorts have said, okay, we'll step aside. Buy then with a very tight 100-point stop. If the level has broken by the next 30 minutes or 45 minutes, nothing to do, step aside.
Okay, got it. And individual stocks? Sudarshan, you want to give us some views?
Yeah, Oro Pharma is a buy for me also with a stop under 1270. Marico is a buy with a stop under 745. BEL is an intraday short. The word here is intraday with a stop above 445. And Vedant is also an intraday short with a stop above 700. The reason I'm not suggesting carrying short positions is the markets may be willing to find a low somewhere around this level. So there's no need to take unnecessary risk.
Okay, all right. Thanks a lot for joining in, gentlemen. We'll come back to you all. For the time being, let's address the index that sold off actually on Friday's trading session, which was the metal index. We have Vikas Singh, Vice President at ICICI Securities, who joins in. Hi, Vikas. Good morning. Good to see you in. Vikas, what happened on Friday? Was it routine profit taking? Did something change with regard to the metal stock selling off? And also a quick word with regard to this, the facility in the Middle East that has announced a partial shutdown. I think it was part of the earlier force measure that they had announced, right?
Yeah, good morning, Nigel. Thank you for having me on the show. So firstly on ALBA, basically ALBA has already declared a force measure when the war started, but they have not stopped the production. So Bahrain has a 1.6 million ton of annual capacity, and out of that, roughly about 19 to 20% of the capacity, they've started partial shutdown because they imports alumina and like aluminium exports is getting difficult, alumina imports is also getting difficult. So they're just trying to prolong the rest of the capacities because once you close the aluminium smelter, it takes a fairly long time and money to get it back online.
All right, aluminium Bahrain, that's what ALBA is what Vikas is referring to. So Vikas, in terms of aluminium prices that have held very, very strong, in your estimates, what are you working with with regard to the numbers? And currently, the price is quite elevated. So what is the difference between the two, both on aluminium as well as on ferrous?
So as I mentioned in the last week, our conversation, we are still maintaining a long-term average of 29.50 in our estimates for FY28. But in a short term, we expected it to go to $3,500, which we still maintain.
So then that will be good news for the aluminium players. Nalco has been a stock that's actually done quite well, but I think you are more comfortable with Vedanta. Could you tell us, among the aluminium players, what is your preference as of now, just to revise? Because as you're saying, your estimates are working with a sub $3,000 number, while we're currently closer to around 3,400 odd.
Yeah, so in current scenario, Nalco is slightly better benefiting from the overall aluminium prices because of the mix. Vedanta has also the copper, steel, and zinc as well. And silver also was a big segment which is going down. So relatively, Vedanta is less overall beneficiary, but we have our top pick Vedanta as of now at this point of time.
Okay, tell us a little bit about this Middle East crisis, and one of the stocks to focus on is being APL Apollo. I recall in the last quarter, actually, it appeared things were turning around for them, both on the volumes, on the profitability, and that big boy actually has stood tall because you had a smaller players that were trying to creep in there, but they have held on to their market share. However, they have exposure to the Middle East and also they have some gas dependence. So quantify the hit for a company like APL Apollo, and would you be a buyer post this recent sharp correction?
So domestically, they use gas for their galvanized production, which is a zinc bath to maintain that temperature. Roughly about 20% of the production comes from galvanized. We don't expect the entire 20% to get shaved off. So assuming 20 or 30% gas reduction, you usually get that percentage, 5 to 6% might get impacted. Also, Dubai, basically 7 to 8% in total EBITDA. There, what we understand that the production is not fully closed, but yes, the demand might get into a little bit of situation. Basically, the demand might not be that great since the war is going on. We will still wait before initiating any fresh buying call to our clients for APL Apollo.
So it's a double whammy for them. One is on the galvanized side of it, which is 20% of their mix. Some part of scale back there because of the unavailability of gas, and the Middle East as well. Though it's functioning, it may not be functioning at optimal level. So some pullback out there, but for the time being, you're maintaining a cautious stance. Got that. The other big announcement last week was the Jal Jeevan mission, right? It got a green signal, and there could be a few beneficiaries. You want to name the biggest beneficiary from the list?
So the DI pipe players are supposed to get more benefit than the rest of the pipe players, followed by HSAW pipe players. So the DI pipe players are the biggest one is Electro Steel Casting, Rashmi, which is not listed, and Jindal Saw. Basically, these guys were supposed to benefit more in this scenario. Jindal Saw also has HSAW capacities as well, so they get benefit slightly better than
Okay.
others.
Got it. Okay. All right. And finally, Coal India. I know you don't have official coverage or it's in your restricted list, but that one has outperformed. The hope is that now they'll get pricing back and they'll get volume offtake as well, both of which has been missing for the last 12 to around 18 months. Have you seen any signs on ground that e-auction prices have moved up marginally in comparison to, say, the Q3 average?
Would be slightly early to talk about e-auction prices movement, but if you just compare with 2022 crisis when the energy prices went up, including the coal, e-auction prices did went up, but not to that extent which the international prices have gone up. So our expectation is that the e-auction prices would go up, but relatively in lesser quantity. Plus, you need to mind the fact that versus 2022 and now, many of the private players also have their own thermal coal mine, so that would cushion the full impact.
Vikash, we'll leave it there. Thank you very much for joining us. Good speaking with you here on CNBC TV 18. I think we're at 9:10, which is 5 minutes to go for market open. The Nifty pre-open has ended, and we are. It'll come up on your screen, 35 points lower, so 23,100, around where we left off on Friday. A 9:10 call. Sudarshan, what do you have?
It's Oro Pharma. Buy Oro Pharma with a stop under 1270.
Okay, Mitesh also had Oro in his list earlier. Mitesh, what about you? 9:10 call?
I think the pharma pack is doing really well, so that's going good. But I'll go with the sell on Cohort.
Okay, sell on Container Corporation. So that is the 9:10 calls. More later. Now, let's talk about a couple of other names, right? L&T sold off hard on Friday. And Vivek is here with this one in focus. Vivek, tell us.
Well, that's right. L&T Friday down over 7%, over 20% correction since the West Asia crisis has unfolded. So today, a couple of very interesting notes have come about, a bull case and bear case, if you could call it that. First on the list is what CLSA is saying as far as L&T is concerned. They've gone ahead and analyzed L&T's number one West Asia customer, which is Saudi Aramco, and they've said that despite the fact that Saudi has guided for a flat capex in 2026, it augurs quite well for L&T given the fact that there were expectations that there could be cuts on account of the ongoing conflict. Also, CLSA says that the recent 23% correction is an added opportunity to accumulate India's key as well as one of the global key energy capex plays. On the other hand, quite a few bear cases as well. Access Capital, in fact, has done an interesting analysis. They're saying that the entire fall has to be seen in the context and in the backdrop of the ongoing conflict in West Asia. What they're saying is that execution in West Asia has been materially impacted by disruption to movement of men, material as well as construction equipment. So they've gone ahead and they tried to quantify the entire impact. They're saying they're expecting close to 1,200 crore of impact to EBITDA in Q4. So almost 7% of the FY26 EBITDA estimate would be impacted. Now what they're saying is that in case there is an extension to the war beyond March, they're saying that there is a possibility of a further 18% correction as far as L&T is concerned. And Nuvama in too has done, they say that downside from current levels is limited as far as L&T is concerned. They're saying that the SOTP bear case target itself works out to close to 4,000 rupees. And they're saying L&T currently is trading near its historically low valuation multiples. They're saying not much downside left despite all of the worries that are being priced into the stock currently.
Okay, all right. That's L&T for you. 20%, by the way. Down actually just this month, and I think 20% from the highs as well. Let's talk about the other set which is in focus. That is oil marketing companies, and Sud is here. He's parsed through some brokerage notes on this sector. So take it away.
So HSBC has come out with a note and has downgraded all the three oil marketing companies, HPCL, BPCL and IOCL. It's on the back of sharp increase in the crude prices we have seen. In the last month, the average crude price for the Brent was around between $65 to $70 per barrel now, which has moved higher. It's above $100 per barrel for the last few days. And because of the HSBC believes that there would be a sharp cut in the earnings as well as the multiples. And even if there is a recovery in the crude and Brent goes back to $75 per BBL, despite that, there would be losses on the marketing front. So for IOC, it has downgraded to hold, target cut to 150 from rupees 200. For HPCL, downgrade to hold and target price is cut to 360 from 620. And for BPCL, it's downgraded to hold and target price is cut to 340 from the earlier price of rupees 470.
Okay, all right. So thank you very much for that. That is oil marketing company. So L&T is an upgrade, and I mean actually at least a constructive view, and OMCs is a downgrade. But stocks have already corrected a fair bit, right? Now, a quick recap of all the other names as well, which we've highlighted from the morning. Reliance Industries should come up flat. JSW Steel is up about 0.25%. Interglobe Aviation is down about 1 1/4. That's about 4,100 now on Interglobe. There is Zydus Life, GMR Airports, VA-Tech, Webug, etc., which are also coming up with starts. You got Data Patterns, Bajal Products, which is up about 7%. IDBI Bank is another one, down 11%. Boy, that's a big one. And there is Aster DM, which is starting slightly lower. We've got the first rates coming up anytime now, and then we will sort of read those out and then go on and look at the broader space as always. What do we have? The Nifty and other large indices are starting flat to slightly lower, maybe in the green. Yeah, in the green. 23,200, 1/3% higher. So there is a bit of a bounce afoot. Let's hope it lasts. Nifty Bank is, yeah, it's also starting about 1/3% higher. So, I mean, actually quite damaging falls last week. And now there is some green. Nifty mid-cap index is flat to slightly lower, and actually sideways, nothing at all. It's blinking red and green. The Nifty small-cap index will come up as well, and that'll give you a sense of where we are. So 40, 50 points lower on the Nifty small-cap index. 640 higher and about 1,000, 1,100 stocks which are lower on the NSE 500 list. So that's the overall picture, but let's dive into individual names and the broader market. Nigel.
Well, that's right. You know, a few stocks actually, Prashant, deserve special attention. IDBI Bank, the government might not proceed with the divestment as bids likely to be below the reserve price. CNBC TV18 had given you a bit of a heads up on that one. IDBI Bank is the one that's taking it on the chin. Big downtick is what we're seeing on that particular name. So that one's losing out. Bartek, you know, they're backed an order of around 1,000 crores to build Chennai's looped water grid. So that one, in fact, I think has opened up well in the green, up close to around 3% or thereabouts. Adani Power as well, there was some favorable news that did come in there. And the stock is clearly reacting to that. So that stock has opened up with a gain of close to around 4% or thereabouts, 3% now. The other stocks that are doing pretty well, Tejas Networks, the stock did see a bit of a pullback from the recent top. So today it's moving up on high volumes. Tejas Networks, I think HFCL, as well as Sterlite Technologies, all of them doing pretty well in today's trading session. What else? On the upside, Bagel projects, because of the order win, the stock is up close to around 10% or thereabouts. Ramki Infra as well, up close to around 5%. There's an order win even on that particular name. On the flip side, from the broader markets, a few stocks are getting clonked. IDBI Bank now down 12%. HPL Electric, that's down close to around 6.5%. So big downtick is what we're seeing on that one. And Chennai Petro as well. The refining margins have moved up. The stock has been all over the place, fluctuating big time. For the time being, that one's lost close to around 5% as we speak. And TTK Prestige as well, after the recent run, has come in for some profit taking. As we do that market check, the markets are as flat as can be. The Nifty Bank as well flattened out. The mid-cap index continues to see pressure, one stock advancing for two stocks that are declining.
Absolutely. And, you know, just if you look at what's doing well, apart from outside of what we've already discussed, Zydus Wellness is up 4% and it's got some volumes on it within the top 5 volume-led gainers on the NSE. I think VA-Tech Webug, we mentioned earlier, that is about 4% higher. Keynes is starting about 1% in the green. Again, I mean, a name which is actually corrected quite sharply over the last few. Actually, it's not recent. From the highs, it's come off from 4,100 or so was the high. It's about 600 rupees lower. But of course, I mean, you know, from the top, it's lost a lot. Ultratech is higher. Thermax is up about 3% or so. GMR Airport is up about 1%. Aeroflex is another one which is coming up with about a 3% pop. That is Aeroflex Industries. You know, but it's 1,800 lower and about 600 higher. So it's clean 3:1. declines to advances ratio at this point. Lots of silver. I'm not sure if silver has seen a bit of a down leg right now, but silver, the ETFs are all down, anything between 2, 3, 4%. And that is populating the losers list as well. IT is a big one, right? I mean, LTTS is down 4%, and that is a large cut which is coming through at this stage. Happiest Minds is the other one. We had, by the way, the management with us, I think this was last Thursday or Friday, and that is down about 4% as well. The recent high was about 450. Stocks back at about 370, 380 at this point in time. 20 points, so 23,100. And 70 or so is where we are trading. Hiren Ved is with us, Director and CIO at Alchemy Capital Management. He's with us here on our studios. Hiren, good to have you with us here. Thanks for joining us.
Thank you.
So how do you assess the situation, Hiren, with all the damage that we've seen so far and near to medium term? What's the view?
I think, obviously, whenever geopolitics impacts energy prices, I think India... it's always a problem because we still import a large part of our energy, right? But as we have seen even during the Russia-Ukraine war, oil prices spiked and then things settled down, right? So I think that eventually in the medium to long term, I think the only heart we can take is that we are aligned with the US in some sense, because I don't think even Trump wants higher energy prices, right? But I think right now we are in a little bit of a bind where none of them can afford to quit midway. And therefore, we just have to wait it out and see how things, move on from here. Hopefully, we've seen peak oil prices. Typically we see a peak price and then it hasn't gone beyond 120. If it goes beyond 120 or approaches that, I think we would, that would be a little bit of a challenge. But if not that, I think the markets more or less have absorbed peak oil prices.
Would you, let me, and this is a slightly near-term question, and no one knows when this will end, but let's say if it ends tomorrow. Tomorrow morning we wake up and overnight there is some de-escalation that's happened. You think there is a chance that and by the way, since the war started, the Nifty has lost about 9% from that level, 26th or 27th of February. You think the market kind of, goes back pretty quickly? The rebound is going to be sharp, quick, or it's maybe you get a bit of a tactical bounce and then you'll see. What's your sense?
I think you will get a bounce, probably. And I think more than anything else, at least in the near term, the oil price will be a barometer, right? So if oil comes back down to kind of 80, 85 levels, then I think we are fine. I still believe that we can't go down to 60 because there'll be some premium which will be built into oil prices, at least in the near term. But I think if oil starts to fall back below 85, I think then we are okay.
And at current reckoning, the Nifty has corrected this 9% odd. We have factored in more or less crude oil prices around the $120 per barrel mark. That's what
typically happens, right? Whenever we have a big risk event, the market tends to discount the worst initially, and then it settles down somewhere there. Unless obviously, things escalate far beyond anybody's comprehension, then we don't know, right? Then all bets are off. But I think my sense is that we have probably seen the peak risk priced into the market.
All right. Hiren, over the last few days, speak to market people, you speak to a lot of retail audiences as well. There are two schools of thought, right? One go with history, what it suggests, that war cries are the buy cries. You buy and you've made some money. The other point is that at times, equities as an asset class itself, gets ignored for a couple of years. What do you think the current scenario is throwing up right now? Because the SIP money has been coming in, domestic investors have showed a lot of maturity, but now things are getting a little bit tricky because the headline index is down 12%, portfolios around 20, 30, 40%.
Correct. So I think historically, we all look at history and all the past events, and we've seen so many WhatsApps moving around and, saying that the average fall has been so and so. But people forget that each event creates its own history, right? Yeah. So this event will also create its own history, whether finally we are 9% down or 12% down or 15% down, or we've already seen the worst. We don't know, right? But yes, I think that at least what I've seen in many years is that whenever markets are too focused on a single variable, which is oil prices today, that correlation never lasts for too long, right? Because markets are far more complex. A lot of things impact markets, but there are times when people only look at one variable, right? There used to be a time when if the rupee opened lower, the markets would open lower, right? And now people forget that correlation. Now it's oil, maybe tomorrow it's something else. So I take heart from the fact that today there is a lot of risk premium that has been built into the way markets are behaving. I certainly feel that this is an opportunity, and specifically because we've seen at least 18 to 20 months of sideways movement, right? And I think valuations are now fairly okay. Having said that, I think that people have forgotten what sideways markets are, right? I mean, I remember that, post the Harshad Mehta crash, and I know this is like several decades back, but between 92 and 98 and early 99, markets went nowhere for 6 good years, right? I mean, we haven't seen that kind of a lull, 2 years and we are already crying.
The more recent one herein is, I think, 2010 to 2014, right?
Correct.
2010, we hit 6,350 on the Nifty, which was the high, and then 4 years later, we were there, nothing, absolutely, right? So I think, yeah, absolutely right. I mean, that was, of course, a longer period, but this was equally long.
I think that was I think it was 2008 to 2023 to 6,300 on the Nifty, and then September 2013 when Mr. Modi was BJP's face. I think that's when we went back to 6,300. So that's
what I said.
Around
So I think it is 2010, Nigel. 6,350, and then
correct, absolutely.
And then
so initially it was 6 years, then it was 4 or 5 years. So, we've seen those kind of, periods where markets have gone nowhere, right? And I'm not saying it'll happen, but I'm saying that these things do happen in markets, right? So we just have to be cognizant of the fact. And I think that's why people say that equities is for the long run. But we tend to forget all of that.
Yeah. So what are you doing in your portfolio, Hiren? I mean, so have people, and just give us a sense of what other HNIs are doing. Have they sold what needed to be, I mean, even stuff that you like and you normally hold, but because the environment is soured and you don't want to stand against what you don't know, right? So all that has already happened, right? I mean, has happened some time ago.
Yeah,
so the market's light.
I mean, markets are very swift, right? So I think most of the stuff gets discounted very quickly, and then somewhere down the line, sense prevails, right? But we had a little bit of cash, and we have been deploying these last few days. We don't know where the bottom is, but I genuinely believe that if I were to look 6 to 12 months out, I think we would be significantly higher, from where we are today, hopefully. You never know, because these days you have disruptions happening very quickly, one after the other. But I think that we've spent a lot of time. And I'll give you, I was just looking at some data yesterday that when we ended March 2020, just before COVID, right, the top 500 companies' aggregate profit after tax was 4 trillion rupees. Today, in this financial year, our quarterly run rate is 4 trillion, right? So we've gone from 4 to 16 trillion of absolute profits. And the peak of just before COVID happened, I think peak Nifty was 12,200, if I'm not mistaken. From 12,200, you are even less than double today, right? While profits have actually gone up significantly higher. So I think even from a valuation, aggregate valuation perspective, I think we are at fairly attractive levels. Now, what happens in the next 1 week, 2 weeks, 1 month, I don't know. But I think if we are long-term investors, to me, this is a great opportunity to buy.
3 ideas, Hiren. Leave us with 3. I mean, things to chew on, things to...
no, I think...
maybe research a little bit more. I mean,
look,
what would make your watch list?
Okay,
yes.
let me put it this way. I think that typically the the thinking is that let's hide into something which is not impacted by what is happening in the near term.
Yeah.
Right. My sense is that one should do slightly the opposite.
Yeah.
Right. You buy the stuff that is significantly impacted by what is happening, because there is already that risk premium that has been built into those stock prices.
Yeah.
So when things normalize, you not only capture that and the normal return, right? Yeah. So my sense is that today, again, I can't say, individual names, but I think broadly speaking, I think small and mid caps have corrected substantially. There will be some areas where, stocks are available 30-40% cheaper.
So you would allocate more to small and mid caps rather than the headline names, right?
I would.
Okay, all right. I want to ask you about a couple of companies, and you could, pick and choose between them. One has been a big winner, which has been Force Motors. It's been a multi-bagger for y'all. From the recent peak, I think it's corrected close to 20%. And by the way, I was in Uttarakhand for the last week, and I was surprised to see so many Urbanias even over there. And the other one I want to ask you about is Bajaj Finance. I think you track that one closely as well.
Yeah.
Lot of focus with regard to the AI adoption, and it's a quality name.
Yeah.
That's pulled back close to 20% as well.
Yes.
What's your view on that name? If either these two stocks or another one, if you want to give us.
No, again, I would refrain, but I think that let me put it this way: that there's been a lot of fear about AI, but as you mentioned, companies like Bajaj Finance, and full disclosure, we own it.
Yes.
Right, have been early adapters
Yes.
of AI, and I think what's going to be interesting going forward is that there will be companies that will adapt quickly and benefit from it, and the ones that will not. So there will be in the future divergence in valuations of companies that actually use AI to their advantage, either to cut cost or to improve growth, either which way, or a combination of both, right? So I think it's going to be very interesting which companies are able to integrate AI into their business processes to really improve their competitiveness. And the ones who do will actually do better than the others. And that's where I think the men and the boys will get separated going forward.
And you'll be optimistic on the prospects of a company like Bajaj Finance from here on with due disclosures.
We would.
All right. And just one more point, gentlemen. Maybe I was watching you all on television in 2008, but the high that the markets made, the Nifty made, was 6,357 on January 8th, 2008. And we saw that level after that only in December 2013. I had a memorable day on January 8th, 2008, which I'll tell you in the break. But that's the reason I remember that. So we went through that 5-year period of not going to those highs. Hopefully it doesn't happen this time around.
But good. I think you're setting the expectations that people...
No.
The other point is, once this Iran thing stops, right?
Yeah.
And you're going to go back to the AI story. And that's what we were kind of worrying about, if you remember.
Yeah.
Almost, that was another kind of war.
Yes.
This is one war, that is another kind of war. And that is war now, which perhaps there is no end date to it, right? There's no expiry. Here we are saying, well, it'll get end. Will it end tomorrow, next week, whatever, right? But that is like here to stay.
Correct.
That disruption.
Correct.
Right? And now we're ignoring it, but there are things happening there.
Well, I think, it's like any other disruption. It's just that the scale is going to be far bigger, right? I mean, if you remember when e-commerce companies came and what happened to the mom and pop retailers, or when EVs suddenly came on the scene and everybody derated the ICE companies. But what happens usually is that whenever there is a disruption, we tend to over-discount the risk in the short run and under-discount it in the medium to long run. And I think that's also what has happened in IT services, right? So I think even within IT services, there will be companies who will actually benefit from AI, and there'll be ones who don't adapt very quickly, who will actually, get into oblivion or irrelevance. But that will happen over a period of time. It's not going to happen today. But the market tends to take the worst case and bring valuations to that. And then there is an adjustment as people fear, oh, it's not as bad as we thought, or maybe. And what we forget is that companies can also adapt, right? So when EVs came, people, as I said, you massively derated all the ICE companies, but look at who's leading the race today. You know, it's not Ola who came and disrupted. It's actually TVS and Bajaj.
Yes.
And you have a new player like Ather, who probably came from nowhere and has done phenomenally well. So I think something like that is also likely to happen, where the existing incumbents will adapt. Maybe they will acquire, right, capabilities and actually benefit. And there'll be some who will be fallen by the wayside. And I think that's where the opportunity and the risk is. You'll have to find those guys who you think will adapt well.
And that adjustment period is always painful, right? I mean, you kind of sell off hard, and then you kind of market perception changes. I mean, that is it's also the interesting thing about markets.
So you would be looking to get into some of these IT names?
We would.
I think he already has maybe exposure.
What's the exposure?
We have some exposure.
And you'll look to build on from here?
And we will look to build on, because I think that's a great opportunity as well.
All right. Hiren, thanks very much for dropping by.
Thank you.
Always a pleasure, and thank you so much. Okay, all right. I think just a quick word on the market, which is now, I mean, it's so light that you will get these sharp moves. We're up about 70 odd points, but because there is so much uncertainty, I mean, expect those sharp moves to fizzle out and then reappear through the course of the day. So it's that kind of a day where it's continuation of the same third week of the war, but in terms of shock value, there isn't anything new. So that uncertainty is there without the immediate shock in that sense. Well, at the 21st edition of the IBLA, that is India Business Leader Awards, Entrepreneur of the Decade and Chairperson of Aditya Birla Group, KM Birla, revealed that the company's next cement unit commission will make it the largest selling cement company and the second largest in the world by capacity. Just want to play out some sound bites.
Our next cement unit commissions in 2 weeks. With that, we reach a capacity of 200 million tons. Thank you. That makes us the largest selling cement company anywhere in the world. It also makes us the cement company with the second largest capacity anywhere in the world outside of China. That's a matter of great pride for all of us. A large part of that group, of that growth has come in the last 10 years.
Okay, well, that is Mr. Birla. Now, let's, as I said, the big focus point is going to be supply, gas supply to industrial units. We'll have to track it closely because you're getting stray reports from here and there that gas supply is affected. I'm not just talking about LPG, but also, in that sense, natural gas as well. Vinny Mehta is DG of Automotive Component Manufacturers Association of India. And we also have Uma Shankar Mahapatra, President of the Indian Specialty Chemicals Manufacturers Association. Gentlemen, great to have both of you here. Thank you very much for joining us. Mr. Mehta, if I can start by asking you, sir, a simple question to both of you to begin this. What's the situation? Have supply and where are supplies at on average for your members?
Good morning, and the situation is definitely concerning at this juncture. And, post the two notifications from the government on LPG and the natural gas, the problem is that the industry, the supply is intermittent in certain places. It's not there in certain places. So definitely the production is challenged at this juncture. There are many functions in the industry or operations in the industry that are very energy intensive. And therefore, there are challenges, especially when you look at forging, castings, not just that, chemicals, derivatives of petrochemicals, they are all in short supply and the prices are going up. And not just that, not just the gas part of it, even aluminum scrap, some of the suppliers have declared force majeure. So like there are tier 1s, tier 2s and tier 3s, various people in the value chain or the supply chain facing different kind of challenges in their operations. So definitely it is a challenging time for the whole industry at this juncture.
Mr. Mehta, what we're talking about is LPG, sir? or
I'm talking about not just LPG. There is LPG, there is LNG, there is propane, and
so
this is the
across the
gas part
board,
of it.
yeah, across the board there is some disruption.
Not just the gas part. I'm saying there are many kinds of chemicals, and not just chemicals, even import of scrap, aluminum, they are under stress at this juncture. And the auto component industry is also a very export competitive industry. So we also have challenges in terms of export at this hand because, the customer has deadlines and you get penalized if you do not meet those deadlines. So the challenges
just to look at the gas thing, Mr. Mehta, for 1 minute. Is it possible to give us a number? I'm sorry,
No, there is no number.
Okay, I won't press you then because it's
I don't have a number because different
That's fine.
geographical regions have different, have different functions in the industry, and each consumes differently.
That's fine. You said some companies in the supply chain have declared force majeure. That is on account of unavailability of products or again because of the gas issue? Just trying to be as specific as possible, as much as you can.
Both. You could have challenges in front of availability of gas. And let's say if I'm into thermal management and if my supplier down the line is not able to give me aluminum because they're not able to import aluminum scrap, it's a challenge at hand.
All right, Mr. Mehta, just to close the loop, you briefly mentioned even logistical problems. That would be another big factor out there. So if you could tell us in terms of container availability and the pressure that's being faced out there.
So again, the ports are clogged. There are no containers that are available. The export routes, say if we were to go to Europe, where we export almost 30% of what we export, you have to go down the Cape of Good Hope, that's Africa, and go to the Europe. So not just the times have gone up, that is the time for delivering has gone up, but also availability of containers, because you will take much longer time. The containers will be on sea for a longer period of time. And these are all kinds of challenges. So logistics costs, costs due to non-availability of containers, demand supply issue, costs because you will be on sea for a much longer period of time. And then the risk and the insurance costs, everything is going up. So the costs are going up multifold, 2 to 5 times.
Yeah. Let me get Mr. Umashankar Mahapatra into the conversation as well. Mr. Mahapatra, I mean, some questions remain the same, but we want to get a sense from you in terms of what your industry is facing, sir.
Thank you. I think problem is very similar. ISMA is actually association of many large, small, and medium-sized, specialty chemical manufacturers of India, primarily from western part of the country. And we are facing very similar issues, and our members, it's not very specific to gas directly, because many of them have other fuel sources as well. Like for me particularly, like say I am working for an organization called Cohort Chemical, which is a German chemical company. So we don't use LPG or any gas as our energy source, but many of our suppliers they use. So they are facing a lot of challenges. And the price impact is not in single digit. In some cases, it can be even double. So that is the problem we are facing. So all petroleum derivatives has impacted our packaging materials. So specialty chemical, you need a lot of HDP drums or, those kind of packaging materials are also in short supply. So it's not only the price, we are not getting the packing material as well. And the impact is also in the downstream, because we supply to a lot of export-oriented unit. For like say textile, leather, you have the specialty fiber manufacturing, you have water treatment chemicals, which is supplying across various industries. So impact is very huge, and our guys are also using a lot of ethoxylated products. Those are primarily coming from ethylene oxide, and those prices has gone up significantly. So there is a significant challenge. But it's depending on how much stock you have in your hand, because this problem is for say last 2 weeks. So if somebody has got enough material covered for at least for next 1 month, they are little better off. But those who are working in a very just-in-time inventory, they might have more challenges, because getting the material, finding new alternate source, those are the challenging. Somebody might have more material.
Yeah, Mr. Mahapatra, in terms of in the specialty chemicals industry which you represent, this is, in the inputs that you use, I'm not talking about the petroleum derived products, right? But energy, this is largely, it's dependent on what kind of fuel, sir?
So primarily, I would say the specialty chemical per se sometimes is not very highly energy intensive in our case, because these are primarily formulation or mixing, sometimes, but not very highly energy at our end. But our supplier will have a lot of impact. So we are facing not at our end, it's primarily from the supply chain we are facing the issues. Our manufacturers, our members, at in-house, we don't have much issues. But the problem is getting the material on time. The raw material supply chain is a big challenge.
Okay, and could you, could you give us a sense of which are the main pain points with regards to these, chemicals where there is product availability issue and price surge, etc. Just 3-4 item heads, sir. We're not chemical specialists, neither is the audience, but just to get a sense of where this is turning out to be a big pain point.
So major is the plastic derivative, because anything related to plastic, it could be packaging in drums, it could be packaging like LDP or HDP or anything plastic packaging, even in the consumer goods, that will have an impact. So packaging is a major challenge, which is a purely petroleum derivative products. Lot of detergent and surfactant, those are also coming from ethylene oxide, which prices is going high. Supply is not a problem right now. The prices is really very, very high. Lot of polyester derivative, silicon related products, so multiple products, and the more importantly is the acid. Lot of acids are being used in the chemical manufacturing process and also in the downstream process. So acid is in short supply and price is almost double. So these are the very specific product, but all the products prices has gone high, and this particular 3-4 products is really out of control. So we cannot,
And when you say acids, what are the kind of companies which use this, sir?
I think everyone will need acids in some form, like say for our case, you need something for neutralization. For our textile industry, they will need it for, neutralizing anything you do in the process, alkaline process, you need to neutralize it with acids. So it's a very, very, important ingredients both for manufacturing and also in the application stage. So acid is a real challenge right now. So the price impact is almost double there. And transferring this price to the downstream industry is also a challenge. We can understand our customers, they have already booked the orders from retailers or brand for a longer period of time. So you cannot transfer the entire price rise to the customer. So that will become a challenge. And even if the conflicts get resolved, we hope it gets resolved very soon. But still, the supply chain will take time to to get streamlined. So impact will be there for some time, some more time to get streamlined. So,
Mr. Mahapatra, just a quick point. So oil is coming, right? We're getting crude oil. Oil availability is not a problem. Refineries are working. Our refinery, I mean, you buy all this, I mean, all these products that you mentioned, right? This comes from our refineries. So why is there an issue?
So some of the specific grade of plastics, it's imported also from Middle East. So there are certain grades available in India as well. So one side you have the price rise. So some grades are available, but price has gone high. And some specialty grade are also, getting imported. So those are in short supply. So sometimes you need to mix, two grades together to achieve a particular grade of plastic. So those are facing more challenge. Some grades might be available, but at a higher cost.
Last word to you, Mr. Mehta. Just wrap it up for us in terms of what we're likely to see if this were to go on, say, for another 10 days.
Oh, very difficult for me to say, but definitely it's very, very challenging. But I very well understand that the government is seized of the issue and they are talking to various agencies. So I hope they'll resolve it ASAP. Otherwise, it's going to be a big challenge. And I must also caution that the small and medium enterprise are very badly hit because they're running into a working capital issue also. And that apart, we are finding problems with the migrant labor also. They're going back home because cylinders for cooking at home are no longer available for them. They buy it off the shelf from these smaller stores. So we're running into a problem at the labor front also. Yeah.
Well, why labor, Mr. Mehta? Sorry? what's the
No,
issue there?
the two issues. One I said is on the working capital issue because of what Mr. Mohapatra mentioned. For smaller companies, it's a big problem because the payments get stuck because there's a delay in the whole chain now. And secondly, there are a lot of migrant laborers that we employ in the industry. We are a very labor-intensive industry, and those smaller cylinders that you have that they cook at home, they are no longer available in the market. So how do they eat at home? So they're going back.
Yeah. No, point taken.
We need people to work in the factories as well. We cannot run our canteens also.
Yeah. There's a lot of fair bit of disruption in that sense. Mr. Mahatra, just one last question. If you can give us feedback on how, stuff that you buy from Indian refiners, etc., for the industry that sources it, that is not disrupted, right? There is no problem there.
So far, no. It's only the price rise. So supply is still there. Only we are facing challenge. Everyday price is changing. So we are unable to give a right clear-cut price list to our distributor or our customers. So we cannot change every day the price. That is a problem.
Yeah. Got that. Thank you very much for joining us, and it's a pleasure speaking with both of you. And we will sort of have you back on with more as time passes by. Hopefully, we won't have to, and this situation resolves and everything goes back to normal, but we never know. We'll take a break. The management of Hudson Agro joins us to discuss their 527 outlook and the road ahead. Stay tuned. Coming up.
Welcome back. This is Corporate Radar. Well, at least some green on the screen for now. The Nifty is holding with a gain of around 80 points, but things still very, very fluid. And the other good part is at least the number of stocks advancing has crept up a little bit to around 1,200 stocks from around 700 stocks earlier. Well, let's welcome our next guest. We have Mr. R.G. Chandramogan, the chairman of Hudson Agro, who joins us on the show. Hi, sir. Good morning. Good to see you, and as always, and thanks a lot for speaking to us here on CNBC TV 18. Before I come to you, I just want to highlight the three broad points that we're looking at. One is the demand environment on ground. The second point is the milk procurement prices. And the third, the regulatory environment. Let's address the demand factor first, sir. How has demand been in the quarter so far? And if you could give us a sense about the outlook for FY27. If I look at your numbers, the 9-month revenue, including the acquisition, your revenues grew by close to around 14%. So mid-teens growth is what you've done. Where do you end this year? And what's the outlook for next year?
The milk prices of late has increased a little higher. The reason is actually a lot of fat got exported from India to abroad. And normally fat is not exported from India. It's only SMP that normally gets exported. But this year, due to better prices, SMP didn't go, but the fat went on. That created a fat shortage and it also applied pressure on fat prices. Coming back to our own procurement, we have done well, and the unit that we have taken over is also getting amalgamated now, and probably by this month end, this will be only a standalone report and not a consolidated report, and it is already merged. Initially, we had difficulties in bringing the company into the requirement of us, and probably we are now able to control it better. The volumes have increased and things are getting better. Actually, we are now close to 10,000 crores on the run rate. Hope we will be able to achieve plus or minus 1% or whatever it is. Not even 1%, plus or minus 0.5% we may achieve or we may not. Milk prices have recently increased by about 8 to 10%. And the price increase has been given an effect only in the recent, a week back.
All right, so you're saying procurement prices are up by 8 to 10%?
Sorry?
Milk procurement prices are up by 8 to 10%?
Almost 8%. And price increase is almost 6%, you can say.
Okay, got it. So you'll end this year with closer to around 10,000 crores of revenues going by the current run rate?
Stability is not clear. My system is having some problem, I don't know.
So, sir, going by the current run rate, you briefly mentioned a revenue number of around 10,000 crores. You end this year with closer to that number, correct?
We are on track to reach that, but probably, as I said, plus or minus
here or there.
There may be a miss, or probably we may hit it. We are not sure about it.
All right. And on that base, what kind of growth can you look at for the next year?
Next year, we are expecting a good thing, but probably the war has to stop, and probably right now the plastic raw materials are not available, and probably there is a premium getting attached, and 30 to 40% price increase is already on the cards. And we are not in control of the packaging material. We are working on it, and we don't know how far this will just lead to little inflation in the selling price of products.
So the war impact is impacting your packaging material, and the prices have spiked up there, and availability as well is a bit of an issue. Is that correct, sir?
That's right. Packing materials have increased. For example, we require gas to produce wafer cones, but we are finding it difficult to get. But the rest of the materials, we have our own unit to produce polythene films that we are comparatively safe. We are in a position to manage till next 1.5 months. But before that, probably things have to improve.
All right. So you have some inventory on that front. However, on a couple of other, like cones, I believe, is where you're getting a little bit impacted. Right, sir? So, but for the next 1 month or so, you can still sustain operations with a decent amount of profitability that you were seeing in the previous month.
That's right.
All right. Reports also suggest that the unorganized industry may come under the FSSAI lens. How would that benefit a business like yours?
Somehow, probably the audibility is not clear. I don't know.
All right. Let me come again, sir. Am I audible right now?
Okay. Probably not so clear, but tell me.
Let me try again, sir. Reports suggest that the unorganized industry may come under the FSSAI lens. How would that benefit a business like yours?
May be good for the organized industry in a way. Probably things gets regulated and compliance becomes easier, and probably the complication of small guys manipulating will stop. I think probably it's a good move.
Okay, all right. So it will have some kind of a tailwind for organized players. Let's get back to your business then, sir. And we're looking inward now, since there are various parameters at play. How is revenue from value-added products growing for you? What is the current share from milk in comparison to other products?
We are not in a position to give the breakup. Basically, milk is the core value for us, and milk is giving the operations efficiency for all other products. Right now, milk is actually growing in a better manner because we are only into the consumer business and not in the HoReCa segment. We don't give credit, and our receivables are zero. And in fact, when HoReCa is affected, most of the people tendency is to consume it at home. So this may be making an impact on our sale in the next 20 days or till the war stops. There may be an incremental sales that is likely to come, but it is yet to be gauged.
Okay, all right. What about your diversification, sir, geographically? What is the share of sales coming in from, outside of Tamil Nadu and as well as in Maharashtra? If you could give us a broad breakup. What is it right now and where is it headed?
Now, outside of Tamil Nadu, right now, we are almost at 45%. And this is likely to come to 50% in the next 2 years. We are actually using the capacities built over a period, now getting it better. And the coming year will be much better because the capacity utilization is getting enhanced, as a matter of fact.
Okay, a quick word on profitability, sir. Targeted spends on advertising. I think you were spending around 2% of your revenue on advertising. So where is that likely to stabilize at? And given the fluctuation in procurement prices, what kind of gross margin should we look at? Your last reported number was in the vicinity of around 29 to around 30%. Please go ahead.
Our margins are always better because of the type of model what we have built. See, we have got 4 brands. All the 4 brands are market leaders. Arun Ice Cream, Arogya Milk, Ibaco, or Hudson. We are also not focusing on Horeca. The reason why we are able to get a better margin than the peers, almost our margins are 1.5 times to 2 times the margin of our listed peers. The main reason is actually we have our own distribution where we have formed a network of around 4,500 outlets across the country, where we do not have a major wholesale distributor, and all the distribution is happening through our own outlets. So this is something unique, which is actually giving the better margin. But at the same time, probably it calls for infrastructure, and we have made infrastructure investment, and that has just really made our depreciation very high. Over a period, this depreciation or interest will fall now. We are already at the debt-equity ratio of less than 1:1. And this is, earlier probably we used to be at 1:2 or 1:3. Now it is under 1. And we hope things will start improving further from here.
All right, sir, we leave it there. It's always a pleasure speaking with you and look forward to the next one. Appreciate it. That's Hudson Agro. Stocks up about 0.5% or so. We've got the market, which is, as I was saying earlier, you'll see these easy rises and then easy sell-offs as well. When I say easy, I mean, quickly and very blink of an eye, you kind of go up and then come down. The market's light, and I think that basically is the underlying setup out there. Nagaraj Sethi is with us of HDFC Securities for a quick technical view on things. Nagaraj, good to have you with us here. Thanks for joining us. So what's the trade? Indices first, and then we'll get to stocks.
Hi, good morning, Prashant. Yes, rightly said, market is not sustaining the high. The lower tops, lower bottoms on the chart is indicating the weak inherent strength. The opening downside gaps which are still open. The overall chart pattern is indicating we are in a bearish trend, and this just a small pullback rally from the lower levels. Anyhow, market is at the support somewhere around 23,000 level, 23,100, 23,000 levels. So any pullback rally up to 23,500, 450 is going to be a sell on rise opportunity, and after that market could come down further. I wouldn't be surprised if the market read down to 22,800, 700 levels in the near term. And I have 2 stocks. One is from a long side, one is from a short side, both extremes. Timken India has been in a constant up move over the last few weeks. Higher tops and bottoms. Now it is placed at the edge of upside breakout. One can look to buy at this point of time, currently trading around 3588, 3590 levels. So 3800 is going to be a immediate upside target. One can place a stop loss at 3500. And second one is from a sell side. Bandhan Bank, chartically Bandhan Bank after a stellar up move has shifted into a consolidation. The chartically it is indicating a formation of a triangle pattern, a descending triangle pattern, which has a bearish implication and currently breaking below the neckline of the pattern, which is indicating a negative outlook for the stock price. Currently trading around 172.75, 172.50. One can look for a short in this stock price, and 162 is going to be the immediate target, and one can place a stop loss at 179 to 180 levels.
Okay, all right. Thanks a lot, Nagraj, for joining in and giving us the view with a couple of picks as well. Let's focus on a couple of stocks then that are buzzing around. In IDBI, that's the stock of the morning on the downside. Gaurav joins us to give us a quick update on that one. Gaurav?
Well, it's not a good day for IDBI, and the reason being that for the last few years, we have been seeing that IDBI was at the forefront when it comes to government's divestment plan. Now, this time, there was a concrete plan, and government was also talking about the divestment likely to be concluded in FY26 or FY27. But what the latest update is that, as per sources, the bids that they have received are below reserve price, and that is the reason why the divestment will not be concluded. Now, if you look at the structure, government along with LIC holds more than 90%, and they were going to offload around 60% stake for a valuation of around more than 30,000 crores. Now, as per sources, there were two prominent bidders, Emirates NBD and Fairfax. Even if you look at the background, recently we have seen Emirates NBD entered into RBL, and if you look at Fairfax as well, they already own a bank which is CSB Bank. Now, sources say that as the bids were lower than the reserve price, that is the reason why this will not go ahead, and again this divestment plan will be delayed. If you look at the IDBI Bank's share price as well, in the last 1 month itself, barring today's fall that we have seen bank failing almost by 17% in terms of share price. There could be multiple reasons. Now the war was also ongoing, which also impacted. But given that this plan is again delayed, we are seeing another major reaction. As we speak, the stock is down more than 12%.
All right, thanks very much for that, Gaurav. IDBI Bank 14% lower. Manisha joins in on the other side with a sort of quick eye on what's happening in the commodity space coming up. Okay, welcome back. Let's shift focus to commodity markets. And Manisha is here with what's her focus on. Of course, it's got to be the underlying dynamics of this Iran war, which is into its third week. But Manisha, take it away.
Oh, well, exactly. Crude it is, because we've seen $106 a barrel in the early morning trades in Asia today. And as you said, it's a third week that we are getting in with the conflict still continuing in the Middle East there. And the U.S. strikes on military assets on Karg Island is something over the weekend that this is an area that actually sees export of nearly 90% of Iranian oil. While we do understand the hit only has been at the military bases and not oil facilities, but Iran does say that if there is any attack on the infrastructure, it would trigger a retaliatory attack strike on US-linked energy facilities there. And that's exactly what the markets seem to be reacting to. Having said that, the prices are slightly off highs on the reports that US could announce a coalition of countries to escort the ships through Strait of Hormuz. Apart from that, when you look at the overall inventories, we have seen slight gains onto that one as well. And there is oil loading operations in Middle East at Fujairah resumed. So a couple of reasons that you haven't seen crude prices surge beyond 106 there. There also is a statement from IEA suggesting that the 400 million barrels that have been agreed upon will be made available, especially into the Asian countries, with immediate effect. That also seems to be capping the prices at this point in time. But there are long-term implications that the markets believe that this could have on the global markets therein. And also, when you look at the supply that is expected to decline by nearly 8 million barrels per day from the Middle East, which is 8% of the global oil supplies. This is the highest ever disruption that we have seen in history when it comes to global markets therein. And I'll quickly take you through some of those really. The first one is 1973-74. That is when we saw the Arab oil embargo. At that point in time, the oil loss was 4.5 million. And we saw the crude oil prices gain up from nearly $2 to $11 a barrel therein. And then you had the 1978-79 Iran revolution. At that time, the production loss was 4.8 million, and that was 7% of global supply. And the crude prices had gained up by nearly 50%. The third instance that you saw prices gain quite strongly was during the Gulf crisis in 1990-91. The production loss at that time was 4.3 million, and you saw the crude oil prices gain to nearly $36. This was nearly from $17 a barrel. And then remember, it was those hurricanes Katrina and Rita that came in 2005. At that point in time, the production loss was 1.53 million barrels per day. The Russian invasion on Ukraine was in 2022. At that point in time, there wasn't a loss immediately, but the prices did gain 50%. And we saw the prices go all the way up to nearly $130 a barrel therein. What the street is looking at right now is that at around 8 million barrels per day of a loss is the highest ever that you have seen. The other thing that you're looking at with the crude oil price rise is the mining price that have continued to increase. So this is a data that has come in from Wood Mackenzie, which says that with every 10% rise in case of crude prices, the mining cost impact on iron ore is up by 4%, copper 3.5%, and gold at 2% as well. Now, when you look at the crude oil prices at $100 a barrel and assuming that it continues to average there, in that case, you could be looking at iron ore mining costs gaining up by 20% year-on-year basis, copper by 16%, and gold by 9% as well. So it's not just crude oil that we're looking at, but various agriculture, fertilizer, and mining costs as well going higher.
All right. Thank you very much, Manisha, for that, and something to continue to track. As you know, some of the guests earlier in that discussion told us as well. More later. We'll take a quick commercial break here. Latha speaks with Macquarie's Suresh Ganpati on the recent sharp sell-off that we've seen in banks, and led by private banks, mind you. Nifty Bank was down 7% in the last 5 trading sessions. What's worrying that space? Chat coming up with Suresh.
Welcome back. The Nifty Bank has been the clear underperformer since the Iran war began. As of close of trade on Friday, the Nifty was down 8% since the start of the war on Feb 27, while the Nifty Bank has been down 11.2%. Now, are there worries specific to the banking sector in terms of asset quality or growth due to the war? Have banks become bargain buys? For these and other questions, I am joined by Suresh Ganapathy, the Managing Director and BFSI expert from Macquarie Securities. Suresh, good morning. Thank you very much. But I'm going to start with a googly. Yes, I'm going to ask you all the banking NBFC insurance questions.
I'm prepared for that, Lata.
Okay, I'll tell you the googly is this. IDBI sale getting called off. I mean, see, in the last few months, Yes Bank, arguably a weaker bank, could raise 483 crores or something like that by the stake sale of other banks to SMBC and then some more with Carlyle. Likewise, RBL raised a fresh, 26,000 crore? Why is it that IDBI, which is arguably a stronger bank, for 12 years? The first interview I did with Jayant Sinha as Minister of State for Finance was, he proudly said that, you will watch IDBI divestment. Why is government not being able to sell when private sector is succeeding?
Yeah, see, you have to understand, Lata, that this is not a complete takeover or a merger, right? The government is trying to sell some stake and the LIC is trying to sell some stake, and the government still retains a majority control, or rather at least a significant control. So unless and until a complete control is handed over to the participating entity, clearly there is going to be a difference in valuation expectations, right? And at the end of the day, what we hear, of course, going by the news reports, was that the government had a reserve price and the bidding came below the reserve price, right? So clearly there has been a valuation mismatch, and unlike in other deals where very clearly there could be a bilateral negotiation which could have happened here, of course, through the bidding system, the government had an expectation of value, and more importantly, for anybody who is going to get into IDBI Bank, complete control is required. In the absence of that, clearly they would try to build in a discount, and therefore the merger has not happened, or rather the stake sale has not happened for ages, Lata, over the last, you're right, it's been going on for the last 12 years, but they have not been successful.
Yeah, but to be fair, RBL also gave away 60%. So, a whole chunk was given away.
Yeah, but
anyway,
then they got
I think
the
we
board
have
seat and all those stuff. Like Lata, you have to see the finer terms and conditions and the prints there for the kind of stake sale that the government is planning to do and the eventual control that was going on for these guys.
No, I take your point. The point I'm trying to make here really is that the government is perhaps not as clever as the private sector banks have been able to
I think the
be.
bigger question, Lata, you should be asking is they have budgeted 80,000 crores as divestment revenue for FY27. Much higher than the 35,000.
No, we are used to them not achieving divestment targets. And nowadays 30,000, 40,000 crores is hardly anything as percentage of GDP, given the way our GDP size is. But anyway, let me come to banking. Is there any fundamental justification for the way the banks have fallen? Is there something by way of worry? You're exposed to the ceramic industry in Gujarat. You're exposed to several MSMEs who are not getting packaging material. And so even unrelated companies. Should we worry that asset quality has bottomed and now we will start seeing prices?
No, so let's look at it in this way, right? For any investor who want to invest in India, they take a very macro call, right? An allocation which has to go towards India. Now, of course, let's assume a scenario where oil price remains at $150 and the Iran war continues for another 6 months. Of course, these are all hypothetical scenario. But in that circumstance, India has a far higher degree of problem with respect to inflation, current account deficit, and currency. Now, that all flows into a macro call, and then financials obviously get affected, in fact, directly. So if you look at what happened during December and Jan, just to set the context, when there is a massive amount of FI outflows, and at the same time, the rupee, of course, is depreciating, the RBI comes heavily to sell the dollars and buy the rupee and suck out the excess liquidity. Apparently, 70 to 80% of the OMOs which were being done were sucked out through the FX sterilization issue. And let's assume if indeed we are going that path, liquidity significantly tightens, and in the tight liquidity scenario, remember, financials never do well. So that is the macro view that the market at large was taking, and accordingly the financials were bearing the brunt of selling, apart from the ownership issue, which anyways they have, right? I mean, the FIs own what they sell, what they own, and they own financials to a large extent. Yeah.
Okay, so largely it's because they have what they own. At the moment, actually, RBI is trying to pump in as much money as possible.
Yes.
We are seeing banks saddled with cash and enjoying
Yeah.
it. But
Yeah.
you're not, okay, that apart. So banks are falling because FIs are selling. And what do they have most? They have all the HDFCs and the ICICIs.
Plus the
and that's why-
implications on the macro front, right? From a liquidity angle, which definitely is has more implications for the banking space.
Yeah, exactly. So that's what I'm coming to. Are you rewriting, or will you expect to recalculate any of the numbers for any of the banks or for the sector as a whole, as
Yeah,
in more bad loan worries or more mark-to-market losses, anything?
Yeah. Look at it in this way, right, Lata? I mean, if you look at the broader drivers of P&L for the banking system and eventually boil down to the ROE, right? Because your book value will always compound at the ROE level. And so today, for example, our expectations on an average, even for SBI for that matter, and even for the private sector banks, is around 15% plus minus 1% here or there, right? Usually we have wild gyrations in ROE only when you have got an extreme credit quality cycle. Let the margins going up 10-15 basis points, or loan growth instead of being at 13% goes down to 11%, doesn't move the ROE in a big way. In the current environment, we can be reasonably confident that the asset quality parameters are expected to remain reasonably strong for the overall financial system. Right. And if that is the base case assumption that we are working with it, slight movement in growth or margins is not going to move the needle in a big way. And the valuations are more than adequately factoring in. And my way of looking at it is that whether it is COVID, whether it is GFC, I mean, predicting a doomsday scenario, at the end of the day, these are all fantastic opportunities for investors to enter into some of these high quality private sector banks are trading at 1.3, 1.4 times price to book on an FY28 basis, Lata, with a reasonable 14% ROE. And I don't see a major risk to that ROE is how I'm looking at the fundamental picture.
Yeah, actually, I'm running your ROE and your price to book chart, which you put out today. So very much, I mean, that's my question, therefore. What should one buy? Should one buy private or public first?
Yeah. So look, I think let's try to construct this entire argument in this way, right? The PSUs have, of course, outperformed over the course of last 12 to 18 months massively over the private sector banks. Today, the gap between the PSUs and the private sector banks are at the lowest ever, and the PSUs are at the highest ever when it comes to their fundamental parameters, which I judge in the form of an ROA at 1.1, 1.2%. From here, obviously, the ROA can go in one direction, which is down and not up, right? Because you have to understand that there is a structural cap of 1.1, 1.2% ROA at which the PSUs operate. Tough to extend it beyond that. Whereas if you look at the private sector banks, the ROAs are still pretty healthy. They've not come down much. And the valuation gap with PSUs have narrowed to an extent that today, if you look at the valuation, an SBI is at 1.2 time price to book, and Axis, Kotak and HDFC Bank are anywhere between 1.3 to 1.5. I mean, come on, Lata. I mean, it's very clear that at these kind of actually virtually zero valuation gap, I'm buying a private sector bank over a PSU at this point in time.
Okay. Well, yes, but perhaps something is structurally changed also for PSU banks. There are some people who argue that way. But let me come to the other sector, NBFCs.
Yeah.
Is that a buy? Even that's fallen, but is that a buy or an avoid? Because market rates are rising.
Yes, that's right. So we do believe that we are done with the rate cut cycle. All that, we don't know when maybe the RBI starts hiking rates, which is positive from a bank margin perspective and negative for NBFCs from their margin and cost of funds perspective. Let's also admit the fact that, Lata, gone are those days where these NBFCs used to grow at 25 to 30%. I mean, the reality of the matter here is growth now has structurally come down to a level of 20%, either because of size, because of market opportunity, or because of the market circumstances itself, right? Today, a customer in India is far more over leveraged than what he was 5 years ago. So you can't keep growing at 30%. So growth rates have come down quite significantly for the NBFC space. So have been the valuations to some extent, and we're looking at the turn of the rate cycle. In that environment, very clearly, our preference is more towards the private sector banks or NBFCs, and all said and done, look, they offer a greater degree of value and risk reward at this point in time compared to the NBFCs, where the good quality NBFCs are still trading at premium valuations, I would say.
Okay. Okay, time permitting, I'll come back to which NBFC, but a word on insurance.
Yeah.
We had all those strict rules from Reserve Bank.
Yes.
Selling could be mis-selling is going to be penalized. So where do those stocks have also fallen?
Correct.
Insurance stocks and the let's pull up 1 month of insurance stocks as well.
Yes.
Any buys there?
Yeah, so they have also done pretty badly in this fall. Of course, they have also corrected quite sharply. I think there are two things here with respect to the insurance. One is on the regulatory front, where obviously the RBI has come up with the mis-selling guidelines, which is bound to have some recalibration for the insurance companies. And on top of that, there are obviously talks about the IRDA looking at the commission caps and guidelines, right? So we'll have to see how that shapes up. So there is some near-term, let me put it this way, headwinds for the sector. But I think where the valuations are, we are completely ignoring the positives. So let's look at the couple of positives which are there for the space. First, the regulators is going to implement the IFRS as well as the RBS norms. The RBS norms, risk-based solvency norms, can easily push up the solvency margin by significant 50, 100% kind of a number. So it's a pretty large uptick that we are looking at it. So that gives more leeway for these guys to do more protection business. And if you look at the latest numbers of Jan and Feb, Lata, the sum assured numbers are still growing at 25 to 30%. Despite the correction post the GST, the numbers are very strong, which implies that the protection business is still strong. If at all they can continue the momentum of protection heading into FY27, then we are looking at margin upsides for the insurance space. So even people are trying to overlook some of these positives which are coming in the light of the recent negatives. But these valuations, again, insurance comes out to be a pretty attractive space, I would say. So my priorities, private sector banks or life insurance over NBFCs, fintech somewhere in between. Yeah.
Well, I have one more question on PhonePe very quickly. But before that, what is your hierarchy of, if you can name the banks, do mid-cap private banks come in the picture? What's your hierarchy across BFSI?
Now, the large ones itself are trading, Lata, at extremely compelling valuations. I don't think you should go down to mid-cap level at all. I mean, I'm saying Axis is at 1.3, Kotak is at 1.4, 1.5, HDFC at 1.5. I mean, all these banks are the private sector bank. I do like SBI, to be honest. But having said that, these large private sector banks are the ones which you need to be in very clearly at this point in time.
Okay. PhonePe, I saw your report. I don't know when their issue will come going by the state of the market now, but is that a great stock to set aside money for? What happens to the competition that's listed, Paytm?
Yeah. Look, I won't be commenting on the valuations and the fair pricing out there, but one has to understand that the bigger money obviously has to be made on the merchant side, right? That's where, so while of course PhonePe has a great market share on the UPI space, we still need to see how well they are going to monetize the consumer space, because that's where the margins are low and it's a bit difficult space for one to monetize. This one important point which I thought I should mention for the benefit of your viewers is that a lot of these fintechs, and I'm not referring specific to PhonePe here, had a great model in trying to cross-sell a lot of these financial or loan products to the consumer ecosystem. Unfortunately, what has happened over the last 3 years is the consumers have become over-leveraged, defaults have happened, and therefore the kind of personal loans opportunity that you did see in that consumer ecosystem is no longer there. While people can argue what is the total time, my way of looking at it is that market today, with the kind of over-leveraging that we have seen in the consumer space, is a far more difficult market to monetize compared to what it was 3-4 years ago.
No, I take your point entirely. Overall credit growth itself will ultimately converge towards nominal GDP. And maybe ours is doing in a bit of a hurry. Maybe that's what is the middle income trap. I do not know. But this over leverage is an issue that's going to bedevil NBFCs and, as you say, fintechs as well. That discussion for a later day. Suresh, it was a pleasure having you with us. Thank you very much for giving us a many-sided view of the BFSI space. Markets in a spot of bother. Mid-caps in particular, we thought today we saw some green on the, the gift nifty, but that got evaporated very, very quickly. Wrap up on Bazaar. Chartbusters will take the action forward.
The IPOBs bank divestment hits a roadblock. Financial bids received for the stake sale come below the reserve price. Sources say the centre is likely scrapped the strategic sale. The stock down 15%.
HSBC downgrades oil marketing companies, cuts the earnings estimates and valuation multiples, says higher crude prices have triggered sharp reductions in earnings. HPCL, BPCL, IOC and ONGC downbeat in early trade.
Shares of VA Tech Babak jump after the company secured a major contract from the Chennai Metropolitan Water Supply Works worth around 1,000 crores. The order book of the company over 16,300 crores. The stock minorly off highs.
Small counter Bagel project skyrockets. The company secures over a 700 crore mega order from Maharashtra State Electricity Transmission Company. Project is expected to be executed in the next 23 months. Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and things no different this morning. The market's selling off from the day's high. We're down close to around 80 to around 90 points or thereabouts. Hey, Mangalam.
Hi, Nigel. You know, all of last week, you had a similar pattern when either the market opened flattish and then sold off, opened with a small cut and then sold off, or opened with a mild gain and then sold off. Today, opened with a gain, stayed in the green for a bit and then has sold off quite strongly. In fact, right now, as we speak, the mid-cap index down about 700 points, 1.3%. And the decline in the front line end is led by the Nifty Bank, which is lower by about 200 points. We've seen some correction even in the IT pack, and at the same time pull up the intraday chart of Reliance. So all these factors, taking the market lower right now. The only question that everyone's asking is where does it stop? Let's bring in Shivangi Sada of Motilal Oswal Financial Services for a quick technical check on the market. Shivangi, it's been a brutal last few days for the bulls. What technically are important levels to track now, as we've broken more important ones in the last 4 or 5 trading sessions already?
Very good morning. Of course, we've seen that the indices have slipped by more than around 1,500 points or so in the last couple of weeks. We've seen that the selling pressure is continuing, and of course, India VIX is at a heightened level. So unless India VIX cools off below 15 levels, we would see this kind of pressure sustaining. We've seen that 22 is a kind of a panic level out here. If you talk about the levels, Nifty is expected, to continue the selling pressure, and we could look at the downside support of 22,700, 22,500 till the time global concerns settle off. And on the upside, somewhat hurdles are seen at 23,500, where call writers are seen making, their positions out there. Now, talking about Nifty Bank, we've seen this had been one of the strongest pillars, but this has also given up the gains of the last 3 to 4 odd months, and we've seen an important 50 exponential moving average being broken on the larger time frame, which is a cause of concern. So a little bit of selling pressure would be seen over here as well. 52,750 is the next support that we're looking at for Bank Nifty, and some sort of hurdle can be seen at around about 54,500 levels.
Okay, all right. Shivangi, just one quick point on the VIX. As you said, till it cools up drastically, only then will you get a little bit constructive on the Nifty. But today, it's a bit of a rarity, right? Because the Nifty is down 100, 110 points, and the VIX as well is cooling off. Sometimes in the past, this has signaled a near-term consolidation pattern or sometimes a bit of a bounce. Any comment on that? And if you want to give us your stock calls as well?
Absolutely, Nigel. We've seen that the markets have already discounted in a lot of, the weakness that we've seen in the last 1 week. And previous week itself, India VIX was seen heightened to 24.5 odd levels. Now, of course, we are at a still higher level. But then again, somewhere people have already discounted in the global pressure that is impacting us. And we as a market have kind of stayed strong in the banking front, but overall the other sectors have underperformed in the previous financial year as well. So we are heading into a bit of a weakness, but then again, some bit of support-based buying would also be seen, which is why India VIX is right now at a stable level. But we could see some bit of pressure which will sustain in the market. Now, stock-specific action in this kind of a market, Metals have shown strength and they are holding up despite the volatility and weakness. So my first preferred pick would be Hindalco, which is holding on to the weekly, upward sloping channel. And I'm recommending a buy here. Now, the next targets that we're looking at for Hindalco is 960 levels with a support of 905 zones. Now, the second pick is Glenmark. Pharma space tends to, kind of hold strength, but Glenmark is also kind of consolidating. We would recommend a retracement level by over here, and we are seeing support levels being supported. So 2270 is what we're looking at for Glenmark and a support of 2130 levels.
All right, take that point. So you have a couple of buys out here. Shivangi, just, a lot of stocks making the lows of trade right now. Bandhan Bank is one, down about 6.5%, and most of the cuts have come by in just the last 20 minutes or so. Jindal Stainless is the other one. Biocon, Oberoi Realty. In fact, the entire Realty pack comes up for you. Oberoi, DLF and all of them. They're not doing particularly well. But a big spike has come on ITI. That's the one which is buzzing around right now, up 12%, with a fair amount of volumes backing that counter as well. So ITI is the one which is up nearly 12%. So in a market like this, what's the idea for profit? Let's go across to our colleagues from Money Control Pro. Neha Dave joins in with a stock that she's been tracking. Neha.
In today's risk-off environment, we are going to talk about HDFC Bank. HDFC Bank's stock has taken a beating due to broader sell-off in the equity markets following the outbreak of the war in the Middle East. Consequently, in terms of valuation, the bank is trading at around 1.7 times core book value estimated for FY27 after adjusting the valuation of subsidiaries. The valuation is attractive given that return on asset of the bank is around 1.9% and return on equity of around mid-double digits. While the geopolitical risk can be a speed breaker in the near term, it is unlikely to derail the bank's journey upward in the long term. The street continues to focus on the two key variables for the bank, and that is loan growth and net interest margin, both of which were under pressure since the merger. However, both these variables have showed improvement since the last reported quarter and can improve further going into FY27. The bank's loan growth has accelerated to 12% as of December end, marking a clear recovery from a single-digit loan growth witnessed since the merger. Management reiterated its guidance of meeting the industry loan growth in FY26 and surpassing the industry loan growth in FY27. HDFC Bank trades at a discount to ICICI Bank in terms of valuation. Going by management's guidance and improving earnings outlook, the valuation gap with ICICI Bank can narrow going forward. Long-term investors should keep this stock on their radar.
All right, Neha, thanks a lot for that. Time to slip in a short break. You come back. We'll continue to focus on markets and stocks that are moving around. Stay tuned.
Welcome back. You're watching us here on Chartbusters, still lower for the market. So let's get in oil marketing companies, why they're under pressure. Sudarshan's been talking about the bearish note that is coming from HSBC. He joins us once again to detail that one. Sud.
So all three names are under pressure today, down somewhere in the range of 3 to 4%. They have extended Friday's losses. So two news flow. First, HSBC has downgraded all the three names. And second, over the weekend, Election Commission has announced election dates for some of the states. And Model Code of Conduct is coming into effect. And because of that, there is unlikely these companies will be taking any price increase. Now talking about the note of HSBC, it has downgraded all the OMCs to hold and saying that there's a sharp cut in earnings and the multiples, mainly because of the sharp increase in the crude price that we have seen over the last few days. Brent is now firmly about $100 per barrel. If you compare against the average of last month Brent was hovering around $65 to $66 per barrel. Now from that level, there's a sharp increase. And because of that, there is going to be a major cut in earnings and the multiples. And HSBC also believes that even if there is a recovery in crude and Brent comes back to $75 per BBL, then also there will be a loss on the marketing front as far as these OMCs are concerned. So for IOC, downgrade to hold, target price is cut to 150 from 200. For HSPL, target price is cut to 360 from 620. And for BPCL, target price is cut to 340 from the earlier target of 670 rupees.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Gaurav, who's here to tell us about IDBI Bank. The stock is reeling under pressure. This after sources suggest that the lender's long-awaited divestment plan has been scrapped. Gaurav, run us through that piece.
Well, as IDBI Bank, we can actually call it as an accident of the day, because the reason being, if you look at the stock price, stock is down almost more than 10%. And that is because if you look at the divestment plan, it has always been at the forefront of the divestment plan of Government of India. There were talks about the divestment for the last few years, but even in this year, as government was expecting it to conclude, it seems that it is not going to happen. And the reason being that, as per sources, the bids that they have received were below the reserve price, and that's the reason why even in FY26 we will not see IDBI Bank's divestment. Remember, if you look at the performance and the structure that IDBI Bank currently has, Government of India and LIC together holds more than 90% stake, and they were going to offload around 60% stake at a valuation of more than 30,000 crores for the bank. Now, there were two names which were coming up as a prominent contenders. One was Fairfax and second is Emirates NBD. If you look at the history as well, Emirates NBD recently acquired RBL Bank, and at the same time, if you look at Fairfax as well, they own a bank which is CSB Bank in India. Now, given that the bids were below the reserve price, as sources suggest, this divestment plan is not going to happen, and that is something which is hurting the investors. Even if you look at the stock performance, now there could be multiple reasons. War was one of them, but even in the last 1 month, considering today's fall, the bank's performance, if you look at it, the stock is down more than 30%, but on a 1 year time frame, the stock is still up 6%. And at the same time, even if you look at the valuation, despite this fall, the stock still trades at around 1.5 times current price to book. So that is also something which is a key thing to consider. But for now, we are not seeing investors are happy. And as we speak, the stock is down more than 15%.
Take that point, Gaurav. Thanks a lot for that. So that's about IDBI Bank now 16% lower and volumes piling up. In fact, this month itself, the stock is down 31%. Meanwhile, you have Varun Beverages that is holding mildly in the green in today's trading session. If you look at this month, the stock is down about 10% in this month and down about 28% from its 52-week high. Typically, it's counterintuitive. Why is that? Because, ahead of summer, you expect a company that makes summer products to actually bounce back on the bourses, but that wasn't the case this time around. And it is this correction in recent times that brokerages have taken note of. BofA has written that with good earnings potential, which is growth in teens, even before the inorganic acquisitions that the company has done, the stock valuation is below its history and peers as well. Risk reward, as per them, post this correction seems favorable, which is why they have a buy rating and a 550 rupee target price. They're saying the company is strengthening its portfolio to effectively meet peak India summer demand and navigate competitive intensity. Overseas business is steady and long-term gains on new forays like snacks, beer in Kenya is possible, and as a result of which there is fair amount of optionality out here. That explains why the stock, after seeing a big correction, is higher in today's trading session. With that, we take a short break, come back, get you more on the markets and a lot of stock-specific action.
day is a long time in politics. But I always feel that a decade is a remarkably short time in business.
I think the rupee will also bounce back in a more gradual fashion, possibly, once the war is over.
Thanks to a number of FTAs you've created, we aim to take full advantage of that and have our products go to many parts of the world. We believe we have world-class products today.
There's no need to panic as India has robust forex reserves. That's the word that's coming in from Piyush Goyal, the Commerce Minister, on the LPG crisis from the sidelines of the CNBC TV 18 21st edition of Indian Business Leader Awards. Let's listen in to what he had to say.
We are looking at various sources of alternate sources which will feed the requirements of India. What we have only done is to increase the time between two cylinders that a person can take. And of course, there's been a short term, it's more a supply demand time issue. It's not an issue of finally the availability as much as the timing to be able to give enough shipping time for these gas sources to reach India. And therefore, I see no reason to panic. I wish people would understand that we are in a war situation. They should not hoard gas cylinders. India stands by the trade agreement with the US. All GM products will not be allowed entry into India, which means almost 90 or 95% of American major crops are just not allowed entry into India.
Right.
So whether it's corn, whether it's soy meal, whether it's rice, wheat, millets, some of the pulses, many items which we are self-sufficient in, there's no market access that we have given. We are able to get free trade agreements with the European Union, 27 nations, with the United States of America, with the United Kingdom, with the 4-nation EFTA bloc, with Australia, with New Zealand, all of these without opening our dairy. None of these countries has ever done a free trade agreement which did not have market access in dairy.
Right, important commentary coming in from Piyush Goyal. Before we move on to some more interesting snippets from the India Business Leader Awards, just do not lose sight of the market. The Nifty is below that 23,000 mark, led lower by the Nifty Bank now. And this despite some outperformance coming in from HDFC Bank. The Nifty has actually broken that 23,000 mark for the first time in almost a year. Our ticker team tells us April 11th, 2025 was when the Nifty was last below that 23,000 mark. So do not lose sight of the market right now. The market breadth has turned worse with 2,500 stocks in the red for about 400 stocks in the green right now. So that's about the market at this point in time. We opened mildly in the green, and from there has been a fair amount of a sell-off. But let's go across to some more conversations coming in. The brains behind Persistent System founder and CMD Anand Deshpande was awarded the IBLA Lifetime Achievement Award. Rima caught up with him on the sidelines and began by asking him about the Indian IT industry and artificial intelligence. Take a look.
See, I think we have to demonstrate it at the moment, but definitely there are lots of opportunities because of AI. And the Indian IT industry has been supporting mainly the enterprises across the world. And if you look at AI for enterprises, I think there is a lot of work that still needs to be done. Many of the technologies that have been designed specifically for consumer markets, and they are absolutely brilliant. And some of those will evolve into the enterprise. And I think that's where the opportunities for the Indian IT sector will be visible. And I think it's still early days. So I think you must wait and watch to see how the IT industry kind of demonstrates that it is capable of handling these challenges.
Okay. Now, you've seen multiple cycles in the past. How different is the AI cycle versus what we've seen in the past? And tell us the positives and negatives in terms of how Indian IT is impacted.
So one, of course, is that we are at a very large scale right now. So the previous challenges that happened, whether it was the Y2K, which was in our context a dot-com burst, or the global financial crisis, the industry was much smaller. The good news right now is that this is an upmarket challenge. In the global financial services and other sectors, we had a down market. So the market was slow, and that's why we were hurt. Right now, the market is very buoyant. So overall, the opportunities to build new stuff is amazing and quite a big opportunity. If you think about AI is going to make many kinds of problems solvable today, which were not solvable in the past. So I think it's a different market, different opportunity, different sets of sizes of challenges, but I think it should be a good fun ride in the next few years.
All right, on that note, though, we'll wrap up on this edition of Chartbusters. And as you can see to the top of the screen, it's a sea of red. Trading Hour comes up next, and we'll take all the market action forward. Stay tuned.
Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Manglam Malu. With me, as always, Horma Svetakia, as well as Ritu Singh joining in. This morning, it's an ocean of red as we speak on the front line indices. The Nifty was actually, below that 23,000 mark just moments ago. Has managed to hold on to and recover above that level. But it's an important mark to track because the last time we did that was in April 2025. So near one-year low for the frontline index, led lower by the Nifty Bank as well as the mid-cap index, which is down almost 1.5%. No respite. All of last 2 weeks, we've seen a correction of over 1,500 points, and this morning as well. That continues, Ritu.
That continues, Manglam. Good morning. It was down 5% for the Nifty, 7% for the Bank Nifty last week. And again, you're seeing the pressure continue in trade today. The Bank Nifty, as we speak, is down by almost 0.7%. About 380 points cut is what it's trading at. The advanced decline ratio has about 5 stocks that are declining for every 1 stock that is trying to advance. But that said, there are some individual names that are gaining in trade. You have the likes of ITI, MRPL, Aditya Birla Sun Life that are all up and about, Tejas Networks, Jindal Saw. While there are individual names like IDBI Bank, for instance, that are also some of the big accidents of the day on the back of news that has come in. So let's go across to Hormaz, who's standing by with the top movers in trade.
To tell you how bad the sentiments are in the market right now, when the GIFT Nifty first began to trade this morning, the implied open was suggesting a 180-point gap up. And now the index has come off significantly from the highs of the day, as has the Nifty Bank, and it is the index heavyweights that are leading that fall. Now, of course, when it comes to specific stocks, it has been the downgrade that HSBC has come up with on these oil marketing companies, both HPCL, BPCL, IOC, all of them trading with losses in today's session, losses of anywhere between 4.5% to 5% now for all of these names. Of course, the state election result, the dates being announced also having an impact on these names. Now, the impact of the rising bond yields was impacting PSU banks. It continues to do so. The PSU bank index is now down for the 4th day running. It is down 14% in the month of March, which is turning out to be the worst month that the index has had since September of 2020. And most of these names are at 52-week lows, barring Bank of Maharashtra. But mind you, the other 3 names are stocks with a very little free float in the market. Ritu highlighted Tejas Networks, but there are other names as well that are bucking the trend in with regards to order wins. Tejas Networks has won an order this morning. Bajel Projects had won a 700 crore order. The stock was up 10% at one point, still holding on to those gains. And CMEC as well, a 400 crore order from ONGC. The accident of the day undoubtedly is IDBI Bank, 16% lower now on the stock, and that continues to grind lower. And these railway names at one point which were rebounding in the month of January are now back to 52-week lows. Titagarh is one of them, is down 4. Ircon, Rights, RVNL, all of them at 52-week lows. In fact, RVNL's record high is close to 650. It is now nearing levels of 250. And some of the big movers from last week, LTTS was one name that bucked the trend on Friday, was up 10% odd. Happiest Minds, after raising its growth guidance, also did well last week. Both of these stocks now seeing profit booking in today's session. LTTS down 5, Happiest Minds down 6%.
Right, we take that point. Thanks a lot for that, Hormaz. A lot of these stocks lower, but seems like the market's trying to make some sort of recovery right now, and that recovery has been led by a couple of these index heavies. So pull up something like an HDFC Bank, which is about 1% off lows, a fair weight on the Nifty Bank, and that's the one supporting the frontline index, both the Nifty Bank as well as Nifty. And the other one is, Interglobe Aviation. Remember, all news is against or stacked against Interglobe Aviation. The stock has seen a major correction as well. But from today's low, the stock has seen a formidable recovery, about 3% from the lows today. Right now, sitting with a gain of almost 1.5%. And as a result of which, the Nifty now swiftly 100 points off lows. Today's low close to 22,945, 955 to be precise. Right now, we are at 2350. So in just the last 15 minutes or so, after breaking below that 23,000 mark, the Nifty has recovered 100 points from the lows swiftly. But one stock under pressure is L&T, as brokerages raise a concern about West Asia orders in light of the ongoing war. Vivek, the stock's down 19% already, but is there more to go?
Well, now it depends on which side of the street or which sell-side analyst firm you choose to go ahead and listen to, given the fact that, like you mentioned, 19% from the recent peak, 7% lower on Friday, and a lot of news flow too over the weekend. So first up, let's have a bull case. If you're looking at CLSA, what is it that they're saying? They're saying that L&T is #1 customer in West Asia. Saudi Aramco has actually gone ahead and guided for a flat capex in 2026. Now, this is on a very high base, so it's good news as far as L&T is concerned, given the fact that there could have been a few capex cuts, especially when it comes to the oncoming year. Also, they say post the recent correction in the stock, it's an added opportunity to accumulate a key India as well as a global energy capex cycle play. Now, on the other hand, Axis Capital actually has gone ahead and done a scenario analysis. What is it that they're saying? They're saying that the recent stock fall is in the backdrop of the ongoing US, Israel and Iran conflict. They're saying West Asia execution, at least in Q4, will be impacted by disruption to movement of men, material as well as construction equipment. Now, what they're saying is that they expect time as well as cost overruns for existing contracts in the backlog, and they say that the situation can potentially defer awards as far as new West Asia awards contracts is concerned. Now, what they're saying is Q4 FY26, they expect a 1,200 crore hit to the EBITDA, close to 7% of the FY26 estimated EBITDA. Now, they say in case the war or the conflict does drag on, they see a further potential for an 18% downside from the current level. So that is something that we need to keep an eye out for. On the other hand, again, if you're looking at Nuvama says that as per their bear case, most of the concerns are priced in. In fact, they say with just a 10% lower, bear case possibility as far as the stock price is concerned, they believe risk reward is quite favorable at current levels.
Vivek, thank you for summarizing that for us. L&T, one of the worst performers since the war in West Asia has begun. And as Mangalam was just highlighting a couple of minutes ago, Interglobe Aviation doing well for itself today, bucking the trend in what has been an otherwise an extremely choppy market. And that's because the airline has now introduced a fuel surcharge for domestic and for overseas flight travel to offset the soaring fuel costs driven by these issues in West Asia. Winnie is here with more details on this. Winnie.
Hi, yes, Orma. So what has actually happened today is they've introduced this fuel charge, additional fuel charge that they'll be taking and charging on flights. For domestic flights, what's this charge come in? It is at around 425 rupees, while for international routes, it could cost as much as 2,300 rupees additional fuel charges as well. Now, do not forget, for airline companies, 40% approximately of their cost is fuel charges, and we've seen a sharp increase that's going on in terms of the crude prices, and fuel cost in turn has also increased. Overall, mainly the fuel surcharge that I've seen is 85% surcharge in terms of fuel prices because of this ongoing geopolitical tension. So maybe at least a part of it is going to be offset. They've taken an increase over here in terms of this fuel surcharge. So that is something that could support the profitability of the company, not a sharper cut that one could expect to see now. Citi, they have also come out with a brokerage note. They're maintaining a buy rating. Target price is 5,100 rupees per share. What they're saying is that this is a blanket rule that's come in across sectors, this surcharge. So overall impact on yield could be fairly lower. And obviously, do not forget, there have been a lot of cutbacks in terms of the aircrafts that they've taken or the routes that have been cancelled also since the disruption has started. So it will be key to watch out for, but at least some bit of a relief or some small portion of a relief because of this fuel surcharge.
All right, Winnie, thanks very much for bringing us that update. We'll slip into a short break, but up next, we'll focus on the bond market with Manisha Gupta in just a bit.
Welcome back. It's a solid recovery from the lows that we're seeing. The Nifty now 23,070, which is a good 85 points from the lows that we hit just moments ago. And a large part of that, in fact, nearly all of that could be attributed to HDFC Bank, which is now about 1.2% higher. The other couple of index heavies that are doing well, Maruti has recovered from the lows, and we are seeing some traction on Bajaj Finance as well. So HDFC Bank up 20 points in terms of a positive contribution. Ultratech Cement up around 11 points as a contribution. Hindalco, Grasim, all of them are doing their bit for the frontline index. The India VIX has come down, so that's a positive as well. You would have expected the India VIX to, a spike given the sort of volatility that we've seen in the first hour itself. But the fact that it's moderated is not particularly bad news. And even if you look at the advance decline ratio, right now, while we have almost 1/5 the number of stocks, advancing as against the number of stocks which are declining, those lines will tell you the story of the day as we move around. But just for today, seems like maybe the market's put behind itself a narrow range, which is today's high. It's a little closer to that 23,300 mark, and today's low would be a little under that 22,950 as well. If you look at the options which are active, 23,000 put and the 23,100 call, both of them come up for you on the screen. 23,000 put has a premium of almost 150 rupees. Again, telling you between 22,850 to 22,900 is strong support. 1 crore shares written out there, and remember, these are ones that expire tomorrow. And the 23,100 call, that's the one that should come up for you as well. That's seen a fair amount of writing as well. So every move around the 23,150, 23,200 mark may see some bit of, a sell-off is what the street is actually positioned for. The put-call ratio is at 0.74, so not necessarily oversold, but closer to the oversold zone. And a lot of these stocks are seeing a lot of long build-ups coming by, and one of them definitely is Hindalco. A lot of long positions being added on that stock. So let's see how that goes. As of now, there is consolidation, the range between 22,850 to around 23,200 thereabouts. With that, we'll shift focus from the equity markets, the derivative markets in specific to the bond markets. Manisha Gupta joins in. Manisha.
Well, thank you for that. I'll start with the overall price itself, and we have seen some decline continuing when it comes to the bond prices for the Indian markets therein. Well, Iran war entering its third week is something that's weighing on to the market, and then a major impact also seems to be coming in from the crude oil prices, where we are holding above $100 a barrel, and that seems to be stoking inflation concerns there. Crude, remember, has gained up by 40% since the time that this war engulfed from Feb 28th. So it has been a very strong, sharp surge coming for crude prices, impacting various other asset classes there. The markets also seem to be reacting to the India inflation numbers. For the month of Feb, it is at 3.21%, vis-a-vis 2.7% for the month of January. In the meanwhile, you already have, and we've been talking about this as well, with RBI continues to buying bonds in the secondary markets, conducting OMOs as well. This is being done to pump liquidity into the markets there. Take a look at the Indian rupee should be coming in on your screens, because we're looking at off-record numbers coming in for this one, but still trailing above that 92.4 kind of levels therein. If you look at the India's forex reserves, well, they have declined to 716 billion vis-a-vis 728 billion in the previous week itself. The RBI on Friday also did said that 21 states will raise nearly 584 billion rupees. The sale of bonds, this will happen on Tuesday therein. Interestingly, you have Union Bank as well coming into the markets, issuing green bonds. This is worth nearly 50 billion in one or more tranches. But Union Bank also is looking to raise long-term bonds as well. This is worth 200 billion. Union Bank is issuing long-term bonds for infrastructure and affordable housing there. And finally, this is an important week. You have one inflation data coming in from US that would impact money markets across world. But you also have monetary policy meeting, not just in US, but various countries like Switzerland, Japan, UK, Europe, Canada, Brazil, Russia, etc. So it's going to be a busy week, and you'll be hearing one meeting to other through the days therein, and that would see an impact as well.
All right, Manisha, thanks very much for joining in with that. We'll slip into another short break, but when we return, we're going to discuss market technicals with Somil Mehta from Mirae Asset Sharekhan, and also discuss his top trading bets.
Well, we told you it's a volatile market, and as we speak, the Nifty is back in the green. The Nifty is up by 15 points versus yesterday's close, which means that it's actually higher by over 200 points from today's low, and it's cruising towards that 23,200 mark right now as we speak. The day's high today is 23,284, so that's still a distance away. But in just the last 20 minutes or so, in fact, even not 20 minutes, the Nifty has seen a big recovery of almost 200 points, and a large part of that, while can be attributed to HDFC Bank, look at some of these metal names as well. JSW Steel has moved higher. Hindalco has done well. Ultratech Cement is the second best contributor to the Nifty in terms of point gains, sitting with a gain of 3.5% on that one. M&M isn't doing too bad as well. M&M has moved higher. That stock has moved to the high point of today's trading session. But the consumption stocks, let's talk about all of them. Manoj Menon, who's the head of research consumer analyst at ICICI Securities, as always, joins us in our studio. Thank you, Manoj. Every time we speak to you, it's some or the other pivotal moment in the consumption space. This one comes after a very long spate of underperformance for the space. You can call it time correction, maybe multiple correction as well. And you've written a report that the consumer sector overvaluation versus last March, which was at 15%, has now come down to about 12%. Look below that, staples are still overvalued, 18% versus 17% if you take out ITC. Discretionary is where the overvaluation has come down from 54% to 50%. So the obvious question here now is that when everyone's questioning valuations in India and, in context of the growth, do you think the consumption sector, staples in particular, is in for a structural derating?
I think thanks, Mangalam, for having me today. So look, I think if you look at the last 5 years particularly, right, a lot of the stocks really has not delivered any absolute returns.
Exactly.
Right? Now, one way to look at it is say that some time correction has happened, multiple corrections happened, but the reality is that even earnings has not caught up.
Exactly.
Right? Now, variety of reasons for it, right? It has been an urban slowdown. It has been, let's say, disruption, from D2C players, etc. There are multiple reasons you can attribute. The fact of the matter is there are certain parts of the FMCG companies or portfolios, right, are going through a phase of one, demand headwinds, and point number two, losing, let's say, consumers and niches to newer players, etc. Right, and also don't forget the bottom of the pyramid, let's say in a detergents, etc. A lot of active players out there. The fact of the matter today is that you actually have got two baskets of companies, right? There are companies like, let's say, a Godrej Consumer or a Marico or a Tata Consumer, which has got a strong core and have got a very, very strong inorganic, let's say, activity out there. And a bunch of other names, without naming them, right, probably doesn't have either of it, right? I mean, so in that context, I think, FMCG particularly, which has been a bottom-up story for a very long period of time, will remain that way. What I mean to say is that there will be haves and there will be have-nots. So you got to it's about picking which winner rather than having a broad brush thought process here.
So which are the haves and the have-nots then?
Just kind of name them, right? Kind of, So Marico happens to be one. Godrej is another one. Tata Consumer is another one, right? Only exception, if I may, of a company which doesn't really have an inorganic thesis and still performing well is Nestle. Right? Okay. Of course, there is also an element in Nestle of urban consumption probably making a comeback. Second, also, Nestle happens to have in the listed space, a lot of categories which are impulse-linked, right, or discretionary within consumer staples, right? So to that extent, the GST cut, etc., seems to be helping demand recovery for a certain Nestle categories like a coffee or a chocolate or a Maggi, etc.
But the broader question on multiples, what are your thoughts here? Because do you think that, the street needs to relook at these multiples once again and maybe trade at 15, 20, some even 30% lower multiples versus what they've historically traded at?
That's a very good question. Honestly, quite scary as well for the investors, right? So you are essentially reminding investors of what happened to HUL and the Colgate. HLL in those days, between 2000 and 2010, right? For 10 years, these stocks did nothing from an absolute return point of view, except for dividend yield, what you got, right? Look, I think that scenario is quite pertinent to discuss today, right? Maybe cyclically there is a recovery there.
And we're halfway there already, 5 years of no returns.
I agree with you, actually, right? And on that context, I completely agree with you. The only context to remember is that we are at a stage in which we had early signs of a demand recovery in the last, let's say, 3-6 months, etc. Right? Now, we need to see how much of, let's say, this input inflation, if it persists and if it gets passed on, how much of this recovery is fragile versus how much is right. So in my view is that I think it's a fragile recovery, right? But that said, also remember that 12 months, 18 months hence, there is a pay commission, bounty also coming, right? Maybe not for staples, but generally from a consumption point of view, right? And the government is also fairly aware of the challenges, etc. That's where the GST cut happened, which is also a boost for consumption, right? So I think we are in a stage, let me summarize here, right? Saying that, look, I think longer term risks to multiple exists. right? That's a reality, right? But I think if you're able to pick those outperformers, winners, etc., I think FMCG is still a space to make money.
All right. Ritu has a question.
Manoj, hi. Broadly, if you look at what's happening with the crude prices and the kind of jump they've seen, and the derivatives of these crudes, including in packaging, could cost, I was reading, as much as 10 to 15% for some of these FMCG companies. So if they have to absorb these hikes, what kind of impact could we see on margins? And if they do take on some of these price hikes, this very fragile recovery that you were talking about on the demand front, following the GST rate cuts, could that get impacted, especially in the rural areas? Because we're also starting to see inflation inch up slightly from the multi-quarter lows we'd seen, in November, December.
Thanks, actually. So 3 parts to, or rather, I would address this in 3 parts. One, what happens to volumes if there is a price increase? Point number 2, what happens to the price growth which the companies may get? And point number 3, what happens to the premiumization trend, right? So there are 3 parts to the revenue here. Now, there are some concerns that if price increases are taken beyond a certain affordable aspect to maintain gross profit, I think volume recovery can get hurt. But that said, again, we need to differentiate. Let's see, if you take a company like Hindustan Unilever, which is the largest player in, let's say, a commodity-linked category like detergents, right? Now, I've seen quarters or years of 20% plus revenue growth as well. Largely led by price, right? Now, what happens is that while your volumes may take a slightly bit of a knock in the short term, but also remember that even within that, let's say, input inflation impacts everybody. It's not just one company issue, right? It impacts all the players, right? Which means there may be relative market share gain possibility, but having said that, consumption may shrink, right? Because what typically happens in many of these categories is pack size deflation, right? So you reduce the grammage, right? So consumption definitely shrinks. But the price growth, which is actually there in the P&L, actually gives you operating leverage, right? So it's not such a bad scenario, for some of these companies. Premiumization, the large assumption we are making is that that part of the, let's say, consumer basket, right, which has been premiumizing, appears unaffected by, these price changes, right? So, not being very sanguine, but at the same time, not too concerned either, largely speaking.
All right. So, we take that point. Now, let's hasten things up here. I'll put a company's name in front of you and give me a one-line summary of what happens then. Last week's biggest loser was Colgate. What's happening here?
Look, I think Colgate has been a sell call for us for a very long period of time, for a fundamental reason that, in our opinion, this company has been overrunning. So that's point number 1. Point number 2, a couple of trends which happened in the last decade, right? One was the arrival of naturals as a toothpaste segment, right? I mean, so Colgate dental cream essentially was losing to the natural segment, right? To Dabur, to Patanjali, et cetera, et cetera. And I think that phase was largely coming to an end in the last couple of years, as we observed. But I think what has happened from Colgate's point of view, the outperformance of Sensodyne as a brand, right? I mean, so if you look at Haleon is unlisted in India, right? Which is erstwhile GSK Consumer. So in fact, I was looking at the Haleon financials available till FY24. 25 is still not available. This company has actually grown, mid-teens CAGR in the last 5 years in revenue.
All right.
Okay. And I would presume that Sensodyne has grown even faster, right? So our opinion is that Colgate Dental Cream continues to lose to sensitivity, right, aspect. And also, in our understanding, thanks to arrival of newer channels like Q-commerce, e-commerce, etc., the access issue or product availability issue, which was a challenge for Haleon long back, right, not an issue anymore, which essentially means that Colgate still has got headwind. Maybe they'll find some solutions, but until they find a solution, it's an avoid for us.
Right. Running out of time, Manoj, but ITC, the cigarette issue and the issues facing the sector as well. So what about ITC?
See, ITC, if you look at FY27, we do believe that the consensus earnings expectations will be met, right? Or if you put it differently, right? I mean, consensus is currently at about 13-14% volume decline for FY27, right? Now, going by elasticity studies of the past, we strongly believe that the company can beat to those expectations, right? Having said that, from ITC's stock point of view, I think it is yet to reach the value zone.
What is a good value zone for ITC?
Probably still, in an SOTP, it's still some time away. Right, I mean, so still something that I can say, right?
75?
I mean, so something like that, actually. That's a value zone, right? Kind of, So the challenge in ITC is actually about the exit multiple, right? Because given the surprise element in the tax side which actually happened, right? I think the challenge is what is the right exit multiple, which means that you'll have to buy with a lot of margin of safety.
Pleasure having you as always, Manoj. Thank you so much for sparing time and joining us today, for having you more often on the platform. There's Manoj Menon there. And well, the index though has seen even more recovery from the lows of the day now, 30 points higher now. So from the lows of 22,955, it's an almost 220-point recovery that we have seen on the index. Good time to get a chart check as well. Saumil Mehta from Mirae Asset Share Khan is now joining in. Saumil, good morning. Thank you for joining in. Now that you've seen that recovery from the lows, would you use this recovery to lighten up positions further? Does the template still continue to remain a sell-on rallies on the index?
Good morning. Good morning to everyone. Yes, absolutely. The trend is still down. I'll be expecting lower levels. The bounce should be, as you said, the bounce should be used to lighten the positions, definitely. But also go short on weaker sectors, the sectors which are, bleeding. And there are a few sectors which were strong before, and now it has started forming low top, low bottom, like PSU banks and metals. They've started looking a little bearish from here, trading below some, short-term averages, making low tops, low bottom on the weekly charts, which is a negative sign for the markets. Now for Nifty, I'll be expecting a target of 22,750, which is a 78% retracement of the entire rally, which we saw from mid-25 to just a couple of months back till 26,300. So 22,750 would be my target in the short to medium term outlook, and I'll not be expecting markets to go about 23,600 or 23,800, which is a 20-hourly or a 40-hourly exponential moving average. Yes, we can definitely have a small bounce here till 23,500, 23,600, but that should be used to go short on weaker stocks, weaker sectors.
Saumil, any specific names you'd like to call out, especially some of the names that have been in focus today? For instance, IDBI Bank.
IDBI, see, at this point of time, huge gap down, upward sloping trend line has broken on the downside, trading below averages, trading below 200 daily moving average. Definitely not looking good at this point of time, and I'll be expecting, downside levels of at least 66, which is the previous swing lows of quarterly charts. So yes, bearish on the stock, stay away for now.
What about other specific stocks, Saumil, that you're recommending?
I have two stocks. As I said, the weaker sectors and the sectors which are reversing from the top. The weaker sector would be reality stocks. Oberoi Reality looks weak from here. I'll be expecting, more downside here. A small triangular pattern has broken on the downside. Stop loss would be 1450 and target would be 1300 on Oberoi Realty. The second stock which I've chosen is Jindal Steel. Metal stocks have started making low tops, low bottom, and Jindal Steel is trading below, short-term averages, formed a small flag pattern. I'll be expecting this pattern to break on the downside. Stop loss would be 1185 and target would be 1070.
All right, Saumil, we'll leave it at that. Thank you so much for joining in with your calls. We have to take another short break, but up next, we're going to discuss market fundamentals with Sunny Agarwal from SBI Securities.
Welcome back. 23,210 now on the index, 60 points higher. So the recovery continues from the lows of the day. The only question is how long will that last? But the big story of the day today, IDBI Bank. The stock is down 16%, reeling under pressure after sources are suggesting that the lender's long-awaited disinvestment plan has likely been scrapped. Gaurav is here with more details on this. Gaurav.
Well, yes, IDBI Bank, we can actually call it as an accident of the day, and the reason being that the stock is down 16%. And if you look at the reasons why, there was a plan of divestment from Government of India. Now, this plan has been there for last few years, and today, as per sources, this plan has been scrapped, and the reason being that the bids that the government has received were below reserve price. Now, if you look at the bidders, as per sources, there were two prominent bidders. First is Fairfax and second is Emirates NBD. Even if you look at the history of these companies, Emirates NBD recently got a deal with RBI where they are going to own around 60% stake in the bank, and at the same time, let's also not forget about Fairfax, who already owns around 40% stake in CSB Bank. So already they are also a promoter at another bank. So that is also something which can be a concern. And at the same time, even if you look at the shareholding structure, currently Government of India and LIC together holds more than 90% in IDBI Bank. They were going to sell around 60% stake. Together they were going to sell around 60% stake for a valuation which could have got more than 30,000 crores in the pockets of Government of India. But it is unlikely to happen right now. At the same time, even if you look at the stock performance, now the stock has fallen almost by 15% in today itself. In 1 month's time frame, the stock has gone down almost by 30%. But even if you look at 1 year performance, it is still up by 6%. Does that make it a cheaper investment for investors? Well, it is unlikely to say so, because price to book still trades at around 1.5 times for the bank. And even if you compare it with other banks who are actually candidates for the divestment from Government of India to meet that minimum public shareholding criteria, we have got banks like UCO Bank, PJSB Bank, who are still actually trading below that mark of 1.5. So again, it is not actually a right thing to say that even after that 15% stock fall, the stock is at a cheaper price. But all in all, taking all these things into consideration, it seems that the investors are not liking that the divestment plan has been cancelled, and that's the reason why the stock is down more than 16% in a day today.
All right, Gaurav, thanks very much for taking us through that big story of the day. Now, it's been more than 5 years since that process actually started, and we're back to square one. That's why you're seeing the pressure on the stock. So what we've done is we've pulled together the timeline of how the entire process began to give you a sense of, when the sale picked up and how it came apart. So you had the IDBI Bank privatization first formalized in the February 2021 budget, and that was followed by a cabinet clearance in May that year itself. By October of 2022, the next year that is, the formal request for proposal was issued and the process was officially started. By January of 2023, again, then a year later, the names of the suitors became clearer after RBI gave a fit and proper certificate to Fairfax, Emirates and Oaktree. Kotak Bank also entered the race. Due diligence by suitors began in August, and finally the financial bids were received last month in February after a full 5 years. And now you have, of course, the process getting scrapped because the bid just came in below the reserve price. Now, industry feedback points to 5 pressure points why the deal fell through. The first, of course, is the reserve price, as Gaurav was telling you, simply too high. It didn't correspond with the bank's, price to book valuation. The buyer pool, secondly, had also shrunk. We started with 4 suitors. You had Kotak Mahindra Bank that didn't submit a bid. Oaktree also was not in the fray, leaving just Fairfax and Emirates NBD at the table. And keep in mind, Emirates itself is already digesting that huge RBL Bank acquisition. So hardly the time to take another 60% stake in a very large public sector bank. You also have almost a 95% government LIC holding, and that means IDBI Bank's stock market price was also not a very reliable anchor for valuation. And buyers price in what running a former public sector bank actually means, and you have to deal with union contracts, legacy systems, a government era culture. So that discount also went straight into their bids, and as a result of it, you had a gap between what the government expected and what the market was willing to pay.
Indeed, and that has been the story for IDBI Bank. 15% lower still on the stock. Our big story of the day. Continuing our conversation on the markets with Sunny Agrawal, the head of fundamental research of retail desk from SBI Securities, is now joining in. Sunny, good morning. Thank you for joining in today. You heard about IDBI Bank. If you have any views on the stock, if you had coverage on it, because disinvestment was the one and possibly the only trigger why the stock price went up from what 40 odd rupees to as much as 100 rupees. And now with this news emerging, what do you do if you are still stuck in IDBI Bank?
Yeah, good morning, Hormuz. I think thanks for having me on the show. I think regarding IDBI Bank, yes, as we speak, the valuations are slightly expensive. So at current juncture, if I remember, the net worth of the IDBI Bank is closer to 70,000 crore. And as we speak, the market cap is closer to 85,000 crore. So trading at 1.2 trailing 12-month price to book multiple. So I think maybe a further deflation of closer to 10-15% is possible as far as IDBI Bank is concerned. Anyway, earlier the street was betting on assumption that the bank will be going to some private hands, and hence there can be an acceleration in terms of earning growth, and hence pursuant a change or re-rating in an valuation multiple. So I think that is on the back burner as we speak. So maybe further 8 to 10% correction can't be ruled out in IDBI Bank.
You know, Sunny, the other major problem that currently plagues PSU banks, since we are on the subject of banks, speaking of PSU banks, the PSU bank index itself is down almost 14-15% this month. The fact that bond yields are rising and is impacting not only PSU banks but other NBFCs as well. Now, does that mean that for this quarter, the PSU bank earnings take a bit of a hit this time around because of this rising bond yields? And if this issue continues to prolong in West Asia, do you believe that PSU banks could also have a secondary impact, even though they're not directly exposed to it, but because of the rising bond yields, they'll continue to face pressure?
Yeah, definitely. I think during the last 2 weeks, the narrative has entirely changed. Earlier, we were talking about a benign inflation, rate cut scenario, NIM improving. I think during the last 2 weeks, with a spike in crude oil prices, I think the entire narrative has changed for the entire rate sensitive, including a PSU bank, wherein with a crude at $100, if it is able to sustain at $100 for 4 to 6 months, definitely it will have an impact on inflation number. And pursuantly, obviously, that is the reason we are seeing that market is discounting increase in market is putting pressure on bond yield, and obviously that will have an impact on one-time profitability, at least for ensuing quarter, which is a March quarter number. But we need to wait and watch when this war-like situation will get over. In case the crude oil is able to settle closer to $70-80 in next 1 or 2 weeks, maybe the entire narrative will again go back in the favor of PSU bank. So maybe wait and watch approach is the right methodology right now, or right way to approach the entire banking space, including public sector banks.
So, Sunny, wait and watch for the financial space, but what about the other sectors? Given where oil prices currently are at, well above 100, the rupee is weak, markets have been under pressure for the last week or more. What are the sectors that you look to accumulate your position in, and what are the sectors you'll stay away from at the moment?
I think although the narrative is against the auto sector as we speak, but what we believe is that auto ancillary is a very, the sector is in a structural long-term growth trend, because what we have seen is that because of the premiumization or because of safety regulation, diversification or export as an opportunity, safety as an opportunity, most of the auto ancillary companies are very well placed to deliver a 25 to 30% earning CAGR over the next 2-3 years. A case in point, companies like Lumax Auto, or for that matter, Precol, SGS Enterprises, all these three companies have reported a very strong numbers during the Q3. At the same time, they are looking for an inorganic growth opportunity. So I think there are many opportunities in auto ancillary pack. So I think any dip should be utilized to accumulate auto and name. In addition to that, what I feel that in case the inflationary environment sustain for a pretty longer period of time, maybe FMCG consumer staple is the one pack which can see some value growth. So what we have seen that during the last 15 to 18 months, because of the deflationary pressure, most of the FMCG consumer staple companies were reporting a kind of low single digit kind of earning growth. In case the inflation is sustaining at closer to 3 to 4%, maybe consumer staple companies can witness some kind of earning upgrade. So we believe within consumer staple companies, Varun Beverages is the one stock which we like, Tata Consumer, Marico. These are the few stocks which one can look forward to in the consumer staple space.
Interesting one. Varun Beverages, there's a BofA Securities note on that one. And moments ago, we had Manoj Menon who spoke about both Tata Consumer as well as Marico as some of his picks. Just a final question before we let you go. At some of these manufacturing names, do you like any of them in particular?
So Mangalam, we would like to ride this manufacturing theme through CNC manufacturing or a CNC machine manufacturer like Jyoti CNC, where we are seeing that because of the increase in capex by most of the manufacturing firm across the different cohort, different sector, CNC machines manufacturer like Jyoti CNC are witnessing a very strong order book, and at the same time for Jyoti CNC, we are going to see that the capacity is likely to get doubled over the period of next 6 months from 6,000 units to closer to 12 to 15,000 units. So the entire benefit will start flowing through in the second half of FY27 and FY28. So Jyoti CNC is the one stock which we are recommending to our client with a price target of $900.
All right, take that point. Thank you so much for joining in and giving us your views on the big story of the day, which is IDBI Bank, the banking space, and then, of course, some of the more interesting investment ideas during this point in time. The markets flattened out. The up move that we saw from the lows has been sold into at higher levels, but currently at the same level as we were on Friday at close, 23,150 thereabouts. Take a short break, get you more markets on the other side. Stay with us.
Welcome back. Let's get you a check on the macro signals for the day. The markets have made a recovery since we started the show. Market breadth actually has improved, although there are more stocks that are declining than advancing. Broader markets, though, continue to see some pressure. Now, the rupee, that is trading near all-time lows again today after opening at 92.43 against the dollar. It remains under pressure from both global and domestic factors. Oil prices remaining above $100 a barrel, and the West Asia war entering now the third week is continuing to weigh on sentiments. You now have the benchmark 10-year GSEC yields also rising to about 6.69%. This is an increase of about 1 or 2 basis points from the previous session's close. A rise in the 10-year US Treasury yields towards 4.25% kind of levels has also added to some external pressure on the rates. Now, the oil prices, they're surging again. Both major benchmarks trading well above $100 a barrel after the US attacked Iran's primary oil export hub, that is Karg Island, over the weekend. The West Asia conflict has also led to continued closure or severe disruption on the Strait of Hormuz. The supply shock, therefore, has caused both these benchmarks to surge more than 40% this month alone. NYMEX near 98.93, Brent 104.33. We'll slip into another short break, but more on the markets when we return.
Welcome back. CET is a stock which is doing extremely well, currently at the high point of trade. Remember, it gained on Friday, broke a multi-day losing streak as well, and now is building onto that. So up around 1.7%, and off lows. It's off lows by about 5.5% as well. But let's get you some highlights from the CNBC TV18 India Business Leader Awards. From the sidelines, the mega event, I caught up with Gyanesh Chaudhary, who's the CMD Vikram Solar, and began by asking him about renewables and solar. are they in favor? Has there been an increase in the current prices due to crude spike and gas shortage?
Given the current geopolitical situation, we see that overall fossil fuel becomes more expensive and more unaffordable, more unavailable, and because of which renewables and specifically solar becomes even more interesting. So we see good times ahead.
And while you see good times ahead, as of now, the immediate change, have you seen any spike in spot rates for solar power?
Apart from the change in commodity pricing like silver, copper, lead and other things, we so far have not seen significant change because the supply chain mostly circles around Southeast Asia, and that is fairly consistent as of now.
All right. And how does the next couple of quarters look for you? As much as you can reveal while you're awaiting your fourth quarter numbers.
Of course. I think we're in for phenomenal growth. We're looking at 2x growth in top line and as well significant EBITDAs as well. The new plants are coming up, great initiatives. The government is implementing cell manufacturing, domestic. So all of these are very positive signs for the sector, and we are in for good times.
If there's any risk that one needs to be mindful of in the current environment, what would that be?
I think apart from commodity risk, there is no risk. I think Indian manufacturers have reached scale, size and economy, and I think this will drive the next wave of growth.
Time to take your leave on this edition of Trading Hour. The topsy-turvy moves on the markets continue. Mangalam, Ritu and I take your leave, and Halftime Report takes the action forward on the other side.
A volatile day of trade for the Dalal Street as the extending war in West Asia continues to roil global markets. The Sensex and the Nifty recover from lows to trade flat. Metals and auto stocks see some green while realty and oil and gas drag. Mid-caps see selling pressure.
The government has cleared a revision in listing norms with market capitalization linked dilution criteria. The passage should facilitate upcoming mega cap offers from NSE and Geo.
The government is expected to put off the divestment of IDBI Bank after CNBC TV18 learns the two suitors, Fairfax Financial and Emirates NBD, likely offered bids below the reserve price. The stock tanks even as questions arise over the centre's divestment target.
The Iran war is causing a whole host of problems, Industry Association tells CNBC TV18, from a short supply of inputs to price escalations to working capital challenges for MSMEs and also labor migration on LPG shortage.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vinny Motiwala, and Lata is also here with us in the studio to address the WPI data, which is flashing for you at the bottom of your screens. It has come in at 2.13% versus 1.81% on a month-on-month basis. So we'll just go to Lata and understand what this really means, because food inflation has increased, and that is something I think was expected, Lata, this time.
Yes, I mean, that's a marginal increase. Actually, the reason why we must start giving wholesale price index more importance is not this month, but more next month, when the March WPI will come. At a wholesale level, I mean, Sonal, you would know this better than anyone else. Look at the prices of propane or any of the derivatives that people are paying, packaging material. All this hits at the wholesale level first. Not everything can be passed on to the CPI level. And in any case, the most important products, which is, petrol, diesel, etc., are controlled by the government. But it does hit at the WPI level. This is a dress rehearsal. It's not going to hit in February itself. My poll had given a number of 2%. We've got 2.13, which means it is very much in line with expectation. But this may be the last benign number we will get on WPI. Going forward, we are going to get higher prices. And as you know better than anyone else, even assuming the war, starts petering out, the turnaround of ships, the restarting of refineries, all of them have a lead time. So we are going to stick with maybe higher WPI for a bit. This has many macro implications. It has a macro implication into GDP itself, because nominal GDP is impacted by a higher WPI. But more importantly, it will eat into GVA. It will eat into the gross value add of companies, and therefore EBITDA will be hit. Even if some of it can be passed on as a higher cost, your volume and your value is going to get impacted. So there will be a top line impact, there will be a margin impact, and therefore a bottom line impact. We are going to see it in earnings, we are going to see it in nominal GDP, we are going to see it in inflation as well. And there are times when high inflation can even take away from consumption. We are not at that point at all. At the moment, CPI is not in danger, but WPI could be, which is why I thought we should start giving it importance. And maybe next month onwards, we are going to have some disturbing numbers. Joining me now is Kanika Pastricha, the Chief Economic Advisor at Union Bank. Kanika, it's coming in at the moment, WPI overall headline inflation has come in at 2.1, but already we are beginning to see core getting hit. Core has come in at 3.3%. Would you worry about any of the numbers that have come? Manufactured products is up 0.5% month on month, February over Jan.
So, Rata, first of all, thanks for having me on the show. I would say that Fed number is still in line with the sequential momentum we saw in the Jan number as well. So, like looking at core, you're saying that, it's up 0.5% month on month. Even in Jan, it was up around 0.65%. When we estimate core excluding food and fuel. Now, what is more important is, as you rightly pointed out, for February, our estimate was also around 2.06. Number has come in at 2.13. Food, we were at 1.85. Absolutely similar numbers. What we've got to watch out for is, for instance, metals, which played a big spoil sport in the month of Jan, where they contributed 60 basis points delta in that 100 bips pickup in Jan's WPI from 0.8 to 1.8.
May I interrupt you there?
Metals are no longer a spoiled sport, at least.
Yeah. It's fallen by 1% month on month, metals, for the month of February. So some of the correction that happened in, some of the price rise that happened in Jan has been corrected. You know, I want to hurry you more in terms of what are you expecting in March? How much of a WPI? And more importantly, FY27. Are you marking up your WPI number?
Yes, Lata, because as you have been reporting since early today, in fact, even the last few weeks, across segments, the channel of impact will not just be oil, petroleum, there'll also be chemicals, fertilizers, aluminium, metals. So across the board, even some plastics. So when we see a run up across commodity prices, WPI is one of the worst affected. This year tracking less than 1%, next year tracking above 5%. That's one. For March also, the number currently is tracking around 2.5%, 2.6%. But these are only initial estimates we've got from first 15 days of data. Upward bias likely even to our March estimate. Thanks.
Kanika, I just wanted to comment on how we usually talk about how oil prices would impact the economy, right? That's been the discussion. But even lack of gas supply, what is the impact it has on numbers across sectors on the major numbers that we talk about, GDP, GVA, and the inflation numbers as well?
Basically, GDP for fourth quarter.
The fourth quarter, what is the impact that you're seeing there now?
So, first and foremost, the number that was tracking for fourth quarter after a 7.5%, close to 7.5%, that in fact, 7.8% number that we got for the third quarter, even for the last quarter, it was tracking above 7.5%. There is a downward bias, significant downward bias, because there are some sectors, like you only are reporting, chemicals, even fertilizers, alumina, they have actually declared force majeure. Auto sector has already written to the ministry about lack of inputs. So, of course, there's a very sharp downward bias, but the number even today, statistically, I would still say it's too early to call for a very sharp downward revision. Let us track data, get some more information. It's only a 15 days disruption. Let's see how things goes. Otherwise, yes, that 7.5% number for the last quarter is tracking close to 7% with a downward bias. Just
No, I take your point that it is only 15 days right now, but as Sonal has been saying for some time now, the restarting will take more. So we practically have to write off the next 2 weeks as well. We will be lucky if that is all we have to write off in terms of higher prices. And March significantly usually accounts for 2 months of production. I mean, if you take IIP or if you take, sales, PMI, if you take a whole year number, then March normally accounts for 2 months, whereas the monsoon months, say July, August, usually see because there's no sugar, there's no cement, there's no construction. It's a slack season, as we call it. So losing March is not like losing any other month. It is a very significant month in terms of overall output loss. We cannot take it, agriculture, etc. will chip in. But we have to account for some impact on the output. A final question to you, Kanika, since we have so much more to cover on stocks as well. What is your sense? There is a positive spin given that because you have a high WPI, like you said, you're expecting 5% next year, you will have a higher nominal GDP, which will mean tax to GDP, etc., will be better. But will it be? Because just as nominal GDP rises, it will actually have a negative impact on EBITDA of companies, on maybe even the top line of companies. So should we be so happy that nominal GDP will be high, or will it be that real GDP will actually go down?
So, Lata, if you do a quick math, if 1% WPI this year becomes 5% next year or higher, and 70% weight when you calculate that nominal GDP for that deflator, the number goes up by 350 basis points. So, of course, the jump is big, right? When you look at the real GDP downward revision, purely on the basis of demand destruction and supply disruption, as you're talking about, be it gas, metals, or other segments, we still think that 7% forecast for real GDP next year may be closer to 6.5%. If things stay, oil prices stay at $90, closer to 100, close to $90, the normalized number will be close to $80. So a 50 basis points decline in real GDP, when you compare to 350 basis points rise in WPI-led spike in nominal GDP, of course, the balance may be in favor of nominal GDP being closer to 11% or at least 10.5%. But Yes.
Got it, Kanika. So there is some silver lining, is it, even in these numbers? You're right. We had such depressingly low numbers in inflation that at a point in time, manufacturers won't manufacture until they have some guarantee of a price rise, and therefore perhaps some inflation is welcome. Kanika, we have to make this a quick chat because it's markets time. Thank you very much for joining us. Back to you, ladies. It's a benign number, but I just thought we should fasten our seatbelts for March.
March is going to be the key now to watch out for. But thanks so much for that, Lata, as well as Kanika, for joining us in that conversation as well. As of now, a quick look in terms of the market, 23,160, around that what the Nifty is trading at, recovered from the day's lowest point after 11 a.m. and now it's stable at around those levels. So let's watch out for that. But on that note, we're going to slip into a very short break. We'll continue and put the focus now and spotlight on the recent changes to the IPO norms and take the conversation forward with Bhavesh Shah of Equirus Capital. Stay tuned. Welcome back to Halftime Report on CNBC TV 18. While the recovery continues in the market, Nifty IT, that continues to be under pressure. Broader end of the market, the Nifty mid-cap, that's down in trade as well. So that's seeing a significant pressure versus what we are seeing for the benchmark indices like the Nifty 50. Though recovery is something that is there across the sectors. But let's move on and now bring on board Bhavesh Shah, who's joining us as well. What we're going to be discussing is the government has eased the public shareholding norms to facilitate mega IPOs, and the reform mandates gradual increase to 25% public ownership within 3 to 10 years, depending on the market cap of this as well. Now, ensuring broader investors' participation, stronger corporate governance. We're going to be discussing all of this, what it means as well. Bhavesh Shah, Managing Director and Head Investments at Investment Banking at Aquarius Capital is joining us right now. Bhavesh, good afternoon. Thank you so much for joining us on the show. Let's just start by the simple thing. In terms of this new norm or the policy that comes in, how does it make it and how much easier it is for these larger companies now to come into the market? Could we see a new wave of these large companies coming into the market now because of these new norms?
Yeah, good afternoon, and thank you for having me on the show. See, this is a very significant step which has been taken by SEBI, and I think it is basically recalibrating MPS to strengthen the capital markets with really good quality issuances. It also takes care of the concern that companies will have, that in terms of dilution at the time of an IPO. And it also addresses the concern from an investor perspective as to the overhang. So I think what SEBI has done is in a very pragmatic manner, and keeping in consideration the latest times, the valuations and the size of the companies, they have made the regulations much more pragmatic, such that all these stakeholders are very, very well taken care of.
All the stakeholders are taken care of. There are extended timelines as well according to these new rules, Bhavesh. What do you make of that? If you can explain how does that change things for, say, the promoters as well as the other stakeholders?
So what SEBI has done is very smartly, I think, kept the 25% eventual dilution that is needed for any public company, that they have kept it intact. However, what they have done is very nicely spaced this out over a time frame of 5-10 years and so on and so forth, depending upon the size of the issue, size of the market capitalization at the time of an IPO. What it does is effectively the timeline for the extended timeline ensures there is no stock overhang, which is generally a normal investor concern, that whenever a public issue comes in, there's always an overhang that, yes, the existing shareholders will be selling the shares, and that can have an impact on the share price, which really impacts the new investors coming in also. So by dealing, by extending the timeline for the same, I think what SEBI has done is made sure that the stock appreciates, and they ensures that the stock is very well understood by the investors over a period of time. And then more and more investors comes in, and when the demand goes up, the stock comes in. And let me just tell you that for every IPO that we do, out of the, let's say, I'm just giving a ballpark, let's say if there are 50 investors who are interested or 100 investors who are interested in any IPO, not all of them come in the IPO on day one. A lot of them actually take some stake and then over a period of time build their positions going forward. So which means the demand is going to happen over a period of time. And then, what SEBI has done is matching the supply also in that time frame. So I think what is happening is that there's a little bit of a price, I would say, stability that the stock will be able to achieve by these kind of measures.
Bhavesh, could you just help me understand this one thing? Now, the listing by the offer that they have to give to the public is a very low percent, right, versus what previously it was. Then what does it mean for investors, right? Because at an IPO time, then that float becomes lower, right? Is that the understanding? Is my understanding right on that front?
No, you're right in terms of percentage, but when you look at the absolute amounts, I think the absolute amounts are really large. And when we talk about something like a 5.5 lakh crores, 5 lakh crores, we're still talking about an issue size of 20,000 crores. And now issue size of 20,000 crores is a big number for any IPO to happen. And it kind of really requires a good amount of capital market machinery to be activated for that kind of a good issue to happen. So by any means, that's not a small float at all. 20,000 crores is not a small float at all. But what the norms ensure that as the time goes, there is more stock going to come, but there's always, we have seen a commensurate demand going up for companies which are large and people want to track it and then invest. so that these new norms kind of match that supply and demand time frame.
This means it's a win-win, right, for both the shareholders and the company, right? Even as investors, because the value-wise amount is still large.
Absolutely, it's a win-win not only for the shareholders, which is the capital market investors. It's not a win-win also only for the companies, but in my view, it's a win-win for the overall capital markets, because what we'll be talking about India as a capital market is a much more robust, a lot more large issuances, good quality companies approaching even more and more. So I think it's a very, very positive and pragmatic step taken by SEBI in this regard.
Bhavesh, if you could give us some names of the expected IPOs which could benefit from this move.
Yeah, I think I'll just speak out of the whatever is there in the public domain, rather than I won't be able to share any more details which are private in nature. But from the public reports, the companies which will benefit out of this are obviously the National Stock Exchange IPO, the Reliance Jio IPO. I think these are some of the large companies, and I'm sure as we kind of progress in India with more and more companies gaining valuations and they're becoming bigger, the names which we're not even talking about will start thinking about it and think about an IPO. So we might see a pipeline increase in this fashion.
Okay, Bhavesh, thank you so much for joining us this afternoon, explaining us these new norms, what it means for investors as well as companies. So thank you so much for joining in. But on that note, we're going to slip into a very short break. And after the break, we'll have Sneha Sheth, who is of Angel One, who will join us to talk to us about the trading strategies as well as more on the market. Stay tuned in.
Welcome back. You're still tuned into Halftime Report. Well, the benchmark index has recovered from the lows of the day, but the broader markets, they continue to be under pressure. The mid-cap index is down around 450 points as we speak. While this has recovered, there is still some red that we're seeing on that screen. Couple of names which are buzzing on the higher side in a market like this. We have ITI, which is up 13%. Bajel Projects is up another 12%. We do have MRPL, 10.5% higher on that one. Refining margins have been through the roof, so that index is up around 11%. CSB Bank is the other one, which is seeing gains of around 6.5% as we speak. But let's shift focus. Nomura has downgraded its December target for Nifty from 29,300 to 24,900 due to the recent geopolitical developments. There are other factors as well. Rima is joining us now with the details of that note. Rima.
Thanks so much for that. As you rightly pointed out, Nomura has lowered the Nifty year-end target to 24,900. This is on the back of, one, an earnings cut by 7.5%, two, a revision in the PE valuation multiple to 18.5 times. They're saying that if crude remains, say, till $90 per barrel, then the impact will be absorbed by the oil and gas companies and the government. But if it goes beyond $90 per barrel, then you will have that inflationary impact on consumers. It will impact the margins of many Indian IT companies. They're saying that on account of the war, we've already seen the Nifty correct by nearly 8% in the last 2 weeks. We've seen similar corrections to this magnitude in 2020 during COVID, 2022 when the Russia-Ukraine war conflict. They're saying if geopolitical hostilities persist, an additional 5% correction cannot be ruled out in the near term, with small and mid caps likely to be more vulnerable. But they believe a correction beyond 5% represents a long-term buying opportunity. Valuations today have come down to 17.8 times forward multiple, which is at the lower end of the 4-year range of 18 to 20 times. From a medium-term or long-term perspective, Nomura believes that there will be de-escalation in geopolitical tensions, a cooling off in the crude prices, but the timeline for that remains a bit uncertain. They've downgraded real estate from bullish to bearish. They see potential demand headwinds there. Their preferred sectors include utilities, coal, oil producers, healthcare, pharma, consumer staples, telecom. They're underweight infrastructure, capital goods, healthcare services, consumer discretionary on account of high valuation multiples. And they've also made some changes in their portfolio. For instance, SBI has now been removed after strong outperformance. Asian Paints is also out of their model portfolio on account of margin pressures. Ashok Leyland is removed. They've replaced L&T with Adani Ports, and they've added Lloyd Metals as the new initiation.
Okay, thank you so much for that, Rima. But let's also bring on what Sneha says, the derivatives research analyst, Angel One, joining us now to talk to us about the technical levels trading strategies in terms for the market as well. Sneha, good afternoon. Thank you so much for joining us. Now, today, in terms of the low, we were at those 22,980 around that mark. What are the levels now we should keep an eye out on? Even though we've seen a recovery in the market, is there any sign of strength that this will hold on?
Looking at the overall data and the kind of recovery we have seen today, I believe there is chances that again 22,900, 23,000 should be acting as a support, because we are seeing fresh pricing coming in put options. At the same time, the put call ratio are at the oversold territory. FI's long short ratio around 10. So the data remains quite oversold. A bounce back is expected, but any strong move only above 23,500, 600 would be interesting. But for now, yes, there are chances of some respite. So one can go ahead and long Nifty, Bank Nifty for a day or two. As far as individual counters are concerned, banking index is placed at a very good support zone, which is around the 89 EMA on the weekly chart structure. In case of any respite, I believe already we are seeing some decent move coming in HDFC Bank. We have seen this counter correcting from 1,000 levels. Now it is trading around 830. And looking at the overall recovery in today's session and also the chart structure, I believe one can take a long position in HDFC Bank. Keep a stop around yesterday's, like Friday's low, that is around 815, and the potential target would be around 865. Apart from this, one counter which looks very interesting to me is NTPC Green. Now, if you look at the overall chart structure, we have seen this counter, being under pressure, but recently we have seen some buying interest coming in. The volumes were very good, and I believe 95 zone, 94 zone should be acting as a support for this counter. And today as well, we have seen some respite from those 94 zone only. So keep a stop around 94 and expect a target of 105.
Okay, all right, take that point. Some interesting names. NTPC Green Energy has also recovered from the lows. Thank you so much for joining us today and taking us through your levels on the Nifty and individual names as well. Time for a break now. On the other side, Manisha Gupta will join us with Chandu Siroya of Siroya Jewelers. And this is our commodity segment. Stay tuned for that conversation.
Welcome back to Halftime Report on CNBC TV 18. Now let's put the spotlight on commodity space and what's happening there. And Manisha Gupta is joining us as always to take us through our conversation there, as well as what's on your radar today, Manisha.
Well, I'm looking at the gold and silver prices, Vinny, because we've seen some profit taking continue into this one even today. We started below $5,000 an ounce, seem to be holding around those levels. Interestingly, it is the strength in US dollar and the money rotating, by the way, in crude, which has led to some pressure continuing in case of precious metal prices. But joining us now is Chandu Siroya. He's MD at Siroya Jewelers in Dubai. Mr. Siroya, hi, thank you so much for joining in. First of all, how is it in Dubai? How is life? And we hope that everybody is safe and secure there.
First of all, yeah, thank you very much for having me here today, and very good morning or good afternoon to everybody. Life is quite stable, and we are all secure here. The fear, the panic is, I don't think there is so much as has been reported in the press many places. I think people are quite confident of the approach of the government and the security and the information provided by the government. So I would say life is almost normal. I cannot say it is 100% normal. Of course, there is some fear in the mind, but I think we are all doing very well. Thank you very much.
Good to know that, Mr. Siroya, also. But the trade clearly isn't doing so well. Whether it is about domestic markets, the global trade clearly has come to a standstill, would you say?
Yes, of course. You see, gold is one of the most liquid assets, as we know, and people are afraid to sell their gold even against check or against credit. Generally, the business is done on a 2 or a 5 day or 10 day credit, but here everybody is taking a precaution that it is better my gold is in my safe rather than in somebody else's safe. So that is the reason the business is a little low. At the retail level, yes, definitely there is a big slowdown. I would say maybe normally what we do, we are at maybe 10 or 15% of that business. The reason being that nobody is thinking of buying jewelry right now for use. They will buy it right now only if they want to invest, and investment is generally done in gold bars. So there is a demand for gold bars, but jewelry business is down. As far as the wholesale business is concerned, you see, we are the jewelry destination of the world. People from all across the world come here to source their jewelry. And right now, due to the uncertainty and the advisories which have been given by various governments, people are refraining from travel. Also, the availability of flights to come in and out is also limited. So that is the reason we are seeing a very big slowdown in the wholesale and retail business of jewelry. But as far as bullion is concerned, there is a demand, there is good business happening because there is you see, the cost of holding gold is always there due to the interest factor. And people take advantage of that. There is gold being offered at $20, $30 negative from the ounce price. So people, the bullion dealers, they buy the gold from here, they send it to Europe, they make it into kilobars again, and then they trade it. The ounces are given to the bank. So there is a margin of $5, $7, and there is quite a substantial business happening right now.
All right. Just to get a sense, Mr. Siroya, when Dubai is a major trading global hub when it comes to gold, diamonds, various other segments as well, how much of that really is, how much jewelry sales or gold sales for that matter is tourists and travelers which come to Dubai vis-a-vis the domestic demand, local demand that is?
At retail level, we believe that about 80% of the business is tourism. And that is at the retail level. At the wholesale level, almost I would say much more than that, because we have the buyers coming from across the world, and we also have shipments going from across the world. See, today we are in a digital world, and people are not necessarily traveling. They buy jewelry online also. We show the jewelry to the customers and they sell it, and then we ship them. So that business is still happening, but it is very, very negligible. You can say almost 10% of the normal turnover, maybe less.
Mr. Siroya, also, as you said, we're trading at a discount when it comes to gold therein. Dubai also is a major hub when it comes to diamonds therein. And we understand for India, especially much of that export-import or even the roughs has taken a bit of a hit. Within Dubai, how are those numbers looking like?
You see, it's the same. What applies for gold applies for the diamond industry also. Okay. And diamonds are generally sold on credit. So people are not selling right now on new credits. The movement is restricted. So yes, that business, the diamond business is also severely affected, I would say. But coming back to the discount part, the discount which was reported in the media was 20-30%. That is nothing like that. It is $20 to $30 per ounce. It is almost a fraction of a percent. So that is the normal, in the normal circumstances also, when the demand supply is a little adverse, people do sell that discount. It's not something major.
Mr. Surya, also, I mean, we've entered a third week rather. It's a 15th day of conflict in Middle East. As you said, the work, the business, the sales, global and domestic are pretty slow. How longer do you think the industry is working as a calculation on how longer can this go on?
You see, the confidence in the government measures is so much that I have told all my staff, I have over 200 staff, and I've told them that if anybody wants to go on leave, they can go on leave and come back when the times are better. But nobody is opting to go because they are saying, where else we will go? This is a very secure environment. Of Commerce with other government departments also, they have asked us, what can we do to make your business better, or how can we support you? And we are looking at some very positive impact from the government decisions. We do hope that they will give us some leeway in the rent, some discount in the charges which are there for our license fees and other things like they did in the COVID period. This is an unprecedented, I would say, situation, and this is the first time we are all facing this. So I'm sure all of us will put in our best efforts, and the government will also help us in surviving and passing this. As we said, this too shall pass very easily, hopefully.
Life has not been the same since COVID, right? There's been something new every day. But Mr. Surya, thank you so much for joining us with that, with those thoughts on precious metal prices. And Manisha, thank you so much for taking us through that conversation. That's about commodities. But quickly taking a look at the markets, the mid-cap index is now down 600 points. It is seeing some more selling. Yes, it did recover, but it is failing to contain that recovery or sustain that recovery. We'll keep tracking market moves for you. We'll slip into a short break now. When we come back, we'll get you more on the markets, talk about some stock-specific action as well on the other side. Welcome back. You're still tuned into Halftime Report. We have enough crude oil and fuel supply. That is the word coming in from Piyush Goyal, addressing the gas supply disruption and LPG crisis from the sidelines of the CNBC TV 18's India Business Leader Awards. Listen into a slice of this conversation.
On crude oil, on fuel, we are pretty well placed. We have good stocks in hand. So you've seen there's been absolutely no disturbance of any sort on the crude or the fuel front. Petrol, diesel, aviation fuel. We've in fact ramped up kerosene production so that should there be any delays in LPG supplies, we'll be able to make it up, give alternate cooking medium to the common man. Incidentally, we are also covering through imports from diversified sources the requirements of LPG and LNG also.
Right.
But we all know that the major chunk of gas came from the Middle East. And the shipping times were barely 3 or 4 days, at best 7 days, when these shipments of gas came into India. Now we have to diversify to sources which are significantly far away from India. So Canada, the United States, possibly Russia. We are looking at various sources of alternate sources which will feed the requirements of India. What we have only done is to increase the time between 2 cylinders that a person can take. And of course, there's been a short term, it's more a supply demand time issue. It's not an issue of finally the availability as much as the timing to be able to give enough shipping time for these gas sources to reach India. And therefore, I see no reason to panic. I wish people would understand that we are in a war situation. They should not hoard gas cylinders.
On the Indo-US FTA, how does the US Supreme Court ruling change things? Will there be a delay? Because
well, I think we had a very, very robust and good free trade agreement that we had, the first tranche of it, we had finalized with the United States. We stand by the free trade agreement. We are looking to rebalance to get back our preferential access compared to our competitors. Our teams are in continuous negotiation and we'll hopefully finalize it soon. With the US, all GM products will not be allowed entry into India, which means almost 90 or 95% of American major crops are just not allowed entry into India.
Right.
So whether it's corn, whether it's soy meal, whether it's rice, wheat, millets, some of the pulses, many items which we are self-sufficient in, there's no market access that we have given. The only access given is areas where we are currently importing or we do not threaten our farmers. We are able to get free trade agreements with the European Union, 27 nations, with the United States of America, with the United Kingdom, with the 4-nation EFTA bloc, with Australia, with New Zealand, all of these without opening our dairy. None of these countries has ever done a free trade agreement which did not have market access in dairy.
Okay, on that note, we're going to slip into a very short break, but here's some good news for our viewers. India's business news leaders now a click away. Introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV 18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to Halftime Report on CNBC TV 18. While markets seen a bit of a fall right now, but first let's go to the stocks that are moving around in the trading session. A lot of action that's happening on the broader end of the market. So let's go across to Vivek for that update. Vivek, over to you.
Well, thank you so much for that. Every rise is being sold into, especially in the last half hour or so, significant volatility. And in the broader end of the markets, you are seeing quite a few stocks that are sold into quite heavily. In terms of individual movers, what is it that we're tracking? Well, look at the metals and mining, mining, cement names. Most of these names that were sold heavily last week, they're seeing a bit of a comeback. Grasim, Ultratech doing quite well. JSW, Hindalco, most of these stocks are seeing a minor bounce back in the session today. One stock from the broader end of the markets, ITI, the top gainer as far as NSE 500 is concerned. Good volumes as well today. The other stock that's doing quite well and seeing a bit of a recovery is actually BSE, one of the top gainers as far as the F&O space is concerned, up almost 2%. And MRPL, remember MRPL, CPCL, both of them benefit from higher spreads, especially given the current benchmark that they're trading against. So this stock doing quite well, almost 10% higher. On the other hand, well, oil prices continue to hover over the $100 a barrel mark. Most of these stocks, with the downgrade coming in as well, HPCL, BPCL, ISCL, downstream stocks, seeing quite a bit of selling pressure. IDBI, well, was expected today, bids not coming in, even above the reserve price. On the back of that, it appears that the divestment may be off the table. That stock down over 15% today. Happiest Minds, remember, a guidance upgrade came last week. That particular stock surged almost 30-35% in the week gone by. Today seeing a bit of profit booking. Have a look at the entire mid-cap IT space. Some of the small-cap IT names too. Today seeing quite a bit of selling pressure emerge. Birlasoft, Tanla Platforms, and even some of the larger mid-cap IT names seeing significant selling pressure today. And along with that, if you're looking at some of the platform names too, they too are seeing quite a bit of selling pressure. Overall, weak market. Most of the rises getting sold into today.
Absolutely, Vivek, that's the exact case, right? Most of the rise is getting sold into. So look at the Nifty. Again, it's moved to a bit of a red right now on the screen for the Nifty 50 as well. It's down 32 points, 0.1% of decline. Yes, still off the day's lowest point. But again, we're seeing a bit of a downtrend. Now, where are we going to see this move in the second half of the trading session will be key. The broader end of the market, that continues to be under pressure, like I said as well. So when you look at the Nifty mid-cap, that's down almost 1% in the trading session. So 1.2% decline for the mid-cap. The small cap also similarly is seeing a bit of a decline in the trading session as well. So keep an eye out on that. Last 1 hour specifically, we've seen a fall coming in some of the names like Bandhan Bank, Siemens Energy, that clearly under pressure. And as of now, most of the indices continue to trade in the red. So that will be key to watch out for. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your business lunch.
A volatile day of trade for Dalal Street as the extending war in West Asia continues to roil global markets. The Sensex and the Nifty recover from lows to trade flat. Auto stocks see some green while realty and oil and gas are the big drags. The mid-caps see selling pressure.
The government has cleared a revision in listing norms with market capitalization linked dilution criteria. The passage should facilitate upcoming mega cap offers from NSE and Jio.
The government is expected to put off the disinvestment of IDBI Bank after CNBC TV18 learns that the two suitors, Fairfax Financial and Emirates NBD, are likely to have offered bids below the reserve price. The stock tanks even as questions arise over the centre's disinvestment target.
The Iran war is causing a whole host of problems. Industry associations tell CNBC TV18, from short supply of inputs to price escalation to working capital challenges for MSMEs and also labor migration on LPG shortage.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormaz Patakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormaz. Hi, guys. You know, the market started off in the red. We saw a little bit of respite. It recovered from the lows of the day. We saw a little bit of green for some time, but now back in the red, nothing working for the markets at this point.
It's been the case that way, right, for the last couple of weeks now. And if you take a look at the market, well, you could say it could have been a lot worse, considering the fact that we have recovered, almost 200 points from the lows of the day. The low of the day being 22,955. So there has been a recovery from the lows of the day. The only issue being that this recovery is getting sold into. Now, as we head into the second half of the trading session, the bulls would be looking to move higher, of course, but most of the analysts who we've been speaking to are also saying that this texture of the market continues to remain a sell on rallies one. Although HDFC Bank is the one that's contributing the most to the Nifty gains, but the pressure though is in the broader markets. The mid-cap index at one point was down almost 1,000 points, still down around 600 and 650 as we speak. So no respite for the broader markets. There are specific stocks that are moving along, and the index though is the one that continues to consolidate.
Absolutely. And if you take a look at the sectors, right, autos are finally seeing some green after the, sell-off that they saw last week. We've got M&M, Ashok Leyland, Maruti Suzuki holding on to some gains, like nearly 1%. We've got Ashok Leyland over 1%, the others holding on to 0.6 and 0.3%. FMCG also managing to hold on to some gains. Godrej Consumer, ITC, HUL, all of them in the green as we speak, but the realty index is the top losing index today. We've got Lodha, Prestige and Oberoi, all of them down between 2 and 4% in the red. Oil and gas stocks also seeing some pain. IOC, BPCL and HPCL, all of them down over 4.5%, IOC, BPCL over 5% in the red. So that's how the markets are looking today. But the top story, IDBI Bank reeling under pressure. This after sources suggest that the lender's long-awaited divestment plan has likely been scrapped. Gaurav is here with all of those details. Gaurav, what are you picking up?
Well, as IDBI Bank, we can actually call it as an accident of the day, and the reason being that now sources suggest that the divestment plan has been cancelled by government, and the reason being that the bids that they have received were lower than the reserve price. Now let's understand how the structure of IDBI Bank is. Earlier reports suggested that there are two prominent investors who are looking into IDBI Bank. First is Fairfax and second is Emirates NBD. Now even if you look at these investors, Emirates NBD recently signed a deal with RBL Bank where they will hold around 60% stake in the bank, and at the same time look at Fairfax. They already own CSB Bank with over 40% share in the bank. Now, if you look at the IDBI Bank as well, earlier, if you look at the current shareholding structure, together LIC and Government of India holds more than 90% stake. They were going to sell more than 60% stake, out of which government was expected to monetize more than 30,000 crores from the deal. But given that the bids were lower than the reserve price, it seems that the plan has been cancelled. If you look at the timeline as well, this plan has been going on since 2021, and after 5 years of prolonged time, if it seems that in this fiscal the plan is cancelled, it seems that the investors are not taking it in a positive way. Even if you look at the stock performance, it is down more than 15% today, but if you look at 1 month time frame, it is down 30%. Now there were multiple reasons war was being one of them. But at the same time, on a 1 year time frame, the stock is still up 6%. If you look at the valuation, it still trades at 1.5 times. So we cannot actually say that the stock is trading at a cheaper price despite that 15% fall that we are seeing, because let's compare it with other PSU banks who are candidates for divestment because of the minimum shareholding, public shareholding rule. And if you look at these banks like PJSP and UCO Bank, the IDBI Bank's valuation is still higher than these banks. So it is also key thing to highlight here. So all in all, given that there are some disappointments coming up from the divestment plan, it seems that IDBI Bank is currently under pressure.
16% lower on IDBI Bank, already down about 34% from its 52-week high levels, which was around 118. Now, Ritu is here with the disinvestment timeline for IDBI Bank. It's been a long drawn process, Ritu.
That's right. Long drawn is the word, because it's been 5 years in running and we're back to square one. You know, you had the IDBI Bank privatization process first formalized in the February 2021 budget, and that followed a cabinet clearance in May of that year. By October of 2022, the formal RFP was issued and the process began. By January the next year, 2023, the names of the suitors also became clear, with the RBI giving a fit and proper certificate to Fairfax, Emirates and Oaktree. Then you had Kotak Mahindra Bank entering the race. Due diligence by the suitors then began in August of 2025, and finally, why the deal potentially fell through. Of course, the reserve price simply too high, didn't correspond with the price to book valuation of IDBI Bank. The buyer pool has also shrunk from 4 to 2. Oaktree didn't participate. Kotak Mahindra Bank didn't come forward to submit a bid. And that left just Fairfax and Emirates NBD. Emirates itself is digesting a large RBL Bank acquisition, and that's hardly the time to take on a large stake in a public sector bank. Then you have a 94.7% government LIC holding, and that means the stock market price is not really a reliable anchor for valuation with the very limited free float. And the buyers, of course, were also pricing in what running a large PSU actually means. I mean, union contracts, legacy systems, government era culture. So that discount went straight into the bids, and the result is a gap between what the government expected and what the market was willing or not willing to pay.
Right, Ritu, thank you so much for summarizing that for us, the long-drawn process of IDBI Bank's disinvestment timeline. Shifting focus to the auto sector now, the parliamentary panel has expressed deep concerns over India's dependence over rare earth and critical minerals. In light of these concerns, the committee has made recommendations seeking incentives for both electric 2 and 3-wheelers. Sudarshan is here with more details on this. Sudarshan.
So over the weekend, this update has come that Parliamentary Standing Committee has made certain recommendations related to electric vehicles. And if these recommendations for electric vehicles are implemented, there is a possibility of Ather Energy getting PLI, that is Production Linked Incentive Scheme. Remember in 2021, when this scheme was launched, that was a one-time window. And there were two major clauses. For global automotive revenue had to be 10,000 crore rupees, and for non-automotive companies, minimum net worth size was rupees 1,000 crore, and Ather Energy had just started. That was the reason Ather Energy could not become eligible for PLI. Now, Parliamentary Standing Committee seeks flexibility, especially for electric 2-wheelers, and they are saying that it should be a calibrated flexibility and also differentiated criteria for high potential domestic players. And if you take at Ather Energy, that also can be part of high domestic automotive players. Now talking about, they have raised certain other issues related to the outlay. Whatever the outlay government gives in the budget and whatever the outlay they give in a revised estimate, there is a huge gap. Now, Parliamentary Standing Committee is saying that there should be a utilization remains the low, and the gap should be minimum. Now going forward, they are saying that demand incentives for electric 2-wheelers should be extended up to March 31, 2028, and revised and enhanced target for electric 3-wheelers be worked out, and incentive should be resumed, and that also up to March 2028. And two norms that were there, stringent global revenue and investment thresholds for auto OEM eligibility, they are saying it may limit the participation. That's the reason they have recommended calibrated flexibility or differentiated criteria for high potential domestic players, especially for the electric 2-wheeler segment, and that can be taken positively for Ather Energy.
All right, Sudarshan, many thanks for those details. Now, shifting focus, we understand from sources that market regulator SEBI appointed Commodity Derivatives Advisory Committee has sought feedback on permitting FPIs in the commodity derivatives market. Yash Jain is here with all of those details. Yash?
Well, SEBI chairman and of course the market regulator SEBI stand was very clear that they want to move towards deepening the commodity derivatives market, expanding the commodity derivatives market, and this move seems to be in that very direction. What we've been given to understand is that SEBI appointed the Commodity Derivatives Advisory Committee, met very recently, where the proposal of allowing foreign portfolio investors to trade into options, commodity derivative options, was discussed. And what we've been given to understand is that the Commodity Derivatives Advisory Committee, or CDAC as it's called, has sought views from all exchanges, the National Stock Exchange, BSE, MCX, NCDEX, in terms of how they would want to see allowance of foreign portfolio investors when it comes to commodity derivative options. What we've been given to understand is that CDAC currently is considering allowing FPIs to trade into options in commodity derivatives, starting with gold and silver, and then maybe in the next phase look at base metals as well for options trading for commodity derivatives. What we've been given to understand is that all exchanges are expected to submit their feedback to CDAC before the next meeting with CDAC does, which will happen very soon. We've written to market regulator SEBI on this particular query. A response from them is still awaited.
All right. Let's now hear out what the SEBI chairman had to say.
So you will see it soon, in what way we are moving, because it will be based on a very deep work which has been done in the working group and the deliberations that will be made in the CDAC and then converting into a consultation paper. So I would not like to prejudge these matters, but whatever needs to be done in order to develop the market with due guardrails, we'll need to move forward.
Take a short break. All the updates from the conflict in West Asia on the other side. Stay tuned. Welcome back. Now, the war in West Asia has entered its third week. US President Donald Trump has said that Washington is talking to Iran, but Tehran is not yet ready to make a deal to end the war. He also demands that NATO allies help reopen the Strait of Hormuz, a key shipping route. Let's go across to CNBC's Dan Murphy for the latest, who's joining in from Dubai. Dan, what are the latest developments that are transpiring right now in West Asia?
Well, good morning to you. We are tracking two separate incidents in the UAE this morning. The first is in Abu Dhabi, where authorities have just confirmed that one person has been killed after a missile struck a civilian vehicle. That victim is reported to be of Palestinian nationality. And here in Dubai, flights at Dubai International Airport are now gradually resuming after a drone struck a fuel tank near the airport early this morning, forcing Emirates to halt and divert flights. Emirates now saying in the last hour it is operating a limited schedule. And of course, as you say as well, President Trump also now reportedly racing to announce a Hormuz coalition this week. President Trump telling reporters aboard Air Force One on Sunday that he demands that NATO countries and oil importing nations help to secure the strait. Axios also reported on the weekend that he actually spent the weekend on the phone with European and Gulf and Asian allies, and now expects some to announce their support as soon as this week. Those countries will ultimately be asked to contribute warships, drones and command and control support. And of course, the question of who sends what, one official said, will be worked out later. The responses so far are pretty cautious, as you would expect. South Korea's foreign ministry saying it's going to be closely coordinating and carefully reviewing the situation. China is yet to respond publicly, and the UK also says it is intensely looking at what it can do as well. But of course, at the same time, what we see here is President Trump also now threatening to take control of Karg Island. And I know you've been talking about this too. This is a critical piece of Iranian oil infrastructure, and we have seen US and Israeli strikes underway inside Karg. But of course, now the president is talking about potentially keeping Karg's oil infrastructure and perhaps even making this part of what could be a future negotiated settlement. So we are also watching that space. In the meantime, as you have also mentioned, we've seen oil prices continue to have a risk premium associated with them this morning. At the Asia Open today, we saw both Brent and WTI testing the triple-digit range once again, with Brent crude holding on to 100 USD. It's back over to you.
All right, Dan, thank you so much for taking us through what's happening in the latest with the West Asia war and what's happening in the United Arab Emirates. Thank you so much for those details. But moving on, let us now listen in to Iranian Foreign Minister Abbas Araghchi, who in an interview with MS now confirms that the Strait of Hormuz is technically open and that energy infra and logistics in the region belonging to US, Israel will only be attacked if their own is. Take a look.
Well, as a matter of fact, the Strait of Hormuz is open. It is only closed to the tankers and ships belong to our enemies, to those who are attacking us and their allies. Others are free to pass. Our armed forces have already answered that they would retaliate if our oil and energy infrastructure are attacked. And they will attack any energy infrastructure in the region which belongs to an American company or an American company is a shareholder. So the reaction would be clear.
Meanwhile, Israel has dismissed social media claims suggesting that Prime Minister Benjamin Netanyahu has been assassinated. Here's what the ambassador Azar had to say.
Okay, so first of all, yes, Prime Minister Netanyahu is alive. I saw him personally when I was in Israel more than once. Yes, this video at the cafe is not AI fabricated.
On that note, it is time for us to head into a short break. But up next, we get you more excerpts from our conversations at the CNBC TV 18 India Business Leader Awards. Stay tuned. Welcome back. You're still with us on Business Lunch. At the 21st edition of India Business Leaders Awards, Entrepreneur of the Decade and Chairperson of Aditya Birla Group, K.M. Birla, revealed that the company's next cement unit commission will make it the largest selling cement company and the second largest in the world by capacity. Take a look.
Our next cement unit commissions in 2 weeks. With that, we reach a capacity of 200 million tons. Thank you. That makes us the largest selling cement company anywhere in the world. It also makes us the cement company with the second largest capacity anywhere in the world outside of China. That's a matter of great pride for all of us. A large part of that growth has come in the last 10 years.
Now, Surya Kumar Yadav, the captain of India's T20 cricket team, was honoured as the Sports Leader of the Year. Speaking at the event, he highlighted lifting the T20 trophy as the most memorable moment, and he also said that an Olympic gold is definitely on the cards. Listen in.
I mean, see, when you're playing this sport, you start such lovely tournament. Outside sport, there are a lot of moments when you see the families happy, as he rightly said, the administrators happy. I mean, seeing everyone happy is a very good thing. But yeah, lifting that trophy together in that lovely stadium, I think that was a happy moment. I think after this, definitely 2028 LA Olympics is definitely on the cards because that cricket is entering in that event for the first time. It is going to be very special. Yes, we relax for a bit for some time, but then we start our journey to achieve something special in 2028.
And shifting focus away from the markets, it was a big night at the 98th Academy Awards. Paul Thomas Anderson's one battle after another swept 6 Oscars, including Best Picture, Best Director, and a Best Supporting Actor win for Sean Penn. The Academy handed out the Best Casting Award for the very first time, which was won by Cassandra Kulkundis. Ryan Coogler's Sinner was close behind with 4 wins. Michael B. Jordan bags Best Actor, while Coogler took Best Original Screenplay. Other big winners include Guillermo del Toro's Frankenstein, which took home 3 awards, and the Netflix animation sensation K-pop Demon Hunters, which bagged the Best Animation Feature and the Best Original Song trophies.
The market continues to remain as choppy can be. Just a couple of stocks before we sign out. Fino Payments Bank is one of them. And that is now among the top losers in the small cap index, 15% lower on the stock. And a lot of these oil sensitives too are bleeding in today's session. Hindustan Oil Exploration is down 15%. It's the top loser on the small cap index. Confidence Petroleum is another one that too is currently down 14%. And Go Fashions, the company recently announced a buyback, and that stock too is currently trading with losses of 9%. TTK Prestige, though, that stock that was surging away last week, seeing some bit of profit booking at higher levels, 7% lower in today's session at the lowest point of the day. Take a leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. We leave a very volatile market to the team of Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Well, Nifty is in the red as we speak, but it did recover from the lows of the day. Continues to be above the 23,120 mark. We have the mid-caps, so the broader markets, which are not doing so well. So that is one index that should be on your radar. It's down 700 points as we speak, and that is all we are going to discuss on the show today. Hey, Vivek.
Good afternoon, Sonal. Like you mentioned, a brief intraday recovery, but at the broader end of the market, every rise is being sold into, and quite a few sectors continue to languish in the session today. But a lot lined up on the show, a couple of important corporate conversations. So let's start off with the top headlines. A volatile day of trade for Dalal Street as the extending war in West Asia continues to roil global markets. The Sensex and the Nifty recover from lows to trade flat. Auto FMCG stocks see some gain, while realty and oil and gas track. Mid-cap see selling pressure.
Fino Payments Bank shares tank after reports that the DGGI may soon recommend an ED probe into online gaming transactions connected with the bank. The management clarifies it is not under investigation by any authority other than the DGGI Hyderabad.
The government is expected to put off the divestment of IDBI Bank after CNBC TV 18 learns that the two suitors, Fairfax Financials and Emirates NBD, likely offered bids below the reserve price. The stock tans even as questions arise over the centre's divestment target.
Bajaj project skyrockets as company secures a 700 crore mega order from the Maharashtra State Electricity Transmission Company, project to be executed in the next 23 months.
HSBC downgrades oil marketing companies, cuts earnings estimates and valuation multiples, says higher crude prices have triggered sharp reductions in earnings estimates. HPCL, BPCL, IOC as well as upstream ONGC downbeat in early trade.
Okay, those are the top headlines that we are tracking, and mid-caps, they continue to be the big talking point as well. We did see some recovery that has been sold into. Nifty is absolutely flat with some negative bias as we speak. Volatility continues to be the name of the game. But if you talk about the small caps, they are also under pressure, falling as much as mid-caps as we speak. That index is almost at the day's low. Closer to the day's low is what I have to say, down 1.5%.
Well, that's right. And especially when you're looking at the mid-cap index, right, most of the stocks have seen very significant correction compared to some of the large-cap names, some of the auto ancillary names within the mid-cap space, tire companies. All of them have corrected anywhere between 20 to 30% since the start of the West Asia conflict. But these names and a whole host of other stocks is what Gaurav has on his radar. He's standing by the wall to take us to the mid-caps that are moving around in the session.
Yes, if you look at the stock market today, Nifty 50 is currently at flat rate, but at the same time, mid caps and small caps are something which are currently under pressure. So first, let's talk about some of the stocks which are still gaining in trade. We have got companies like ITI, Bajaj Products, because recently the company has won an order. Other than that, we have also got companies like MRPL, Tejas Networks, Adani Power. All of these stocks are up in trade. And at the same time, let's also not forget about the mid cap index. Now, only a handful of stocks are in green. And if we have to name a few, we have got companies like Vishal Megamart, BSE, Paytm, Ashok Leyland and NTPC green. These stocks are currently marginally in green, but not a strong move is what we are seeing in these companies. On the losing side, when we look at some of the big names like Fino Payment Bank, a big move coming up here. And the reason being that there were news reports about a potential ED probe as well. Now, although management has clarified, it seems that the stock is down 16%. IDFC First Bank. Now, the report suggests that the government has cancelled its divestment plan, and that is something which is hurting the stock. Stock is down 16%. We've also got companies like HOAC, Adani Total Gas, and TTK Prestige. All the yesterday's winners are seeing some kind of pressure today. And on the other side, let's also not forget about the mid-cap index itself. We've got companies like HPCL. Now, there was a brokerage report where they have downgraded the target price, and which is something which is taken in a negative way. And on the flip side, we've got defense companies like Cochin Shipyard and BDL, which are currently under pressure. And also not forget about some of the commodity companies, specifically in the metal space, in the likes of SAIL and National Aluminium. These stocks are also in pressure in a day-to-day.
Okay, take that point. Some big names there. Thank you so much for joining us as always, Gaurav, and taking us through that list. Taking a slight detour to the primary market space, Central Mine Planning and Design Institute is in focus. The company's 1,800 crore issue opens for subscription on March 28th at a price band between 163 to 172. My colleague Rima caught up with the management on the company's business and segmental breakdown. Listen into a slice of that conversation.
Coal India's revenues are dependent upon the sale of coal, which largely for the power sector is under the notified prices. CMPDI provides services right from exploration, mine planning, infrastructure planning, environmental services, geomatic services, and mine closure services, repurposing of the mined out land. So we get paid for all these services separately. So there is a difference in revenue model of Coal India as well as and CMPDI. So if you see in overall the revenue of CMPDI, we capture in under four major verticals. One is exploration, where we get about 46%, and then second one is the mine planning and design, where we get about 21%. 17% from environmental services and 16% from geomatic services. These environmental services and geomatic services are very growing verticals for us, as environmental conditions are becoming more and more stringent. Our work for environmental compliances and ESG compliances become higher and higher.
Your margins are unusually high for a consultancy company, 35 to 40%. Can investors assume 35-40% margins going ahead also?
So we are confident of maintaining the 30% profit margin as well as the 40% of EBITDA margins.
And in all the four segments that you operate in, with exploration being the highest at 45%, which segment attracts the highest margins? Is there a breakup?
So highest margin comes from environmental and geomatic services.
How much?
So that ranges between 60 to 80%.
Okay, and then planning, design and exploration?
So there we get the margin of about 15%.
For both exploration and...
Exploration is exactly 7.5% and 15% for the mine planning.
So today the share of Coal India is 65-66%, and the balance comes in from other mining corporations, NTPC, NLC, etc., other PSUs. What is going to be the target of Coal India by FY30?
So if you see at present, the mix is 67% from Coal India and 33% from Government of India, as well as public sector and private sector companies. So by 2030, we are trying to build up more and more outside coal clients as well into critical minerals as well as REs. Because RE space for exploration has been opened up, and this has extensive area for exploration. So there again we will be making up more work from the private sector as well as public sectors.
So what percentage of your projected order book comes in from the REE or the critical mineral space today, and what will that number stand at 5 years later?
If we talk about the minerals, it is about 5% at present, but RE is now just growing. It has started. We have taken one block, Coal India has taken one block, and this exploration is now starting. So this is giving an opportunity for increase. So again, out of coal, if we see, and out of total government and coal we see, we are targeting about 30% in the next 5 years.
Do you want to share the numbers of the receivables?
So if we talk about the receivables, it is more from the subsidiary companies of the Coal India Limited. But now Coal India has taken a decision for 75% payment in advance as soon as our bills is submitted. Then balance 25% after verification and all. So that is going to reduce from 140 days, I think, at present to about 90 days.
Got that. Mr. Kumar, the company also generates very strong operational cash flows?
Yeah. Actually, the company is in the space of the asset-like company, giving the consultancy services and all. So as far as the OPEX is concerned, it's very limited. And most of their OPEX goes to the salary side.
What's the planned CAPEX and the dividend payout?
On OPEX, you see 46% is the employee cost and 46% the contractual, because we are doing on our own, mainly on exploration job, we are doing 50% on our own and 50% we are outsourcing, mainly to MECL and some other players. On CAPEX, if you see, we are very asset-light company, and last year we made only 35 crores of CAPEX. But now as we are moving towards capacity building for exploration in RE and critical mineral areas as well, and providing services, as well as we are now trying to become globally competitive with the adoption of digital technologies in AI. So I see about 200 crores of CAPEX in next 2 years.
And dividend payout from the company?
Dividend payout, 30% is mandatory, so that we are definitely bound to. But we have been paying more than that. Last year we paid 45%, and this year again about the same.
Mr. Agrawal, for Coal India, another bonanza, 1,800 crore in your cash kitty.
Yes, madam, we had already discussed that the Coal India has a very vast diversification plan. Yeah. There we need around 70 to 80,000 crore rupees for this because we had taken 3 gasification projects. We are trying for the critical mineral space, renewable and the thermal power. So then we require an equity of around 20,000 crore rupees. So this will be some cushion for this equity. Okay. So that will for the diversification projects.
So how many more Coal India subsidiaries we should expect an IPO from?
Currently, we had done second, and we are expecting some 2 more companies in the coming financial year. That is the Mahanadi Coal Limited and SECL.
Okay. What is the expectation of the timeline for Mahanadi and the Southern Eastern coalfields?
We are planning to complete it by FY27.
By first half or second half?
First half Mahanadi, and then we will see the SECL.
So, Mr. Shivraj, just to summarize, right, this is a company which should comfortably grow 20-25% on the top line, 40% plus on margins and 30% plus at the PAT level, and continue to give a dividend payout of 45%.
That's right.
Is that fair? What about overseas expansion?
So number at present is very low, less than 3%, but this is, we are targeting to increase to about 10% in next 5 years.
Okay, all right. That's the conversation about a new kid on the block. Let's get a technical check going now. Ruchit Jain, Equity Technical Research, Wealth Management. Motilal Oswal is joining us now. Ruchit, good afternoon. If you can quickly tell us the next important level on the Nifty that one should keep an eye out on.
Yeah, hi, very good afternoon. Markets are trading around the initial support, which is around 22,800 to 23,000. But what we are watching out, the data still remains on the negative side. If you look at the recent correction, which is mainly because of this geopolitical tensions, the crude oil is still above that 100 mark. FIs have been selling relentlessly this month. So far, they have already sold 58,000 crore in the cash segment, and their long-short ratio is also only around 10%. Now, forget about short covering move. Even at 10, 11, 12% long short ratio, they are adding more shorts in the index future segment, which is definitely not a positive sign. And India VIX is still trading above that 22 mark. So VIX, FIS figures, crude oil prices, I think these are all certain data points that we are watching out for in case of any reversal. So rather than looking at what levels the market would take support, we are more inclined towards the change in the data. So whenever the data changes, the trend may change. In between pullback moves may be there because of oversold. But as I mentioned that it's the change in the data, they will give us more intentions that how the markets would shape up. So 22,800 is the initial support for the markets. In case if we see any pullback move here on, it would be just a relief rally towards 23,400 mark.
Okay, Ruchit, thank you so much for joining us today. Positive time. We'll take your calls next time. Well, we'll now slip into a short break. Up next, we will connect with the management of Dhanuka Agritech to decode the impact of the West Asia war on the agrochemical sector and supply chain. Stay tuned. Well, it's a good time to welcome M.K. Dhanuka, Chairman of Dhanuka Agritech, as we come back to Mid-Cap Radar. Well, Mr. Dhanuka, thank you so much for joining us once again. The first question which we want to ask you is, given the current scenario, especially as far as West Asia is concerned, what is the kind of impact it's had as far as the supply chain for the entire agrochem space is concerned? And for Dhanuka Agritech, what has been the impact?
You see, because of the West Asia war, there is a lot of impact. In my last interview, I informed that we are not expecting any price increase in the near future. But because of the war, the crude has grown from $70 to $105. And because all the raw materials for agrochemicals are crude based, so maximum raw material prices have increased by 15 to 20% in the last fortnight. So availability is also has become a question mark because the shipments are getting delayed, and for the first quarter we don't foresee any issue in the supplies. But because the major season will start from the second quarter after the monsoon, that is from July 26 onward. So there we see that if this war continues, then the shortage-like situation can arise.
Okay, take that point. So crude oil prices, they have led to higher prices for raw materials, ultimately impacting the final output prices. How much have those prices risen by, Mr. Dhanuka? Have you already started passing it on to customers?
We increase the prices on monthly basis since the war started later on, and we decided our prices for the March by last week of February. So we have not increased the prices in this month, but from April onwards, definitely we have to increase the prices for our finished products.
How much are you planning, since raw materials have increased by 15 to 20%? Will it be that much, considering the war is still ongoing? So minimum 15 to 20%, is it what you're expecting?
Yeah, it will depend from product to product, because in some products the price have increased by 10%. So as per the raw material price increase, we will pass on the increase to the customer.
Mr. Dhanuka, now that you've mentioned that there is significant input cost pressures and there is a need to go ahead and increase the prices come April, can you give us a sense of what will be the impact on margins? Number one, across the agrochem universe, and secondly, for Dhanuka itself, because Q3, you had margins of close to 14.4%, which in itself was 270 basis points reduction versus the same quarter last year. So what is the kind of impact you're estimating for Q4? And with the price increase, how much of it can you recoup?
We have already given guidance for Q4 that the EBITDA margin will be around 125 bips lower than the last year. Last year it was around 20.47%. So this year we are expecting around 19.2% EBITDA margin we expect for the whole year in FY 25-26.
Okay, Mr. Dhanuka, I wanted to understand from you the industry structure. While most of it is export, we are one of the biggest exporters of agrochemicals. The inputs is something that we depend on in terms of imports, be it basic chemicals, be it chemical intermediates, or technical grade active ingredients. Give us a sense of how much is the breakup in terms of imports, where does it come from? And when you talk about availability issues, is it across most of the raw materials?
Yeah, the increase in most of the raw materials, you see, for liquid formulation, we used one liquid solvent C9, which is a crude derivative, and which has increased from 70 rupees to 105 rupees. So around 50% increase in the solvent prices. So product to product, although the cost of the solvent is very less in the final product, but still it will have the impact of 10 to 15% increase in the overall finished product prices.
Okay, Mr. Dhanuka, the other question is, due to the ongoing conflict, have any of the partnerships that you have currently, are you re-looking at any of them? You have partners across Asia, especially. Any disruptions over there?
No, there is no disruption in the partnership with the Japanese companies, and we don't expect, because Japanese believe in long-term relationship. So these short-term war-like situation, etc., don't impact the relationship.
Mr. Dhanuka, in case this continues, of course it's uncertain, so difficult to make any predictions, but if it does, you are saying there could be an impact on production as well. You will not have the volumes you could supply to customers overall.
Yeah, definitely. If it continues and the availability of raw material becomes a question mark, then definitely it can impact in the second quarter. For first quarter, I don't expect any shortages, but in second quarter, major consumption is after the monsoon, so then there is possibility of shortage and the volume may be impacted in the second quarter.
Okay, thank you so much, Mr. Dhanuka, for joining us, giving us a sense of how the current geopolitical situation is impacting the supply chain and also the outlook going forward. Thanks once again. Well, we now slip into a short break. Up next, we will focus on Fino Payments Bank, which is under pressure today. Stay tuned.
Welcome back. You're still tuned in to Mid-Cap Radar on CNBC TV 18. Fino Payments Bank, that is the stock on our radar now. Gaurav is joining us now with more details. Gaurav?
Well, yes, Fino Payment Bank, if you look at the stock price, it's down more than 14%. And the reason being that there was a news report which suggested that the DGJI may soon recommend ED probe into online gaming transaction connected to Fino Payment Bank. Although if you look at the company, they have actually responded on this news article. What they have said is that bank is not currently subject to any investigation other than DGGI Hyderabad in connection with this matter. Other than that, they have also clarified that the ongoing investigation pertains to certain program managers and not with the GST compliance of the bank itself. And they also said that the bank does not directly or indirectly engage or promote online gaming or gambling. Even though if they have clarified the stock is down because there is another trigger. Remember, bank has received in principle approval for the transition to small finance bank on 5th December 2025, and this is actually first of its kind from this sector to achieve this milestone. Now there are certain headwinds which are there because of the probe that is going on, and that's the reason why investors are concerned that given these investigations are ongoing, there may be some delay in its transition, its small finance bank. Remember, let's also not forget that bank also said that the deposit growth has been healthy. In fact, they said that 9% deposit growth over the past 2 weeks is what they have seen. But at the same time, because of these concerns, it seems that the share price has taken a backseat. As we speak, the stock is on more than 10%.
Well, that's right, Gaurav. So the news flow, and despite the clarification, the stock is down, like you mentioned, over 10%. In fact, 14.5% lower to be precise. So it's a weak session as far as Fino is concerned. But with that, it's all the time we have on this edition of Midcap Radar. Finding Alpha when we return.
India's power sector is entering a major expansion phase driven by renewables. But how should investors play the space, from generators to transmission companies? Hello and welcome to this edition of Finding Alpha. I'm Nigel D'Souza, joining in from the Mumbai News Center. And joining me today is Nikhil Nigania, Director and Senior Analyst at Bernstein, who joins us on the show. Well, Nikhil, thanks a lot for coming down and joining us in the studio. Well, you're going to tell us all about the power space and where exactly is the current likely to flow through. So thanks for coming down.
My pleasure. Thanks for having me on the show, Nigel.
All right, we've got plenty to discuss. But first up, let's start with the basic question first. What's India's current installed power capacity? And if you could break it out for us, the traditional power, that's thermal, gas, nuclear, and how much of it is renewable? Give us the mix right now.
Oh, absolutely. So if you look at the power generation capacity in India, it's about 525 gigawatts of installed capacity as of February end. In that, almost half of it is renewables, which is solar, wind, and hydro.
Okay.
The other half is everything else, which is coal, gas, and nuclear.
All right.
Predominantly coal. So out of the 525, 220 is coal, 20 is gas, and about 8 is nuclear.
Okay, all right.
Yeah.
And the remainder 250 would be renewables.
Renewables.
All right. Just a quick word with regard to this gas capacity. It'll be struggling right now, right? Because of the current Middle East crisis. But it's a small part of the entire mix.
You're right. So even in normal years, it doesn't run a lot. There's 20 gigawatts of gas. But this year in particular, I think the summer months is where it would be a tight situation, given gas would effectively be out of the system.
All right. So 500 gigawatt odd, and this would be less than 5%, and that too not running at optimum levels. That's the gas capacity.
Correct.
Got that. All right. Let's take a broader term view then. In the next 5 years, say, what kind of capacity addition plans are there in place right now? And how much of it would be renewable? How much of it would be traditional? If you could help us out with that.
No, sounds good. So if you look at capacity addition plans of India, India is actually number 3 in the world in terms of renewable capacity addition a year.
Okay.
So after China and the US.
How much is that number?
So it's about 50 gigawatts is what we are targeting to add.
Okay.
So last year we did about 45 gigawatts of addition.
Of renewable power.
Of renewable, just renewable, which is incredible.
Indeed.
Yeah. So next 5 years, the plan is to add 50 every year. So about 250 gigawatts of renewable. On the thermal side, the plan is to add about 8-ish a year, so about 8 to 10 a year, about 50 gigawatts of thermal, which is coal.
Okay.
And nuclear is more slower, so about just 5-6 gigawatt of nuclear.
All right, we'll talk about the nuclear part a little bit more, but since you said 8 to 10 gigawatt of thermal or conventional power is what is going to be added, the main players would be what? NTPC, Adani, would they be the main players who are adding capacity?
By far. I mean, if you look at capacity addition on coal, many players have stepped back. So NTPC is obviously leading from the front, and which have about 17 gigawatts under construction. And second is Adani Power.
Got it. All right. So we've got a broad addition in terms of the plans, in the coming years as well. Got that. Now let's talk about the geopolitical tensions, and the war situation right now. Do you see any kind of disruption in, say, fuel supply, project execution, or demand trends for India's power sector as of now?
So geopolitical situation, so if you look at this recent event of Iran and the previous one where we were importing Russian oil, the solution is simple, to electrify everything, right? I mean, electrify to the extent we can.
Right.
A good example of that is China. So if you look at how China consumes energy, 30% is electricity.
Right.
70% is fossil-based.
Right.
Oil, gas, etc. In India, that number is 18%. So we need to take that number of electricity as a share of energy up a lot from where we are. So we need to electrify. In fact, power demand has to accelerate for us to be energy self-sufficient. We don't have oil, we don't have gas. What we have is coal and lots of sunshine.
Right. So electrification globally, what is it? And in India, what is it at and where is it headed?
So India is about 18-ish%.
Okay.
China is about close to 30.
Okay.
Global would be in the 20s, early 20s. Something.
All right. So electrification as a percentage of the mix needs to move up from around that 18% odd mark to say closer to around 30%, which is where China is at.
Absolutely.
Would that be a fair estimate?
Yes.
Got that. Let's talk a little bit about this renewable piece, because as you broke it up for us, you said 50% of current capacity is renewable, and that'll be ballpark 250 gigawatt odd, and we're looking to add another 250 gigawatt. Could you tell us where do you see the biggest bottleneck in achieving this particular target? Where will India struggle with regard to this renewable capacity addition target?
Exactly. So if you look at, we see 3 challenges for renewables in terms of this capacity addition plan. Number 1 is transmission. So while we have a much better grid than most countries in the world, better than US, for example, our transmission network is better than US, which many people find surprising. but it is still lagging renewable capacity addition.
Okay.
Because a transmission line takes 3 years to make. A solar plant can be made in a year.
Right.
So transmission capacity is lagging solar addition, and hence that is one constraint, which is transmission, which is a global constraint everywhere in the world.
All right. So transmission could be a bit of a bottleneck to get this renewable capacity up and going. But since you mentioned India is standing out, I want to know a little bit more, in terms of adding transmission capacity. 3 years, if I got that number correct.
Yeah.
How does it compare with the globe? You said we are better off than the United States. I think China's at around 2 years approximately. I was reading your note. So if you could give us a comparative, where does India stand out, both on adding transmission capacity as well as the cost of power, the economies of scale, basically? Run us through both those 2 data points.
Sure. So transmission, setting up a high voltage line in India takes about 3 years, as I said. In US and Europe, it's a very time-consuming process. It can take 6 years, 7 years, even 10 years in some cases.
Okay.
So it's a massive challenge there due to permitting, the approvals needed to set up these transmission lines. And India is it's a synchronous grid. So, I mean, you can set up a plant in Rajasthan and it'll flow seamlessly to Kerala, Tamil Nadu.
Right.
US is not.
Okay.
US is not a synchronous grid. Each state has its own sort of a grid. So that is one comparison on transmission. Second, on cost of power. Solar power, we are one of the cheapest in the world after the Middle East. So solar cost of power is about $30 a megawatt hour or 2.5 rupees per unit of power in India.
Right.
China is slightly higher than us also because we have higher number of sunny days in a year.
Right.
US is even more expensive.
Right. All right. I think we should get some of those data points which Nikhil is talking us through with regard to the levelized cost of power, as well as with regard to the time it takes to set up transmission capacity as well. That should flow for you on the screen. Let's talk about nuclear power, since you briefly mentioned about that. Where does nuclear power fit into India's long-term energy strategy? Do you see it playing a larger role in the coming decade? And if you have a broad estimate, because right now it's very, very small. But there is capacity addition plans out there. And who could be the companies that partake in this?
Yeah. So the government is very keen to go on nuclear. So we, as I said, we just have about 8 or 9 gigawatts of operating nuclear capacity. The target which the Prime Minister has announced is 100 gigawatts by 2047.
Okay.
So it's a massive uptick from here. A good parallel I look at is France. So after the 1973 oil crisis, when France used to depend on oil for power generation, they heavily moved to nuclear. They had the same issue as us. They didn't have oil or gas.
Right.
But they could set up nuclear plants. So even in the case of India, I think this crisis should lead to possibly accelerating nuclear and coal addition in India. And these plants are massive plants. A nuclear plant takes 10 years to build.
All right.
Massive capex. I visited one nuclear plant in India. That single plant was 1.5 lakh crore.
Oh.
It's possibly the most expensive asset in India.
Absolutely. So it's going to be very capex heavy then?
Super capex heavy.
All right. You were telling us about this entire addition. Which are the companies that are currently involved in nuclear power here in India? And which are those that will participate in this entire journey from that sub 10 gigawatt to close to around 100 gigawatt?
Right now, it's 100% owned by Nuclear Power Corporation of India, which is not a listed entity. Incrementally, NTPC has formed a joint venture with NPCIL.
Yes.
And even on the standalone basis, they are looking to set up nuclear power plants. Other than NTPC in the listed space, private entities have or are likely to be possibly allowed to set up nuclear power plants after this nuclear bill, which was announced recently, gets implemented.
Okay.
So, but largely be NTPC on the asset ownership side.
Give us a few numbers if it's possible. The cost to set up, say, nuclear power, a thermal power plant, if you could give it on a gigawatt basis, as well as renewable energy. So we have, all those 3 numbers and the time taken. For example, you told us that nuclear will be around 10 years.
Correct.
I think coal-based will be 1.5 years or 2 years, or maybe sub that, maybe a year or thereabouts.
Solar will be less.
So solar will be. So just give us that breakdown in terms of the capex per gigawatt and the time taken to get this plant up and running for all the 3, segments. That's nuclear, traditional power, and renewable power.
Correct. So a solar plant, we're talking about a gigawatt of solar is about 5,000 crores of capex.
So that'll be 5
crores a megawatt.
Megawatt, yeah.
A thermal plant is nowadays it's almost 15 crores a megawatt.
All right.
A nuclear plant is about 25 crores.
All right.
A megawatt.
All right. So 25, 15, and around 5. Though we need to keep in mind that the amount of power production that will be coming out of a solar unit will be far less in comparison to what we see in conventional power. Would that be correct?
Absolutely right.
And the time taken to get these units up and running, nuclear is 10 years?
Nuclear is 10, coal is 5.
All right.
A new greenfield coal plant takes 5 years.
All right.
And solar can be done in a year or 2.
Okay, all right. So we've got a broad gist on that front. Now, investors, they can play this theme multiple ways, right? Generators, if I look at transmission companies, lenders like PFC, RAC, or even the exchanges. Where are you leaning towards right now to play this entire power push theme, and why? Just a basic understanding first.
Yeah, sure. So when we look at this space, our view till now, which we still hold, is we are a bit cautious on renewables.
Right.
So we have underperformed ratings on mostly all renewable names in our coverage, almost all, and even the exchange due to regulatory challenges.
Yeah.
On the rest of it, which is coal, nuclear, transmission, we are positive on all those 3 legs.
Right.
Our top pick in our coverage has been NTPC for quite some time, which is the one adding coal plants, which is the one adding nuclear plants in the future. And even on renewables, their subsidiary is probably going to be one of the biggest in India.
Okay.
So in generators, NTPC has been one of our top picks.
All right. And as you mentioned that you have been fairly cautious on the renewable generators as well as the solar PV players. But that call has played out. So good on you on that one. But after the kind of correction we have seen in some of these stock prices, do you think valuations are coming to some level where you'll be a little bit interested on some of these renewable power players, which have been big underperformers? Go ahead.
Yeah. So on the solar equipment players, see, valuations, you're right, have become more reasonable. The challenge I see is what I said. I mean, we can't add so much solar in a year. The aspiration we have, I think, due to the transmission issue, we struggle to add that. So demand will be softer.
You're right.
At the same time, there's a lot of supply coming on solar equipment manufacturing. A lot of solar cell manufacturing plants are coming. So 1 year out, we see a margin pressure
on these companies.
So
the current margins are not sustainable, is what you're saying, with regard to the solar PV players. But post the correction, is it coming to that stage where you'll be a little less bearish at least?
Absolutely, yeah. So more positive than what we were earlier, I think. But we still see margin compression happen. So
you know, Nikhil, I say that because, there was this time when these companies were coming for their IPOs and there was a lot of excitement. But you were one of the lone voices in there saying that, no, we're not interested. We believe margins will be under pressure. Demand is not as much as the supply that's coming on stream. And you pointed out various other constraints. So now, post the recent correction, at least you're not sounding as pessimistic on these companies, post the correction at least, but we'll wait by to hear whether or not you turn optimistic at some stage. Let's get another basic point out of the way. Power demand has been very soft in FY26. I think the first 9 months were actually negative, then we've seen a bit of a bounce back on. So what kind of growth are you working with in terms of power demand for the coming year? That's 27, 28 from year on. Are you seeing a bit of a pickup?
So power demand, if you look at the long history of India, so power demand is easier to look at long-term basis, right? Near-term, there's weather-related variations.
Right.
So longer-term power demand in India has grown at 0.8x of real GDP, slower than real GDP growth, actually.
Right, a little less than that.
Less than that, because we have been a services-led economy,
right?
Not a manufacturing-led economy. Going forward, we expect 1x kind of a multiplier to real GDP for power demand, which is about 6% or so in the long term. Near term as well, we expect a pickup on a very low base of last year. As you said, it was almost negative in many months last year. And the weather forecast also, at least whatever we are looking, seem to hint at favorable power demand.
Got it. All right. Let's talk about data centers then. That's going to be the big power consumer. India is going to be the big power consumer globally. What's the current capacity in India and how is it expected to grow, say, in the coming years? And also, do you see data centers shifting closer to demand, which is generated here in India? Highest amount of demand from India. Do you think some of these companies will say, let's shift the business to India itself and let's set up a shop here in India? Your take.
On data centers, we have about 1.5 gigawatts of capacity in India right now.
Yes.
Most estimates we have seen are in the range of 5 to 8 gigawatt by 2030 of data center capacity.
Okay.
And we have seen many announcements come as well, whether it's Reliance, whether it's Adani, whether it's Google as well. On your point on the case for India in data centers, if you look at the decision parameters to decide the location of our data centers, the top 3 reasons are electricity.
Yes.
Access to the grid, cheap power, and clean energy. All those 3 metrics India does well.
Stand out.
Yeah. And customers also, as you said, for most of these customers, for companies, OpenAI, etc., India is one of the biggest customers.
Right.
So we see a good case for India.
So 1.5 gigawatt to around 5 gigawatt in the next 5 years or so.
By 2030.
By 2030, got that. And as a percentage of the entire power mix, it'll still be low single digits, I think so. Could you give us those numbers? And I think expected growth in terms of data center part will be, power demand from data centers will be growing at what, 30, 35, 40%, I'm guessing so. So just give us that contribution.
So this 5 or 6 gigawatt of data centers in 2030 contributes to about 2% of India's electricity.
Right.
So it's not a game-changing number, but definitely incremental to the growth story or electrification story, which I was alluding to. And post that also, I mean, there's enough runway. I mean,
got that. You know, I'll tell you what, Nikhil, we're going to take a short break. Going to come back. For the time being, you've told us you're fairly optimistic about NTPC, but we want to talk about a couple of stocks. I'll tell you what, we'll slip into a short break. Come back, we'll push Nikhil a little bit more to tell us the other stocks that he's quite optimistic on. Stay tuned. Welcome back here, tuned in Finding Alpha, and we have with us Nikhil Nigania, who's helping us out with everything we need to know on power. Nikhil, just to touch upon on what you are very optimistic about. NTPC as well as Power Grid. Those are the frontline names that you've been fairly optimistic on. Could you tell us what are the target prices on both those two, and do you continue to maintain that positive stance? I think in this current uncertain environment, and given that you expect power to pick up, the prospects look good for both these two.
Oh, you're right. So if you look at the tailwinds for these companies, so one is power demand coming back. Second is they are defensive stocks. So in difficult times, they are the names to own. And third is if the electrification theme plays out, data centers come. And then, of course, you need transmission and generation. Hence, these are good names. The target price for NTPC is 430. That's what we've had for quite some time. For Power Grid, it's relatively closer to our target price. Our target is about 306.
Yeah.
So NTPC is the one we've been more optimistic on. Power Grid, I think the challenge has been land. Because of land issues, they have been struggling to complete transmission lines. We saw a pickup last quarter, but still remain a bit cautious.
So NTPC is ticking all the right boxes. You know, they're giving you, in terms of capacity addition, they're talking a little bit about nuclear. You're comfortable with the valuations as well. So that's one of your top picks. Got that. Let's shift focus to the engineering side, because that's looked a little bit interesting, particularly a stock like L&T. That's got smacked out of shape. I think their exposure to the Middle East is more than 30%. And the street is fairly cautious on that. Now, things are very uncertain with regard to what's going on in the Middle East. But that aside, do you think it's come to a price where most of the bad news is in the price? And also, would you be relatively more optimistic on the company? I think one of your data points is that the return ratios are fairly okay. So why doesn't the company get a better multiple in comparison to, say, some of those cement names? Take us through that.
Oh, sure. So L&T is a name we have liked for quite some time. I mean, after NTPC in my entire coverage, that would be our second choice for the longest time. And as you said, the metrics look solid, right? I mean, ROE is inching from 17 to 18, 19%. Earnings growth visibility of, mid-teens to high teens. The challenge with the stock is right now it's become a call on the war, right? So Middle East is almost 37% of L&T's order book,
okay,
right now, which is a massive part.
Absolutely.
And if the situation continues, if it's just a few weeks, then things will normalize and all the estimates will hold. But if the situation drags on for longer, you could see an impact on all three metrics. You could see slowdown in new orders from Middle East. You could see slowdown in execution in Middle East. And third, even on margins and payments from customers, you could see an impact in the Middle East.
All right, so for the good of everyone, we hope that that war comes to an end. But from L&T's perspective, what the data point that you're driving home is ROEs in high teens with EPS growth in high teens as well. That's why you believe that the stock is well placed. Am I getting that correct?
Yes.
All right. Let's focus on the power financiers then. You know, PFC and REC, the stocks had a good run and then they came off the top.
Correct.
Now, this is an indirect way of playing the entire power theme. The financiers. There's talk of a merger as well. Do you think that makes it even more delicious? And what's your view on these names from here on?
So these two stocks have been cheap for the longest of time. And as you said, they had a good run, but fell off from the highs. The biggest reason was actually loan book growth. So the most important metric, loan book growth, slowed down for them.
Yes.
As the health of power discoms improved, so they needed lesser working capital funding or loss funding. And second, on renewable projects, we have seen other entities like SBI and other PSU banks chip away at their market share. So loan book growth has slowed down, and hence these stocks have come off the highs. Do we hold a positive stance on them? Yes, we do.
Okay.
But the challenge, I think, a loan book growth will sustain. So we see them more as trading stocks rather than, as some investors say, not the stocks you buy for your children.
Okay, all right. That we'll discuss later on. But what about the merger? Will it be a tailwind for them? Is it accretive?
A merger, some benefits, yes, but more to PFC. I mean, so PFC owns 50-ish% of REC, so it's getting a holdco discount. So A, that goes away. And B, the combined entity becomes so big. So put together, they'll be like the 8th most profitable company in India, which is incredible. So could come in Nifty possibly.
All right. Yeah. Oh, interesting. So valuation supportive, growth is important. And if they come together, it'll be favorable PFC. And also in terms of profitability, it could be in the top 10. Got that.
If they merge, yeah.
If they do merge. Got that. We have a query that's coming in there. So let's address that. Rajat Kapoor writes to us from Pune. Rajat says that he holds a few shares, 150 shares of IEX at 127 rupees. He wants to know what's the long-term view on the stock. Anyone's guess, right? I remember IEX having that run, from sub 100 rupees to more than 300 rupees. And then these regulations started going wrong. You have that coupling overhang as well. What's your view at current reckoning? Sub 120 rupees at some stage, would you be interested? Or do you believe it's too much of uncertainty?
So valuation-wise, it's there towards the lower end. So we are at 115 as a target price. The challenge for this stock, coupling, of course, well known. The second challenge we see, and the reason we had an underperform rating for the longest time, is the transaction fee. So it's a simple business, volume into transaction fee equal to revenue. And the transaction fee in India is one of the highest in the world.
Right.
Our transaction fee is 5x of Europe per unit what we are charging.
And what is that number?
its buyer-seller combined is about 4 paisa.
4 paisa, which is much higher than what global averages.
Global averages. So it's almost 1%, which is quite high for an exchange. So it's a good company, but we see these regulatory overhangs, which will keep the stock under pressure.
Okay, all right. So because of that, you're not yet interested, though the stock has come down very, very close to the target price. Well, thanks a lot, Nikhil, for joining in and giving us all the views with regard to everything we need to know about power. Capacity moving from around 500 to closer to around 800, 850 gigawatt. You believe that stocks that are well placed are NTPC as well as Power Grid, throw in there in L&T as well. And the play on the renewable stocks, you've been bang right that, in fact, these stocks needed to come off. They come off the top. Now it appears you're a little bit more interested. Thanks a lot, Nikhil. It's been a pleasure having you on the show on Finding Alpha. And thanks to all of you for watching this edition of Finding Alpha. We'll wrap up on this edition and hopefully you learned most of what you needed to know on the power space. Thanks for watching.
go beyond market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Hang Seng, a very mild cut, 0.06%. Taiwan index is down almost 0.2%.
I think we're talking about a matter of weeks. Our expectation is that any effects we see will be short-lived.
So U.S. struck near Iran's key export hub at Kharg Island. Flat to slightly lower, maybe in the green. Yeah, in the green. 23,200, a third of a percent higher. So there is a bit of a bounce afoot.
We are aligned with the U.S. in some sense because I don't think even Trump wants higher energy prices.
While we do understand the hit only has been at the military bases and not oil facilities.
Today opened with a gain, stayed in the green for a bit and then has sold off quite strongly in fact.
HSBC has downgraded all the three names. And second, over the weekend, Election Commission has announced election dates for some of the states.
Domestic flights, what's this charge come in? It is at around 425 rupees, while for international routes, it could cost as much as 2,300 rupees additional.
As per sources, there were two prominent bidders. First is Fairfax and second is NBD, Emirates NBD.
Look at the prices of propane or any of the derivatives that people are paying, packaging material. All this hits at the wholesale level first.
Nomura has lowered the Nifty year-end target to 24,900.
There is a possibility of Ather Energy getting PLI, that is Production-Linked Incentive Scheme.
The market regulators' heavy stand was very clear that they want to move towards deepening the commodity derivatives market, expanding the commodity derivatives market.
The mid-caps, so the broader markets which are not doing so well. So that is one index that should be on your radar. It's down 700 points as we speak.
Well, there is a recovery afoot and a strong recovery afoot as well. Let's just look at the Nifty straight up in terms of where we are at. This is closing bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. But I just want to quickly put up the Nifty intraday because that is where all the action really is coming through. So that's the surge that we are talking about. 6 minutes flat. I mean, the market basically jumped about 200 points. And I'll tell you exactly where the move started in that sense at about 218. 218, just a one-way move to about, 228 or so. And we were at about 23,350 or so. So that's about 200 points straight. And if this builds on, I mean, it'll be, I think, even larger as we come in. So this is quite something. I mean, the most natural kind of urge is going to be to look at what has happened if something has really come through, which is leading to this kind of surge. What I mean by that is, of course, news flow, but I don't think there is anything, at least not that what we can pick up on the wires, etc. We will be on the lookout for it, but so far nothing. Ultratech is the biggest gainer with a 4% surge. Let's just look at the stocks. Mahindra is up about 3.5%. Grasim is up 3%. Bajaj Finance and Eternal and HDFC Bank are some of the other stocks which are surging about 2 to 3% or so at this point in time. So that's the picture, and it's a strong bounce. Tomorrow, of course, also is the expiry, Nifty expiry, and ahead of that and perhaps into tomorrow, you will see some short covering, etc. I mean, the markets, of course, extremely light. It is also short, so it kind of takes little for the market to go the other way in a fast and furious way. And I was making this point earlier as well. I mean, moves are easy. I mean, slicing like a hot knife through butter. I mean, both on the way up and then quite easily sliding off as well. So no real certainty, but this is, I'm assuming, largely positioning related at this stage. And positioning has been very, very one-sided. So more on this in just a bit. But let me just quickly also run you through what else is coming up as far as the show is concerned. And we will, of course, talk about stocks, lots of names there. And, you'll have that's the market basically. But Fino Payment Bank is down sharply. IDBI Bank, the last I checked, was down 15-16%. But you also have, a bunch of other names, oil marketing companies and L&T. And some of these names, of course, we've discussed from the morning, which we will revisit in just a bit from now. So this is a This was lined up. This is what you will see here in the last 60 minutes, over the next 60 minutes here on trade. Mitesh is with us with what he'd likely to do in terms of trades. Mitesh, just a quick comment on this sharp surge in the last 10 minutes, and what would you do?
Good afternoon, Krishna. In fact, today morning I was allocating chances of pullback are much stronger, much higher than ever before because of two reasons. One, I think the Nifty, I highlighted that there was a gap between 22,920 to about 23,300, and we got a low of around 22,955. So we were in that gap area, extremely oversold in the hourly to hourly chart. Same for the Bank Nifty. If you look at the historical chart, I think we had 4 or 5 bottoms lows being made around 53,600 on the Bank Nifty on the 2nd, 3rd, 4th of September. Then before that on the 12th of May, and before that 5 intraday highs were made at 56,500 on the 9th of December 2025. So very clearly it was again an important support zone for the Bank Nifty as well, multiple pivots there, and similar to Nifty, it was an extreme case of oversold readings on the hourly, 2 hourly, 3 hourly charts, etc. So I think this clearly suggests that the pullback is on its way. I still believe it will be a pullback, and on the Nifty, if I was to look at targets, the first level is close to about 23,550, then 23,800, and in a very good case scenario, maybe even 24,200, 300. But that should be it. So that still is about 900 points higher than here. But yeah, let's not forget we have fallen 3,200 points straight, and then therefore a 900,000 point kind of pullback will still be only a 1/3 of a pullback. Having said that, the calls that I have right now, 2 buy calls. The first one is a buy on Indian hotels with a stop at 599 for targets of 630. And BSE, Bombay Stock Exchange, is a buy with a stop at 2824 for targets of 2910.
Okay, all right. Just one quick word, Mitesh. You said that the first level of resistance will be 23,550?
Right.
All right. And, the recent, the Friday's high, I think, was around 23,450 odd. So we'll see whether or not by the end of today we can get closer to that mark. On the Nifty Bank, the level that you were looking at, because that had a sharper pullback, right? That was down 7% just in the past week.
I think I'm not looking at Friday's high, but what I'm looking at actually is the gap between Thursday and Friday.
Okay.
There was a falling gap. So 23,550 is the level on the Nifty. On the Bank Nifty, that level is close to about 54,800, 738, 750. And then the next level on the Bank Nifty, which is closer to about 10-day average, is about 56,200. So these are the 2 levels on the Bank Nifty.
Got it. Okay. All right. Thanks a lot, Mitesh. We'll keep coming back to you during the course of this show itself. For the time being, it's good to see green. I'm happy at least I got the green jacket on this sort of a day, because a lot of selling is what we have seen. But I think the biggest positive today is not only the headline index pulling back, the mid-cap index that was struggling, that's on its way to move into the green. And the number of stocks that were advancing had fallen to around 500 stocks. That's on its way to around 1,000 stocks. So I think the crisscross lines as well, some bit of pullback, trying to come a little bit closer to each other. That's what will make portfolios feel good, at least for now. For the time being, we'll refer to this bounce as a bounce from oversold levels. Let's talk about a couple of sectors, though. Oil marketing companies, they're under pressure following the bearish HSBC note. Let's go across to Sudarshan for details on that particular note. Sir?
So over the last few weeks, OMCs, or say oil marketing companies, have seen a sharp fall. And all these 3 names, IOC, BPCL and HPCL, had hit record highs, or say 52-week highs in the last few months. So IOC hit 52-week high on Feb 27, BPCL on Feb 5 and HPCL on Jan 5. And from the time, since the time this war had started on Feb 27, if you take a look from that day, these 3 names are down somewhere in the range of 21 to 22%. What are the reasons? First, crude has seen a sharp spike. So in February, Brent was hovering in the range of $65 to 70 per barrel. Now it's about $106. It's at a 4-year high. Second reason, over the weekend, Election Commission has announced poll dates for 5 states. Now Model Code of Conduct comes into effect. Now there is no question, there won't be any hike in the fuel prices if there was any expectation. So these two news have impacted. And another thing has come today is HSBC downgrading all the 3 names to whole, IOC, BPCL and HPCL, and has cut target price. It believes that even if there is a fall in crude and comes back to the level of $75, these 3 names will still look have losses on the marketing front. So as far as the target price is concerned, for IOC, target price is cut to 150 from rupees 200. For HPCL, target price is cut to 360 from 620. And for BPCL, target price is cut to 340 from the earlier target price of 470.
Got it. Okay, all right. Thanks a lot for that, Sudarshan. Well, we have Deepan Mehta, Director, Alexa Equities, who joins us on the show. Hi, Deepan. How are you feeling about the markets? And if you want to comment anything on these OMC companies, you've got a bit of a grin on your face, so that's good. After the kind of selling that we've seen, a relief rally was due. A relief rally is what we have got, at least as of now. Go ahead, Deepan.
Yeah, that's right, Najib. Good afternoon, and thank you for having me on your show. Yes, I think we will have such bounces from time to time, but question in my mind is that are these the V-shaped recovery we're looking out for, or is that the bounce which is going to get sold into and creates a space for the markets to go down further? That any time will tell. Very difficult to say. We have seen such uncertain times in the past, and I can tell you it's impossible to predict. Specifically on oil marketing company, I think what is a bit rattling the investors is that the way the government is right now also controlling the prices, Ideally, if it was a free pricing mechanism, then the oil marketing company would naturally have to increase their prices, but they are not. They're holding it, which means that on the marketing margins, they may be going negative, or at least they may be giving some huge compression of the marketing margins over there. So, where is the kind of independence which these oil marketing companies have? And that's been the bane for so many years, that there is a certain amount of tacit pressure from the government from time to time. And then there are the elections also, during which time they are not allowed free pricing. So that does affect the kind of, value, I would say, discovery as far as oil marketing companies are concerned. But look, once we're in blue sky scenario, nobody thinks about these things. Once oil prices are down, you will see that there's a great rally in oil marketing companies as well. So if you want to bet one stock, one sector, which will do extremely well when oil prices go down, it has to be the oil marketing companies. It's a no-brainer. Valuations are low, dividend yield is great, and they have done a lot of expansion plans, the benefits of which are still to be realized.
Okay. You're never in love with oil marketing companies, Deepan, from what I remember. So point taken. Just a quick word on, take something like a Mahindra and Mahindra, or let's just forget Mahindra and Mahindra. Let's talk about companies which are going to be lesser impacted because of everything which is happening. Everything gets impacted in some way or the other, at some level, right? Some lesser than others. What would those be? I mean, what are what kind of, because everything is corrected, but you got to find things where, valuations have come off quite sharply, become more reasonable. And also, even if this goes on for a while, underlying businesses will remain relatively unaffected, Deepan. What would those be?
No, Prashant, we cannot take that simplistic view. Because if you go back into history, what really happens is that high oil prices have a direct impact on our economy. And that boils down to corporate earnings as well. Because if the oil prices go up, inflation goes up, therefore interest rates go up. And to that extent, it affects the GDP growth rates. That in turn affects the corporate earnings as well. So whenever oil prices have crossed the $100 mark, you go back into the Gulf War and to the recent situation also when Russia attacked Ukraine, it does have that 1 to 2% hit on the GDP. It's historically been proven. And that can happen over here as well. We are growing at 7.5%. Who knows, if this extends for a long time, we grow at 6.5%. And a 1% drop in GDP has an even more dramatic effect on the earnings. So it's not something, which is that.
No, so allow me to explain. So press that point. Yeah, you're absolutely right. I mean, but the point is then you're analyzing this $100 for the next 1 year. I mean, which we don't know. You can't say it'll stay at 100, or I can't say it won't stay at 100, right? No one knows. That's the point. But take Mahindra, I started with that example, right? Mahindra on a trailing basis now, that is M&M, if you look at consolidated numbers, is trading on a trailing basis, now trading at 20 times earnings, Deepan, right? I just looked at something like a completely different business. Gokuldas Exports was 900 rupees sometime back. It's under 600 now. Again, I just looked at numbers. FY25 was bombed out. They'll probably do 100 crores in profits. That is Gokul Das. Next year, numbers should be north of 200 crores because of tariffs, etc. now settling down. That one is trading at about 20 times earnings, but not trailing on a FY27 basis. So, I mean, the point is you can't say oil will be 100 1 year from now. We don't know if it will be or not be. So, it's like trying to time the absolute bottom or the top, which is impossible. So, wouldn't it make sense to look at these kind of businesses?
No, Prashant, you're right. And M&M, Gokul Das are not just two companies. If you go across many sectors, many companies are available at very, very attractive valuations or at reasonable valuations. But there's also the sentiment, and there's also the fact that although the earnings may not compress as much, like say if you expect M&M to grow at 17%, it'll grow at 15%. But the P ratio is where the hit is. And that's usually what happens. In a bear market, the Ps get hit. In a bull market, the Ps expand. The earnings trajectory remains more or less in that, hardly 2 to 3% band that it changes. And also there's a big issue about the liquidity in the market. The fact that so much of FI selling pressure is coming through, and they're the price makers. The FIs are the price makers. I know that every dollar they sell is matched by rupees being bought by the domestic mutual funds, insurance companies, but they are the price makers, and the velocity which they sell across the board, that impacts the prices. So there are many other things. It's not just fundamentals. If just by analyzing the fundamentals, the market was going to work for you, then you know it has not done in the past. Also, the technicals have got completely disrupted, and they have completely, I think, broken down, if you ask me. I mean, I don't know why the technical has not talked about this death cross, where the 50-day moving average goes with the 200 moving average. I don't track fundamentals technicals so much, but there are a lot of other kind of complications or a lot of other issues, and it's not just that you can focus on the only the fundamentals and the earnings per share and what P multiple it is trading at.
Mm-hmm. Okay, got it, Deepan. By the way, we saw a bit of a bounce, and we are approaching that 23,450 odd mark. We hit that and we immediately got rejected. We went down 30-40 points, but that dip got bought into very quickly. So from around 23,400, we're back moving towards that resistance mark. I think this 23,450 to around 23,500 will be a bit of a resistance zone. It coincides with Friday's high as well as today's high. So that range is going to be important. Let's talk about IDBI Bank, though. That's reeling under pressure. This after sources suggest that the lender's long-awaited divestment plan has been scrapped. Gaurav joins us to break it down for us. Gaurav?
Well, yes, IDBI Bank is in focus, and the reason being that if you look at the bids, as per sources, the bids that they received for the divestments were lower than the reserve price, and that's the reason why the divestment plan is assumed to be scrapped in this year itself. Now, if you look at IDBI Bank, there were two prominent investors who were looking into it. First is Emirates NBD, and second is Fairfax. If you look at Emirates NBD, they have already signed a contract, and they will be having around 60% stake in RBL Bank. On the other hand, if you look at Fairfax, they already own CSB Bank. Over 40% ownership is what they have in the bank itself. If you look at IDBI Bank as well, Government of India along with LIC, they hold more than 90%, and they were gonna sell around 60% stake in the company, from which government was going to gain around 30,000 crores, more than 30,000 crores as per reports. But now, given that the bids were lower than the reserve price, it seems that the deal is not going to happen. Why this is actually hurting the market is that this deal was actually a long-awaited deal. Since FY21, we are seeing some updates coming up on the divestment of IDBI Bank, and when it comes to divestment, IDBI Bank has always been at the forefront. But given that there are some concerns and it might not happen, we are seeing a sharp fall in the stock price.
Thanks a lot for that, Gaurav. In fact, we caught up with the MD and CEO of LIC on the sidelines of the India Business Leader Awards on what he makes of the development in IDBI divestment process. Let's hear into what he had to say.
No, they are not linked. Actually, I don't want to be responding to such speculative kind of points. The DIPAM has been taking a call on what is going to be their priority, which divestment is going to go immediately and which is going to follow what.
Correct.
So it has been their considered move, and I'm not very clear. I don't know why there are rumors about the reserve price and other stuff like that. It's not yet very clear.
Okay, all right. And it's a dichotomy is unfolding in the PSU banks as well. A set of investors believe there's outperformance on the anvil. while there's a group that cites the ROA trigger that could even cap price up more. Let's understand this, Gaurav. Tell us more about this data point.
Well, yes, if you look at PSU index in the last 1 month, we are seeing PSU index is down almost 9%. In fact, in this month itself, it is one of the biggest losers with 15% losses that we have seen in an index itself. And we've got companies like SBI, Bank of Baroda, who are actually down almost by 10 to 13%. Even in the likes of Punjab National Bank, we are seeing a 10% fall in this month itself. But for the last 1 year, if you look at this pack, it has clearly outperformed the market with around 45% gains, with banks like SBI, PNB gaining more than 20%, and the bank like Canara Bank gaining more than 60%. Now, what's the argument going on in the PSU bank sector? One set of investors, they believe that there are actually technological changes which are happening in PSU bank, which leaves little gap between PSUs versus private sector banks in terms of technology. Second is that they also believe that PSU banks are gaining market share, which is actually true in terms of loan book, specifically in the vehicle book and the retail book. These banks are gaining share, and that's the reason why we are also seeing some profitability increasing. But at the same time, there is another set which is concerned about the valuation. So if you look at PSU bank's index valuation right now, it trades nearly at around 1.2 times price to book, quite higher than its 5-year average of 0.9 times. And even if you look at some prominent banks like SBI, PNB, Bank of Baroda, all of these banks are currently trading above their 5-year average. Specifically, if you look at Canara Bank, it is trading at 1 time price to book, and SBI Bank trading at 1.6 time price to book. But remember, now the concerns, or rather the talk points are, is this valuation gap actually valid? Recently, in the morning, we had a conversation with Mr. Suresh Ganpati from Macquarie, who believed that the valuation gap is nearly zero now, and he also believes that the PSU banks, now they do not have enough triggers for ROA expansion that we have seen in the last few quarters, and that is something which is concerning, and that's the reason why they are in favor of the private sector banks, given that the valuation of private sector banks are also lower. In fact, in his view, HDFC Bank, ICICI Bank, all of these banks are trading in the range of 1.3 to 1.5 times price to book, which is actually a cheaper valuation. So all in all, in the last 1 year, we have seen PSU banks actually outperforming. But now, given that it has already declined almost by 10%, it will be really interesting to see how the story pans out for PSU banks, and if there is any gist left or any gains left in the PSU banks in coming days.
Okay, all right, got that. Thanks a lot for that, Gaurav. Deepan, you heard what Gaurav has to say. IDBI Bank, the reason that it was afloat was because there was reportedly a lot of interest, and there was hope that the divestment will see the light of day. That's not happened. The stock has pulled back drastically. Your view on the stock, and what else do you like from the PSU banking space?
No, Nigel, I think, when I heard this news about IDBI privatization being called off because the bids were lower, the first thought that came to my mind is that is the Indian banking sector now less attractive than it was before? And I've always said that although short term they may do well because of lower interest rates, improved economic activity, medium to long term in the banking sector is a red ocean. And maintaining these kind of net interest margins, I'm not so certain. At some point of time, I think they're going to face a lot of competition from the debt market mutual funds in terms of raising low-cost deposits, and big projects, I think, will go directly to the debt market or through debentures. So it's going to be extremely challenging times if you ask me for the banking sector. There was a time when the private sector banks had a great run because PSU banks are out of the market, but now they also have come back rejuvenated with much better balance sheet quality. So the entire industry, I think, slowly you will see the profitability slow down, as we have seen in HDFC Bank, Axis Bank, IndusInd Bank as well. So I would be a bit circumspect on the bank industry, although a trading rally can happen any point of time because of, it's a cyclical business. So I would just like to be a bit cautious there. The better way to play would be through the NBFCs. This is a great time to buy stocks like, say, Bajaj Finance or a Cholamandalam or even a Shriram Finance. Having said that, we got investments in all of these three NBFCs and even L&T Finance for that matter. So I would think that the better way to play the lending industry through the NBFCs rather than through the banks.
Okay, all right. Thanks a lot for that. But we're not yet done with these banking names. Fino Payments Bank, that continues to remain under pressure. Gaurav, what's the latest on that front?
Well, yes, there was a news report which suggested that the DGGI may soon recommend ED probe into online gaming transaction connected to Fino Payment Bank, and that is something which is hurting the stock. Even if you look at the stock performance, today it saw a decline of more than 15%. But what is actually happening? The bank has clarified. What they have said is that the bank is currently not subject to any investigation than DGGI Hyderabad in related to the matter. Other than that, they have also clarified that the ongoing investigation of DGGI pertains to certain program managers, and it is not about the GST compliance of the bank itself. Third point which they have mentioned is that they do not directly or indirectly engage or promote any gaming or gambling activities. But all in all, why it is actually becoming a concern for investors despite bank's clarification is that if we go back in time, now in December 2025, bank has received in principle approval for transition from the current status to small finance bank. Now it is actually first of its kind if we compare it with the space that the bank currently trades at, and at the same time there are some concerns which suggest that there may be some delay in the conversion from the current status as financial institute to small finance bank, and that is something which is concerning the investors, and that's the reason why if you look at the stock price, it is currently under pressure.
Okay, all right, Gaurav, thanks very much for that. Deepan, any thoughts on this one?
No, Prashant, many times I thought of investing into Fino Payment Bank because very impressed with their business model. I think they are going very deep into the rural areas and working with the unbanked customer, and they act like a correspondent bank for many other banks as well. And the technology platform also is very strong, whereby each of the regions can actually act like a branch. If you look at their presentation, it is very impressive. The story is really compelling. But when you look at the track record, it has always been disappointing. So somewhere something is not going right. I'm not sure what it is. I'm not going to put my finger on it. But it was a bank with a different type of a business model and a tech platform, but it has not delivered as yet. And with these kind of uncertainties around top management and now maybe whatever truth is there about this, we can't say. But end of the day, the performance never came through. So therefore, I never invested in the company. And that's one company to watch. I think if there's a turnaround, it enters into a new growth phase. No doubt the stock price will be up by 30-40% after that. But once these uncertainties are behind and you understand exactly how it's going to grow at faster than its peer group, that's the time to look at this company in positive light. For the timing, I think it's just best avoidable. Again, unfortunately, the time to sell is gone. So you just remain invested if you're a shareholder of the company.
Okay, all right. Got that, Deepan. Thanks a lot for joining in and giving us your take on the markets. And today, I think, Deepan, you could take part of the credit as well. From the time we started chatting, the market started getting its act together. So let's chat more often on a lighter note. Let's hope things recover from here on. Have a pleasant evening. Okay, all right. Time to swim into a short break. On the other side, we have Ronak Onkar of PPFAS Mutual Fund, who's waiting for us. Stay tuned.
Okay, 265 points, and we're at what, 23,400, and it's a sharp spike which is materialized, and it's all happening in the last 40 odd minutes of trade. Started at about 220, and we've picked up, I think, about 350 points actually since then from that level at about 218 or so. 23,400 plus is where the Nifty is. And as I said, tomorrow, of course, is also Nifty expiry, you know. To stay short, to roll over positions, I mean, you know, it takes a little bit of firepower, especially with the markets very, very light, news flow very, very volatile. So perhaps ahead of that, some amount of covering maybe into tomorrow as well. We'll see. Ronak Honkar is with us, Head Research and Fund Manager at PPFA's Mutual Fund. Ronak, great to have you with us here in the program. Thanks for joining us. You know, levels are better, but are they better, you know, are they very good levels you know, to sort of go in and buy? I was having this conversation with our earlier guest Deepan on names like Mahindra, where valuations have dropped off to about 20 times trailing earnings. And he was making the point that no one knows how long this goes on and whether this, what is so far a terms of trade shock, becomes a growth hit if oil prices stay this high for an extended period of time. How would you account for that, Ronak?
Thank you for inviting me. So I agree with what you just mentioned. The shock, which seems like a short-term shock, has not really decimated valuations across the board. Some of the stocks which have fallen, they are merely corrected from their peak valuations, but they were also stretched to begin with. We already own companies like Mahindra. We are part of the portfolio in the FlexiCap anti-tax saver scheme. So we are benefited from whatever growth they will have. But I agree, in the past, whenever we have seen oil prices shooting up, there has been a inflationary trend, and that might affect growth. But it's very uncertain to put a timeline to it, put a number to it. It's better we look at company by company, sector by sector, how the performance pans out from now onwards.
All right. Hi, Ronak. Good afternoon and good to see you, and congratulations to you and the team. Sitting on cash for a while. I've been pushing you for the last many interviews. Have you all deployed? You're saying no, it's gone up by 1% or so. Give us the updated number. What is the cash as a percentage of the money you're managing right now that you're sitting on? And tell us, last few days, have you deployed some money or you're still sitting on that cash?
Well, we still have about 20% cash. And although we discuss percentages on an absolute basis, the cash number has been deployed over a period of time. If you see, I think a better trend to look at is the last 1 year. When started by somewhere close to 25% cash allocation, it's now about 20% cash in the FlexiCap fund and even lower cash in the tax saver fund. So we have been deploying, but only in areas where we find valuations to be attractive. Some of those companies we already own, but a few new names we've added which are in the mid and small cap category, but not meaningfully. So we have not added significantly to the positions that we have had. Also looking at the sectoral caps that we want to maintain in the portfolio. But yeah, there has been a little bit of buying, also some selling, but at the same time, cash is at 20% now.
Okay, at least 20% is better than 25%. Lot of market watchers, they say, ask Ronak, when is it going down to mid-teens? Then we get a little bit more optimistic if they are deploying. For the time being, at least on a 1 year basis, it's come down a little bit, though you're sitting on a good amount of cash. And talking about stocks that you all have added, I'm just looking at the recent edition. If I compare it with the previous one, it appears in some of the tech names you'll have added positions. Infosys, HCL Tech, just to name a few, and TCS as well. Are you all getting a little bit more optimistic on tech? And do you think that the price damage, much of it is in the price now?
It remains to be seen where the prices will be. But if you look at the IT services play over a period of time, the basics are known to everyone. The governance quality of these companies is good. The cash flow profile has been good. The only challenge people are looking at is whether the business model itself will change with the implementation of AI tools coming in. So how will the pricing work? How will the margins work? How will the hiring work in this industry? In my view, so far, if you look at IT services, whenever technology has new technology has come in, a lot more work has happened. If prices fall down of the services that they provide, more volume of work has been created. So it remains to be seen in the next 5 years how this business will turn. But mostly from the basics of this business, they are adaptable. They have cash flow to go behind acquisitions. They have cash flows to experiment. I think some of these are good characteristics to have. And valuations have been lower even better if we can buy more.
Okay, all right. Sounding a little bit more optimistic on the tech services. Ronak, request you to stay with us for the time being. Let's turn the spotlight onto stocks near the 52-week low. Hormuz, run us through that list.
You know, there were a lot of names across the market today before that recovery happened that had hit a 52-week low in today's trading session. So we'll start off with the index first up. There were 5 big names that were at 52-week lows in today's session: HDFC Life, ICICI Bank, Infosys, Trent, TCS, and made intraday lows. The interesting bit is that even today's lows are well below their lowest price target on the street, be it for HDFC Life, be it for ICICI Bank, be it Infosys, TCS, or even Trent. TCS is slightly higher than its lowest target, but Trent, all of the others are significantly below their lowest price target on the street. Same is the case for a lot of the mid-cap names. In fact, if just 5 names that we are highlighting here, a lot of other mid-cap index names that were at 52-week lows earlier in the day. With Concor, Colgate has taken a bit of a thrashing in the recent times. Exide Industries, KPIT Tech, SBI Cards, all of them now, most of these still again below their lowest price targets on the street. And the story is no different for the small cap index as well. Now look at names like Aditya Birla Real Estate. This stock is down almost 60% from its 52-week highs. We'll get to that in just a bit, but take a look at Amara Raja, MGL, Inox Wind. They are either well below or near their lowest price targets as well on the street, so the Mahanagar Gas being a case in point. But what next for all of these names? Is the street continuing to remain optimistic on these? Look at the Nifty names. HDFC Life and ICICI Bank have no sell recommendations on them despite the fall that they have seen. Infosys and TCS, after the pummeling they took in February, still down for the year. Still, majority of the analysts still have a buy recommendation. Upside potentials ranging from anywhere between 35% to as high as 50%. There are a couple of broader market names that stand out. One of these is Aditya Birla Real Estate. Why is that so? It is a consensus buy among all the 9 analysts that have coverage on it. The stock is down almost 60% from its June 2025 peak, and the consensus estimates of price targets is implying an upside potential of almost 90% from current levels. Now, the other broader market name that remains a consensus buy is Inox Wind, and that one too, all 7 analysts who have coverage on the stock, they have a buy rating. That stock too is down 55% from its June 2025 peak, and the implied upside potential from current levels comes up to as high as 80%. And the last name on this list is KPIT Tech, and that is one of the biggest underperforming names in the IT space currently. The 23 analysts have coverage on the stock. May not be a consensus buy, but almost 2/3 of these still have a buy rating on the stock. It's down almost 60% from its peak, and based on the consensus estimates of price targets, the implied upside potential comes up to around 84%. Though the stocks may have taken a pummeling, but the street continues to remain optimistic. There is still some hope for a lot of these names at 52-week lows today.
Okay, all right. Thanks a lot for that, Harmas. And Mangalam as well joins me in the studio. Mangalam.
Nigel, you know, near 500-point recovery on the Nifty from the lows. Let's see where that goes. It's the green coat, maybe. Let's see how that goes. And, you know, we monitor how it progresses from here as well. We have Ronak is still with us. Ronak, you know, I'm looking at the nature of stocks which are moving right now today. Obviously, the Nifty Bank has led the rally, but we've seen a lot of traction in a lot of these consumption stocks as well. Now, most of the street believe that for staples, it is a long and extremely grinding and sorry sort of path from here on when it looks to growth and, you know, valuation multiples as well. Some calling it structural derating as well. But amidst all of this, the stock that has done actually well for you guys lately has been Zydus Wellness, because the company's gotten into newer forms of consumption, be it the protein play, be it the sugar-free play, you know, post-semaglutide, the kind of nutrition that would be required, well placed for that. And recently they made an acquisition to go overseas as well. All these factors, do they make you a lot more, you know, comfortable at these valuations now that it's off 20% from its highs? Are you adding more?
So in Zydus Wellness, this is our second innings. In the first innings, we saw that the growth was moderating with the portfolio not doing so well. So we waited and studied it for a few years. And this is the time we got a chance to re-enter after some of the changes that they have done. But it remains to be seen how the business grows. So we will wait and watch. It's not necessary that just because we bought something, the business starts performing in a fundamental way better than what it was. We have to monitor the growth, we have to monitor the distribution. Even the new areas they have entered are very competitive areas. So we'll wait and watch and see how it performs.
Okay. All right. Quick word in terms of the frontline names, Ronak. Coal India is something that you'll have added on to. You know, the growth hasn't been there and pricing, strength hasn't been there. However, Now, with the disruption in gas, the street believes that the pricing will come back and demand will come back in a big way. Do you all continue to add on to this position? Because I was looking at least in the past month, there was a good amount of addition.
So on the margins, if you see the additions is because the covered call options that we write. So we might marginally add whatever gets sold off when the options are sold. But in a Coal India kind of stock, I think longer term, we have to just zoom out a bit and see the energy mix that we have. It's still quite coal dependent, although terminal value growth of that business cannot be ascertained. But at the same time, we have to see that coal is an important resource for our energy security. And it has been an important source for a long period of time. And despite the fact that there are newer forms of hybrid technology coming in, we still depend a lot on coal. And even if you look at the electrification that is happening across the country, the dependence on the base load of coal has not gone down that dramatically. So we'll see how this business performs. Although productivity-wise, it's one of the most profitable coal mines operated in the world. Also, the size at which they operate, the cash flows they generate, it gives a dividend yield cushion for us as investors also. So not necessarily a very growth-oriented business, but at the same time, a stable cash-generating business.
Would you say the same of ITC? I mean, just trying to understand, because the regulatory overhang has actually made the business, disrupted the business quite a bit over the last couple of months or so.
So the regulatory overhang on ITC has been there for more than 3 decades now. So we cannot ignore that. In fact, the company has not ignored it. They have made investments actively to diversify from the tobacco portfolio. And that is yielding results. Although the tobacco piece also has kept growing. So you don't see a meaningful change in the profitability mix of the business. But if you see the revenue mix of the business has definitely changed. In fact, capital allocation has improved when they demerged some of the capital guzzling businesses from the ITC fold. And we'll see. So the business profitability has not dramatically changed. The quality of growth itself we'll have to see on the consumer side as well as the tobacco portfolio. But still, again, the same piece, cash generating business, great dividend yield comfort. At the same time, they have good distribution reach as well. So everything that a consumer business needs.
Take that point, Ronak. Always a pleasure speaking with you. Thank you so much for joining in. Nigel, the F&O space, short covering underway?
Well, I will attribute a few factors actually to today's pullback. The pullback, actually, the correction was very, very sharp. So relief rally was due. So that's exactly what you got. The RSI level we had pointed out earlier as well, that had moved into the oversold territory. But earlier today, when Mangalam and myself were on Chartbusters, we had made this point. The Nifty was down close to 200 points and the India VIX as well cooled off. Normally, that signals one kind of factor that there could probably be a reversal. Currently, it's cooled off close to 5%, but even at the day's low, the India VIX wasn't going up. And if I look at it in the last few trading sessions as well, imagine a day when the Nifty is down 500 points and the VIX moves up only around 5%. That's what happened even on Friday. So the India VIX is not going up the way it was going, in the previous few trading sessions. Case in point being on last Monday, I think it shot up more than 15-20%. So cooling off of VIX, that's one factor that you should be tracking. The PCR, it had moved to the lower end of the range of around 0.7. That's currently at around 1. Because now there is some sign of put writing. Remember, this market is still brittle, but the put writers are putting in a bit of a fight. 23,200 put, the premium is down to around 84 bucks, I think from around 270 rupees, around 80 rupees approximately. 23,100 put as well, the premium is down to around 60 rupees, 60 to around 59 rupees or thereabouts, from around 222 rupees. So there is writing we're seeing on both those two strikes. While on the upside, there appears still there is writing at around the 23,500 call. The premium there is ballpark close to around 100 rupees. The market is up, but still you're not making money on that particular strike. The premium is holding at around that 100 rupees or thereabouts. So that 23,600 mark, that's the next line in the sand. Well, for today's trading session, you'll want to end closer to Friday's high, which was at around 23,492. But I think Liberation Day low, which was in early April, you don't want that level to break, 21,700 to around 22,000 odd mark. Important mark on the downside, not just for today, not for the next few trading sessions. You do want that mark to breach, because the last time around we visited that mark, you saw a very, very good rebound out there. Individual stocks, BSE has come in for about a short covering. Good uptake on the stock. Open interest down. On Bandhan Bank, there is aggressive shorts actually that have got into the system out there. And there are some mild signs that some of the shorts are covering. So I'll keep an eye out on that one, because from the lows, actually, it's seen a decent amount of a recovery. When Bajaj Finance, the stock we spoke to Hiren Ved earlier today, that one's seeing a good amount of fresh buying. Remember, this is a stock that's corrected more than 15% from the recent peak. So relief rally was due. A relief rally is what we have got. Hopefully, this can extend a little bit on the upside. For the time being, take a short break, come back. We'll continue our chat on markets. We'll also tell you what the dealing rooms are saying.
Welcome back. The market continues to do well. The frontline indices continue to recover extremely well, though the IT index as well as the pharmaceutical space are seeing some bit of profit taking. IT has been under pressure for a bit and continues to be so. And it's the mid-cap index, actually, which is slightly under pressure in today's trading session as well. Not full confidence returning, perhaps 2,000 stocks which are still declining versus 1,000 stocks which are advancing. The gap has been narrowed from the start of the day and more so in the last couple of hours. But nevertheless, there is still a gap. What are the D Street doyens speaking about? In our special segment, D Street Chatter, Nimesh gets us an insight. Nimesh, there is a strong recovery, but is it a recovery of confidence or is it still a pullback from oversold zones?
Well, Mangalam, it looks like it's a pullback from extremely oversold levels. And today's recovery is largely led by the large cap names. And, we highlighted in the morning as well, a lot of the stocks like L&T, Interglobe, all but fallen to almost bare levels or, bare target prices for most of the brokerages. So, M&M, all these large cap names were sharply down in the last couple of weeks. And hence, you're seeing a bit of a recovery. And that's helping the Nifty as well to recover from the extremely oversold levels. From a flow perspective, still, I believe that the FIs are net sellers. And today's selling seems to be largely in the PSU bank stocks as well as in the OMC names. So these two sectors are standing out as far as aggressive selling from the larger FIs. Even the bank Nifty has recovered from the intraday lows, but again, that took extremely oversold in the last many days, and hence looks at stocks like HDFC Bank, ICICI Bank are all recovering in today's market. The only notable gainer there in the private bank names is Bandhan Bank today. So that's one an outlier. But in general, you've seen a bit of recovery in the broader market, in the banking names as well. Technically now, which was seen to be a big support, 23,800, that will act as a big resistance on the upside. So watch the level on that level to watch out for on the upside. But frankly, today's pullback seems to be largely led by large caps and a bit of short covering from an extremely oversold levels.
All right. And individual stocks, Nimesh, what's the insight that you picked on that?
Well, so as I mentioned, the two sectors that stands out in terms of aggressive selling is OMCs and PSU banks. And within that, Canara Bank and IOC stands out. Both these names are expected to see very high delivery volumes, but on the sell side. So aggressive selling is my sense in both those names by the larger FIs in today's market. So that's the first couple of stocks. The second name is Eternal. A couple of reasons why the stock is pulled back in today's market. One, the selling pressure from a leading domestic mutual fund seems to be largely over. And there is very small buying, but there is buying nevertheless in today's market in Eternal. And the other name which stands out in terms of buying is MRPL. Big move on that name, but my sense is that backed by very large FI buying in today's market. So watch out for delivery volumes, expected to be very high in MRPL as well. The third is Kotak Mahindra Bank. I've been reporting for the last many weeks now that there is aggressive selling in Kotak Mahindra Bank. Looks like that selling from a leading FI is largely over. There are some indication of small buying from larger institutions into Kotak Mahindra Bank at current levels, but largely looks like the selling is largely over from the leading FI. And the last one is BSC Limited. Even that's buzzing in trade today on back of buy flows. Some bit of buying has resumed, and leading domestic mutual fund is an active buyer as well in BSC at current levels.
Right, Nimesh, take that point. Thanks a lot for that. You spoke about Eternal. The other platform company is Urban Company, which too has seen a big recovery. In fact, all of last week, it was the only one which was in the green. Before that, it has fallen to its pre-IPO price or below the issue price as well. The issue price was 103 rupees. The low on the stock was about 100 rupees hit on 4th March. And from those levels, the Urban Company stock has seen a decentish rally, sort of 10-12%, coming by in just the last few trading sessions. The market was under pressure. Good time to welcome Mitesh on the show once again. Mitesh, the tomorrow trade, what would it be?
So I think for carrying longs may not be a bad idea right now. I believe that the bounce back will extend because we still have some space. So NTPC is a BTST with a stop at 378 for targets of 385. And the other one is State Bank of India. It's at a gap support area. It's bounced back from there. So BTST with a stop at 1056 for targets of 1080, 385.
All right. So those are a couple of buy calls. Carry it today as a long position for unwinding tomorrow. Also, good time to welcome Amrish Balika on the show. Amrish, what's your idea after the market has corrected so much? Individual stocks down 30-40% from the peak, and most of them capitulating in all of last week. Is there any contra long that you have? Is there any opportunity?
Yeah, Mangalam. In fact, there's one opportunity which I've identified. It's a VA Tech Wabag. In fact, they provide the complete range of water and water treatment solutions, and they have around 90 patents. Desalination is a huge opportunity, and that's the focus area also during this Iran war. And in fact, we may see many more decentralized projects being awarded post the war. In fact, to lower the risk of the centralized desalination plants which are there in the Middle East. They have a strong execution track record, more than 2,300 projects in the last 3 decades. Order book position is excellent at about 15,000 crores, which is 4.5x FY25 revenue. And nearly 1/3 of this book is those high margin engineering and procurement orders. They also follow an asset light model, and O&M annuity business also has been steadily growing. So we have seen the Q3 earnings were decent. Revenue was up about 18.5%. Gross margins improved by 225 basis points to about 25%. And even as far as India is concerned, government focuses on clean water segment. And the ESG regulations are also tightening. So demand for water-related projects will move up, even domestically. So FY28, I'm expecting an EPS of 90. So the target price is 1620.
A lot of these new age companies are now finding buyers. So we spoke about Eternal and Urban Company. The one that is adding to that list right now is 197, Paytm basically. Paytm has seen a biggish sort of up move from the lows as well. And this, I don't know whether it's coinciding with PhonePe deciding to, delay their issue plans right now, given the sort of market circumstance that we are in right now. The big concern for them was, the subsidy that would come on these POS machines, which accounted for a fair amount of their earnings cushion. Amrish, do you have thoughts on Paytm?
I think, I mean, that will surely, I mean, have an effect going ahead. But, I mean, right now, I think it's because of that delay of PhonePe IPO, because of which this stock is moving up. I think it could be temporary. So I think the upside could be about, 1,080, 1,100 levels. I think going beyond that could be a bit difficult.
Another one which is surging is ITI, up 18%. Big volumes, has been up all through the day, and now with the market up move, it's extended its gain. ITI obviously has seen a cut over the last many months. Now, if you look at it, it's up 18%. Do you have a view on this one?
No, in fact, ITI I don't track, so difficult to give a view.
Okay, all right. Hi, Amrish. Good to see you, Ben. Any view on Ola? Came at very premium valuations, went up, then came down, saw a bounce back. It came down to around 22 rupees. Now it's seeing a bit of a bounce. At around 23 rupees, would you be a buyer, or you're saying there's too much of, hodgepodge that's gone around? Or you rather not, participate?
No, it depends, on what sort of investor you are. I mean, if you're a safe investor, even at 30 rupees or even at the current levels of 22, 23 rupees, I wouldn't say you should invest. But then if you're a risk taker, yes, because in case we see a decent move from here, it can actually double. Because see, it's been a major fall from grace. I mean, when the IPO came, post that, we saw levels of even 170. From those 70 levels, we saw 170, which was high expectations from the management. I mean, from there, we have moved to a trust deficit. So, end of the day, you are actually investing in a management. And when you know that the statements of the management don't really carry weight, I mean, every time they make an announcement, nothing really happens. So, for a safe investor, trying to stay out. But if you are a risk taker, yes, I think you can take that risk. Because I think one product which they are again talking about, I don't know whether it will finally come or not, is the inverter. I think that could be a game changer. If whatever they've announced is true, it can be a game changer. And the gigafactory which is there, which is, at least a good supply chain for the Ola scooters, I think, that's also a big positive. But like I said, question mark is how much weightage do you give to whatever the management says?
That's the if. That's the big if that you've spoken about here. And if you're a risky or risk-seeking trader, then maybe go ahead and buy Ola Electric. Finally, before we let you go, we have about a minute to close. Amrish, cement space, Ultratech, the top Nifty gainer right now. Following suit is Grasim. We've seen, a fair amount of price damage on these counters already. Do you want to back any stock in the cement space? Do you have a top pick here?
Yeah, again, if you're talking of longer term, you need to have cement in your portfolio. End of the day, infra growth in India is going to continue. We've seen that pace increasing in the last couple of years. I think that's going to continue. So one of the picks which I'll surely have in this space is Ambuja as well as Ultratech.
Got it. Okay, all right, Amrish. A short but effective chat. Thanks a lot for joining in and giving us that view. Let's do a quick recap then of markets today. The Nifty goes home with a gain of close to around 200 points, but at one point of time, we were on the verge of testing that 23,450 odd mark. Got rejected from the highs. There were a few stocks that bounced back. Ultratech Cement, Mahindra & Mahindra, Eternal, Grasim, Trent, all of them bounced back. Remember, these stocks have seen very, very aggressive selling, but they did fight back a little bit. The Nifty Bank recovered close to around 1,000 points from the lows of the day. Not a bad day to see the big boy put its hand up. HDFC Bank was quite strong in today's trading session. ITC as well was another name that did pretty well, and Axis Bank was higher. On the flip side, you had BEL that was lower in trade, and Max Health as well that did see some selling in today's trading session. Mangla?
Can't say the same about the mid-cap index though, Nigel. Even though we saw swift recovery in the frontline end of things, the Nifty ending with 200-point gains, the mid-cap index still has some lack of confidence, and that reflected in the BSE advanced decline ratio as well. Over 3,100 stocks in the red for about 1,670 in the green. In the NSE as well, 2,100 stocks ended in the red with about 960 in the green. Bandhan Bank was the top loser, 7.6% lower. Adani Total Gas, a big move we saw last week, and lower by about 7% right now as well. All the oil marketing companies, though on the way up, we did see some traction on persistent systems. Some names like ITI, Zydus Wellness, Chennai Petro towards the end of trade as well saw a spike of almost 6%. But on the way down, we did see names like HOEC, HPL Electric, TTK Prestige after a big move last week coming in for some selling, down almost 9% for TTK Prestige. So all in all, a good day of trade for the frontline indices, a big recovery from the lows for the Nifty Bank and the Nifty, not so much for the mid-cap index, sustaining this up move on the frontline indices will be crucial for the broader markets. With that, we wrap up on this edition of Closing Bell. Thank you so much for watching. Markets Forward comes up next.
Market stage a smart recovery after a volatile session. The frontline indices snap a 3-day losing streak with the Nifty closing above the 23,300 mark. The Nifty Bank also rebounds over 2% from the lows of the day.
Shares of IDBI Bank plunge in trade. Sources say the government is likely to put off the divestment plan after bids from Fairfax and Emirates NBD were below the reserve price.
HSBC downgrades India's oil marketing companies, HPCL, BPCL, IOC, and also cuts their earnings estimates, valuation multiples, and price targets. Says that higher crude prices have triggered a sharp reduction in their earnings potential. The entire pack gets hammered in trade.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear up for the next trading day. I'm Ritu Singh and with me is my colleague Hormaz Fatakia. What a day of recovery it's been after the kind of lows that we saw during the trading session today. The market's now ending very much in the green, up by more than 1% on both the frontline indices. It was the banking pack that had been dragging the markets lower, and it is a recovery in the banking pack that has now led the markets to close higher. Of course, also helped by some of the auto names, but HDFC Bank was a standout stock. That singularly helped the Nifty gain, the highest, perhaps one of the biggest pullers in the market today, while Airtel, BEL, these are some of the other names that dragged the markets lower. Sectorally, you had the auto, financial services, bank and FMCG that helped the markets gain, while on the flip side, you had the realty, pharma, energy and media packs as some of the bigger losers. Hormaz, but a good end to the trading day eventually.
Well, off the day's low, closer to the day's high, the bulls were praying for such a session for a while now. And it was the last 60 minutes that led to this bit of short covering that we saw. Of course, we were in extremely oversold territories, so a bounce was due. And the bounce did come after that intraday low of 22,955 that the index made earlier in the day. And of course, the bulls will take this. Of course, we head into the weekly expiry in tomorrow's session, so that will be an important one to watch. Also important to watch will be how Wall Street fares overnight. But we got you covered for the next 20 minutes with the big news and the key developments on Dalal Street, the top corporate voices, and important events to track ahead as well. Here's what we have in store for you today. Start with the top movers and shakers with Vivek. We discuss why IDBI Bank is under pressure, what is driving the rally in MCX, and the outlook for the Nifty, and the rationale behind PhonePe's decision to put its IPO on hold. Last but not the least, we delve into the key market events to watch for tomorrow's trading session. Over to Vivek first up, who is here with the top movers and shakers of the day. Vivek.
Well, thank you so much for that. Well, throughout the trading session, we were talking about how every rise was getting sold into, but the last hour was a completely different story. Like you just mentioned, a sharp bout of short covering is something that ensured all of the indices ended with gains. In terms of individual stocks, individual sectors, what did quite well? Well, the materials pack is something that recovered quite smartly. Cement stocks especially did quite well. Names like Grasim, Ultratech, JSW Steel, all of these names bounced back quite sharply. Along with that, large banks, most of them, remember, were sold into quite heavily in the last couple of weeks. Most of them made a bit of a bounce back. HDFC Bank almost 3% higher today, SBI, IndusInd Bank, and in the last hour, ICICI Bank too joined the party. Reliance Industries, of course, heavyweight as far as the entire index was concerned, one of the top gainers on the Nifty today, and a sharp bounce back there is also something that led to a bit of a recovery as far as the overall market was concerned. Moving on, have a look at a name like MRPL as well as Chennai Petro. Both of these names, remember, they gained significantly from very high GRM spot price on the Singapore exchange. Both of these names up on significant volumes in the session today. And lastly, MCX news report that we told you earlier about how FPIs could be given an entry into the lucrative commodity option segment is something that ensured that particular stock ended closer to the day's highest point. On the other hand, quite a few laggards. Remember, Brent continues to trade above the $100 a barrel mark. Oil prices are a bit of a worry. HSBC downgraded the oil marketing companies, so names like HPCL, BPCL, IOCL, all of them under significant pressure. IDBI Bank bids coming in below the base price as far as divestment was concerned. That is something that the street didn't like. The entire mid-cap IT basket, most of these names were under significant pressure today. Names like FirstSource, Birlasoft, Intellect Design, KPIT Tech, have seen significant derating in recent times. And lastly, when you're talking about a name like Happiest Mind, that particular stock, after a bout of a significant up move post the guidance upgrade, today that particular stock saw a bit of profit booking emerge.
Vivek, thanks very much for putting a spotlight on the top movers in trade today. But brokerages Citi and Nomura have cut Nifty's annual target, saying that rising crude oil prices and escalating West Asia conflict could weigh on India's growth and corporate earnings as well. Nomura has slashed the target by 15% to 24,300. Reema Tendulkar joins us now with the details of this interesting note. Reema.
Thanks so much for that. As you rightly pointed out, Nomura has lowered the Nifty year-end target to 24,900. This is on the back of an earnings cut by 7.5%, to a revision in the PE valuation multiple to 18.5 times. They're saying that if crude remains, say, till $90 per barrel, then the impact will be absorbed by the oil and gas companies and the government. But if it goes beyond $90 per barrel, then you will have that inflationary impact on consumers. It will impact the margins of many Indian IT companies. They're saying that on account of the war, we've already seen the Nifty correct by nearly 8% in the last 2 weeks. We've seen similar corrections to this magnitude in 2020 during COVID, 2022 when the Russia-Ukraine war conflict. They're saying if geopolitical hostilities persist, an additional 5% correction cannot be ruled out in the near term, with small and mid caps likely to be more vulnerable. But they believe a correction beyond 5% represents a long-term buying opportunity. Valuations today have come down to 17.8 times forward multiple, which is at the lower end of the 4-year range of 18 to 20 times. From a medium-term or long-term perspective, Nomura believes that there will be de-escalation in geopolitical tensions, a cooling off in the crude prices, but the timeline for that remains a bit uncertain. They've downgraded real estate from bullish to bearish. They see potential demand headwinds there. Their preferred sectors include utilities, coal, oil producers, healthcare, pharma, consumer staples, telecom. They're underweight infrastructure, capital goods, healthcare services, consumer discretionary on account of high valuation multiples. And they've also made some changes in their portfolio. For instance, SBI has now been removed after a strong outperformance. Asian Paints is also out of their model portfolio on account of margin pressures. Ashok Leyland is removed. They've replaced L&T with Adani Ports, and they've added Lloyd Metals as the new initiation.
Reema, thank you for that update there. To take this discussion forward, we are now being joined by independent market expert Amrish Baliga and Jay Thakkar from ICICI Securities. Gentlemen, good afternoon. Thank you for joining in. Before I get to Amrish, Jay, the bounce that you have seen today, you would call it just a technical bounce and use this bounce to reduce your positions? Your call on the index.
Good afternoon to you, Hormaz and Ritu. Well, see, Hormaz, I would say one thing that yes, today the market have bounced back from quite an oversold territory as well as psychological level of 23,000 on a closing basis. We had that gap area of 23,000 to 23,200, which got filled today. And thereafter, we have got this close, well in the positive territory, and wherein Nifty was up by almost 1%. And we have seen a good bounce back coming in Bank Nifty as well. With last trading session, the FI net shorts have gone to 2.6 lakh contracts. The India VIX, in fact, today had fallen, and now if you see the index made a new low, recent low in this fall. And if you see, Hormaz, then since last 2 or 3 trading sessions, India VIX is unable to surpass its previous highs of 24, clearly showing a divergence wherein Nifty is falling or making new lows, fresh lows, and India VIX is not making highs. So there is a good probability of a bounce back or a short covering from these levels until 23,000 levels are held. I think we can see Nifty going up to 23,800 to 24,000 levels, at least for this series. I think 23,000 remains a very crucial support.
Yes, 23,000 a crucial support. But Amrish, very quickly, the story of the day has been IDBI Bank, the government looking to scrap the process because the bids were just even below the reserve price. The stock was down, almost 16.5% today, 30% in the last 1 month. At 1.5 times price to book now, does it still make a case for buying, or, do you see this as a protracted process, and is this something you'd stay away from?
No, see, first of all, this was a major hope for the public shareholders, the strategic sale. I mean, it's been on for so many years. If I'm not wrong, since 2021, I mean, every now and then we keep hearing there have been major talks, but nothing has happened. And I mean, this time there was a big hope that it will happen because even the government has a divestment target of about 80,000 crores. This would have given nearly 50% of that target. So now, with this being scrapped, I don't know how long it's going to take, because I think we'll need to wait for the market conditions to improve, and that's some time away. So I would say that those who possibly have a holding capacity of more than 12 months, I think they are the ones who could possibly look to buy at these levels. It's possible we could see either 5-10 rupees lower than here. But then, anyway, the fall has been major. So buy for the next announcement, which hopefully should happen over the next 10 to 12 months.
Indeed, that's the story of the day, right? IDBI Bank, and in case those who just joined in and missed the story, Gaurav is here to break that down for us. Gaurav.
Well, yes, IDBI Bank was in focus, and the reason being that, as per sources, bids that were made for IDBI Bank's stake sale were lower than the reserve price, and that is something which indicates that the deal is not likely to happen in this FY. Now, there were two prominent names which were coming in. First is Emirates NBD, and second is Fairfax. Now, if you look at the history as well, Emirates NBD already has signed a deal with RBL, where they will be owning around 60% stake, which will be a majority stakeholder. And when it comes to Fairfax as well, they also own around 40% stake in CSB Bank, and they are being called as the promoter of the bank. So, given that these conditions were also there, and now the bids were lower than the reserve price, it seems that the deal is not going to happen. As we have seen earlier as well, this deal has always been at the forefront when it comes to divestment plans from government. Since FY21, we were seeing some updates coming up on the divestment plan of IDBI Bank. And in fact, even if you look at the shareholding pattern, Government of India and LIC both together holds more than 90% stake, and they were going to offload around 60% stake from the company, from which government was likely to get more than 30,000 crores. Now, given that these plans are delayed or rather cancelled, that's the reason why we saw share price tumbling almost by 16%. But even at this level, even if you look at the valuation, it trades at 1.5 times price to book. If we compare it with other PSUs who were candidates for the stake sale from the government because of the minimum public shareholding norms, even if that level, some banks are still cheaper than the IDBI Bank, and that's the reason why it will be really interesting to see if investors see this as an opportunity, because in the last 1 month we have seen the stock tanking almost by 30%, or they would rather wait and see further cool off in the stock price. But for now, 15% fall is what we saw in IDBI Bank.
Yes, Gaurav, thanks very much for taking us through that. 5 years and counting, and we're back to square one. The other sort of news that has been in focus today is the PhonePe IPO getting deferred. Now, while the stock itself is not listed, you saw a reaction in the Paytm stock, 197 stock surging on the back of this news coming in, because PhonePe, remember, is a key competitor for, Paytm as well. And now PhonePe has deferred its IPO, citing the current geopolitical conflict and the market volatility, and said it is going to resume this listing process once there is some stability. In a statement as well, you had the CEO, Sameer Nigam, saying that, they remain committed to a public listing in India. Remember, they had received SEBI's approval for this public listing in January of this year, and because it was a confidential DRHP, they have a 16-month window until May of 2027 to go public. And as per our sources, they are going to utilize that, depending, of course, on the market volatility. As far as the valuation is concerned, according to various reports, $15 billion is the number that PhonePe was looking at. The offer itself was completely an offer for sale, about 13,500 crores, where you had key investors like Tiger Global and Microsoft Global Finance that were looking to fully exit, while the promoter was looking to offload about a 9% stake. Now, PhonePe is one of the largest fintech companies in India, a broad range of services, including payment services to both merchants and customers. Importantly, it is the largest UPI player as a third-party application provider with a 45% plus share in the market. Of course, there is that overhang from NPCI to cap the market share at 30%. That remains. But that said, it was a highly anticipated listing that has now been deferred. Let's go back across to our guests who are standing by. Ambrish, any thoughts on this PhonePe IPO getting deferred, and at least the near-term breather it seems the market seems to be determining for Paytm?
Absolutely. I think it's a near-term breather for Paytm, because of which we saw the stock bouncing back well. But then we should remember that overhang always is there of the withdrawal of government incentives for digital payments, which I think will still have that pressure on Paytm margins. So I think the upside from here for Paytm is limited. Maybe it can go to levels of about 1,080, 1,100 levels. I think beyond that could be a bit of it.
Beyond that could be a bit of a push for Paytm. 1,080, 1,100 being the fair levels is what Ambrish is projecting. But moving on, sources have told CNBC TV18 that a SEBI-appointed panel has sought feedback from exchanges on a proposal to allow FPIs in commodity options. Yash is here with more details on this. Yash.
Well, Hormas, time and again, market regulator SEBI has expressed its intention to sort of expand the commodity derivatives market to get more participation into it and increase the depth. And this move could be one in that direction. Exactly what we've been given to understand from our sources is that CDAC, which is Commodity Derivatives Advisory Committee appointed by market regulator SEBI, very recently met and one proposal which was discussed in that meeting was to allow foreign portfolio investors or FPIs into options trading in commodity derivatives. What we've been given to understand is that the meeting concluded on the point that a feedback sort of will be sought by various exchanges, the National Stock Exchange, BSE, MCX, NCDEX, on how foreign portfolio investors can be allowed when it comes to options trading in commodity derivatives. What, according to our sources, CDAC discussed is that if foreign portfolio investors are allowed, it should start with gold and silver, and then base metals could be looked at as far as that particular participation from foreign portfolio investors is concerned. We've also written to market regulator SEBI on this thing. A response from SEBI is still awaited, but sources also indicate to us that all the exchanges are expected to submit their response to CDAC before that Commodity Derivatives Advisory Committee meets next.
Yash, thank you for that update there. Jay, moving on from what Yash was mentioning, but the two stocks that stood out today on the moves on the Nifty 500 were MRPL and Chennai Petro. MRPL was up 16%, Chennai Petro was up 8%. Now, what are the important levels that you're watching out for here? Do you book profits here, or do you believe that they are in a much more sustained uptrend compared to the market?
I think MRPL is, definitely, because, MRPL, I would say that was consolidating within the range of, say, 150 to 30 for almost, more than 2 decades, from 2006 to almost 2023. So almost 2 decades, it was consolidating within this range of 150. And now if you see that in the previous fall, it did not sustain below 150. In fact, it made a good comeback, and now it's trading well above the levels of 200. So I think it has got more approved from year on to. I think that anything double or triple from 150 level breakout could not be ruled out from the long-term perspective, and that comes to the target of 300 on MRPL. So I think that from current levels as well, you still have a better risk reward of 1:2. So if I have to choose one out of these two, then it would be MRPL definitely, based on its long-term trend.
Okay, gentlemen, Jay and Ambrish, thank you so much for joining in. We appreciate your time, but we have to slip into a short break. Up next, we'll get you some of the key events to watch out for, and we return.
Welcome back. Now, earlier in the day, we were having a conversation with Matt Orton of Raymond James Investment, who says that the uncertainty around the West Asia conflict could keep oil prices elevated. He added that the firm has aggressively de-risked its portfolio and is cautious on emerging markets. Meanwhile, Rohit Srivastava adds that the rising global bond yields are increasing liquidity concerns. Listen into what they had to say.
I've been generally de-risking portfolios just because of other factors that I didn't like how they were playing out in the market, but I've aggressively de-risked over the past few weeks, and I'm perfectly fine sitting on elevated levels of cash, getting a shopping list ready for high quality assets with good balance sheets, revenues that are generally insulated from whatever is happening with respect to the war, and eventually we'll take the elevator back up. But there could be a couple more slashes, a couple more steps downward before we actually get to that capitulation moment with respect to the war. But the main concern is the longer that this plays out, the longer that the strait is closed, it increases the probability of elevated oil prices. And this is not something that a ceasefire can immediately turn back on, because we're turning off production in the Middle East, and that takes a while to get back online. So there will be disruptions even after this war temporarily or permanently wraps up.
Don't look for a particular level. People obsess with, is the bottom going to be at 22, 21, 19? I'm like, it's not about a level, but do we price in the risk in terms of India VIX or the volatility index? So the volatility index has two key levels. One is close to around 24, 25, which we've seen during the India-Pak war, the Israel attacks, even the Adani fiasco when it happened more than a year ago with the yen carry trade. But there are a couple of times we went to 30, 35, and that is, I think, more relevant. We got there, I think, even when the Russia-Ukraine attacks happened. And I think that's a level where we would get, maximum panic. So while markets are down, the India VIX doesn't reflect that people have, reached an extreme in terms of panic. And that is when we would take a call as to, whether we should book those hedges.
Okay, and before we wrap, we'll get you some of the key market events to watch out for in trade tomorrow. Gaurav Javalkar is standing by with those. Gaurav.
Yes. If you look at the market and how it is going to perform tomorrow, the West Asia war is something which is an important thing to watch out for. And we have been seeing this updates for the last few weeks itself. Now, the important update is that now United Nations experts are going to brief in media, and they will be talking about the war in Iran. And that is something that we will be closely watching out for, as if there are any comments to be made or any new development that we should know. Apart from that, from the US market, important event is the FOMC meet, where they will decide on the interest rates. Now, consensus believe that the interest rates will remain in the same range of 3.5 to 3.75%. The stable update is what they are expecting. But let's see if there is anything new data point that the Fed is also looking at, because there is an ongoing war. Apart from that, let's also not forget about producers price index, ADP employment change data. That is something that we will be tracking from the US market and from the Indian market. First, let's talk about the insurance companies. Now, insurance CEOs are going to meet IIDAI to discuss Bima Sugam product launch. Now, on the back of that, we will be watching all the insurance companies like SBI Life, ICICI Life, HDFC Life, and at the same time, let's also not forget about PB Fintech. And lastly, let's also not forget about the CleanMax Enviro Energy. This company, they will be announcing their third quarter's numbers, and we will also be watching out for PFC and Five-Star Business, because there will be board meeting for both the companies to consider fundraise via debt or other instruments. So let's see if there is anything significant that we should be reading out from these announcements, and see how the market performs tomorrow.
Gaurav, thank you for those updates there. Take a leave on this edition of Markets Forward from Ritu and me. Thank you for watching. We continue with more news and updates on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. US President Trump presses NATO allies and China to help secure safe passage through the Strait of Hormuz as the West Asia war stalls shipping. Trump threatens to delay his scheduled visit to China. India's Foreign Minister Jaishankar says talks with Iran are yielding results. The war in West Asia enters a third week. Israel continues to bomb Iran, says they still have thousands of targets in Iran, begins limited ground operations in southern Lebanon. Flights resume at Dubai airport after a drone-related incident sparked a fuel tank fire nearby. A port in UAE has also been hit. A relief rally on the last street sees the Nifty and Sensex snap a three-day losing streak. Nifty ends above 23,400. Brokerages Citi and Nomura trim Nifty year-end targets amid the West Asia conflict. Nomura cuts target to 24,900 from 29,300. India's trade deficit narrows to $27 billion in February ahead of the crisis in West Asia. Imports declined by 24%. Exports remain largely steady. Rupee continues to languish near record lows against the dollar. The big exclusive from India Business Leader Awards. Commerce Minister Piyush Goyal says the government stands by its proposed trade agreement with the United States, clarifies that government will not provide access to crops in India in which India has attained self-sufficiency. Goyal says this tantamounts to up to 95% of American major crops not being allowed entry. Kumar Mangalam Birla bets on scale and new sectors for growth, says cement capacity will hit 200 million tons, making it the second largest in the world. Birla was named Entrepreneur of the Year at the CNBC TV18 India Business Leader Awards. Walmart-backed PhonePe temporarily defers its IPO plans, citing geopolitical tensions and market volatility. Reiterates commitment to go public in India. SEBI approval for the IPO will lapse by May 2027. Shares of IDBI Bank plunge in trade. Sources say government is likely to put off the divestment plan after bids from Fairfax and Emirates NBD were below the reserve price. A parliamentary panel flags gaps in the government incentive scheme for electric vehicles, questions stringent eligibility rules for two-wheelers and proposes relaxations. Startups like Ather Energy did not qualify for the scheme even as established players made the cut. Once valued at over $3 billion, Unacademy is sold to Upgrad for just $300 million, a 90% drop from peak valuation as EdTech continues to unravel. Over 2,000 firms have shut shop since the pandemic. Paul Thomas Anderson's one battle after another wins 6 Oscars, including Best Picture and Best Director. Michael B. Jordan wins Best Actor for Sinners. Jessie Buckley takes Best Actress for Hamnet. K-pop Demon Hunters makes history as the first K-pop film to win Best Animated Feature. Right to the top story this evening. The US and Israel have intensified attacks on Iran as the war in West Asia rages on for a third straight week. A new wave of explosions shook the Iranian capital of Tehran as Israel conducted large-scale overnight strikes. Health officials say that 503 people have been killed in the Tehran province alone since the start of the conflict. Lebanon's capital also continued to feel the onslaught of Israel's airstrikes. Officials say that the death toll in the country has crossed 850. Tel Aviv said that it has begun ground operations in southern Lebanon to tackle militant group Hezbollah. Escalations continued in the Gulf region. Authorities suspended flights at Dubai International Airport after a drone incident sparked a fire nearby. The fire has been brought under control and no injuries have been reported. In Abu Dhabi, a Palestinian civilian was killed on the outskirts when missile debris hit a car. A drone attack on oil infrastructure in a major oil industry zone on the UAE's east coast sparked a large fire. The Emirati Defense Ministry said its air defense systems were intercepting a wave of Iranian drones and missiles. Meanwhile, Saudi Arabia said it intercepted 61 drones in the east of the country since midnight. Bahrain, Qatar and Kuwait also intercepted Iranian drone attacks. Brent crude prices remained above the $100 mark as US President Donald Trump presses NATO allies and China to help open up the Strait of Hormuz. Trump also threatened to delay his scheduled visit to China in a bid to ramp up pressure on Beijing to help reopen the strait. A call for de-escalation echoed from countries globally, with India also engaging in diplomatic discussions with Iran. In an interview to Financial Times, External Affairs Minister S. Jaishankar said that his talks with Iranian officials, and I quote, are yielding some results. He added that there is no blanket arrangement for all Indian ships to pass through the Strait of Hormuz. Trump has yet again repeated his assertion that Iran wants a deal badly, but he maintained that they are ready to do what they need to do to secure an agreement. He also added that he isn't ready to make a deal yet. However, Iranian Foreign Minister said that Tehran has never asked for a negotiation.
They want to negotiate. They want to negotiate badly. I don't think they're ready. Just on what I'm hearing, they want to negotiate badly, as they should. But I don't think they're ready to do what they have to do. I think they will be, but it's okay.
So do you mention are there any diplomatic talks going on between the U.S. and Iran at all?
Yeah. We're talking. But I don't think they're ready. But they get pretty close. We are talking to other countries about working with us for the policing of the strait. And I think we're getting good response. If we do, that's great. And if we don't, that's great. But as an example, it's about 90% of it's all from the Hormuz Strait. And nice to have other countries police that with us. It will help work militarily with, as far as I'm concerned, we've essentially defeated Iran.
Well, as a matter of fact, the Strait of Hormuz is open. It is only closed to the tankers and ships belong to our enemies, to those who are attacking us and their allies. Others are free to pass. Our armed forces have already answered that they would retaliate if our oil and energy infrastructure are attacked. And they will attack any energy infrastructure in the region which belongs to an American company or an American company is a shareholder. So the reaction would be clear.
Now, US President Trump's calls to build a coalition and secure the Strait of Hormuz is appearing to fall on deaf ears. NATO allies like Japan and Australia have said they have no plans to send any military vessels. Santiago is here with more on the response to Trump's calls to address the energy crisis. Santia, how are these countries responding to Trump's calls?
Since Trump's call for help, responses from these countries have started coming in, and not quite in the way Washington may have hoped. So far, not a single country has committed to sending warships. Most responses have been cautious, vague, and largely non-committal. Let's take a look at where key countries stand. Starting with the UK, British media has reported that Keir Starmer said no to Trump's warship request over a phone call that took place between the two leaders. An official statement from the UK's Ministry of Defence says London is in discussions with allies over a range of options to ensure shipping security in the region. UK Energy Secretary Ed Miliband also said the UK is in talks with the US and other partners on how to keep the strait open, adding that options like mine hunting, drones are being considered. Japan's response has been even more cautious. Tokyo says the threshold for sending its warships to help protect the Strait of Hormuz is extremely high. Germany and Australia have also ruled out sending any warships to the Strait of Hormuz. South Korea says it is closely monitoring Trump's remarks and the situation in the Middle East. Seoul says it will review the matter in coordination with Washington while exploring measures to protect its citizens and ensure the safety of energy transport routes. China, meanwhile, has simply called for an immediate cessation of hostilities, making no comment on Trump's request for naval support. France has also made its position clear, saying it will maintain a purely defensive posture and will not be sending warships to the Strait of Hormuz. So at this point, while discussions are underway, Trump's call for a multinational naval presence in the Strait of Hormuz has yet to translate into any concrete military commitments.
All right, thank you, Satya, for that update. Let's put the spotlight on the markets now. The Wall Street stages a smart recovery after a volatile session. Nifty and Sensex snapped its three-day losing streak. Nifty ended above the 23,400 mark, while Nifty Bank recovered over 1,000 points from lows. However, the mid-caps underperformed the blue chips. Meanwhile, brokerage firms Citi and Nomura trimmed their year-end targets for the Nifty amid the West Asia conflict. Nomura has cut its target to 24,900 versus its earlier target of 29,300. The Commerce Minister Piyush Goyal has said that the government stands by its proposed trade agreement with the United States. Speaking at CNBC TV18's India Business Leader Awards, he clarified that the government will not provide access to crops in which India has attained self-sufficiency. Goyal added that this means 90 or 95% of America's crops will not be allowed entry into the Indian market.
India stands by the trade agreement with the US. All GM products will not be allowed entry into India, which means almost 90 or 95% of American major crops are just not allowed entry into India.
Right.
So whether it's corn, whether it's soy meal, whether it's rice, wheat, millets, some of the pulses, many items which we are self-sufficient in, there's no market access that we have given.
Senior officials across ministries briefed the media on the West Asia war and the LPG rationing in India, which has hit restaurants the hardest. The Petroleum Ministry has said that while the LPG situation continues to be worrying, no dryouts have been reported so far.
LPG मैं दोबारा से वही बात दोहराऊंगी कि स्थिति अभी चिंताजनक है, लेकिन हमारे डोमेस्टिक एलपीजी कंज्यूमर्स को एलपीजी की सप्लाई की जा रही है और डिस्ट्रीब्यूटरशिप्स पर कोई ड्राई आउट रिपोर्टेड नहीं है.
I'm at Delhi's most iconic Chana Bhatura place, Sitaram Devanchand store in Paharganj. Had it been a regular day, I would not have got a space to even stand here, forget about walking in this outlet so freely. It would have tables all around, people coming in and going, rather people waiting in long queues to get that taste of Chana Bhatura, which Delhi is famous for. This place, which is selling Chana Bhatura since 1970, has shut down for the first time, and that too because of LPG crisis.
I haven't seen this phase in my whole life, and yeah, this is the first time, and yeah, we are trying to shift on PNGs also. We have been applied for that also. It will be taking around 7 to 10 days for that, and hopefully if the things get better, we will be starting our operations very soon.
I'm at ITO, the iconic place for the press street and all the nearby government offices, etc., who come here to have their daily meals, both lunch and dinner. These dhabas operate 24/7. And now with the LPG crisis, they are facing a tough time.
मेनू आधा कर दिया ना हमने. कुछ हमारा जो मेनू था उसमें हमने मतलब 40% का समझ लो वो कर दिया है कि हम कम आइटम बना रहे हैं आजकल. गैस सिलेंडर है नहीं तो जितना हो पाता है हम तंदूर पे चला कर जैसे भी बनाते हैं उसके बाद छोड़ देते हैं. बाकी पब्लिक भी समझ रही है कि क्राइसिस तो पूरे यहाँ स्पेशली कोई इस एरिया में नहीं है, पूरे ऑल ओवर इंडिया में ही है वो सब चीज़ें.
Loss of livelihoods, loss of earning, loss of income. They have to sustain their staff because the staff cannot go. And to sustain their salaries, they are unable to function properly. Meanwhile, they are resorting to alternates of using coal and wood-fired tandoors so that they can keep at least bare minimum supplies.
All right, fintech startup PhonePe has temporarily deferred its plans to enter Dalal Street. The company has said that this move was largely due to the current geopolitical conflicts and market volatility. The company will resume the listing process once there is some stability in global capital markets. PhonePe CEO Sameer Nigam says the company remains committed to a public listing in India. Remember, since PhonePe did a confidential filing, it has a 16-month window after SEBI's approval. The current approval will only lapse by May 2027. Now, shares of IDBI Bank crashed 16% in today's trade. This after sources told CNBC TV18 that the bank's divestment process has been scrapped after bids came in below reserve price. The privatization plan was formalized in the 2021 budget and the process officially began in October 2022. A parliamentary committee has raised concerns about the government incentive scheme for electric vehicles. The committee questioned stringent eligibility rules for two-wheelers and proposes relaxations. This as startups like Ather Energy did not qualify for the scheme, even as established players made the cut. The panel said that strict global revenue and investment thresholds may be limiting participation. Another big headline, India's trade deficit narrows to $27 billion in February ahead of the crisis. In West Asia, imports declined by 24%, while exports remained largely steady. Meanwhile, the rupee continued to languish near record lows against the dollar. Lata Venkatesh is here with more on the trade deficit and the rupee. Lata.
Well, the negative from the April-February data is that if you took the entire 10 months, then the goods and services deficit is 20% higher than last year. That's not a laughable number. Positive only for February, the goods import is down to 63 billion from 71.2 billion year ago. That is, from 71.2 billion in January. So compared to January, we have imported less. But this is usually the case because February is a shorter month, shorter by 3 days. The other positive, if you may say so, the monthly goods plus services deficit only for February is down to 3.96. In January, it was about 10.4. So at least that deficit has come down. However, if you looked at exports alone, exports have been flat month on month, year on year. It is 36.5 billion in January, 36.6 billion in February, and last year in February it was 36.9 billion. So, we are not been able to promote exports to other destinations if we have lost in the US. The important point is because we have now got a trade deficit in Jan and Feb, as you can see on the screen, and there is an oil flare-up in March, so we will definitely have a deficit in March as well. Hopes of economists that for the entire Q4 we may have a current account surplus are totally dashed. These hopes arose because Q4 of last year we had a current account surplus. Not possible to repeat that. Finally, on gold, which everyone would want to know, it remains a pain point. Gold imports, if you took April to February, the entire 10 months, it is up by 20%. But don't blame Indians for importing more. The volume has come down 8%, but price is up 30%. In any case, the March data is going to be more crucial. This is just February. March usually has imports and exports double that of an average past 11 months. It's a very busy month for importers and exporters. So anything negative there is going to really hurt.
All right. Thank you, Lata ma'am, for that update. On that note, we'll slip into a short break. Coming up next, once valued at over $3 billion, Unacademy is sold to Upgrad for just $300 million. That and more when we return. Welcome back. The Delhi High Court granted time to former Delhi Chief Minister Arvind Kejriwal, Manish Sisodia, and other accused to file their responses to a petition filed by CBI. The agency has challenged a trial court order that discharged the AAP leaders in the alleged liquor policy corruption case. During the hearing, CBI told the court that serious allegations cannot be made and then abandoned. The High Court has now deferred the matter to April 6th. Once valued at over $3 billion, Unacademy has been sold to Upgrad for just $300 million. This is a 90% drop from its peak valuation. India's edtech sector continues to unravel as funding falls and over 2,000 firms shutting shop since the pandemic. Rachna Dhanrajani is here with the details. Rachna, please take us through the consolidation being seen in India's edtech.
Well, the acquisition of Unacademy by Upgrad is more than just another startup deal. It reflects a major shift underway in India's edtech industry. Because just a few years ago, edtech was one of the hottest sectors in the country's startup ecosystem. The opportunity looked enormous, and India has more than 250 million school students and the world's largest population between the ages of 5 and 24, making it one of the biggest education markets globally, and also what it seemed like at its peak. When the pandemic shut classrooms, millions of students moved online almost overnight. EdTech platforms suddenly became the primary way students learned, and investors rushed in on the opportunity. In 2021 alone, more than $5 billion flowed into the sector as startups expanded aggressively, hired thousands of employees, and spent heavily to acquire users. But when schools reopened, the industry faced a sharp reality check. Demand for purely online learning began to normalize, while many companies were left with expensive business models built during the boom. High marketing costs, large sales teams, and aggressive growth targets. The most dramatic example, of course, was Byju's, which was once valued at $22 billion. It became India's most valuable startup, but eventually entered insolvency proceedings in 2024. And that's the context behind the Upgrad Unacademy deal. Unacademy itself had reached a $3.4 billion valuation, but is now being acquired in an all-stock transaction, reportedly valuing it roughly around $300 million, though official figures are not out yet, and the founder has said they will only come out once the regulatory approvals come through. So this just highlights how sharply the sector is resetting. But the story isn't only about the decline. It's also about survival and reinvention, because some companies have adapted better. Physicswala, for example, focused on affordability and disciplined spending, built a hybrid model combining online and offline coaching, and eventually went on to list even as competitors continued to struggle. And now the sector is entering a new phase, the one focused on profitability, consolidation, and new technologies like AI-driven personalized learning. The boom years created dozens of startups. The downturn forced a reset, with nearly 2,000 edtech startups shutting down in the past 5 years as per traction data. And deals like the one between Upgrad and Unacademy signal what the next phase may look like, which could be consolidation across segments. Unacademy brings strength in K-12 and test prep, while Upgrad has built its business around higher education and professional upskilling, expanding the combined platform reach across a much wider learner base. In fact, the combined revenue rate that is estimated is about 2,500 crore rupees. So it's safe to say that the companies that survive this reset will likely shape how millions of Indians learn in the decade ahead, and the Upgrad Unacademy deal could be an early glimpse of that future.
All right, thank you, Rachna, for that update. With that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
Asset Management presents Capital Horizon Summit in association with CNBC TV18.
Hello and welcome to the curtain raiser episode of Capital Horizon Summit presented by Neo Asset Management in association with CNBC TV18. I'm Prashant Nair. At a time when global markets remain volatile and traditional asset classes continue to move through cycles, investors are asking more fundamental questions. Where is durable long-term value being created? And how can capital participate responsibly in India's growth story? Family offices are emerging as a powerful force in this shift. Backed by generational capital, longer investment horizons, and the growing influence of next-gen decision makers, private markets are steadily moving from the periphery to the core of asset allocation strategies. This curtain raiser episode sets the intellectual foundation for the Capital Horizon Summit. Over the next half hour, we'll explore why private capital matters more than ever before, how it is being structured in India, the risks investors must navigate, and why discipline remains critical to protecting and compounding capital over the long term. Joining me to decode this evolving investment landscape is the senior leadership team of Neo Asset Management, part of the Neo Group, which today oversees 1 lakh crores of client assets. Neo Group has emerged as one of India's fastest growing wealth and asset management firms, guided by a philosophy of trust, transparency, and unbiased advice, with a clear commitment to do good for investors and the broader financial ecosystem. I'm delighted to welcome Nitin Jain, Chairman and Managing Director of Neo Group. He's joining us virtually today. Ladies and gentlemen, Nitin is a respected industry veteran with deep experience in building and scaling financial services platforms. Joining us from the studio are Hemant Daga, co-founder of Neo Group and CEO of Neo Asset Management. With him is Puneet Jain, co-founder of Neo Group and Chief Investment Officer at Neo Asset Management. Welcome to this program. It's a pleasure to have you all with us today. And I want to just start with Nitin first. Nitin, over the last few years, private capital has moved from the margins to the center of investment conversations in India. Could you tell us what has changed, and are we witnessing a rare alignment of growth, policy, and capital maturity? How is it evolving in India currently?
Oh, first of all, thank you for having me, Prashant. I think I've been quite lucky to have witnessed this spectacular growth in private markets over the last 20 years. I remember from maybe a handful of private equity players in early 2000s to today we are more than probably 100 meaningful private equity, private debt, hedge fund players in the country, and more than $350 billion of AUM. I think the industry has really come of age. I think there are many factors why this has become such an important part of capital markets now in India. So when you think about the demand side of the equation, I think probably India is one of the very few emerging markets which provides the kind of diversified investment opportunities as far as sectors are concerned, sizes are concerned, etc. And the ambition of the entrepreneurs. I think a lot of entrepreneurs today, when you look at them, I think they're all shooting for global ambition, and that is the right environment for private equity, private debt to come in. I think from a supply side, I must say, of course, India is a very interesting asset class per se from a global asset allocation perspective. But also, I think what SEBI has done to ensure that a lot of domestic capital through AIFs can participate in these opportunities, I think that has been very, very progressive.
Well, that's well put, Nitin. Now, coming to both of you, gentlemen, if I can start with you, Hemant. Public markets are volatile, interest rates are cyclical, right? So things like private credit, infrastructure, private equity, are they becoming core investment avenues from an investor standpoint? And how should we think about liquidity management? Because these are not what investors have traditionally been familiar with in that sense. Hemant.
So conceptually, Prashant, public markets are a beta play on markets. And hence, by nature, the returns will be volatile.
Yeah.
I think what's interesting in private markets is that they offer a very different range of solutions to clients. So they can be pure income generating solutions, directly linked to the cash flows of the assets. For example, an infrastructure asset, right? Deriving annuity cash flows from the underlying asset. Or they can be a mixture of income plus growth assets, right? The very fact that the nature of income is very different from public markets, it adds serious diversification to client portfolios. Globally, what's very interesting is some of the world's largest pension funds and insurance companies have close to 30 to 60% of their portfolios in private markets. And their returns are really stellar. They've delivered 10% compounded dollar returns over the last decade on billions of dollars. Clearly making the case for private markets to be an integral part of clients' allocations. And in India also, we are seeing 5 to 30% of allocations in client portfolios to private markets. It's a trend that's growing exponentially. So yes, private markets offer serious diversification. They offer good risk-adjusted returns, and hence they are a compelling play in every client's portfolio. Now, coming to your question on liquidity, I think it's an important one, but sometimes I think it's overtly focused on. 5 to 30% of a client's portfolio, if it's in slightly longer locked duration assets, I think it's a relatively easily manageable proposition. Secondly, it's not that these assets are not throwing income regularly. They are throwing income. So in a way, they are throwing cash flows. Also, some of the asset class plays within private markets, so for example, a listed REIT, a listed InvIT, fundamentally by nature are liquid, right? Then you also have some funds which are called liquid alternatives. So if they are liquid alternatives, they offer interim liquidity. I think liquidity for the risk return that you want to achieve can be easily managed by portfolio allocations and the choice of the solutions that clients go for.
Do you foresee the growth in these assets, what we spoke about, what you described, to follow the same pattern what we've seen globally? Because globally, I mean, these asset classes are huge, humongous, right? Would you say we see something similar in terms of growth trajectory in each of these asset classes we spoke to with regards to what we've seen overseas?
Interesting question. Actually, we are already seeing that. If you look at the Indian AIF industry, it started in 2014-15. Over the last 10 years, we've now become a 14 lakh crore industry pool. And then there is offshore capital coupled with this, which will take it closer to 25 to 30 lakh crores. And just to put that in context, 25 to 30 lakh crores is versus a mutual fund industry which is close to 80 lakh crores. So we are close to 30% of the mutual fund industry already in private markets and growing at 25 to 30% per annum. And that is how what global markets have experienced also. And we are seeing those trends play out very, very similarly in India. And I would attribute that to the returns that some of these asset classes offer, plus the diversification that some of these asset classes offer. So conceptually, if you look at it, any asset class derives its returns from the underlying assets, right? So in equities, people expect to make nominal GDP plus maybe a risk premium to every company, right? So if India is growing at 10, 11%, add 3, 4%, and your expected equity returns are maybe 14 to 15. Similarly, in private markets, if you're investing in a commercial real estate, the rental yield will be 7 to 9%, plus there is a growth aspect, right? So typically, investors can make underlying asset class returns of 7 to 9, plus a growth premium closer to 12 to 14. And hence, the fact that these asset classes are deriving fundamental returns from the underlying assets, whether through cash flows or capital gains, is making a compelling story for their growth to continue.
Any pitfalls one should be mindful of, again, taking the global experience?
I think extremely important to evaluate risk. And this is a very cliched answer, but I think governance of the asset management firms offering these solutions to clients. I think SEBI has gone a long way in really reinforcing the governance mechanisms in India.
Puneet, let me come to you, and specifically with regards to private credit, right? What's the role of private credit really at a fundamental level? I mean, is it to fill the funding gaps where sort of banks don't want to step in? Are they competing with banks? Are they sort of, filling the gaps, as I said, where banks they don't want to provide funding? What's the fundamental role? What's the growth visibility, growth runway, roadmap for this asset class?
I think yes, Prashant, this is a very important question. The first and foremost is that they are complementary to banks. If you see private credit, they typically provide 3 key functions. The first is refinancing. In many cases, the companies want elongation of the liability profile, which banks are not able to provide. This is where private credit comes in. The second, which is very important, is last mile capex or working capital. We see many examples where asset has been created, but there is no working capital available for the plant to start.
Sure.
That money is being provided by private credit. And the third is stake acquisition. Now, whatever public markets are behaving at this point of time, many of the promoters do want to buy other promoters out. Sometimes they want to buy private equity out. This kind of capital is not available from the banking system. So private credit provides unique three needs. In fact, I will go on to say that in many cases, private credit actually protects asset value. If a private credit is protecting asset value, he is actually doing a favor to the banking system, because we have seen multiple examples where companies have finished 90% of the capex. If 90% of the capex has been finished, but banks cannot provide last 10% capex, unless private credit steps in and provides 10% of the funding, the entire capex may not get completed. So to that extent, what you are doing is that you are protecting banking capital, you are protecting whatever money has been invested in the company and completing the asset value. So overall enhancing value of the ecosystem, plus you are also preventing large number of jobs by doing this process. Similarly, we have done funding where the plant was 100% complete, but there was no working capital in the system. So which means that unless we funded, so like if a company doesn't have any working capital and capex is complete, there will be no profitability. By our funding, the plant has become profitable. They have been able to service banks in a lot better manner through our funding. So 100%, I do think that it is complementary to bank funding. Yes.
You know, let me go back to Nitin. Nitin, how have Indian family offices evolved over the last decade in terms of decision making and asset allocation? I know it's a slightly broader question, but an important one, because they're increasing exposure to private markets. Which capabilities matter most, sourcing, underwriting, or governance, in your opinion?
I think it's been one of the most fascinating developments in India for the last 10 years or so. I think from a handful of family offices, say around 40 in 2018, today we have more than 300 registered family offices. And mind you, a lot of these family offices are not professionally run, which means people from the industry have gone and heading these kind of family offices. So the sophistication levels are very, very high, which means, of course, from traditional asset classes, they have started to move to private markets. As far as today, I think where we stand, probably the numbers are more like 5-10% of their overall allocation. And we think this number is going to be moving more towards 20 and 25%. Now, you've asked me a very interesting question, Prashant. Sourcing, governance, origination, underwriting. It is really difficult to say which one, because all of these are critical to get your investments right, to get the right investment returns from a client perspective. But if you were to really pin me down and ask me which one to choose, I would go for governance. I think these are opaque asset classes. These are opaque instruments a lot of times. These are long-term instruments. And I think the conduct and the professionalism with which the managers conduct themselves over a period of time make a meaningful difference in the eventual outcomes for clients. So I think governance is probably the key.
Nitin, that's well put once again. We have to take a quick commercial break, so allow us to do that. We are right back. Stay tuned.
Neo Asset Management presents Capital Horizons Summit in association with CNBC TV 18. Asset Management presents Capital Horizons Summit in association with CNBC TV18.
Welcome back. We are joined by the leadership of Neo Asset Management, who's setting the intellectual foundation for the Capital Horizons Summit. Nitin, Hemant and Puneet, of course, are with us. Nitin, if I can sort of start this segment with you, what role do next generation leaders play in pushing allocations towards private markets? What changes does this bring in terms of risk appetite, governance and innovation?
Yeah, I think it's an interesting phenomena that we are seeing, that a lot of these family offices are more influenced by the next generation than the patriarch. And because a lot of these kids are actually coming from their studies abroad, I think they're able to bring some of the best global practices to India. But mind you, they are very, very focused. I think this narrative sometimes is a bit distorted, that they're not as focused on the businesses or investments. I see the next generation actually as super focused and super driven to achieve better outcomes. What has changed though is now promoters are looking to sell the companies at the right time. Unlike, let's say, 20 years back, where people are very, very averse to parting with their family businesses, now we have seen an increasing trend of selling companies to either other promoters or private equity, etc. This has obviously created the investment pool, which is now actually thriving with a lot of innovation and sophistication.
Right. Hemant, if I can sort of come to you now. Infrastructure, right? Funding for infrastructure, huge amount of requirement. I mean, it's a big government focus. We've seen that over the last 10 years, 11 years under this government. Private capital in infrastructure, usually, I mean, the thing is, well, you know, infrastructure should be handled by the government, the ROI question and things like that. Just come in here. What role can private capital and these sort of new structures play to fill that gap?
Actually, there's a very interesting question, Prashant. And I think private capital has a long runway of growth here. So globally, if you look at it, 40 to 45% of operating assets are owned by asset managers and pension funds because they are the longest providers of capital, right? In India, that number is today a meager 5 to 10%.
Sure.
And hence the runway for growth. Now, from an investor's perspective, the government wants to monetize assets because it's want to churn its balance sheet, right?
Sure.
Similar is the case of private developers. So eventually, some of these assets have to move from the government, the developers, to private asset managers who are holding them on behalf of their clients. So there is a great opportunity. There is a supply-demand mismatch, which makes it an attractive entry point. Maybe 16 to 19% returns. Obviously, what are investors foregoing? They are foregoing the liquidity aspect, which we had addressed earlier in the part of our conversations. So if your portfolio has that room for liquidity, you're essentially getting the same asset, but can add 5 to 6% returns on super safe assets. 16 to 19%.
Yes,
because there are two things at play. A listed InvIT is itself giving 12 to 13. Now, when a fund, when you put in a 5-year, 6-year locked in money, there will be a liquidity premium for putting 5-6 year money.
To locking it in. Yeah.
So if I just start from a listed InvIT, which is like 12 to 13, which you know has been delivered in the last 5 years in India, and add a 5 to 6% illiquidity premium, one can expect to make 17 to 19%.
Yeah.
And very stable asset class, completely uncorrelated with what's happening in public markets and global. It's so negatively correlated to clients.
To everything else.
Yeah. Yes.
Puneet, with India attractive, significant, I'm just sort of zooming out a little bit, significant growth capital and global capital, where do you see the most significant asymmetric kind of investment opportunities? Where will those be in the next 3 to 5 years?
I think, Prashant, I find India is a very exciting market. I think good thing about India is that it is a multi-sectoral market. Not just it's a multi-sectoral market, it's a multi-geography market.
Right.
So which means that if there is a cement plant in North India, it cannot supply to South India. So India has possibly 4 geographies. So you have got maybe 50 combinations of sector and geographies that exist in India. Having said that, I will just say 4 sectors which we find the most opportunities. Number 1 is manufacturing.
Sure.
In India, manufacturing-led growth is just starting. So manufacturing is a large sector. Second is consumer. In case of consumer, opportunities come actually in our secondaries fund. India, in many subsegments within consumer, something like beauty and personal care, etc., the growth is going to be phenomenal. The third sector will be technology as a sector. And fourth is infrastructure. I think all these four sectors are pretty large sectors. They can absorb large amount of capital, and we do see a lot of deals in all these four sectors.
Okay. And Neo is sort of well placed to offer clients sort of foot in the door in each of these areas as you described it.
Yes. So we actually have a 40-member investment team. So we have this team split across various funds. We, over the last 3 years, we would have evaluated deals worth more than 3 lakh crores. We would have evaluated in various funds. We would have evaluated more than 1,000 deals. That is a kind of deal flow we have evaluated so that our investors get the best opportunities to invest. So these are the 4 sectors we have seen most amount of opportunities that have come to us.
Hemant, let's close this out, because this is, as I described it, the sort of foundation for the event that is going to happen, the Capital Horizons event. So what do you aim to do with that event? And it'll bring a lot of people together. We'll have conversations. I mean, what role does a forum like that going to play? Because those conversations are going to be important as many of the trends that both of you described play out.
I think private markets are a very important source of capital. It's a very productive use of capital. And historically, this has been supplied by maybe high net worth individuals, banks, but now asset managers are coming to the forefront because the regulatory framework is setting in. And India, for its growth story, doesn't only need public market capital. You know, we don't only need investors to put money into public markets. India's growth story needs private market capital also. And that is the conviction that, you know, something like a Capital Horizon Summit wants to endeavor to provide to investors. If we can provide this conviction that private market is a win-win, it's a win-win for the economy because it's productive capital. It's a win-win for investors because it's very diversified, non-correlated, a good play on first level sources of revenues, more stable in returns. I think that's the forum that we want to accomplish. And at Neo, we want to champion this cause. We want to be leadership position in private markets to showcase this to our clients, not only in India, but globally also. And that's the endeavor of doing this Capital Horizon Summit in association with CNBC, to take it to a much wider audience, to make this asset class well known to a more broader set of investors.
I think that's, happy to partner with Neo for this. I think it's an important area which will get more and more prominence as we go forward. But that's all the time that we have. Hemant and Puri, thank you very much for joining us on this one. But we'll, of course, talk more at the summit. Nitin, you're not with us today here, of course, in person, but thank you very much for joining us.
Thank you, Prashant. It was a great conversation.
We are summing up the Curtain Raiser show, but we will be back soon with the Capital Horizon Summit. Stay tuned. Keep watching CNBC TV 18.
Neo Asset Management presents Capital Horizon Summit in association with CNBC TV 18.
Hello and welcome to this special show on the West Asia crisis. I am Ashmit Kumar. Now, Israel continues to bomb Iran as the war entered the third week. The Israeli military said that it still has thousands of targets in Iran. It has also begun limited ground operations in southern Lebanon, targeting the Hezbollah. Saudi Arabia, meanwhile, Qatar, Bahrain and Kuwait have intercepted dozens of drones as Iran continues its attacks on the Gulf nations. Emirates was forced to reroute multiple flights after Dubai's airport suspended operations for several hours following a drone-related incident. Brent crude prices have hovered around the $100 mark per barrel. That's as per shipping through the Strait of Hormuz remains largely stalled. Iran has said that the waterway is only closed for tankers and ships belonging to its enemies. But others can pass. U.S. President Donald Trump reached out to NATO allies and China to help secure safe passage through the strait. He warned that it would be very bad for the future of NATO if allies do not help. Trump also threatened to delay the scheduled visit to China, but his words fell on deaf ears. China called for an immediate cessation of hostilities, while France, Japan and Australia have rejected Trump's demand. UK said it is weighing its options. Trump reiterated that Iran wants a deal, but the terms are not good enough. However, Iran's Foreign Minister Abbas Araghchi has dismissed this claim, saying that Iran never asked for a ceasefire or a negotiation. Meanwhile, in an interview with Financial Times, External Affairs Minister S. Jaishankar said that talks with Iran officials helped the two Indian-flagged gas tankers pass through the key oil route. However, he added that there is no blanket arrangement for all Indian ships to pass through. Well, joining us now to discuss this is Martin Wolf, Chief Economic Commentator for Financial Times. Mr. Wolf, thank you so much for joining us. First question, we've seen comments coming in from the IMF that for every 10% increase that we see in the prices of oil, it wipes out about 1/5 of a percentage point from the world economic growth. You've said that this could potentially turn into the worst economic shock since 1973. Help us understand why that is.
Well, I think it's unlikely to be that bad. And I think the IMF numbers that you've given seem quite sensible to me. So obviously, if we get oil prices going to $150 a barrel or even higher, you can work out that the impact on the world economy would be significant. Not as significant as the pandemic or even the global financial crisis, but up there with at least one of the oil shocks of the 70s. The crucial question here is very simple. How long will the Straits of Hormuz remain effectively closed? About 1/5 of world oil goes through the Straits. That's a very big, if it really is locked out for a long period, that's a big reduction in supply. I would expect the impact on prices to be very, very substantial. We could easily see prices at $150 a barrel in that situation, because oil will effectively have to be rationed by price, and people and countries will be driven out of the market because it will be so expensive. That's what's going to happen. And this is a very big supply shock by historical standards, at least up there with what happened in the oil embargo and during the Iran-Iraq war in the 70s. So it's potentially very big. But of course, if the Straits open up very soon, as Donald Trump clearly hopes, then it will all be over.
Well, that's, of course, a lot of large energy importers like India are betting on, are hoping for, fingers crossed there. But moving forward, let me draw a parallel to the recent conflict that we saw between Russia and Ukraine. At that point in time, when this conflict began, the prices for oil had gone up to 140. Now, with the closure of the Strait of Hormuz, there's much more oil at play here, much more oil being disrupted. Do you see, with this blockade continuing and no end in sight, the prices hitting 150, 200? Is that something that is possible in the days, weeks to come?
I don't regard myself as an expert on the oil market specifically, but I've read some people who've done some pretty good analysis of this. And if we are talking about closure for a really appreciable period of time, and in addition, possibly serious damage to oil production and transportation facilities, and of course refining and all the other capacity. And I'm leaving out gas and liquid natural gas too, which is also very important, and the impact on fertilizer and so forth. If you consider that together, the disruption could be very large indeed, and it is perfectly possible, as far as I can see, to imagine oil prices at $150 a barrel or more if that much supply is taken out for a very long time. In the short run, we can use stocks, and there are very large stocks in the world. Actually, China seems to have very large stocks, but in the long run, we're going to go through those stocks and there will be severe shortages. And oil and gas are absolutely essential inputs into the modern economy everywhere, including, as you rightly say, of course, India.
What is a diplomatic way out that perhaps you can see as far as India is concerned? India has been negotiating with Iran to allow access, to allow flow of energy via the Strait of Hormuz. In the past few days, we've only seen a trickle. We've only seen a few tankers sail past the Hormuz dock at Indian ports. The question I want to ask is, the demand, at least that has been put forth by Iran, is that there should be a BRICS condemnation of the attack that Iran has witnessed. Is that a diplomatic cost that perhaps India can stand to bear, especially at a time when it's negotiating a trade deal with Donald Trump?
Well, the first and most obvious point is this has put everyone else in the world in a very difficult, if not impossible, situation. Because they all want their oil and gas, they want the markets to be settled, they don't want a big recession, and on the other hand, they all have important deals to reach with the United States and important relations with the United States, because it's still the world's single most important and powerful country. It's the reality. So this applies to India, and what you say must also be going very actively through China's mind, the minds of the Chinese leadership, who are also very dependent on Iran and, of course, West Asian, as you would call it, West Asian oil and gas. So there are many really important players here. I don't think it is right for me to advise the Indian government about the best way to play this diplomatically. But my view is that the US-Israeli attack was extremely irresponsible, very ill thought out, and very, for obvious reasons, very damaging. And they didn't have an exit plan. So I do think it is definitely right for India and other major powers, China most obviously, to find a diplomatic way out of this, whatever it may be. But obviously, as a matter of sheer prudence, realpolitik, you will want to do this without making the US a permanent enemy. Now, with Donald Trump, you can never predict what he'll do next, and he might not go there. But there are really clear problems. But equally clearly, this situation cannot go on for months and months and months. A way has to be found globally to resolve it. And clearly, a very important country like India is both entitled and duty-bound to be among those actively pushing for a way out.
In terms of Donald Trump reaching out for support, we've seen his pursuits recently with respect to naval diplomacy, asking countries such as United Kingdom, asking countries such as Australia, Japan, France to help with a naval presence in the region to help unclog the blockade that we're seeing at the Strait of Hormuz. So far, we've seen countries such as the UK, Australia, Japan offer a refusal. They are not willing to send or to deploy any of their naval ships towards the region. Does this suggest to you that there is some degree of fatigue that is setting in Washington? Or is this perhaps lack of an end game on part of Donald Trump?
I'll be, again, quite honest. I have found it impossible to work out from the beginning, and I wrote this in my first column on this, what actually they're trying to do. What is the plan here? What would be a satisfactory outcome? What do they expect the Iranians to do? So none of that, to me, is comprehensible. Maybe I'm being particularly stupid, but I can't see what they're planning. Now, to me, this sounds a sort of desperation ploy by the Americans. There are clearly two or three problems for the allies who are being asked to do this. First, they think that if the US Navy, which is still the most powerful Navy in the world, can't do this, they're not going to make the difference. I mean, the naval powers, the naval power of these allies that you mentioned, are pretty small compared to those of the United States. So they think that what is really here is that they want their allies, the Americans want their allies to be dragged into the war. And they don't want to be dragged into the war because they see that it has no obvious outcome, and they want to preserve working relations. They don't like Iran. I don't think anybody really much likes the Iranian government, except possibly the Russians. But they want the Gulf to be peaceful. They want this war to stop. They want working relations with Iran or whatever government emerges there. And so they don't want to start being at war with Iran. That seems to me sensible, particularly since they don't trust the good sense of the United States, and that's a reality, they don't. And in many ways, the United States has been behaving really in quite a hostile manner towards them. We haven't forgotten Greenland, for example. Many of us haven't forgotten the constant suggestions from Washington that they'd like to take over Canada. And so this doesn't look like a friendly regime. And repeatedly, leading figures of the administration have mounted colossal attacks on the Europeans. That they are traitors to Western civilization. So none of this, for the prudent reasons and ideological reasons, they don't want to get involved, just as the British rightly didn't want to get involved in the Vietnam War in the 60s. I hope our Prime Minister continues to say no, and certainly I can understand why the erstwhile allies of the United States with this administration also desperately do not want to get involved in what looks like a losing side in a war that should never have been started.
Just a final couple of questions, Mr. Wolf. Do you see any end in sight? We've heard from the Iranian foreign minister. He's very clear when he says, Mr. Arakchi, that going forward, there is no reason for conversation. They're saying that we had a bitter moment with the United States. We were talking to them, and in the midst of those talks, they attacked us. So Iran is saying that, look, we are just not interested in a conversation. Donald Trump, however, on the other hand, says that Iran is talking, but just the terms are not acceptable to the United States. What is the end game? Do you see any conversation, any off-ramp emerging for either of the two sides?
Well, I don't know whether there's a conversation. My general view is, unfortunately, and I say this with despair, I don't trust what the President of the United States says. This is first in my life. He's the first president of the United States whose word I simply don't trust. So I don't know who's right here, but if the Iranians say we've had negotiations with the United States, we even had a deal with the United States under President Obama, and the United States canceled it under Trump, which they did, and again, they were negotiating in their view, and then a war started, seems to me correct. So I can perfectly well understand that the Iranian regime would regard this joint attack as existential. That is to say, its aim was to overthrow the regime. It's a pretty reasonable assumption. How do you talk to people in this situation? At the same time, even if they don't reach a deal, and I can't see how they reach a deal and what it would be about, what it would look like after all this, the war could stop. So what I suggested, it seems to me the least unlikely outcome, though it may be becoming more unlikely, is the US will say, okay, we've achieved all our aims. This conflict is over. We are stopping hostilities. We're withdrawing our forces, and we expect Iran not to rebuild its proxies in the Middle East and not to restart its nuclear program. And we will monitor these things very carefully. And meanwhile, the Iranian side will say, okay, if they really call off their hostilities, we're going to stop the attacks on the Strait. Of course, if they do restart, we will go back to doing what we are before, and we will just stop the war. And it will be a de facto ceasefire, not even an agreed ceasefire, a peace, as it were, not a peace, a ceasefire of exhaustion. And that seems to me still a perfectly likely near-term outcome. No settlement but that. But of course, it might be that the Americans stop and the Iranians keep on going because they want to punish them, or the Americans don't stop because they want to make it clear they have won. And at this stage, I think we just don't know.
And that brings me to my final question to you, Mr. Wolf. Recently, we've heard from you say that the people making these decisions are stupid. Do you still stand by that, or do you see some light at the end of the tunnel?
I can't see any other plausible hypothesis. When the Secretary of War says, quote unquote, actually Secretary of Defense, but the Secretary of War says that the straits are completely open as far as we're concerned, it's all the fault of Iran, as if they hadn't started an attack in the middle of negotiations without any clear statement of why they were attacking and what the objectives of these attacks were. I would have to say that stupidity is the least you could describe to the Americans. I say this with great sadness, almost despair, as very much a Westerner, very much historically committed to the Western alliance, but I don't have any respect for these people.
Well, strong words there, Mr. Wolf. I'd like to thank you once again for joining us, for sharing your perspective on perhaps what some of these questions are and how perhaps they could be answered, what the road ahead may look like. Mr. Wolf, thank you once again for sharing your insights. With that, moving on, Israeli ambassador to India, Reuven Azar, has threatened action against Iran's oil assets if oil revenues are used to fuel its military machine. He claims that by striking Iran, Israel is protecting the stability of the region and the world. He cautions that Indian trade with West Asia could be undermined if Iran gained such power, and that India's diplomatic approach is based on national interest. Further, he put to rest the rumor around the death of Israeli Prime Minister Netanyahu, saying that he's very much alive.
I would say that this may take a few weeks. What we are seeing now is a great success as a result of the operation of the US and Israel to degrade substantially the capabilities of the Iranian regime to threaten us and to threaten the region and the world. We have seen a complete destruction of their military industry, a degradation of their capability to launch missiles and drones, and we are going to continue this effort because we not only want to remain their capabilities at the lowest level possible, we are also going to hit the besieged forces, the forces of oppression of Iran, because we want to give an opportunity to the Iranian people to embrace the future and try to influence the fate of this regime that has been killing the Iranian people, especially in the last few weeks.
And if the war continues and we see the situation being where it is there a plan of actually attacking the oil infrastructure in Iran?
I don't know yet. I think it would be only reasonable that this regime, if this regime continues to use the resources that they get from the oil in order to fuel their military machinery, that we would target them as well.
Okay. Ambassador, my last question to you is about the other countries. You spoke about India and how it is in a way helping India. There are, reports about China and Russia being involved in the war via media, providing resources or information, intel to Iran. How would you see that? And from an ally point of view, how do you see Indian diplomacy in this entire conflict?
Well, I think that every country that is concerned about the security of the world should stop supplying Iran with what they need in order to build their military capability. And that includes the countries that you mentioned. Now, India will continue to do what is best for Indian interests, including diplomatic efforts that are completely legitimate and serve the aims of the country.
Well, with that, it's time now for slipping into a very short break. But coming up, the government recently amended Press Note 3 to attract investments from global funds, especially land bordering countries like China. That's up. On the other side, MeitY Secretary S. Krishnan decoding this amendment and why it's important for critical sectors. Welcome back to News Center. Now, the government recently amended Press Note 3 to attract investments from global funds, especially land bordering countries like China. In addition, it expects to support Indian companies in developing and transferring technology from countries specialized in critical sectors. To discuss how this relaxation in norms will benefit India and Indian companies, we're joined by MeitY Secretary, Mr. S. Krishnan. Mr. Krishnan, thank you for joining us. Again, this has been cited as an important piece of reform, a way forward as far as foreign investments in India are concerned. Let me begin by asking, Press Note 3, we saw that in 2020 when there was additional scrutiny brought in. Now, 6 years later, we've seen a relaxation. Help us understand why now, why there was a need felt for this change, for this clarification.
I think first and foremost, I think to present it as a major relaxation is not an appropriate way of looking at it. I think what it does is it introduces some clarity in the norms, the first part, which is regarding what should be the nature of the beneficial interest of an investor from a land bordering country in the investor company. That is a company which is investing into an Indian entity. When will it become an entity which is which attracts the PN3? So what should be the extent of interest of one of the investors in that entity in order for you to determine that this is linked to a land border country? So that is being defined for the first time. Clarity has been brought in now, saying that if in the investor company there is an investment of 10% or above of from a land border country, then that is treated as a company from a land border. So that clarity has been brought in, and that we are becoming clearer as to where we stand. So that, I think, is largely a matter of clarity. It's not a relaxation. It's a clarity which was essential earlier, and that has been brought in. It doesn't specifically relax anything from as investment from a land border country. The second requirement is recognizing that in certain sectors where we do need we need to do business with companies and entities from land border countries in certain sectors, specifically electronics, also, rare earths and materials of that nature, including solar and so on. So some of those, and capital goods, manufacture of capital goods. So these 3 or 4 sectors, there is an understanding that these are critical sectors where we need to do business in certain segments. And therefore, there is a fast-tracked process. There is not, it's not as if guardrails have been removed or something else has changed. There's a fast-tracked process because, see, how does the process work? The process works in the sense that there is a security and a political element which needs to be looked at before determining whether the investment should come in. And that is balanced against the need for that investment in that particular sector. Now, on the need for investment in the particular sector, now we are clarifying that in these sectors, it is presumed that there is a need. So that presumption of need is taken up. And so in these 3 or 4 sectors, the need is presumed. So there is no further examination, which is necessary from the end of the concerned ministry. So to that extent, the process is streamlined. But the political and security aspects are still things which need to be looked at. So that aspect is separately looked at, and the entire process needs to be completed within a period of 60 days. So that is how the process has been modified to make sure that the process is streamlined and rendered faster for certain sectors where we believe that the investment from land border countries is also to be received.
Right. Mr. Krishnan, when we say land bordering countries, quite safe to assume that we mean China here. That's where the investment is. That's where the technical know-how is. Also, equally, a second part to that question, is there an equal amount of interest on the side of Beijing to participate as a part of this India growth story, India manufacturing story?
It is primarily Chinese companies, as you can well imagine. So that is one part. But the second part is that interest is, most of the cases which have been cleared in the recent past through the PN3 process have also been cases in the electronics sector. So electronics is becoming one of the largest sectors globally in the manufacturing space. And in India also, this is growing. And therefore, the interest is there, presumably. But at least we are sort of saying that that is an area where investment is something which we will countenance.
Right, Mr. Krishnan, thank you once again for that insight on Press Note 3. And again, this critical clarification that has now come in for investments inbound from land bordering countries, including the likes of China. With that, it's a wrap on this edition of News Center. More news and updates will continue right here.
India's power sector is entering a major expansion phase driven by renewables. But how should investors play the space, from generators to transmission companies? Hello and welcome to this edition of Finding Alpha. I'm Nigel D'Souza, joining in from the Mumbai News Center. And joining me today is Nikhil Nigania, Director and Senior Analyst at Bernstein, who joins us on the show. Well, Nikhil, thanks a lot for coming down and joining us in the studio. Well, you're going to tell us all about the power space and where exactly is the current likely to flow through. So thanks for coming down.
My pleasure. Thanks for having me on the show, Nigel.
All right, we've got plenty to discuss. But first up, let's start with the basic question first. What's India's current installed power capacity? And if you could break it out for us, the traditional power, that's thermal, gas, nuclear, and how much of it is renewable? Give us the mix right now.
Oh, absolutely. So if you look at the power generation capacity in India, it's about 525 gigawatts of installed capacity as of February end. In that, almost half of it is renewables, which is solar, wind, and hydro.
Okay.
The other half is everything else, which is coal, gas, and nuclear.
All right.
Predominantly coal. So out of the 525, 220 is coal, 20 is gas, and about 8 is nuclear.
Okay, all right. Yeah. And the remainder 250 would be renewables.
Renewables.
All right. Just a quick word with regard to this gas capacity. It'll be struggling right now, right? Because of the current Middle East crisis. But it's a small part of the entire mix.
You're right. So even in normal years, it doesn't run a lot. There's 20 gigawatts of gas. But this year in particular, I think the summer months is where it would be a tight situation, given gas would effectively be out of the system.
All right, so 500 gigawatt odd, and this would be less than 5%, and that too not running at optimum levels. That's the gas capacity.
Correct.
Got that. All right, let's take a broader term view then. In the next 5 years, say, what kind of capacity addition plans are there in place right now? And how much of it would be renewable? How much of it would be traditional? If you could help us out with that.
No, sounds good. So if you look at capacity addition plans of India, India is actually number 3 in the world in terms of renewable capacity addition a year.
Okay.
So after China and the US.
How much is that number?
So it's about 50 gigawatts is what we are targeting to add.
Okay.
So last year we did about 45 gigawatts of addition.
Of renewable power?
Of renewable, just renewable, which is incredible.
Indeed.
Yeah. So next 5 years, the plan is to add 50 every year. So about 250 gigawatts of renewable. On the thermal side, the plan is to add about 8-ish a year, so about 8 to 10 a year, about 50 gigawatts of thermal, which is coal.
Okay.
And nuclear is more slower, so about just 5-6 gigawatt of nuclear.
All right, we'll talk about the nuclear part a little bit more, but since you said 8 to 10 gigawatt of thermal or conventional power is what is going to be added, the main players would be what? NTPC, Adani, would they be the main players who are adding capacity?
By far. I mean, if you look at capacity addition on coal, many players have stepped back. So NTPC is obviously leading from the front, and which have about 17 gigawatts under construction. And second is Adani Power.
Got it. All right. So we've got a broad addition in terms of the plans, in the coming years as well. Got that. Now let's talk about the geopolitical tensions, and the war situation right now. Do you see any kind of disruption in, say, fuel supply, project execution, or demand trends for India's power sector as of now?
So geopolitical situation, so if you look at this recent event of Iran and the previous one where we were importing Russian oil, the solution is simple, to electrify everything, right? I mean, electrify to the extent we can.
Right.
A good example of that is China. So if you look at how China consumes energy, 30% is electricity.
Right.
70% is fossil-based.
Right.
Oil, gas, etc. In India, that number is 18%. So we need to take that number of electricity as a share of energy up a lot from where we are. So we need to electrify. In fact, power demand has to accelerate for us to be energy self-sufficient. We don't have oil, we don't have gas. What we have is coal and lots of sunshine.
Right. So electrification globally, what is it? And in India, what is it at and where is it headed?
So India is about 18-ish%.
Okay.
China is about close to 30.
Okay.
Global would be in the 20s, early 20s. Something.
All right. So electrification as a percentage of the mix needs to move up from around that 18% odd mark to say closer to around 30%, which is where China is at.
Absolutely.
Would that be a fair estimate?
Yes.
Got that. Let's talk a little bit about this renewable piece, because as you broke it up for us, you said 50% of current capacity is renewable, and that'll be ballpark 250 gigawatt odd, and we're looking to add another 250 gigawatt. Could you tell us, where do you see the biggest bottleneck in achieving this particular target? Where will India struggle with regard to this renewable capacity addition target?
Exactly. So if you look at, we see 3 challenges for renewables in terms of this capacity addition plan. Number 1 is transmission. So while we have a much better grid than most countries in the world, better than US, for example, our transmission network is better than the US, which many people find surprising. But it is still lagging renewable capacity addition.
Okay. Because a transmission line takes 3 years to make. A solar plant can be made in a year.
Right.
So transmission capacity is lagging solar addition, and hence that is one constraint, which is transmission, which is a global constraint everywhere in the world.
All right. So transmission could be a bit of a bottleneck to get this renewable capacity up and going. But since you mentioned India is standing out, I want to know a little bit more, in terms of adding transmission capacity. 3 years, if I got that number correct.
Yeah.
How does it compare with the globe? You said we are better off than the United States. I think China's at around 2 years approximately. I was reading your note. So if you could give us a comparative, where does India stand out, both on adding transmission capacity as well as the cost of power, the economies of scale, basically? Run us through both those 2 data points.
Sure. So transmission, setting up a high voltage line in India takes about 3 years, as I said. In US and Europe, it's a very time-consuming process. It can take 6 years, 7 years, even 10 years in some cases.
Okay.
So it's a massive challenge there due to permitting, the approvals needed to set up these transmission lines. And India is it's a synchronous grid. So, you can set up a plant in Rajasthan and it'll flow seamlessly to Kerala, Tamil Nadu.
Right.
US is not.
Okay.
US is not a synchronous grid. Each state has its own sort of a grid. So that is one comparison on transmission. Second, on cost of power. Solar power, we are one of the cheapest in the world after the Middle East. So solar cost of power is about $30 a megawatt hour or 2.5 rupees per unit of power in India.
Right.
China is slightly higher than us also because we have higher number of sunny days in a year.
Right.
US is even more expensive.
Right. All right. I think we should get some of those data points which Nikhil is talking us through with regard to the levelized cost of power, as well as with regard to the time it takes to set up transmission capacity as well. That should flow for you on the screen. Let's talk about nuclear power, since you briefly mentioned about that. Where does nuclear power fit into India's long-term energy strategy? Do you see it playing a larger role in the coming decade? And if you have a broad estimate, because right now it's very, very small. But there is capacity addition plans out there. And who could be the companies that partake in this?
Yeah. So the government is very keen to go on nuclear. So we, as I said, we just have about 8 or 9 gigawatts of operating nuclear capacity. The target which the Prime Minister has announced is 100 gigawatts by 2047.
Okay.
So it's a massive uptick from here. A good parallel I look at is France. So after the 1973 oil crisis, when France used to depend on oil for power generation, they heavily moved to nuclear. They had the same issue as us. They didn't have oil or gas.
Right.
But they could set up nuclear plants. So even in the case of India, I think this crisis should lead to possibly accelerating nuclear and coal addition in India. And these plants are massive plants. A nuclear plant takes 10 years to build.
All right.
Massive capex. I visited one nuclear plant in India. That single plant was 1.5 lakh crore.
Oh.
It's possibly the most expensive asset in India.
Absolutely. So it's going to be very capex heavy then?
Super capex heavy.
All right. You were telling us about this entire addition. Which are the companies that are currently involved in nuclear power here in India? And which are those that will participate in this entire journey from that sub 10 gigawatt to close to around 100 gigawatt?
Right now, it's 100% owned by Nuclear Power Corporation of India, which is not a listed entity. Incrementally, NTPC has formed a joint venture with NPCIL.
Yes.
And even on the standalone basis, they are looking to set up nuclear power plants. Other than NTPC in the listed space, private entities have or are likely to be possibly allowed to set up nuclear power plants after this nuclear bill, which was announced recently, gets implemented.
Okay.
So, but largely be NTPC on the asset ownership side.
Give us a few numbers, if it's possible. The cost to set up, say, nuclear power, a thermal power plant, if you could give it on a gigawatt basis, as well as renewable energy. So we have, all those 3 numbers and the time taken. For example, you told us that nuclear will be around 10 years.
Correct.
I think coal-based will be 1.5 years or 2 years, or maybe sub that, maybe a year or thereabouts.
Solar will be less.
So just give us that breakdown in terms of the capex per gigawatt and the time taken to get this plant up and running for all the 3, segments. That's nuclear, traditional power, and renewable power.
Correct. So a solar plant, we're talking about a gigawatt. A gigawatt of solar is about 5,000 crores of capex.
So that'll be 5
crores a megawatt.
Megawatt, yeah.
A thermal plant is nowadays it's almost 15 crores a megawatt.
All right.
A nuclear plant is about 25 crores.
All right.
A megawatt.
All right. So 25, 15, and around 5. Though we need to keep in mind that the amount of power production that will be coming out of a solar unit will be far less in comparison to what we see in conventional power. Would that be correct?
Absolutely right.
And the time taken to get these units up and running, nuclear is 10 years?
Nuclear is 10, coal is 5.
All right.
A new greenfield coal plant takes 5 years.
All right.
And solar can be done in a year or 2.
Okay, all right. So we've got a broad gist on that front. Now, investors, they can play this theme multiple ways, right? Generators, if I look at transmission companies, lenders like PFC, RAC, or even the exchanges. Where are you leaning towards right now to play this entire power push theme, and why? Just a basic understanding first.
Yeah, sure. So when we look at this space, our view till now, which we still hold, is we are a bit cautious on renewables.
Right.
So we have underperformed ratings on mostly all renewable names in our coverage, almost all, and even the exchange due to regulatory challenges.
Yeah.
On the rest of it, which is coal, nuclear, transmission, we are positive on all those 3 legs.
Right.
Our top pick in our coverage has been NTPC for quite some time, which is the one adding coal plants, which is the one adding nuclear plants in the future. And even on renewables, their subsidiary is probably going to be one of the biggest in India.
Okay.
So in generators, NTPC has been one of our top picks.
All right. And as you mentioned that you have been fairly cautious on the renewable generators as well as the solar PV players. But that call has played out. So good on you on that one. But after the kind of correction we have seen in some of these stock prices, do you think valuations are coming to some level where you'll be a little bit interested on some of these renewable power players, which have been big underperformers? Go ahead.
Yeah. So on the solar equipment players, see, valuations, you're right, have become more reasonable. The challenge I see is what I said. I mean, we can't add so much solar in a year. The aspiration we have, I think, due to the transmission issue, we struggle to add that. So demand will be softer.
You're right.
At the same time, there's a lot of supply coming on solar equipment manufacturing. A lot of solar cell manufacturing plants are coming. So 1 year out, we see a margin pressure
on these companies.
So
the current margins are not sustainable, is what you're saying, with regard to the solar PV players. But post the correction, is it coming to that stage where you will be a little less bearish at least?
Absolutely, yeah. So more positive than what we were earlier, I think. But we still see margin compression happen. So
you know, Nikhil, I say that because there was this time when these companies were coming for their IPOs, and there was a lot of excitement. But you were one of the lone voices in there saying that no, we're not interested. We believe margins will be under pressure. Demand is not as much as the supply that's coming on stream, and you pointed out various other constraints. So now, post the recent correction, at least you're not sounding as pessimistic on these companies, post the correction at least, but we'll wait by to hear whether or not you turn optimistic at some stage. Let's get another basic point out of the way. Power demand has been very soft in FY26. I think the first 9 months were actually negative, then we've seen a bit of a bounce back on. So what kind of growth are you working with in terms of power demand for the coming year? That's 27, 28 from year on. Are you seeing a bit of a pickup?
So power demand, if you look at the long history of India, so power demand is easier to look at long-term basis, right? Near term, there's weather-related variations.
Right.
So longer-term power demand in India has grown at 0.8x of real GDP, slower than real GDP growth, actually.
Right, little less than that.
Less than that, because we have been a services-led economy,
right?
Not a manufacturing-led economy. Going forward, we expect 1x kind of a multiplier to real GDP for power demand, which is about 6% or so in the long term. Near term, I expect a pickup on a very low base of last year. As you said, it was almost negative in many months last year. And the weather forecast also, at least whatever we are looking, seem to hint at favorable power demand.
Got it. All right. Let's talk about data centers then. That's going to be the big power consumer. India is going to be the big power consumer globally. What's the current capacity in India and how is it expected to grow, say, in the coming years? And also, do you see data centers shifting closer to demand, which is generated here in India? Highest amount of demand from India. Do you think some of these companies will say, let's shift?
On data centers, we have about 1.5 gigawatts of capacity in India right now.
Yes.
Most estimates we have seen are in the range of 5 to 8 gigawatt by 2030 of data center capacity.
Okay.
And we have seen many announcements come as well, whether it's Reliance, whether it's Adani, whether it's Google as well. On your point on the case for India in data centers, if you look at the decision parameters to decide the location of our data centers, the top 3 reasons are electricity.
Yes.
Access to the grid, cheap power, and clean energy. All those 3 metrics India does well. Yeah. And customers also, as you said, for most of these customers, for companies, OpenAI, etc., India is one of the biggest customers.
Right.
So we see a good case for India.
So 1.5 gigawatt to around 5 gigawatt in the next 5 years or so.
By 2030.
By 2030, got that. And as a percentage of the entire power mix, it'll still be low single digits, I think so. Could you give us those numbers? And I think expected growth in terms of data center part will be, power demand from data centers will be growing at what, 30, 35, 40%, I'm guessing so. So just give us that contribution.
So this 5 or 6 gigawatt of data centers in 2030 contributes to about 2% of India's electricity.
Right.
So it's not a game-changing number, but definitely incremental to the growth story or electrification story, which I was alluding to. And post that also, I mean, there's enough runway. I mean,
got that. I'll tell you what, Nikhil, we're going to take a short break. Going to come back. For the time being, I've told us you're fairly optimistic about NTPC, but we want to talk about a couple of stocks. I'll tell you what, we'll slip into a short break. Come back, we'll push Nikhil a little bit more to tell us the other stocks that he's quite optimistic on. Stay tuned. Welcome back here, tuned in Finding Alpha, and we have with us Nikhil Nigania, who's helping us out with everything we need to know on power. Nikhil, just to touch upon on what you are very optimistic about. NTPC as well as Power Grid. Those are the frontline names that you've been fairly optimistic on. Could you tell us what are the target prices on both those two, and do you continue to maintain that positive stance? I think in this current uncertain environment, and given that you expect power to pick up, the prospects look good for both these two.
Oh, you're right. So if you look at the tailwinds for these companies, so one is power demand coming back. Second is they are defensive stocks. So in difficult times, they are the names to own. And third is if the electrification theme plays out, data centers come. And then, of course, you need transmission and generation. Hence, these are good names. The target price for NTPC is 430. That's what we've had for quite some time. For Power Grid, it's relatively closer to our target price. Our target is about 306.
Yeah.
So NTPC is the one we've been more optimistic on. Power grid, I think the challenge has been land. Because of land issues, they have been struggling to complete transmission lines. We saw a pickup last quarter, but still remain a bit cautious.
So NTPC is ticking all the right boxes. They're giving you, in terms of capacity addition, they're talking a little bit about nuclear. You're comfortable with the valuations as well. So that's one of your top picks. Got that. Let's shift focus to the engineering side, because that's looked a little bit interesting, particularly a stock like L&T. That's got smacked out of shape. I think their exposure to the Middle East is more than 30%. And the street is fairly cautious on that. Now, things are very uncertain with regard to what's going on in the Middle East. But that aside, do you think it's come to a price where most of the bad news is in the price? And also, would you be relatively more optimistic on the company? I think one of your data points is that the return ratios are fairly okay. So why doesn't the company get a better multiple in comparison to, say, some of those cement names? Take us through that.
Oh, sure. So L&T is a name we have liked for quite some time. I mean, after NTPC in my entire coverage, that would be our second choice for the longest time. And as you said, the metrics look solid, right? I mean, ROE is inching from 17 to 18, 19%. Earnings growth visibility of, mid-teens to high teens. The challenge with the stock is right now it's become a call on the war, right? So Middle East is almost 37% of L&T's order book,
okay,
right now, which is a massive part.
Absolutely.
And if the situation continues, if it's just a few weeks, then things will normalize and all the estimates will hold. But if the situation drags on for longer, you could see an impact on all three metrics. You could see slowdown in new orders from Middle East. You could see slowdown in execution in Middle East. And third, even on margins and payments from customers, you could see an impact in the Middle East.
All right, so for the good of everyone, we hope that that war comes to an end. But from L&T's perspective, what the data point that you're driving home is ROEs in high teens with EPS growth in high teens as well. That's why you believe that the stock is well placed. Am I getting that correct?
Yes.
All right. Let's focus on the power financiers then. PFC and REC, the stocks had a good run and then they came off the top.
Correct.
Now, this is an indirect way of playing the entire power theme, the financiers. There's talk of a merger as well. Do you think that makes it even more delicious? And what's your view on these names from your on?
So these two stocks have been cheap for the longest of time. And as you said, they had a good run, but fell off from the highs. The biggest reason was actually loan book growth. So the most important metric, loan book growth, slowed down for them.
Yes.
As the health of power discoms improved, so they needed lesser working capital funding or loss funding. And second, on renewable projects, we have seen other entities like SBI and other PSU banks chip away at their market share. So loan book growth has slowed down and hence these stocks have come off the highs. Do we hold a positive stance on them? Yes, we do.
Okay.
But the challenge, I think, a loan book growth will sustain. So we see them more as trading stocks rather than, as some investors say, not the stocks you buy for your children.
Okay, all right. That we'll discuss later on. But what about the merger? Will it be a tailwind for them? Is it accretive?
A merger, some benefits, yes, but more to PFC. I mean, so PFC owns 50-ish% of REC, so it's getting a holdco discount. So A, that goes away. And B, the combined entity becomes so big. So put together, they'll be like the 8th most profitable company in India, which is incredible. So could come in Nifty possibly.
All right. Yeah. Oh, interesting. So valuation supportive, growth is important. And if they come together, it'll be favorable PFC. And also in terms of profitability, it could be in the top 10. Got that.
If they merge, yeah.
If they do merge, Got that. We have a query that's coming in there, so let's address that. Rajat Kapoor writes to us from Pune. Rajat says that he holds, a few shares, 150 shares of IEX at 127 rupees. He wants to know what's the long-term view on the stock. Anyone's guess, right? I remember IEX having that run, from sub 100 rupees to more than 300 rupees. And then these regulations started going wrong. You have that coupling overhang as well. What's your view at current reckoning? Sub 120 rupees at some stage, would you be interested? Or do you believe it's too much of uncertainty?
So valuation-wise, it's there towards the lower end. So we are at 115 as our target price. The challenge for this stock, coupling, of course, well known. The second challenge we see, and the reason we had an underperform rating for the longest time, is the transaction fee. So it's a simple business, volume into transaction fee equal to revenue. And the transaction fee in India is one of the highest in the world.
Right.
Our transaction fee is 5x of Europe per unit what we are charging.
And what is that number?
It's buyer-seller combined is about 4 paisa.
4 paisa, which is much higher than what global average is.
Global averages. So it's almost 1%, which is quite high for an exchange. So it's a good company, but we see these regulatory overhangs, which will keep the stock under pressure.
Okay, all right. So because of that, you're not yet interested, though the stock has come down very, very close to the target price. Well, thanks a lot, Nikhil, for joining in and giving us all the views with regard to everything we need to know about power. Capacity moving from around 500 to closer to around 800, 850 gigawatt. You believe that stocks that are well placed are NTPC as well as Power Grid, throw in there in L&T as well. And the play on the renewable stocks, you've been bang right that, in fact, these stocks needed to come off. They come off the top. Now it appears you're a little bit more interested. Thanks a lot, Nikhil. It's been a pleasure having you on the show on Finding Alpha. And thanks to all of you for watching this edition of Finding Alpha. We'll wrap up on this edition and hopefully you learned most of what you needed to know on the power space. Thanks for watching.
Piyushji, welcome once again to the CNBC TV18 Business Leaders Awards. Thank you for taking out time for what must be a busy time for you as a minister. So you've clearly been the man of the match when it comes to signing a whole number of trade deals. There's the mother of all deals, the one with the EU, the FTA with the UK, and then the framework agreement which was announced early February, leading to the what was expected to be an agreement in March and April. But barely had the ink dried on some of these agreements, we have a big geopolitical crisis on our hands. So let me start with the what is most topical first. Your first reactions to the geopolitical crisis, has the government worked out any estimates of the impact on GDP or inflation, the direction of the rupee?
I think India is a very resilient country, a very strong economy with good fundamentals. And I'm very confident that while we have a war raging on, I'm not an astrologer and can't predict how long it'll run. But my own sense is the people of India understand that this is a challenge we have to overcome. The people of India are ready and willing to work together with the government, find solutions. And I think what Prime Minister Modi has consistently guided all of us is to find opportunities in the crisis.
Right.
Whenever we faced a challenge, we've always been able to convert that into an opportunity. And I'm sure this will be a wake-up call for many of us. This will help us plan for a better future, a more self-reliant and resilient future. And my own sense is that there will be a certain shortfall in economic activity in the short run.
Right.
But we'll make up for that in the months to come. We'll continue to be the fastest growing large economy in the world for at least 2 more decades. And we are well poised to become the trusted partner of the world.
Would you, specifically on the rupee which has been falling, any views on what we can do about that?
I think it's a function of the confidence in the economic situation as we go forward. We've certainly seen that investments in any period of time when there is a conflict or a war usually look for safe haven. We've seen a lot of money flow into gold, for instance, and the import of gold and silver has shot up. Similarly, in such periods, you find that the flow of investments into the stock market, the confidence of the international investors who are otherwise looking for larger ticket investments in India gets delayed a little bit. And therefore, I do believe that while we are facing a stress on the rupee, my own gut feeling is, given our very robust reserves, and we have almost got 12 months of import equivalents as reserves in the Reserve Bank of India kitty, I don't see any reason for anybody to panic. I think the rupee will also bounce back in a more gradual fashion, possibly, once the war is over.
Right. And specifically for exporters, have you been in dialogue with them? Have you? Yeah.
Yeah, we are in dialogue with all our stakeholders on a daily basis. So as soon as the war broke out, by the second day, the Commerce and Industry Ministry was on the job. We set up an interministerial group which covered all the various stakeholder line ministries. We've been engaging with all the export promotion councils on a daily basis. Right. We have a 24-hour helpline ready to resolve any issues. And we are continuously coming up with the standard operating procedures to help any cargo which needs to come back, to see how we can have customs support or port support to ensure exporters don't face any problem, or importers for that matter, because there are many components we need to import also. And the Commerce Ministry has also worked out certain schemes which will help create an insurance cover should any export cargo be damaged or lost or even inordinately delayed because of the Red Sea problem or the Strait of Hormuz problem, right, or the shipping line difficulties. We are working on a scheme on that. We are doing the interministerial consultation. Next week we'll be coming out with some more concrete action agenda to support the exporters.
In general, what would you, because there is obviously some concern among India Inc. In this room. I mean, they're worried about demand destruction. They're worried about, for example, the shortfall in natural gas. some industries are being affected. So what is your message to them? What can you say to reassure them?
Well, I think the Petroleum Ministry and the Ministry of External Affairs has been very candid and upfront in sharing with both the people of India and also particularly with business that obviously when there is a war, there are going to be problems, there are going to be challenges. We all in this room jolly well understand that. Having said that, the good news is on crude oil, on fuel, we are pretty well placed. We have good stocks in hand. So you've seen there's been absolutely no disturbance of any sort on the crude or the fuel front, petrol, diesel, aviation fuel. We've in fact ramped up kerosene production so that should there be any delays in LPG supplies, we'll be able to make it up, give alternate cooking medium to the common man. Incidentally, we are also covering through imports from diversified sources the requirements of LPG and LNG also.
Right.
But we all know that the major chunk of gas came from the Middle East. And the shipping times were barely 3 or 4 days, at best 7 days, when these shipments of gas came into India. Now we have to diversify to sources which are significantly far away from India. So Canada, the United States, possibly Russia. We are looking at various sources of alternate sources which will feed the requirements of India. What we have only done is to increase the time between 2 cylinders that a person can take. And of course, there's been a short term, it's more a supply demand time issue. It's not an issue of finally the availability as much as the timing to be able to give enough shipping time for these gas sources to reach India. And therefore, I see no reason to panic. I wish people would understand that we are in a war situation. They should not hoard gas cylinders. And should that message go down to the people, and media can play a very important role, sorry, rather than showing a very negative picture on media, I hope all of you get together, show some nationalist spirit,
of course,
educate the people that there is no reason to panic, stop hoarding, and then I don't think there'll be any cause for concern.
Yeah. No, that point is well taken. Just one last question. So are there contracts we've already entered into with some of the suppliers, the US, Canada, Russia?
It's a continuous process.
Right.
Already the people are aware that the government has been looking to diversify its sources of energy. That has been the stated goal of the government over several years. And we have accelerated that process, and many contracts have been entered into. Many have started shipping supplies from new alternatives. And my sense is, A, the war may not last very long. B, even if it should, the alternates and diversified sources should be able to meet our requirements in the very near future.
we were doing an FTA with Israel. We had started talks, and also a wider FTA with the GCC countries, right? We have one with the UAE already. What is the status of those post the conflict? Right?
Of course, I'm sure all of you are aware that the 9 free trade agreements that we have entered into under the leadership of Prime Minister Modi in the last 3.5 years cover 38 prosperous and developed countries. I mean, the least of them is Mauritius, where the per capita income is below $20,000, but they are largely into tourism and financial services and don't hurt the Indian economy, they only complement us. All the other 37 have high per capita incomes, most cases $30,000, $50,000, $60,000 per capita. Some of them $90,000, $100,000 like the United States or Switzerland, or even $200,000 per capita in Liechtenstein. All of this has opened up huge avenues and have given us a global footprint where we have preferential market access for 2/3 of global trade. I think never before has India been so ambitious, so self-confident, and been willing to negotiate from a position of strength as we have in the last few years. These 38 economies will help us expand both our goods and services business, will help us attract large pools of investment and hopefully strengthen the rupee going forward very quickly, because many of these FTAs also have a committed FDI component, and large amount pools of capital for innovation, for manufacturing are expected from there. And as we speak, I have 6 new free trade agreements going on in my office. We have Israel, where we launched negotiations some time back when I had visited Israel. We have the GCC, we already have Oman and UAE. Now all the 6 GCC countries, the Gulf countries, want to have a FTA with India. We are already in dialogue with Chile, and we are already in dialogue with Peru. We are looking at Mercosur for a free trade agreement against a small PTA, preferential trade agreement, that we had in the past. There's dialogue with Mexico, which is still at the initial stages, but in the later part of this year, we hope to launch a Mexico engagement. SACU is another area, the South Africa-led union, where we are looking at possibly working to create a trading relationship. I had the Korean minister with me yesterday. We have a free trade agreement very badly negotiated by the Congress government.
Which you're trying to renegotiate.
And I'm in public, I mean, it's not nothing I'm saying for the first time or politicizing the issue. I think every businessman in India knows that the Japan, Korea, and ASEAN, the 3 FTAs the Congress did, all 3 have hurt India. We've hardly seen any significant increase in our exports. We've only seen greater amount of imports coming from these 3 geographies. So we've already started negotiating with Korea for a more balanced and fair FTA. Yesterday also we discussed it with my counterpart. The ASEAN negotiations are at an advanced stage. Japan has still not started renegotiating, but it's very high on our agenda. So all in all, we are looking to have greater investments, greater trading opportunities, greater amount of countries with whom we can provide services, so that young India, full of aspirations, full of talent, full of skill, becomes the growth engine of the world.
Okay, one last question on the Indo-US FTA. How does the US Supreme Court ruling change things? Will there be a delay? Because
well, I think we had a very, very robust and good free trade agreement that we had, the first tranche of it, we had finalized with the United States. I think it was possibly on 3rd of February that we announced it. I'd like to just specify for some of you who may not be familiar with free trade agreements, A trade agreement is about getting preferential access versus your competitors. The absolute tariff does not matter. The important thing is, do you have a preferential market access compared to your competition? And I must share with you, the US agreement gave India the lowest import duty into the United States compared to all our peers, all our competitors, whether it's Indonesia, Malaysia, Vietnam, Philippines, Bangladesh, Pakistan, all the competing economies. If you go to see, we had the best rate amongst all. Apart from that, we had a number of products where we would get zero duty. So giving us a great opportunity to expand trade with the US. We had also been able to negotiate with the United States, going forward, significant access to technology, significant access to data center equipment, which would lead to huge investments coming into the country. All in all, the first tranche or the interim agreement that we were looking to finalize was very good for the economy. Of course, the Supreme Court of the US has ruled against the executive powers of the president, due to which the preferential part of our engagement has been lost. And therefore, we are in dialogue with the United States to see how they will once again give us a preferential market access, which is better than our competitors, so that we can finalize the free trade agreement. We stand by the free trade agreement. Please don't carried away by some news reports that I saw probably yesterday.
That's right, yeah.
From some foreign news agencies. Half the times I would actually urge you that what you read in some of these news agencies, please do not believe. Only believe what the government or the official media tells you. Fortunately, organizations like CNBC TV18 at least call us up to confirm any news that they're going to play, whether there's merit in it or whether it's a fake news. What you saw yesterday in a couple of foreign agencies was completely fake news.
Which talked about
India stands by the trade agreement. We are looking to rebalance to get back our preferential access compared to our competitors. Our teams are in continuous negotiation and we'll hopefully finalize it soon. One thing I'll take the opportunity of sharing with all of you. India today, when we finalize a free trade agreement, whilst we have significant offensive interests, which we are fighting to get a bigger market share or bigger pie for our businesses, for our farm produce, for our fish produce, for our MSMEs to flourish, at the same time, we protect sensitive sectors where we do not give preferential market access in India when we finalize a free trade agreement. So for example, with the US, all GM products will not be allowed entry into India, which means almost 90 or 95% of American major crops are just not allowed entry into India.
Right.
So whether it's corn, whether it's soy meal, whether it's rice, wheat, millets, some of the pulses, many items which we are self-sufficient in, there's no market access that we have given. The only access given is areas where we are currently importing or we do not threaten our farmers. And I think this is a loud message that India is the only country in the world, and I repeat, India under Prime Minister Narendra Modi, and thanks to all of you who are the backbone of this strong economy, who are the trusted partners of businesses around the world, thanks to each one of you and all those beyond this room, we are able to get free trade agreements with the European Union, 27 nations, with the United States of America, with the United Kingdom, with the 4-nation EFTA bloc, with Australia, with New Zealand, all of these without opening our dairy. None of these countries has ever done a free trade agreement. We did not have market access in dairy. India is the one country, thanks to the strength of all of the 140 crore Indians, the fact that we are the most trusted partner in the world today. The world wants to do business with India. The world wants to have India in their resilient supply chains. Because of that, all 6 of these geographies, all of Europe, all of the Oceania region, the United States, all of them, we have not opened our dairy and safeguarded the interests of millions and millions of farmers, our fishermen, our animal husbandry players, our MSMEs, our women entrepreneurs, and yet opened up huge opportunities, whether in the textile sector, whether in handlooms and handicrafts, leather, footwear, pharmaceuticals, chemicals, automobiles. The world is now our stage. And I think all of us need to get out of our cozy comfort zone, need to look beyond the 1.4 billion Indian market, because as the economy grows from $4 trillion to $30 trillion when we celebrate 100 years of independence, these global engagements and focusing on internationalizing our businesses is going to play the most important role. Thank you.
Thank you, Piyush ji.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Ritu Singh. These are the top headlines from the startup space. Walmart backed PhonePe temporarily defers its IPO plan, citing geopolitical tensions and market volatility, reiterates commitment to go public in India. SEBI's approval for the IPO will lapse by May 2027. Once valued at over $3 billion, Unacademy is sold to Upgrad for just $300 million, a 90% drop from peak valuation as EdTech continues to unravel. Over 2,000 firms have shut shop since the pandemic. Budget hospitality chain Fab Hotels gets SEBI's nod to proceed with its initial public offering. The IPO will comprise a fresh issue of equity shares worth 250 crore rupees with an OFS of up to 2.68 crore equity shares by existing shareholders. EcoFi, a non-banking financial company focused on climate change solutions, bags 380 crore rupees in a Series B round. The round was co-led by BII and FinFund. Funds will be used for expansion across solar, electric vehicles and SME financing. VC firm Accel and Google's AI Futures Fund announces the 5 startups to join its 2026 Atoms AI cohort to build new solutions in enterprise, voice and industrial AI. Selected from over 4,000 applicants, the 5 startups will benefit from Accel's deep history of supporting Indian founders with Google's frontier AI infrastructure to move from initial concept to global scale. Well, those are the headlines we've been tracking for you this evening. The top story, fintech major PhonePe has temporarily deferred its public market listing proceeds due to the current geopolitical conflicts and market volatility, and will now resume the listing process once there is some stability in global capital markets. In a statement, its co-founder and CEO Sameer Nigam said, and I quote, "We sincerely hope for a swift return to peace in all the affected regions. We remain committed to a public listing in India," end of quote. Keep in mind, PhonePe had received SEBI approval for its IPO on January 20, 2026 and has a 16-month window to list before the SEBI approval lapses. Ritu Singh is here with the details. Ritu.
Well, one of the most anticipated fintech listings in India has now been deferred. PhonePe saying it has temporarily paused its plans to list in India because of the current geopolitical conflict and market volatility, and will resume the listing process once there is some stability in global capital markets. Its co-founder and CEO Sameer Nigam has also released a very short statement, and I quote, "We sincerely hope for a swift return to peace in all the affected regions. We remain committed to a public listing in India," end of quote. Now, PhonePe had filed its confidential DRHP last year and received SEBI's approval on the 20th of January this year. So we understand it has a 16-month window until May of 2027 before the SEBI approval for this listing lapses. And as per our sources, the company intends to list within that time period, of course, depending on market conditions. Now, PhonePe was eyeing a valuation of up to $15 billion. According to various reports, it was last valued at about $13 to $15 billion in a General Atlantic transaction that was concluded in September last year. The IPO itself was structured purely as an offer for sale worth roughly 13,500 crore rupees, with investors like Tiger Global and Microsoft Global Finance looking to fully exit. Now, PhonePe offers a broad range of payment and other services to consumers and merchants. Importantly, it commands more than 45% UPI market share as a third-party app provider. Of course, there is that 30% market share cap overhang from NPCI, which has been a concern throughout, but overall, a clear digital payments market leader and a highly anticipated listing that now stands deferred.
Well, thank you, Ritu, for those details. Moving on from fintech to edtech, and another big story. Once valued at over $3 billion, Unacademy has been sold to Upgrad for just $300 million. This is a 90% drop from its peak valuation. India's edtech sector continues to unravel as funding falls and over 2,000 firms shutting shop since the pandemic. Rachna Dhanrajani is here with the details. Rachna, take us through the consolidation being seen in Indian edtech.
India's edtech sector is seeing one of its biggest consolidation moves since the pandemic-era funding boom began to unwind. Upgrad has signed a term sheet to acquire rival Unacademy in a 100% all-stock deal. The companies say the valuation will only be disclosed once the transaction closes and regulatory filings become public. Both the sides have also agreed to a break fee if the deal does not go through. Now, under the agreement, Unacademy co-founder and CEO Gaurav Munjal will continue to lead the platform after the acquisition, while the official price has not been disclosed. Earlier reports suggest that the deal could value an academy at roughly between $300 and $320 million. That is a steep drop for a company that was once valued at $3.44 billion not too long ago, because that was in 2021. It is backed by investors including SoftBank, Tiger Global Management, Temasek and General Atlantic. Founded in 2015, Unacademy grew into one of India's largest online learning platforms with over 50,000 educators, 62 million learners, primarily focused on competitive exams like UPSC, IIT JEE and NEET. However, revenue has been under pressure, falling from 1,044 crore rupees in FY23 to 826 crore rupees in FY25, even as the company continued to cut costs and narrow the losses. For Upgrad, the acquisition expands its reach beyond professional upskilling into the test prep and K-12 learning market. Together, the combined platform could generate a revenue run rate of around 2,500 crore rupees. These are, of course, estimates. Now, this spans everything from school exam preparation to professional career training, everything. So we will keep an eye out for how this deal unfolds and specifically for the price tag that will be known once the details are public. Back to you.
Well, thank you, Rachna, for those details. Appreciate you joining us today. Moving on to a strategic consolidation in India's agri-tech ecosystem. B2B agri-input distribution platform Unnati has merged with agri-tech startup Gramophone in a move aimed at building a scaled, capital-efficient and profitable agri-inputs business. The combined entity will integrate everything from private label development and manufacturing to B2B distribution, farmer engagement and embedded financing, backed by continued support from InfoEdge. To take us through the contours of the deal, joining me now are Amit Sinha, the co-founder of Unnati, and Tausif Khan, the founder of Gramophone and now co-founder Unnati. Gentlemen, welcome to Startup Street. Amit, let me start with you and also bring in the structure of the transaction here. In a stock exchange disclosure, InfoEdge said its wholly owned subsidiary Startup Investments Holding will transfer its entire stake in Gramophone's parent AgStack Technologies to Unnati's Akshmala Solutions as part of a share swap agreement. Could you walk us through the strategic thinking behind structuring the deal this way and what it means for ownership and alignment going forward?
Yeah, thanks for having us. If you look at the kind of a deal that we are doing, perhaps this is one of the largest in the agri-tech sector in the country, split with the two entities being very, I would say, comparable in size rather than one company totally acquiring others. And overall, from a going forward perspective, even today, both the businesses are for practical purposes merged, and we are working together as a team already. And the deal was structured in a few steps, mainly because of the fact that there were quite a few investors on both the sides. None of them were common, so it was a bit of a complex, considering that this is also a regulated segment where local regulation and a whole lot of things are there. So that's why it was structured in a few steps. But for all practical purposes, the end result and the current scenario is that both the teams are combined. The cap tables are being looked at as a combined entity, and we are just getting all the regulatory licenses and everything in place officially also.
All right. So Gramophone is no longer an independent entity. You're saying it's a combined entity. Everything falls under Unnati. Yeah.
Yes. Yeah.
All right. Tausif, coming to you now. Gramophone brings agronomy intelligence and a strong private label portfolio to the table. Tell us how critical are those capabilities in differentiating the combined platform? And given your strong engagement with both retailers and farmers, how will that B2B2C model evolve now post the merger?
Sure. We have spent almost like 8 years building what we call as agronomy intelligence engine. One that understands the crop cycles, soil conditions, pest pattern, and regional level. And that has actually translated into specific input recommendations for farmers. And doing this, we have already engaged with 2 million plus farmers. Now, when we combine that intelligence with Unnati's distribution depth of more than 20,000 retailers across 9 plus states, something very powerful actually happens. The intelligence layer has already started telling what farmers need. Distribution layer is ensuring that availability of products at the nearest retailer. And on B2B2C model, the retailer remains our anchor, but the retailer is now much smarter retailer because the logic that tells them what to stock, when to reorder, and what recommendation. Farmer connects digitally through gramophone, but fulfillment happens through this physical retail. So I think it's not B2B or B2C, it's connected ecosystem where intelligence flows in both the directions.
All right. Okay. Amit, coming back to you again, one of the key themes in this announcement is capital discipline and improving unit economics. What specific efficiencies do you expect the merger to unlock? And could you also share some near-term revenue targets and the roadmap to sustained profitability?
Sure. So traditionally, Unnati has been quite a capital efficient company. We have consistently been in the top 2 or 3 players in terms of the size of the agri-inputs business among the tech-led players. While from a fundraise perspective, I don't think we had been in the top 20 or 25 also. So traditionally, that efficiency has been there. Further now, combining with Gramophone, what is happening is like we would be covering almost 75-80% of the arable land in the country. Now that built on the sourcing synergies, because we are a platform, we sell all the kinds of products, right from our own brand to third-party brands.
Correct.
Now that sourcing efficiency and, agriculture is a very micro market kind of an approach. Every state has different crops and stuff. So there's a lot of de-risking when you talk about a larger platform, whereas one which is only operating in a few geographies. So we are already seeing a lot of sourcing synergies coming in from this combination. Also, if you look at it, as Tausif was saying, the whole intelligence that happens is also going to drive a lot of efficiencies because it is now being built on a much larger data set rather than what it was earlier.
Okay.
Then obviously there will be a few, cost synergies, but more of it is, I would say, the growth synergies that are there, which are already showing up in the numbers that we have. So for this coming year, we are targeting a growth of around 75 to 80%, while traditionally we have grown on an average CAGR of around 50-55%.
All right.
While now we expect around 80-85% growth in the coming year.
All right. Tausif, private labels are becoming an increasingly important lever in the agri-inputs market. How big a role will private label products play in driving both margins and growth going forward?
Definitely, I think they'll play a huge role in terms of market. If we see almost 50% of the market in agri-input is actually with regional link brands. So, and at Gramophone, we started doing it 3 years back. And in terms of revenue, we are already around 30-35% coming from private label. So, which has significantly high gross margins. So, opportunity now is to replicate that across Unnati's much larger distribution system. And now I think the good part is we are also investing in backward integration. We recently acquired land near Kanpur for own formulation facility, which gives us even more control over quality and cost. So when I look ahead, private label or own brands isn't just a side strategy. It's core of how we drive both margin expansion and farmer stickiness. The farmer trusts our products, comes back season after season. That's kind of a real compounding that we are seeing already starting to play.
Okay. But Tausif, one more thing. The integrated model now spans manufacturing, private label development, distribution, farmer engagement, and financing. Which of these layers do you believe will emerge as the biggest growth driver, Tausif? And what does scale look like for the combined entity over the next few years?
Sure. See, I think the answer to it is, I'll go a little deeper into it quickly. So, see, if you see are just a distributor, then own distribution, you're primarily a logistics company. And if you just do private labels, you are a product company. And if you're just doing financing, you are an NBFC. What makes this ecosystem very distinctive is that it has all the 3 layers which actually reinforce each other. And now, I think the biggest unlock that we are seeing is that the private label expansion powered by distribution scale, that's where the margin story and growth story comes from. And I think on scale, agri-input in India is a large and deeply fragmented. And we see a clear path to being one of the most significant players in this space. We are growing rapidly and I think improving unit economics every year. So we are pursuing both organic and inorganic expansion, and the aspiration is clear that we would want to build one of the most integrated agri-input ecosystem in the country. So I think it's the whole cycle which basically is important, and now with that has gotten completed.
Sure. Amit, one final question. How will technology power this combined platform from supply chain efficiency to portfolio planning for retailers? And, 3 to 5 years out, what is the larger ambition for Unnati? What kind of platform are you ultimately trying to build for India's agriculture ecosystem?
Sure. So, technology plays a disproportionate role, or rather will play a disproportionate role in this segment. Because we have like millions of farmers being served through lakhs of small retail shops, and people have been crying for the right knowledge, the right information at the right time to be, because it's a very, very seasonal business, very short cycle windows of application of a product. Now, the only way that can be solved is through the tech. And thankfully, over the last 8 to 10 years, we have been able to build a very scaled up tech platform, which is able to predict the demand and the pricing and the requirement of products at various locations based on the weather patterns, based on the, the traditional historical data and the velocity of the transaction that is happening. Now, that forms the key of integrating the whole agri ecosystem in the country into a single market. Traditionally, agri has been very localized and an aggregation of independent markets rather than a platform which works across all the crops in all the geographies. Now, that is what we are building up. And that is where we have seen some very good early results of the thing to stitch together a really large business. And going forward in the next 4 to 5 years, we expect to be the preferred platform of choice for all kinds of agri input needs of the farmers and the channel. And this is where, all these services of various kinds are going to enable that to happen. So the best possible product at the best possible price, available at the exactly right time when the farmer needs is what we are building.
Well, on that note, it's time for me to wrap up our conversation. But many thanks, Amit and Tauseef, for joining us on Startup Street, and wish you the very best for all your growth plans.
Thank you.
Well, with that, it's time for us to head into a short break. But coming up, from 4,000 applicants to just 5 startups, Accel and Google's AI Futures Fund reveal how India's most ambitious AI founders are shaping the future of enterprise automation, consumer AI, and DeepMind-powered innovation. Details on the other side.
Well, venture capital firm Accel has announced the launch of its 2026 Atoms AI Cohort, which is a program co-launched with Google's AI Futures Fund to back what they're calling India's most ambitious AI founders from day zero. The 2026 cohort consists of 5 startups who were selected from a pool of more than 4,000 applications. Now, each startup receives a co-investment of up to $2 million, which is split equally between Accel and Google AI Futures Fund, alongside up to $350,000 in compute credits that span Google Cloud, Gemini, and DeepMind resources. For more on this, let me invite Priyank Swaroop, partner at Accel, and Jonathan Silber, the co-founder and director at Google AI Futures Fund. Gentlemen, thanks very much for being here with us. Priyank, let me start with you. When we spoke in November last during the announcement of this launch, you both said you have very strong conviction in India's ability to create globally competitive AI-first startups. You got 4,000 applications, picked only 5 founders. So, why only 5, and what separated the founders who made it from the rest of the crowd?
Yeah, Ritu, first of all, thank you for having us on the show. And, me and John were discussing and debating this yesterday. We got 4,000 and we picked only 5. So I think a lot of it, and by the way, we shortlisted over 200 companies. We met 200 of them. And I think they were a very good set of companies. Some of them just didn't meet the criteria which we had, like building for India or from India for the world. Those are being considered outside of the program. Some of them we were slow. We could not end up investing in them by the time their rounds closed. So that's on us. But broadly, we were very happy with the quality of companies which are coming in. And these 5 companies, I think, they are top of the top for us.
Well, Jonathan, this partnership with Accel, as we understand, is Google AI Future Fund's first country-level collaboration anywhere in the world. So, when you looked at these companies, what seemed the most promising to you about this cohort versus what you've seen globally? And again, why stop at 5?
Great questions. And also, thank you so much for having us on the show. So what's really interesting here is that when we look and evaluate the companies in this program, Accel looks at them kind of one way, and we look at them in a slightly different manner. One of the key considerations for us is how do these companies and their existing roadmap map to that of the Google DeepMind roadmap? So we're essentially looking at kind of what's around the corner from a Google model perspective, and we're trying to see companies that actually align really well with that forward-looking plan, so that we can do deep integrations with these companies that can really help bolster these companies and give them a competitive edge, but also highlight a lot of what's coming around the corner from a Google DeepMind perspective. So that's kind of why these companies in particular, we found to be quite interesting.
Priyank, if I look at all the companies you've selected, ERP automation, voice AI for call centers, industrial manufacturing, to me, it seems that the focus is very much on enterprise and operational use cases rather than consumer AI. Should we conclude that that's where you're seeing the stronger signals, so to speak?
No, actually, to be honest, that was not the intent. The intent was to do more consumer AI as well. And unfortunately, we could not get over the line on a lot of these companies which are in consumer AI. The bar is very high. We wanted more and more. We got a lot of companies, a lot of ideas which are looking very similar. And for example, Zingroll is one company which is actually for consumer AI, which does AI-generated videos, AI-generated Netflix, you can call it in a way. So we wanted more, but we just couldn't find high quality which we wanted we could not, there is just so much noise. We got a lot of companion apps, we got a lot of mental wellness apps, we got a lot of health apps. And the quality bar for us, for Indian consumer, is very high. So, we are, by the way, still looking. So it's a call for consumer AI companies. And John can add more.
Well, Priyank, I'll get back to more on that. But Jonathan, very quickly, the program includes these compute credits and early access to your AI stack like Gemini and DeepMind models. For early stage startups, how critical is this infrastructure advantage compared with just capital, would you say?
We think it's significant, right? So just to refresh, combined with Accel and this partnership, we're providing these companies with up to $2 million in co-investment. We're also providing up to $350,000 in cloud compute credits. But on top of this, we're also providing some non-monetary incentives, right? We're providing deep hands-on support. So these portfolio companies are able to really truly co-develop with us. So they're meeting with engineers and product managers and researchers and go-to-market experts from the Google side as well as the Excel side to really help advance their cause. And we're tapping into both Excel and Google's ability to provide co-marketing opportunities and marketing moments for them and provide additional visibility. So we think that this kind of combined suite of offerings, both on the financial and kind of support level, are really quite significant, particularly when companies are in early stages of development. These are companies that really benefit from testing and working with different cloud compute that's subsidized essentially for them at the beginning, so they can figure out what they're building and ensure that they're doing this at not such a great cost to their business.
Well, Jonathan, if we look, say, 3 to 5 years ahead in this game, where do you expect India to produce the most globally relevant AI startups? Will it be enterprise productivity, voice interfaces, industrial automation, or, just something else entirely?
To give you maybe a cheeky answer, we think that we're going to see a lot of innovation that comes out of the AI-powered intelligent task execution companies like Cadence. We think that building autonomous AI agents to revolutionize enterprise ERP management, we think also could be a big space too with Dodge AI. So we think that the group that we found is a fairly nice representative sample of the different segments and industries where we see great opportunities specifically in the Indian markets. So I think that the 5 that we've brought into this initial cohort are a pretty good indication of where, if we put our hats on to prognosticate, where we think the future might come.
All right, take that point, Jonathan and Priyank, both of you, thanks very much for joining us here on Startup Street. It's been a pleasure. Thank you.
Thank you so much. Thank you.
EY Entrepreneur of the Year, India, celebrating shapers of India's future.
The EY Entrepreneur of the Year is the world's most prestigious business award for entrepreneurs. As the first and only truly global business award of its kind, EY Entrepreneur of the Year encourages entrepreneurial activity among those with potential and recognizes the contribution of people who inspire others with their vision, leadership, and achievement. The 27th edition of EY Entrepreneur of the Year 2025 India Awards celebrated the shapers of India's future. Selected from over 300 nominations, these trailblazing finalists are fueling India's economic growth and prosperity through transformative ideas and purposeful leadership. And the India winner will represent the country at the EY World Entrepreneur of the Year Awards in Monte Carlo in May this year.
Good evening, ladies and gentlemen, and welcome to the 27th edition of the EY Entrepreneur of the Year Awards India 2025. These are the world's biggest awards, celebrated in 94 countries and territories, a unique global program to recognize entrepreneurial achievement. And the theme this year is Shapers of India's Future. And that's what all our incredible entrepreneurs are today. With that, we now kick off this glittering evening, and I would like to invite to the stage the Chairman and CEO of EY India and President of CII for 2025-26, Mr. Rajiv Memani.
It's a real privilege to welcome you to the 27th EY Entrepreneur of the Year Awards. I feel those 27 years within me. So thank you for being with us this evening. I know all of you are really busy, but I really appreciate your coming here and your presence. And through these awards, we feel very grateful and privileged to celebrate India's most outstanding entrepreneurs. And this is the only Global Entrepreneur Awards program which culminates with the World Entrepreneur of the Year Awards in Monte Carlo. And we feel proud that India has produced 4 global winners, the highest that any country in the history of the program. So a big round of applause for our entrepreneurs. This is the testament to the quality and depth of entrepreneurship in India. And as we gather here today, it's worth reflecting also on the last 12 months. I think this is an area, this has been a period of big transition and very transformative for our country. I think we have seen an accelerated pace of reforms, which is enhancing India's competitiveness. We are seeing a much deeper integration with the global economy, with the various bilateral agreements that we are doing. And AI and technology revolution is going to reshape the business in a very, very profound way. Taken together, I think these things are the foundation of a very structural transformation of our economy and businesses. But friends, our 2025 finalists represent the very best of Indian entrepreneurship. A big round of applause for all of them, please. And once again, thank you very much for being here. Thank you.
And now it is my absolute privilege to welcome on stage our chief guest this evening, the Honorable Minister for Commerce and Industry, Government of India, Shri Piyush Goyal.
Congratulations to all the finalists, to all the winners of the Entrepreneur of the Year Award. Each one of you truly deserves to be recognized. What you have achieved, many of you in a short period of time, is phenomenal. That is what defines New India. That is the future of India. And you are all role models who will, I'm sure, in the years to come, mentor and encourage many more entrepreneurs, many more startups, as they move up in their journey to explore uncharted territories. The fact of life is today, India is becoming a very important player when it comes to technology, when it comes to talent and skill required to engage with technology at scale. And across the world, Indian talent is respected, is wanted, and is giving very, very profound results. Our entrepreneurs are winners of today. Those who may not have been recognized as Entrepreneurs of the Year this time around will certainly aspire to be here receiving the award next year or the year after. But this journey of growth will continue relentlessly, and each one of you will help us power this growth. My best wishes to all of you. Thank you very much, ladies and gentlemen.
Ladies and gentlemen, we now have a special treat in store for all of you. An exclusive panel discussion featuring as panelists icons of Indian industry. And to moderate this discussion, we have the very sharp, the very incisive Managing Editor, CNBC TV18, Ms. Shireen Bhan. Over to you, Shireen.
It's wonderful to be back here at the EY Entrepreneur of the Year Awards. And let's start with what everybody's been talking about and what has captured headlines and imagination the past few weeks, and that is AI. And I want to start by understanding from you what you make of this AI trade or the AI reverse trade that's impacting the Indian stock markets. Do you believe it's overdone? Do you believe the markets have overplayed the fears at this point in time? Or do you believe the worst is yet to come?
I think AI is for real. We can debate on the time and the speed of change and disruption. And that's where the debate is. But I want to turn this subject a little further. Is we talk about AI. It will change. Artificial intelligence will change how we live. But we're going to come to a stage where what is going to be even more important is what I call as wisdom. There is, as so far, no concept of AW, which is artificial wisdom. Therefore, human beings finally will have a role because wisdom will remain HW, even as AI takes more and more of our lives.
Mr. Jindal, you're now partnering with Chinese companies to try and bring technology to India to power your electric mobility ambitions. So how should we deal with China at this point in time? Collaborators, competitors, what should the approach be?
So there are two ways. One is that we have to learn from China because, my belief is that China is a country which is as large as India, given that population very similar to India. If we try to learn from Japan or try to learn from Germany, which are relatively smaller countries, we will not be able to really do what we need to do as an economy. We need to learn the way China has expanded. If you look at their bullet train program, I mean, we are, for the last 10, 12 years, we are building the bullet train, which is right in front of my office. I think we are still 4 or 5 years away from that first time that bullet train will move. And it happens to be Prime Minister's pet program, the bullet train, right? So it's a very high-profile program, but still we can't execute that program. And you go to China, you see like thousands and thousands of kilometers of bullet train running across cities. So we have to learn from a country like China, which is building the economy at a fraction of the cost of let's say, us. Because we are taking technology from smaller countries and more expensive countries. We have to learn from China. Now, how can we collaborate with China? That's a question which is not for me to decide. It's the government has to decide that. But if we have to expand and take our economy to a different level, we have to build bridges with China. We have to take our relationship with China to a different level.
With it, I want to understand from you, and this is again an issue that the startup ecosystem has demonstrated, speed and innovation. How do you marry the two? And more importantly, in an AI era where both are going to be critical, what is the mantra for success there that you've been able to demonstrate within Misho?
So the speed and innovation always go together. You can't innovate being slow because someone else takes over. So this is the time when all of us who have the right talent, which we have invested in. So I would tell you, like, even before AI became what it is, even 4 years ago, we had one of the largest AI teams in the country. We today have our own in-house trained, like 200 models they will be like small language models. Not a lot of them are large language because you have certain latency when people are using your product.
Yeah.
But we have trained all of them in-house. So we have that talent to basically do it, and we'll keep investing behind it. But you're right, like speed and innovation is very, very important. A lot of things are changing every single day. Like we have to keep refreshing our roadmap every quarter. We think technology is here, let's build it. And you realize like everything has changed.
Yeah.
And that's what it is. I think we have to be very agile. We can't be very rigid. And I think that's what's happening. So I would say like big place where R&D will get solved will be the startup ecosystem.
Well, that, in fact, is the perfect segue to thank Uday Kotak, Sajjan Jindal and Vidit Atre. Ladies and gentlemen, a big round of applause.
EY Entrepreneur of the Year, India, celebrating shapers of India's future. EY Entrepreneur of the Year, India, celebrating shapers of India's future.
We have these stalwarts here on stage as we begin our awards for the evening. We now come to the first award for this evening, and this one is the Special Jury Award. I'd like to request on stage Jury Chair Mr. Sajjan Jindal to please read the citation and announce the winner of the Special Jury Award.
A past EY Entrepreneur of the Year and World Entrepreneur of the Year winner and a past jury chair of this very prestigious program. Uday has shaped India's financial landscape with vision and integrity. He is the architect of one of India's foremost financial institutions, which is among India's largest private sector banks. In recognition of his exceptional contributions to India's economic and institutional strength, he was recently conferred the Padma Bhushan. Ladies and gentlemen, it's our privilege to honor Mr. Uday Kotak.
Let's all continue to be committed to the Indian adventure, to build India. And I genuinely feel our aspiration has to be the top two, Piyush. And let's raise the bar. So that is one. Second, I do feel that the time has come for India to move from a pace which is evolutionary to a pace which is revolutionary. We have to move at great speed because time is against many other nations while India is still young. India has the opportunity now with this young generation to catch speed. And I take this opportunity to congratulate all the winners here. And at heart, I'm always an entrepreneur and will be delighted to see Indian entrepreneurship flourish. Thank you very much, and thank you all.
And with that, ladies and gentlemen, as we come up to the first category of this evening, the category is Startup. I'd like to invite jury member Ms. Shweta Jalan to kindly grace the stage and announce the winner.
The winner of this category set out to bring order to a fragmented and opaque industry after spotting deep inefficiencies. Their cash-efficient and asset-light model earned them the status of the unicorn in 2025. Please join me in welcoming a startup duo, Pranav Goyal and Uttam Digga of Hotel.
The next category recognizes and rewards entrepreneurs who cracked the great Indian consumer. And the category is Consumer Product and Retail. I'd like to invite jury member Mr. Harsh Mariwala to please grace the stage and announce the winner.
Under his leadership, his company expanded from its roots as a commercial cooling specialist into the residential market to build a strong presence in room air conditioners and later expand into adjacent categories. Backed by sustained R&D investment, category-dominating products, and 7 manufacturing facilities across India, the company has driven strong organic growth, expanded internationally to 49 countries, and built a reputation for innovation, quality, and customer trust. Please welcome on stage Veer S. Advani of Blue Star.
Congratulations! The next award honors entrepreneurs who have been pillars of Indian economy. The category is manufacturing.
So over 3 decades ago, the winner began with a focused industrial venture and steadily expanded into a broader integrated manufacturing ecosystem. Measured and practical, this Make in India champion is shaping India's manufacturing backbone. Ladies and gentlemen, please join me in congratulating Jasbir Singh of Amber Enterprises.
We move to a category of entrepreneurs who provide their customer with something intangible, yet valuable, a service that impacts our lives. Yes, you've guessed it right. The category is services. May I request and invite jury member Mr. Nilesh Gupta to the stage to read the citation and announce the winner.
When banks globally were falling like 9 pins during the global financial crisis of 2008, this first generation entrepreneur found an opportunity in providing wealth management services to India's growing population and has emerged as one of the country's top wealth and alternative asset management firm. A round of applause for the winner of the EOY Services Award, Karan Bhagat of 361 Wealth Asset Management.
And now moving on, the category is life sciences and healthcare.
This entrepreneur created a strong moat by steadily deepening capabilities in high-value and complex molecules, creating fully integrated end-to-end CRDMO services for global clients. He steered his company to a successful IPO in 2025, which was oversubscribed 63 times, and is now leading the company's push towards digital transformation. Please join me in welcoming our winner, Ajay Bhardwaj of Anthem Biosciences.
Our next award is a tribute to the turnaround men and women, the people who transform businesses, often launching them into an even higher orbit. The category is business transformation. And I'd like to request our jury member, Mr. Saurabh Agarwal, to read the citation and announce the winner.
The second generation entrepreneur has not merely grown a business, he has transformed India's manufacturing landscape. By aligning with Make in India, investing deeply in R&D and design, and forging global partnerships, he has built the backbone behind manufacturing of some of the world's leading smartphone and consumer electronics brands. Ladies and gentlemen, let's put our hands together for Mr. Sunil Vachani of Dixon Technology.
Ladies and gentlemen, being an entrepreneurial CEO is a truly difficult job. You're expected to be a visionary on Monday, operational on Tuesday, and inspirational every single day in between. So with that, may I invite jury member Mr. Ravi Lamba to please grace the stage and announce the winner in this category.
Amid rapid disruption, intense competition, he chose disciplined execution and guided the business with clarity and resilience. 13 years as MD and CEO and now as Vice Chairman, he is shaping the group strategy and future-proofing his organization, which has stood the test of time. Today, as intelligent systems and AI work silently to protect conversations and filter unwanted noise, his legacy feels fitting. Ladies and gentlemen, I would like to ask you to please join me in a round of big applause for Gopal Vittal of Bharti Airtel.
Energy and infrastructure are really vast topics, and I don't know much about them, but real estate, that we all know or have heard about. With that, I request our jury member, Mr. Dilip Sangvi, to kindly grace the stage to read the citation and announce the winner in this very vast category.
This second-generation entrepreneur succeeded his father and led the group's transformation into one of the industry's foremost players, scaling revenues more than 60-fold from 236 crore in 2010 to over 13,000 crore in FY25. Please put your hands together for the winner, Abhishek Lodha of the Lodha Group.
Now, ladies and gentlemen, the big one, the award we have all been waiting for. The entrepreneur who stands in a league apart, who will be honored with the highest award of the evening and will also represent India at the EY World Entrepreneur of the Year Awards to be held in Monte Carlo this year. So hold on to your breath, but not to your applause, as we reveal the winner of the EY Entrepreneur of the Year 2025. And to put us all out of our suspense, I would like to request our jury chair, Mr. Sajjan Jindal, to read the citation and announce the winner of the EY Entrepreneur of the Year Award 2025.
Weaving a fabric of unity that connects an entire ecosystem of partners and millions of customers, he helped transform how a nation finds food, orders groceries, and reimagines everyday conveniences. Through shifting market dynamics and hard questions, he kept building for the long term, kept recalibrating, and led the transition of a homegrown startup into a Nifty 50 index. And now, with his sights on aviation, health, and beyond, one thing seems clear: the meal was never really the point. Ladies and gentlemen, please put your hands together for the EY Entrepreneur of the Year 2025, Dipinder Goyal.
I would just say thank you so much. It's been an honor. And we have a lot of decades worth of work yet to go. And I hope we continue to make you all proud.
I'm going to request all our winners, all our distinguished jury members to please come back up on stage for our celebratory toast. So let's have you all up on stage, please.
Celebrate all they have done. They have reached up for the sun. Celebrate their victory. This is their moment of glory. Making life so rich, so full for everyone.
EY Entrepreneur of the Year, India, celebrating shapers of India's future.
What has it taken for you to be able to marry distribution and manufacturing from a product point of view that works for the Indian customer?
Berkshire Hathaway was built like that, so I was like, fanboy, let me follow. And we were sort of this challenger to Policy Bazaar, probably the first challenger that came up. I still live in Bangalore, that I was a Swiggy loyalist.
Yeah.
And most people in Bangalore were, but most people in Gurgaon or Delhi were Zomato loyalists.
Yeah.
Like you build a habit.
Yeah.
We sell a PDF at the end of the day. We sell a document, a contract. There are only 8-10 suppliers. Some of the suppliers are bullies because they're all large companies, right? Getting the license was such a big deal.
Yeah.
That, you know, it just became the goal. And we were probably not thinking how hard it's going to be to get get customers aligned. It had been like 2-3 weeks and nobody had bought. I had started calling up my friends, tum to le lo yaar.
People still think of you as a digital marketplace, essentially. People don't recognize the fact that you are truly yourself an insurance company. When do you believe that shifted, that change happened?
Deep sort of philosophy with which we went with was that, hey, we want to own the customer. We don't want the agent or the bank to own the customer. I think for the first year, we didn't sell in Delhi. It's like, I think, it's too notorious a market. Our data is not working. It's too large.
Does it hamper your growth prospects?
Agent or whoever is talking to the customer is constantly deselling Acco. So not only the customer has to select me, he has to select me over a voice that's constantly telling him it's shit. Don't go there. Nobody will help you if there's a claim.
India's general insurance industry is estimated at over 2.5 lakh crore rupees in annual premiums, dominated for decades by agents, intermediaries, and commission-led distribution. But as digital penetration deepens, the battle is shifting from access to experience. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Founded in 2016, Acco set to build out India's first direct-to-customer digital insurance company operating with zero commissions and no offline